session was also a similar story of ending higher but failing to cross important levels. It was only the IT sector that was doing the heavy lifting, and with some support from metals and pharma, but of course they do not have a significant weightage on the index, and which is why the gains were unconvincing in yesterday's session. The Nifty made a higher low on the charts but a lower high, which means it failed to cross Friday's high in yesterday's trading session despite ending in the green. Now, of course, the levels remain the same, with 25,000 and 25,150 remaining that barrier on the upside for the index. The support also, that 24,850 to 24,900 level, remains a key one to watch, and then of course below that we go on to the 20 DMA on the downside. But of course the 55,000 level for the Nifty Bank, that continues to remain a pain point for the index, so that level also for the Nifty Bank will have to be watched out for very carefully. Now, why caution may prevail in today's session, of course with the latest developments that we have seen in the last few minutes, volumes may remain low because tomorrow is tomorrow is a holiday, and today is of course the final Tuesday monthly expiry of the BSE contracts before it shifts to Thursday from next month. When we return on Thursday, it will be the monthly expiry of the Nifty contracts, so that needs to be watched out for as well. And of course, for among the key things to watch today, we'll of course see any follow-up buying in IT names, in paper stocks that were rallying yesterday, and of course whether the Nifty Bank continues to defend that 55,000 mark on the downside. So for now, a cautious start in the offing, the GIFT Nifty indicating an 80-point downtick as of now.
All right, thank you so much for that, Hormaz. Now let's go across to Ria, who will list out all the stocks to watch out for in trade today. Ria, good morning.
Good morning, Vamakshi. Let's take a look at the stocks to watch out for in today's trade. First up is Sai Life. Sources say that TGP Asia is likely to sell up to 14.72% equity in the company, and the offer size is about 2,500 crores for this one. Protein eGov to also be in focus. They have received an LOI worth about rupees 1,160 crores from UIDAI, so keep your eye out on that one as well. Paytm to also be in focus. The board has approved a rights issue. Excuse me.
Ria, yes, let's then move on to Mangalam, who's joining in with cues from the FNO space. Good morning, Mangalam.
Good morning, Vamakshi. So if you look at, the way the indices moved yesterday, it was the Nifty that gained almost 100 points, and it was led by the IT index. The Nifty Bank was actually a bit of an underperformer in yesterday's trading session. And it was actually the export-facing counters that did well yesterday. Not only did the IT index do well, but you have the metals and the pharmaceutical index as well. Those sectoral indices come up for you on the screen, doing a tad better than what the Nifty Bank was doing. The interesting part, it is the expiry week which is underway. This series so far, the Nifty has moved all of 200 points, and the FI long exposure too has gained from what, 10% to about 13%. So there has been a bit of an increase, but nothing really to write home about. And the reason for that is that even after seeing that level of 25,000 a couple of times over the last few trading sessions, the Nifty has been making lower highs. So the day before yesterday, we had a high of 25,154, thereafter 25,085, and now 25,021 itself. The good part, however, ahead of the weekly or the monthly expiry, the FIs have written more puts. So 55,000 put contracts is what they've written compared to 7,000 calls. And a lot of the put writers are active at 25,000, 24,950 and 24,900. A combined weighted average of those premiums tell you that, there is support seen between 24,800 to 24,850. But on the way up, we have to cross past the previous highs, and more importantly, the Nifty Bank will have to take the market higher. The FIs are betting on that. They've bought 285 crores in Nifty Bank futures yesterday, but for the Nifty, we have to cross the 50-day moving average. The one stock I'll be watching out for ahead of expiry, PG Electroplast, is out of FNO ban after a tumultuous series that it has had.
Well, thank you so much for that, Mangalam. But back to Ria now. Hope you've had a sip of water now and list out all the stocks that we need to watch out for today's trading session. Over to you,
yes,
Ria.
I'm actually coming back to the stocks that are going to be in focus today. Paytm will be in focus since the board has approved a rights issue investment of about rupees 300 crores in its arm Paytm Money and 150 crores in another arm of the company called Paytm Services via a rights issue. And they are going to move to consolidate Foster Payment and First Games subsidiaries for a simplified group structure going ahead. Moving on, 3 stocks to be in focus on the back of some management changes. For Aditya Birla Capital, they've appointed Vishakha Molye as the MD and CEO of the company for a period of 5 years. For 3M India, the company has appointed Aseem Joshi as the President and MD designate of the company with effect from the 13th of October of 2025. And lastly, for Naveen Fluorine, Rajendra Sahu has resigned as the CEO of the company, and Vijay Kaiwar has been appointed as the new CEO of the company with effect from the 21st of September of this year.
Well, thank you so much for that, Ria. But Vodafone Idea is another stock in focus today. The Minister of State for Telecom, Chandrasekhar Pemisani, has said that the government has done all it can to help the company. Speaking to Ashmit Kumar, Pemisani ruled out any further measures, saying nothing is in the works. He also added that there are plans for a nationwide 4G rollout of BSNL, which is likely to cost 1 lakh crore rupees.
Whatever we could do, we have already converted into equity. Right now, our focus is to how to rebuild BSNL. So make the BSNL. Vodafone is up to their management. They are all business people. They know how to manage. It's up to them how they want to take it forward. From the government side, there is nothing that's being discussed at this time. In 3 to 6 months, we will see significant increase in revenue. Significant. We have put at least 30%. 20 to 30% depending on the areas. We have asset monetization plan, so we can get internal accruals. Second, as the revenue increases in BSNL, we get additional revenue. In combination of these 3 things, then we will see what else we need. So it will be a continuous incremental increase in the number of towers.
Well, moving on then, the government has appointed Goldman Sachs as the sole banker for its stake sale in 4 public sector banks: UCO Bank, Central Bank, Punjab and Sindh Bank, Bank of Maharashtra. The divestment process is expected to rake in more than $3 billion. So all of these PSU banks will be in focus today. Latest on the GST rate cuts front, even as the centre exudes confidence about back-end readiness, industry players point out that execution on the ground will not be instantaneous. Sources say several sectors seek assurance from the centre on rate cuts, not resulting in duty inversion. My colleague Timsy brings us more on this. Timsy?
Well, sources have told CNBC-TV18 that several industries are now queuing up at the Finance Ministry, seeking government's assurance to ensure that GST rate cuts do not lead to any inversion. Sectors such as tractor manufacturers, pharma, medical devices, chemicals, fertilizers, textiles, insurance, they fear that a possible inversion due to rate cuts is what is likely that these sectors are going to face. And thus, these industries are sending detailed representations, seeking centre's intervention to ensure that inverted duty corrections also come in well within the time. Industries have suggested that if inversion is not taken care of, then the end products might not reflect a change in the pricing. Revenue Department, meanwhile, sources said, are taking cognizance of all such representations. For example, at present, finished medicines, that is the formulations that you and I buy, they attract 12% GST. While API, which is the key ingredient, the core raw materials, they are taxed at 18%. So if the proposed reform pushes formulations or medicines to be taxed at 5%, keeping the rates of these APIs, which are the core raw material, at 18%, the inversion gap would widen from current 6% to 13%, raising liquidity concerns and compliance burdens. Thus, these sectors are saying that even as the reform is a welcome move, but without the rate parity between the raw material and the finished good, it risks squeezing the MSMEs, the industries, and undermining the India's overall economic health. We'll have to see what happens. Actually, government corrects these things or not, something that only GST Council decisions can tell.
Well, thank you so much for bringing us those details, Timsy. But let's jump into a very short break. Up next, we get you the details of the additional US tariffs on India that come into effect tomorrow. So stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18. Well, one day to go for the US government deadline to double the tariffs on India to 50%. Government officials have said that trade negotiations with Washington are ongoing. This comes after a scheduled visit by US trade negotiators to New Delhi was postponed. My colleague Parikshit Luthra joins us now with more on this. Parikshit, give us a status check on the India-US trade discussions.
Well, yes, all likelihood of a 50% tariff coming into effect at 9:30 a.m. in the morning on the 27th of August, India time. Having said that, negotiations are still on. Back-channel talks are on to ensure that those 25% additional penalty tariffs can be set aside for the moment. The Russia-Ukraine talks and US intervention to bring that war to an end holds hope for India. There is a feeling that if that war comes to an end and if there's a ceasefire, that will have a positive impact and possibly the tariffs, the additional penalty tariffs for India will be set aside. Having said that, Nikki Haley, the former US ambassador, a top Republican leader, a former presidential candidate, she had some important advice for India and she made it very clear that India must take Trump's stand on Russia very seriously, work with the White House to find a solution to the Russia-Ukraine war. Commerce Minister Piyush Goyal said that we continue to approach the United States with a very open mind on a trade deal. External Affairs Minister drawing red lines on agriculture and dairy, saying these are areas where we will not be able to compromise at any cost. So lots of developments taking place over the next few days. Sergio Gore, a close member of Trump's inner circle, has been nominated as the next ambassador to India. This is being seen positively because he's not just going to be the ambassador to India, but he'll also be holding charge of affairs of South Asia and Central Asia. So India believes that they will have someone here in New Delhi whom they can interact with on a daily basis and someone who has the confidence of President Trump. So let's see what happens. But the next 24 to 48 hours, very crucial for India.
Meanwhile, Prime Minister Narendra Modi has vowed support for Indian farmers and small entrepreneurs as US's additional 25% tariff comes into effect from tomorrow. Let's listen in.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगी। दबाव कितना ही क्यों ना आए, हम झेलने की अपनी ताकत बढ़ाते जाएंगे।
Strong comments coming in from Prime Minister Narendra Modi. Now getting you the latest on Trump-related developments, we now have my colleague Dia joining in our special segment, Trump Watch. Dia, welcome back.
We now begin with a major trade development. The Trump administration is signaling a sharp escalation in its tariff policy targeting India. A draft notice published Monday outlines plans for a 50% tariff on Indian products set to take effect from 12:01 a.m. Eastern Time on August 27, 2025. Now, the move comes even as U.S. efforts to broker peace between Russia and Ukraine appear to be faltering. Next, President Donald Trump on Monday fired Federal Reserve Governor Lisa Cook, an unprecedented and significant escalation of his attacks on the U.S. central bank's independence over its refusal to cut interest rates quickly. Trump, in a termination letter to Cook posted on Truth Social, cited allegations that she had made false statements on her applications from home mortgages. And in other news, President Trump said he expects to visit Beijing later this year or shortly after, pointing to improving economic ties between the world's two largest economies. Still, he left the door open to even steeper tariffs if needed. And lastly, Trump is also tightening his grip on security in the U.S. Capitol. On Monday, he announced new measures expanding federal authority in Washington just a day after National Guard troops, now numbering over 2,200, began carrying weapons in the city. That's all for today. Now back to you, Vamakshi.
Well, thank you so much for that, Diya. But moving on then, White House economic advisor Kevin Hassett said the government buying stake in Intel is part of a broader strategy to create a sovereign wealth fund that could include more companies. He also added President Donald Trump is determined to do similar deals. Let's listen in.
We should expect the U.S. government to be taking more equity stakes in businesses around the country. That is something that if you're a CEO this morning watching us, you should say, okay, the Sovereign Wealth Fund may be coming and trying to effectively buy in some kind of equity stake.
It's possible, yeah, that's absolutely right. You know, that if in the past the federal government has been giving money away lickety-split to companies, and the taxpayers have received nothing in return. And so now what's happening with the Intel deal is the CHIPS Act money is going out as planned, but instead of it just going out and disappearing into the ether, the U.S. taxpayers are getting a little bit of equity. I can really not see how anyone would think that's a bad thing, unless you thought that the government was then going to go in and run the company. But these are going to be shares that don't have voting rights. The government's going to stay out of it.
Well, on that note, let's slip into a very short break. Up next, we get you cues from the commodities market, so stay tuned. Thanks for staying tuned into Power Breakfast on CNBC TV18. The Indian government's legislation to ban real money games, citing psychological distress, financial loss, money laundering amongst others, has rung the death knell for the $25 billion money gaming industry. My colleague Shireen Bhan spoke to Dream 11's Harsh Jain. Listen in to excerpts from that conversation.
We've always been a legally compliant company. When Dream 11's business model with real money gaming was legally proven, constitutionally protected, and even the Supreme Court of India approved it as a game of skill and protected by the Constitution, Article 19(1)G. Then we ran it and we scaled it. And today the government of India has passed a law which says that they are prohibiting online money gaming, and we will follow that law in letter and spirit. And so Dream 11 will not be challenging this law.
Well, moving on then, my colleague Manisha Gupta is now joining us with all the updates from the world of commodities. Good morning, Manisha. What are you watching out for?
Hi, thank you for that, Mama. Well, for the Indian markets, it really is about the 25% additional tariff that kicks in from midnight for us. But for the international market, it also has to do with the Russia-Ukraine conflict, and the markets really seem to be monitoring that closely because we are looking at further escalation of that. And in the meanwhile, Trump also has warned of additional tariffs on Russia if no peace deal is worked in next 2 weeks or so. So in the light of all of this, we are looking at the crude oil prices trading near 3-week highs. Prices did gain 1.5% in the overnight markets. There is support also seen in the metal space. So gold gained 0.5%. Silver is trading very close to 2011 highs. Aluminum prices have gained to a 4-week highs as well. The weak US dollar has been supportive. There are supply concerns coming in from aluminum in Guinea, in China, and in South African countries as well, and that has been supportive. Market also are looking at a possibility, and there is a 85% probability right now of a rate cut from US in the month of September by 25 basis points. That in turn also has been supportive. So whether it is about silver, copper, iron ore, we've seen 0.5 to 2% of gains in the overnight markets because of this.
Well, thank you so much for getting us that comprehensive roundup. But with that, that's all we have on this edition of Power Breakfast. We're leaving you with the Gift Nifty indicating a muted start, a negative start for our own Indian markets. Don't go anywhere because Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a happier look. The ties are gone, the suits are gone, and we are, in traditional attire. I just want to say, wish all our viewers actually a very happy Ganesh Chaturthi. Tomorrow, of course, is a market holiday. We'll all be celebrating and going to visit the Ganpati idols, and it's a festive mood. It's a festive mood which now hopefully stretches from now, at least if you just go by the roll of festivals, all the way to the end of the year. So this kind of sort of kicks this off. You got markets to track, which I'm not sure are going to be in such an upbeat mood, and we'll talk about that in just a bit from now. I'm Prashant. With me, my colleagues Mangalam and Rima. Guys, hi, morning.
Hi, welcome back, Mangalam. It's a truncated but an eventful week, and we're starting off with a lot of global headlines, as you can see on your screen.
Yep, and the more important part, Ganesh Chaturthi is the start of all things good. It is also the remover of all obstacles. So maybe for the market, for all the uncertainties that we're seeing, may Lord Ganesha be very, incredible and make it a very smooth sailing highway as against the bumpy ride that we've been having so far.
Well, let's hope that definitely is the case. And, let's just take it from the top, as we always do then, and tell you what you need to know. Because there are two things. I mean, not new things, actually. There's just one new thing, but there are two things I want to address right on top, right? So US has notified additional 25% tariffs. This is, of course, the allegation that President Trump has been making that India and its purchase of Russian oil has been fueling the war between Russia and Ukraine. So those tariffs are going to take effect from the tomorrow morning, 9:30 a.m. basically, Wednesday morning, and markets are shut, of course. 9:30 a.m. those tariffs will take effect. So that is point number one. It's nothing new, but for those, and this has been notified now. At the margin, there was a very small minority who were and why not? I mean, people who were hoping that last minute, and being so ad hoc. So many countries have seen tariff deadlines come and then, 24 hours before, even closer to it, deferments. So at the margin, maybe there was some expectation that something will be worked out. It's not happened. So we'll have to sort of go through this. I will still say this, that, cumulative 50% tariffs on a permanent basis, I don't think that's possible. We'll obviously work this down. But for now, this takes into effect tomorrow. We'll just have to see how long these kind of sort of last and stay with us. So that's one. Secondly, news coming in this morning that President Trump has, in the US, fired Federal Reserve Governor Lisa Cook. He's been sort of course, threatening. This was in relation to allegations by a Trump loyalist that she's engaged in mortgage fraud, submitted wrong information in her mortgage applications, etc. And news coming in that he's sort of asked her to go. This, of course, could be challenged in courts, federal courts, and then finally the Supreme Court as well. Remember, Lisa Cook earlier, after these threats, pushed back quite hard, saying, well, I'm not going anywhere. But now that this has come to pass, we'll see if this actually goes the route of the courts. How will markets react to this is the question. I mean, remember when President Trump was attacking Powell with full gusto, there were questions around whether institutional integrity in the US is under question and whether US exceptionalism perhaps will take a bit of a hit. All those questions, of course, I think they were there for a bit, but markets roared back, especially led by the AI stocks, the big tech AI names. S&P 500 last night closed about 0.4. Nasdaq was down about 0.25% or so. This is, of course, is small pullbacks after Friday's massive gains. Russell, remember, on Friday was up 4%. Nvidia was up 1%. It's ahead of the earnings report later today. Yields across the curve, US curve, closed higher. Again, retracing some of the cuts that we saw on Friday. So the 10-year was up 3 basis points. Oil prices have moved up as well. 1.6%. We are back at about 69, but it's been a range 67 to about 70. And both, the upside and downside, those ranges have held. Kevin Hassett, who's a national economic advisor to President Trump, said this on CNBC, and we'll play out sound bites as well, that US could take further stakes in companies similar to the investment in Intel. He spoke about how Fed's a little bit late to the game, nothing new. And of course, he also indicated Trump's decision on who should succeed Powell is months away. It's not now. Remember, Powell's term only ends in May of 2026. But as I said, we'll play sound bites out. Nothing very new in these comments. Just tying in the levels and putting that out. We've had a nice, almost now 7-day uninterrupted run from the lows. And this is where we find ourselves at. The resistance for the Nifty, 25,153, which is nothing but the high that we saw earlier. And 25,702 is the support, which is again the swing high when the market was still down and out. So 25,153 on the upside, 24,702 on the downside. For the Nifty Bank, the numbers will come up on your screen. Resistance is the 20-day and the 40-day. Remember, on the Nifty Bank, the recovery has been extremely weak. So the Nifty got to 61.8 and then last Thursday turned back from there. The Nifty Bank has not even done 38, as I've been saying. So 55,568 and 55,841 are those two averages, which are resistances. And support for the Nifty Bank stands at 54,905, which is the recent low. And then 54,055 to 54,442, which is the gap zone before this rally actually started. So those are levels. GIFT Nifty gives you a quick sense of how we're likely to start. And we'll pick it up from there. 70 points lower is the implied open. But how is the F&O setup looking? Mangalam is standing by today to tell us exactly that. Mangalam, over to you.
Well, it is the monthly expiry week, and we have a truncated week. Tomorrow's the holiday, which implies that the expiry happens tomorrow itself. If you look at the setup for the F&O, you start with the indices that moved yesterday. It was the IT index that actually led the Nifty higher, and it was more export-facing than domestic names. So the Nifty Bank was underperforming. It has been underperforming in the recent past as well. But yesterday, the support came in not only from IT, but we had the metals and the pharmaceutical index doing extremely well as well. All that has happened over the last few years, or last few days rather, the big up move that we've seen on the Nifty, if you look at it from the series start to now, it's been just about 200 points. And that's what the FII exposure also indicates. It started at 10% on the long side and now moved to about 13%. So neither has the Nifty moved a lot more, nor has the FII long exposure increased a lot more as well. And the Nifty Bank has been a bit of an underperformer. In fact, over the last 3 trading sessions, the Nifty itself has been making lower highs. So 25,154 turned into 25,085. And yesterday's high was a little over 25,000 itself, very close to the 50-day moving average. Can this change? That's the big question. Because ahead of expiry, the FIs have actually written more puts than calls. 54,600 puts and 7,000 calls, telling you there is support at the lower levels. Even if you look at the options, which were fairly active in trade yesterday, we had the 25,000 put, we had the 24,950 put and the 24,900 put. All of them fairly active in trade, and the premiums out there suggest that there could be support between 24,800 to 24,850 for the Nifty. Though on the way up, the Nifty has to cross the 50-day moving average. The important part would be what the Nifty Bank does, because despite the underperformance yesterday, the FIs actually went up and bought 285 crores in Nifty Bank futures, which was much higher than they bought in all the other sectoral futures, including the Nifty. So can the Nifty Bank perform in today's trading session and over the next couple of trading sessions? And secondly, can the Nifty stay above the 50-day moving average is the key thing that I'll be watching out for going forward. In terms of stocks, just 1 day ahead of expiry, a stock that has had a tumultuous series is PG Electroplast. For being in F&O ban for most part of the series, now it's out of F&O ban. So that's one thing I'll be watching out for.
Thank you very much for that. Let's move on and get to the equity calls then of the day. Yogesh Agarwal of HSBC says India is expensive for valid reasons. They include higher ROEs, higher long-term growth potential, and the domestic appetite for equities. He believes the perceived risk for India is lower due to strong and proactive regulatory framework and institutions. That said, near-term slow growth and long-term deterioration in ROE are downside risks.
Okay, all right. Those are some views which are coming in. Prashant Paroda is now joining us. He's portfolio manager, emerging markets at Allspring Global Investments. And we also have William Lee, chief economist and executive director of the Milken Institute. Gentlemen, great to have both of you here. Thank you very much for your time. William, as we were saying earlier, so for those, and why not, right? I mean, there's been a fair bit of ad hocism in terms of deferments and extensions, etc. At the margin, maybe there was some hope that these there'd be a deferment and talks would continue. But I guess these will kick in now tomorrow morning our time. and then talks will continue. William, how are you seeing things from your vantage point?
Well, I had said on the show a while ago that India was really at that position in early this year where it could have asked for almost anything, given the goodwill with the president and the vice president. It's unfortunate that time has passed and all of that goodwill has dissipated, in part because the rules of the game that President Trump has set up is that you will get low tariff rates if you invest in the U.S. and if you create jobs in the U.S. and you open your markets to U.S. companies. India, unfortunately, hasn't done any of that. What's more, the strident positions it's taken with the BRICS countries has really caused President Trump to be upset over the possibility that India is actively working to find an alternative to the U.S. dollar. So all of these circumstances, unfortunately, have really put away a lot of goodwill. But the fundamentals are still there. That India is still a very special country. India will also be granted very special status because it is a special country. It is the alternative to China for production. It is a marketplace that is a growing marketplace that every company wants to be in. So all these fundamentals still hold up quite a lot of hope for some sort of agreement whereby U.S. and India will not decouple, as it were. And in fact, integrated complementary investments will be the keynote going forward.
William, at what point will foreign investors find value in India? For the last 1 year, India has greatly underperformed many of its emerging market peers. And now, for all the reasons that you spoke about, the long-term story perhaps still remains intact. At what point will value emerge now in the emerging market basket? And for investors or for you, how would you rate the emerging markets now?
I'm not a big believer in the notion of value investment because things are cheap for a good reason, and once they're cheap, they might go cheaper. So I think the key to look for, I think, in most investors' mind is what will turn things around. Is there something about the circumstance of India that will catalyze change that wasn't there before? And right now, the catalyst that everyone is looking for is China alternative, right? India is the China alternative. And a way of diversifying your supply chains. And India already is a huge marketplace. So I think in terms of prospects going forward, I think on average, capital will continue to flow to developed economies because of what I've mentioned before, the Lucas paradox. But India will get its share of portfolio diversification and also investment complementarity. That's a very key notion, that investments in the United States have to be complemented by industries that are developing in India that complement the kind of developments that go on in the United States. Technology is very, very multifaceted. And India has got those facets of technology, and like pharmaceuticals, for example, right? India has really been the biggest producer of pharmaceuticals, and whatever medications you want to develop in the future that are high-tech and AI-driven, it's going to start with India.
What about, India's own domestic market right now? The shift has become on consumption, where the regulatory authorities, the political authorities, everyone is pushing for consumption improving in India. And the second half typically is a lot better considering the festive season, etc. as well. Do you think that has seen an improvement? And on the tariff front, now that 25% is notified, 50% was threatened, what happens next here? I mean, what are the next courses of action that everyone should keep an eye out on?
Smart thing to happen next would be to find the exemptions, right? Tim Cook found exemptions. Jensen Huang found exemptions. And I think going forward, there will be circumstances whereby important sectors of the Indian economy will find exceptions. And as far as the domestic economy is concerned, the reason why people are so optimistic about India is because it's a rising middle class. It's a huge population, very, very diversified, and unfortunately, highly stratified. Super rich, super poor, but that middle is quite considerable, and that represents a marketplace where companies around the world want to partake in that kind of growth.
Right. William, last time we spoke, we touched upon a few other things as well, which I think if there's time, I'd like to sort of revisit it. Prashant is with us as well. Prashant, what is your sense? As an India investor, and you've got large amounts of money in EMs in India as well, how are you seeing things? I mean, at one level, one can argue that so far these tariffs, etc., have not made too much of a difference to the markets per se.
No, I continue to believe the secondary tariffs, which is the additional 25%, that is more a Russia-Ukraine issue. And I think from time and there is still work being done to set up a meeting with President Putin and President Zelensky. So to the extent that, something comes out in the next few months on that, I think the 25% will be removed whenever there's progress on peace talks. And it's just kind of a stick that is being used for Russia today to get in line and continue the peace talks. So I think the 25%, presumably, if that's a temporary phenomenon, you get back to a 25% again. And then, as William talked to, you continue to engage with White House and talk with exemptions. So maybe you can potentially go from 25 to even 20%. But it looks like even the South Korean president was here today and talking in the White House, and looks like the 15 or 20% will stick. And obviously South Korea came up with additional investments that they'll do on the US side as well. So I think we have to think outside of the box to get that 25 to 20% for India.
Prashant, the other bit with the developments on the Fed side in the US specifically, do you see a reaction?
Well, I think, there's definitely going to be a change of guard at the Fed. And, a lot of Fed followers always continue to say that there is some political element within the Fed as well. So I think a change of guard, even Chairman Powell himself at his speech said that he's open, to potential cuts given where the labor market is. So I think we should expect to see cuts even with this removal and maybe additional personnel coming in place of Ms. Cook. I think we continue to see a little bit dovish Fed. Clearly, the tariffs are going to there'll be a data coming out in September, CPI linked data. So it will be a little bit data dependent on that. But I think the labor market is a bigger concern for the Fed today.
Okay, all right. We'll leave it there, gentlemen. Prashant and William, good to speak with both of you. And we'll touch base again over the next couple of days. Thanks once again. We'll take a quick break, but before that, let me just quickly run you through what's lined up here in terms of interactions. So we'll at 8:30, we have Abnish Agarwal of PL Capital join us with some fundamental stock analysis. 9 o'clock, Sandeep Agarwal of Sovilo Investment Managers to talk about the IT space. IT was, of course, the one big heavyweight sector which did the heavy lifting. 9:20, Karthik Kumar of Axis Mutual Fund talks to us about markets. 9:35, the management of Narayana Health to talk about demand trends. 26 outlook. In our special segment, Charting Trends, Rahul Sharma of JM Financial Services will be with us at 9:45. And we'll talk stocks, sectors, charts, everything. And of course, towards the end of the program, it's the economy, Lata in conversation with Santanu Sengupta of Goldman Sachs and the impact of 50% tariffs on Indian goods by the US.
Right, with that, we'll slip into a short break. But as we do that, a lot of stock-specific action to track today. We will get to all of that in just a bit in our special Top 10 segment. But for those who are looking at a short list, we have Aditya Birla Capital, Tata Motors, Protean eGov, ONGC, IRB Infra, NHPC, and so on, BLW as the stocks that are on the back of positive news. But we have some of these textile stocks, Vodafone Idea, Sai Life Sciences, and the others, which are likely to open in the red on the back of news flow.
Welcome back. It's a cautious start to begin Tuesday morning. The Gift Nifty is down close to about 70 points, reflecting the weak or the muted global cues, the imposition of the 50% tariff deadline effective tomorrow, 9:30 a.m., and perhaps the monthly expiry on Thursday. But what about stocks? Our entire research team is standing by with CNBC TV18's list of top stocks for the day. First up, well, it's the tariff imposition, which could put the spotlight on textile makers. Harmis now joins in. Harmis.
Morning, Rima. And of course, the textile stocks have been in the topic of conversations ever since this tariff announcements came into play. And of course, it was the Trump administration that has notified that these additional 25% tariffs will take effect from 9:30 tomorrow morning Indian time and 12:01 a.m. Eastern time from the 27th of August. Now, which were already reeling under that 25% tariff, now they'll have to pay a 50% tariff. And textiles does not, of course, come under the list of exemptions. So a lot of these names, be it Gokaldas Exports, KPR Mills, Wellspun Living, all of these companies, we've spoken to them in the past. They've mentioned that these 50% tariffs are almost unsustainable and they will have to pass on those additional costs to the end customers eventually. And Gokaldas, in fact, was down almost 5 to 6% in yesterday's trading session itself. So now, once this announcement has now made official and all of these companies get at least around about 30 to 70% of their top line from the US market, so that will have an impact. So expect all of these stocks to open in the red today as well.
All right, Hormaz. So those textile stocks in the red, they have been underperforming. Now with this being notified, maybe some bit more of selling. Gaurav joins in on AB Capital. Gaurav, some stability at the top.
Well, yes, definitely we can say that, because now RBI has approved the appointment of Ms. Vishakha Muley as MD and CEO of the company. And with this, they have also approved appointment of Mr. Rakesh Singh as Executive Director and CEO of NBFC segment. Now, specifically, if we look at the leadership under Ms. Vishakha, we have seen a very good growth in AB Capital. In fact, she was appointed and she was nominated by Board of Directors on 31st March 2025, and now the RBI approval has come through. When we look at the history, she replaced Ajay Srinivasan as CEO and took charges in June 2022. And after that, we have seen a strong rally in the stock as well. In fact, the stock has gone up almost 3 times. If we look at her appointment, she already holds a very strong background, comes from ICICI Bank. And under her leadership, we have seen company taking digital capabilities to a next level and also leveraging the group's ecosystem. Under her leadership, we also saw offerings actually expanding across loans, investments, insurance. So definitely a good positive changes is what we have seen in the company. Shareholders have also been happier ever since she has joined, and after that, this appointment and the RBI approval is a big positive thing that we think can work out well for AB Capital going ahead.
Okay, all right. So that's Aditya Birla Capital in focus there. Gaurav, thanks for that for now. Vodafone Idea should also be in focus. Remember, the stocks come up quite a bit from the lows of 6.5, 7 rupees. It's actually from lower levels then. 7.5 yesterday, about 5% higher. And there's been some expectation that, on the AGR dues, perhaps there will be a moratorium of some sort, which provides relief for Vodafone Idea and in turn for names like Indus, etc. as well. But we were able to speak with a government official yesterday. Ashmit is here with what he picked up. Ashmit, over to you.
Well, we had a detailed conversation with the Minister of State, Dr. Bemasani, and when faced with the same question as to how, if at all, any relief can be managed, if a relief can be proposed for Vodafone Idea or for the broader space, on that one count, he clarified that this is an issue that is up to the management, that they are best positioned to take this forward. From the government's perspective, they said that as of right now, there is nothing that is being discussed at this time, and that said that all that the government had to do, it has already done, that it will not be able to provide any further relief, that they were referring to, of course, the equity conversion of about 53,000 crores. And on that count, they said that the stake where it is currently at 49%, it will stay there, that any relief that they had to be contemplated has already been done. As of right now, the Minister of State clarifying that there's nothing on the government's plate, there's nothing on their table, they're not discussing any relief for Vodafone Idea. Again, clarifying that this is an issue that is best dealt with by the management. Now, this will become critical for Vodafone, given as how the moratorium on the AGR dues runs out by March of 2026, which would mean that subsequent to that, there will be annual payments of about 18,000 crore rupees that will get triggered. This was also an issue that the management was faced with in their latest earnings calls, where they said that they're looking at non-banking channels for raising funds, given as how the banks have been waiting clarity from the government whether or not any relief packages can be worked out. But the big takeaway being from that interaction, the Minister of State clarifying on record that there's nothing on the table, the government is not contemplating any further relief, and that this is an issue that is best left to the management of Vodafone Idea.
Thank you very much for that. Coming in very clear from the government, no intervention, no future relief. The company is on its own. The stock actually did well even in Friday's trade. On Friday, the stock had rallied close to about 7-8%. It followed it up with a gain of about 5% yesterday. And today, some of that may get undone. Sudarshan is now with us for more on Tata Motors. Sudarshan, what's the news?
Good morning. So what has been in the works for last 4 years seems to be reaching a desired conclusion very soon. So the latest update regarding Tata Motors is NCLT, that is National Company Law Tribunal, has approved scheme of arrangement that company's board had approved in 2024. That was in March month. And they had approved that commercial vehicle segment of Tata Motors will be demerged and passenger vehicles that would consist of electric vehicles, JLR, and the PV segment will be one company, and share swap ratio will be in the ratio of 1:1. So shareholders will get one share in CV segment, CV business, for one share that they hold in Tata Motors. So what's next? Now, after NCLT approval, company will file the detailed order of NCLT with Registrar of Companies, and appointed date as already announced, that was April 1 of 2025. Effective date is likely to be October 1, 2025. So come Q3 of FY26, you will have two companies from Tata Motors stable, that is Tata Motors CV and Tata Motors passenger vehicle.
All right, Sudarshan, thanks a lot for that. So that's about Tata Motors. But Vivek joins in. He's got on his radar Sai Life Sciences. Vivek, a clean out trade.
Good morning. Absolutely right. A very large block deal is expected to take place in Sai Life Sciences. We accessed the term sheet yesterday. So as per the term sheet, TPG Asia Fund, that holds close to 14.7% of the total equity of the company, is looking to completely exit its stake in today's block deal. The base price for this particular block deal is at a discount to yesterday's closing. The base price is at 860 rupees a share, implying that the total size of the block would be slightly northwards of $300 million. It's a clean out trade. We are going with the red given the fact that it's a very large offering that we are seeing. But it'll be interesting to see whether post this particular clean out trade, the stock can recover or not.
Okay, all right. Management seems to be pretty confident, and the outlook seems to be pretty strong. We'll let us see once this is done what the stock really does. 905, 906 on Sai Life. Vamakshi is here with a list of other stocks and news. Vamakshi, morning.
Well, good morning, Prashant. Festive greetings to you and everyone in the studio. Protein eGov is the first counter that we're watching out for. Good news for the company because they've won a 6-year contract worth 1,160 crores from UIDAI, which is the Unique Identification Authority of India. This is to establish and run district-level Aadhaar Seva Kendras. ONGC is the next counter on our radar. They've commenced natural gas sales from Chinewala Tibba Gas in the Rajasthan Kutch online exploratory asset. And they've commenced sales worth almost 1 lakh standard cubic meters of gas per day. IRB Infra is the next one we're watching out for. They've received provisional completion certificate for the Vadodara-Mumbai Expressway. They are now eligible to receive biannual annuity payments from NHAI for 15 years, and the project is expected to generate cash of almost 180 crores rupees annually. NHPC, not great news for this counter because the commercial operation of around 85 megawatt solar capacity of the Karnisa project has now been delayed. The earlier date of commissioning was August 31st. It has now been pushed by a month to September 30th. Lastly, keep an eye out on Sona BLW. Some green on the screen could be expected for this counter because they've received PLI certification for 3 products, 2 for traction motors for E3 wheelers and 1 for traction motors for E2 wheelers.
Thank you very much for that. Protein eGov, a stock that she spoke about in July when the news came that the company is no longer being shortlisted for PAN 2.0 project. The stock that time was at 1,400, and since then it's not quite managed to recover, still hovering around 800 rupees. July was the time when the stock got slammed. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Aditya Birla Capital, Tata Motors, Protein eGov. You've got ONGC, IRB Infrastructure, NHPC and Sona BLW Precision. Stocks with negative news flow are textile stocks, Vodafone Idea and Sai Life Sciences. All right, that's equities. What about commodities and currency? Manisha is now joining in for a complete roundup. Manisha, good morning.
Morning, and thank you for that. While, of course, the big news is the 50% tariffs now it's standing in for India from 27th of August midnight, and that is something that the markets will see an impact on various sectors, as you mentioned. But for the international markets, it really is about the weakness in US dollar. A 25 basis point rate cut from the US Fed in the month of September, almost getting baked into many of these prices. And the third important thing to watch out for is the Russia-Ukraine conflict, where we've seen an escalation come in yet again. But in the background of that, there is a statement from the US president warning of additional tariffs on Russia if there is no progress to the peace deal in the coming 2 weeks. So the market's clearly juggling with a lot of things here. We have seen the crude oil prices trade near a 3-week highs because of the supply concerns and, of course, the weakness in US dollar. In the metals as a sector, there is a gain across. Silver gained a percentage point overnight. It's trading very close to its 2011 highs. Gold prices gained up as well. Aluminum currently is trading at a 4-week highs because of supply concerns coming in from Guinea, Mozambique, and, of course, China. We also have seen stronger gains come in for iron ore prices. Those gained by 2% overnight. And copper, with a fourth straight day of gains, is also trading at a 1-week highs. So strength coming in for commodities, but it's more to do with supply concerns than demand, really.
All right, more to do with supply than demand. Manisha, thanks a lot for that. That's about the commodities arena. But a lot of the brokerages, they've written on a few stocks. We do have Sudarshan joining in with the top brokerage calls of the day. Sudarshan.
So in the brokerage corner today, I have 2 Nifty stocks and 1 recently listed companies. First one is Reliance Industries, top Nifty contributor, and it's going to hold the AGM this week on Friday, that is 29th of August. So UBS has resumed coverage on the company with a buy call and targets given of 1750. It says it's building India's digital and new energy future, and Jio and retail are entering a harvesting phase. About O2C, it says diversified O2C reduces cyclicality as new energy scales up that are expected in coming years. It expects new energy to start contributing to total EBITDA from FY27, and it sees there is a room for re-rating in the stock considering the value potential that it has. Next is Titan. Bernstein has initiated coverage with an outperform call, and target is 4200. It says company is best placed to capture increasing formalization and contemporization of demand in India, and it has storied legacy of 23% EPS CAGR for last 2 decades, and it trades at 5-year low PE due to 3 major news. First one is rapid gold price increase, second is increasing competition, and third is natural diamond LGD dynamics, and it forecast 18% revenue and 25% EBIT CAGR over FY25-28. Last one is JP Morgan has written Anthem Bio that was listed last month. It is initiated with neutral call, and target is 820. CMP is around 843. So it says it's innovation-led, tech-focused CDMO with leading capability in small molecule, and it's expanding into high-growth segments such as ADCS, peptides, and some of the more molecules, and it forecasts 26% EPS CAGR over FY25-28. But on the valuation front, it believes that it's trading at a premium if you compare against DVs and sector average, and that's the reason valuations look very capped, and that's the reason target price is below its CMP.
Okay, all right. So Reliance, there is Titan, and then there is Anthem. 3 calls, more coming up a little later. Thanks for that, Sud. For now, we're going to take a quick commercial break here. There's 25 minutes to go for the pre-open session to kick off. We'll have Ajay Sahai, Director General and CEO of the Federation of Indian Export Organizations, join us on the other side as we talk about Trump tariffs, which the additional secondary 25% tariffs also kick in. Which are the sectors which get hurt most? How's the industry dealing and preparing for this? Stay tuned, coming up.
for investment.
Welcome back. You're watching us here on Bazaar Morning Call. It's one day to go for the US government deadline to double tariffs on India to 50%. 25% of that has been notified already. The government officials have said that trade negotiations with Washington are ongoing. Meanwhile, Prime Minister Narendra Modi has vowed support for Indian farmers and small entrepreneurs as the US's additional 25% tariffs come into effect tomorrow. Let's hear him out.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगी। दबाव कितना ही क्यों ना आए, हम झेलने की अपनी ताकत बढ़ाते जाएंगे।
Okay, that is the Prime Minister essentially assuring that he's going to do everything possible. The government will do everything possible to protect the interests of course, small businesses, the agricultural industry, and more. Ajay Sahai is, of course, with us. He represents Indian exporters. Mr. Sahai, great to have you with us here. We spoke yesterday, and good to have you back on the program. So this, is, of course, has been notified. And when we were talking yesterday, there was this small, sliver of hope that maybe last minute something happens and talks continue while tariff imposition is extended. It doesn't look like it now with these having been notified. So just want to straight up ask you, which of the industries most hit, most impacted, sir?
In fact, the 55% of India's exports, which is subject to reciprocal tariffs, covering textile, gems and jewelry, leather, toys, handicraft, chemicals, certain engineering goods, plastics, all this will be impacted because from 27th, we will have 50% tariff, whereas most of our competitors are having tariff in the range of 15 to 20%, and the difference of 30 to 35% will not be possible for industry to bridge in. They don't have that much of profit margins, and therefore, I'm pretty sure that in September, we will see export to US dropping down drastically. The good thing is that 45% of the export, which is under Section 232 or in the exempt category, that may continue for some more time.
Yeah. The other thing is, it's like you start with 50, if you start with 50, you end up finally with 25 whenever this is negotiated lower. But 20, when we started all of this, 20, we were not looking at 25. We were looking at an advantage compared to other exporters. Take apparels, etc. Textiles is a case in point, Mrs. Hai. What's your sense? I mean, this 25 secondary tariffs perhaps at some point go, but would that leave us with 25?
No, I think please bear in mind that the countries who have got the lower tariff, including Indonesia, Vietnam, EU, or the UK, they have some kind of bilateral trade arrangement with the US. We are also engaged in the BTA with the US. Once the BTA is finalized, even this 25% will come down to 10 or 15%, depending on the negotiation, give and take. So properly, we are looking into the situation where 25% penal duty, which is on account of the Russian import of oil, may change with some kind of truce happening between Russia and Ukraine and other factors. The balance 25% will come down when we finalize the BTA. So finally, we are looking into a kind of stable situation with India at a tariff of 10 to 15%.
Do you think that is possible, 10 to 15%? Because 25% has been notified already. And going on from here on, by when do you expect any sort of conclusion on the negotiations which are underway?
In fact, the negotiator was supposed to be in India this week. Unfortunately, they have not come. I'm sure the backroom diplomacy must be working. And We are also hopeful that very soon they will come on a negotiating table. As and when the BTA is finalized, please bear in mind that the top two leadership has given a terminal date of fall of 2025, which is still is few months away. And therefore, we have time till October to finalize the deal. And I'm pretty sure that the deal will be finalized. These are certain hiccups which has been witnessed by us, but as a long-term roadmap, India's US relationship is of a strategic nature, and these kinds of hiccup will not derail that. We are hoping that negotiation will commence soon, and once the negotiation conclude, India will be in much better position than many of our competing countries.
So, Mr. Sahai, morning. So, we still keep the hope alive of an eventual tariff of 10 to 15%. But in the event, it is 25%. How would you assess India's competitiveness? And two, in the interim, while we are slapped with a higher tariff vis-a-vis others, how are exporters' concerns being addressed by the government? What steps do you expect?
In fact, as of now, a lot of them has done the front loading of exports so as to build the inventory. The problem may not be there for month or two. Probably US is having a very large inventory at this point of time. The challenge is, of course, the finalizing the order for the summer season, particularly in textile and footwear segment, where the buyers are holding to the order, looking into what would be the tariff on India. If this 50% tariff continues, as I told that most of the sectors will be impacted, except the sector which enjoys the exemption either under Section 232 or having the zero tariff. So roughly $47 to $48 billion of India's exports will be at stake if this 50% tariff continues. Even if the 25% penal tariff is withdrawn and 25% remains, probably exporters, importer may enter into some kind of negotiation to absorb the additional tariff. Please bear in mind that 10% is the minimum tariff in US now. So we are talking about a differential of 5 to 10% with most of our competitors. And generally our competition from Southeast Asia and South Asia, they are close to 20%. So we are talking about the 5%. Probably the 25% penal duty is hitting the exports very badly. And had it been just the 25%, it could have been managed. But we are not losing hope. We are hoping that negotiation will start. And once the negotiation concludes, we will be in much better situation.
Okay, Mr. Sahai, we'll continue to sort of get your feedback from you because you're clued into most exporting industries over the next couple of days as well. Thank you very much for joining us for now. Amnish Agarwal is with us. Amnish, good morning. Good to have you with us here. Thanks for joining us. You know, as Mr. Sahai, who represents exporters, said, of course, I mean, continue to hope things will get resolved. And he ultimately hopes, you know, given the strategic nature of the long-standing partnership, this is more of a hiccup and, you know, tariffs are lower. From a market point of view, so textile apparels were the hardest hit. I mean, look at Gokuldas exports. Yesterday was the biggest volume-led loser, ended another 5.5% lower at about $700. What's your sense, Amnish? You know, it's of course looking pretty. We don't know when the resolution happens, but would you look at buying some of these names if they are beaten down enough, with, of course, the assumption or the belief that, I mean, of course, 50% will not be permanent.
Go ahead, Prashant. So, see, as far as the entire basket of exports to US is concerned, say, for example, when it comes to your iPhones or pharma, so many segments are still exempt. But as you said, there are a few segments like, for example, your textiles is there, your textile including your home textiles, your marine is there, okay, leather is there, so gems and jewelry are there. So these are the segments which are definitely going to see some pressure. Particularly, I think textile, the hit will be there. But for some of the companies, exports to US have been a very significant part of their total sales. And my sense is that the resolution with US is going to take time. It is not going to be a, you can say, a straight-jacketed thing, because it is not only about tariffs. It is about much bigger geopolitical game which is being played as of now. So at this point of time, yes, everything at a certain price becomes a buy. But I think for the time being, it is, you can say, now the entire action, the impact will start flowing in, which can actually take some of the stock prices even lower. So while in the long term, yes, once the things resolve, things will bounce back, and there could be, you can say, a scope to make good amount of return in some of these stocks. But till the time some clarity comes, even if say it is a quarter or two, I think there could be still significant downside in many of these stocks.
Right, the drama continues from Wall Street. Amnish, just hang in there. We, have some lines coming in from Lisa Cook, who Donald Trump, fired yesterday overnight, and there was some weakness on Wall Street on account of that. But now there are statements coming in from Lisa Cook at the bottom of your screen. She says that no cause exists for the US president to fire me. In fact, she goes on to say that she will not resign. So obviously, there are shots fired from both sides. There is uncertainty. But it's interesting where Donald Trump has said something, whereas Lisa Cook saying that no cause exists for the US president to fire me. The independence of the US Fed and the governor saying that she will not resign, and the US president has no authority to fire me. We will obviously monitor this story as this goes along, may have some market implications as well. But Amnish, the IT pack that did well in yesterday's trading session, the street believes that maybe better days are ahead and the worst perhaps is in the price. Would you concur with that view? And if yes, then how would you like to play it? Via the large caps or maybe some of the mid caps?
You see, IT has been weak from quite some time in terms of, say, number, in terms of outlook. Also, there is no great guidance which is coming as of now, which started with slowdown in US and currently also, I think in terms of numbers, yes, in some segment there might be some stability, but there is no great clarity even now. Now we need to look at it from the angle that so far US economy has been holding on, and the inflation numbers have been under control because first of all, there's a lot of inventory which has been built up into the system to, you can say, prevent any big impact of these tariffs. But in some of the essentials, the prices have even gone up by 20-30%, but that is not a very big part of the total basket. So if this kind of you can say the tariff wars with various countries, it continues, then inflation in US is definitely going to go up, and which could impact demand. And you can say lag impact of that can even start coming on some of these IT companies. So I would say that IT in the current juncture is more like, I would say it offers value. There's a dividend yield also. But in terms of visibility, there is very limited visibility on the ground. Now, if you want to play IT stocks, I think Infi is one stock which we have been liking. And in addition to it, you can say look at maybe say an LTI Mindtree, which again is doing good. Persistent is also a good stock, but I think the valuations there, they have been quite rich.
Amnish, do stay on. We need to slip into a very short break. On the other side, we'll continue our conversation. We'll also get in a few technical trading ideas. Sachidanand Utekar and Sudarshan Sukhani join in with the top trading picks for this morning. Welcome back. Asia is lower today following the weakness on Wall Street. The Nikkei, the Korean markets are down over 1%. The Taiwanese markets, Straits Times too, are down close to about 1/3 of a percentage point. And that GIFT Nifty too is suggesting a bit of a cautious start. But yesterday we had a modest gain. The benchmark indices closed up with a gain of about 0.4%, and there was strength in many pockets of the market. IT was one, paper stocks. So while we did see big gains in the stocks, let's find out how the volumes and the delivery volume shaped up in these counters. Hormus now joins in with those numbers. Hormus.
There are two pockets dominated headlines yesterday, as you mentioned. One was IT and the other one was paper, and it is the delivery volume suggests the two contrasting tales here. You start off with the paper names, of course. You take a look at JK Paper, Tamil Nadu Newsprint, West Coast, Andhra Paper, and take a look at the sheer volumes with which these stocks moved yesterday. Almost 2.5 crore shares traded on JK Paper, the 20-day average of just over 2 lakh. And in comparison to Tamil Nadu Newsprint, West Coast, Andhra Paper, all of them saw anywhere between 70 to 90 lakh shares traded, and 20-day average is anywhere between 70 to 90,000. Then you take a look at the delivery volumes as well. Now for JK Paper as well, almost 20 lakh shares that were marked for delivery as compared to a 20-day average of just 1 lakh. 11.5, almost the other names also saw anywhere between 5 to 11 lakh shares marked for delivery, and their 20-day average for delivery as well ranges anywhere between 30 to 50,000. So it shows the very heavy volumes and the delivery correspondingly as well. On the flip side though, IT was another pocket. And most of these names, they did move higher, but they moved higher on volumes that were almost around about their 20-day average, not significantly higher. In fact, HCL Tech's volumes yesterday were lower than their 20-day average. The 28 lakh shares traded yesterday, 20-day average of just 32 lakh. And on the delivery front as well, almost 50 to 70% of those shares were marked for delivery, and for Infosys and for TCS as well. And in fact, for TCS's delivery volume was lower than its 20-day average, but for the other two, it was higher than its 20-day average, but not significantly. The other name that you want to watch out for today is Vodafone Idea, because of the fact that in the last 6 sessions, the stock has gained in 5 of them. It's up 20% in those 6 trading sessions, and over the last 2 trading sessions, every session has seen more than 100 crore shares being traded in terms of daily volumes. And the last time this happened, when 100 crore shares were traded in a single day on back-to-back occasions, was back on the 24th and the 25th of June. And what you also need to watch out for is that there were almost 23 crore shares that were marked for delivery in yesterday's trading session, as compared to a 20-day average of just 12 lakh. And when it comes to the daily traded volume, yesterday's volumes of 116 odd crore shares was also higher than their 20-day average of around about 46 to 47 lakhs. So it is IT, it is paper, but of course can't take your eyes off Vodafone Idea in today's session as well.
All right, Hormus, thanks very much. Very, very interesting stats there. So in the case of paper, I mean, we don't talk about it, right? It's a very small space and no real analyst coverage or anything of that sort. But you know, we spotted this early yesterday, and of course, it's never one. It's always a pack, and the delivery numbers are up on your screen. So very, very large numbers. I spoke to, since there's no coverage, I spoke to one of the top packaging companies, which basically, so all these companies, paper companies, are clients. I mean, they sell paper and paperboard, etc., to this large packaging company. I think one of the largest in the country. They said it's quite significant. The impact is quite meaningful. And guess where bulk of this comes from? Where the minimum imports? China. So it'll immediately increase capacity utilization for all these companies. And the import duty is on this virgin fiber paperboards, which is nothing but, I mean, the packaging material that you use when you get a package from Amazon, etc. So the feedback I got is it's anything between 35 to 50% of revenues for companies like JK, ITC. ITC, of course, won't move the needle because it's on a stock basis, but those are the two companies, at least the feedback I got, where this is the most significant. The other thing, of course, is that demand has been a little weak. But yes, this GST cut, etc., is able to fire up demand a little bit. I mean, that also, at the margin, helps things. So just thought I'll put that up. We'll try and get an analyst from maybe one of the credit rating agencies to talk to us about what they make of this. And of course, we've been trying to get to the managements as well. We'll take a break. We're back. The pre-open session comes up. Sandeep Agarwal of Sovilo Investment Managers, of course, joins in to talk about the rally yesterday we saw in the IT services space as well. Stay tuned.
Welcome back. Moments away from the pre-open, 15 minutes away from the market open itself. The GIFT Nifty indicating about a 70-point downtick at the open. The Asian markets mildly in the red after the US markets closed lower yesterday. So what should the technical setup be like? Let's get in Sudarshan Sukhani and Sachidanand Utekar for a quick check on the indices and individual stocks. Sudarshan, good morning. We've seen higher levels over the last few trading sessions, but those higher levels have been lower than the previous day. And there has been supply at levels slightly above the 25,000 mark as well. Do you think the index is now consolidating at a higher range and this range-bound trade is likely to play out?
Yeah, good morning. See, what's happening is that every day is becoming a different day. We had a buy on dips opportunity yesterday. Today it's the exact reverse. And there's a message here, a larger message. When there is a trend, most days give an opportunity for buying, whether it is on a breakout, on some days it is on a dip, some days on a consolidation. But because there is an absence of trend, we are having a buy day, then we are having a sell day, which is essentially today, and maybe tomorrow we'll have something different. So you're right, the selling is coming at higher levels, and the markets are perched very, at a very risky point. Once we go below 24,850, we start filling the gap which was created on Monday. That's not good news, and it will create something called an island pattern, which is for the technicals. But all said and done, today is a day when we want to go short. So keep a stop at 25,000 and look for an intraday, and it's all intraday. Look for a decline to wherever we go.
So you were short at open. If we open down, gap down, 50, 60, 70 points down, you would still go ahead and short?
Yeah, that's right. Obviously, we always wait for a cooling off period, but the trade is to go short today.
Sachidanand Utekar is also now joining us. What would your call be for the day, assuming we have a gap down opening? How would you play it?
Good morning, Bima. Good morning, Mangalam. I think Sir has already filled in all the details here, but if you look at the overall structure, I think there is multiple support evidence at 24,810, 24,840. So I think that will be a very good deep pocket wherein some contra longs should be initiated. If you look at last few trading sessions, the Nifty has been more consolidative. Yes, the 25,000 hurdle is remarkable, but if you look at the support, there is good amount of evidence that 24,840 would act as a very strong demand zone. So I think going long near that support would be a prudent idea. One can keep a stop loss at 24,840 on closing basis, and probably we may see the Nifty, oscillating within this range of 24,940 on the higher side and 24,840 on the lower side.
Okay. Let's get in a few trading ideas then. Sudarshan, your stock calls?
Well, UPL is a buying opportunity with a stop under 707. IndusInd Bank is an intraday short, stop above 785. Sun Pharma is a buy. It's also a positional buy. Sun Pharma is a buy with a stop under 1624. And Indus Towers, again, it's a buying opportunity for the day and a positional buy with a stop under 348.
Sachidanand, your stock calls?
The setup of ITC is looking promising. If you look at the last 15 trading sessions, the stock was in a declining trend. It has formed a bullish hammer formation right at the support zone of this particular declining channel. What we are expecting is that there could be a rebound soon. One can play with a stop loss at around 396. A rebound is expected towards 406 to 410. So it will be on the long side. The second stock, which is looking good, is Exide Industries. After 14 weeks of consolidation, we have seen fresh signs of breakout. The 50-week exponential moving average is also crossed with the positive crossover on its weekly RSI. So we are expecting momentum in this particular counter. The trading target is placed at 422. Positional target is at 436. We are recommending building fresh long positions in Exide, keeping a stop loss at 396 on closing basis. And on the short side, there is some exhaustion in Apollo Hospital. We have seen a bearish engulfing kind of formation. The resistance at 79.50 is looking very strong. So we are expecting that there could be a pullback move, which can be participated with fresh shots. Keep a stop loss at 79.80 on a closing basis. One can expect a move towards 76.50.
All right, got that, Sachi. Thank you so much for that. We'll come back to you for trades at 10 as well. Meanwhile, just watch out for a couple of stocks. Sachidanand did speak about ITC. Things may be falling in place for ITC once again because GST rate rationalization coming in for the tobacco business. The belief is that maybe it'll be rate neutral. Not a major change from either side, and there wasn't a much change that came by on the budget front as well. Consumption, on the other hand, is likely to pick up, and now with paper doing a slightly better as well, all things may come together for ITC. The stock's been stuck at around 400 for a while right now. The other stock that I'm looking at is BLS International Services. That's because the ticker team tells us the company's gone ahead and won orders worth nearly 2,055 crores from the UIDAI, which is, the Aadhaar centers. And this is a little more than what we saw for Protean eGov as well. Protean eGov saw 1,600 crore worth order win coming in from, to keep Aadhaar centers. That stock is up around 7.5%. Obviously, it's taken a big knock on account of the PAN 2.0 going away from it as well. So some positive for them, but a bigger positive for BLS e-services. Amnish Agarwal still with us. Amnish, on ITC, do you have a view? Do you think things are coming together with the paper stocks seeing a bit of a rally? ITC likely to be a beneficiary of that as well. Small part in their overall pie, but things aren't looking very bad for them.
I think ITC, the situation overall, I think it's bottoming out because paper, in the overall scheme of things, one might think it is small, but a couple of years back, they had an EBIT of 2,600 crores, which has literally halved from that level. Now, I think once the duty has come, which is more on the paper board, which is a forte of ITC, being the market leader. I think more than 80-85% of ITC's volumes are from paper board only. So I think the profits will come back. They will, I think, virtually double from here, plus the acquisition of Century paper and paper boards, which they did. So I think it is going to be significantly accretive to ITC over the next, say, year or so. So I think in terms of paper and paper boards, the profit will at least double over the next couple of years. That is one. Even in terms of, I think, cigarettes, the volumes have been good now with the raw material prices softening, plus if GST rates are also likely to be more on the neutral side, I think things are bottoming up. Even FMCG looks, I think, set for some sort of a recovery. So ITC is actually a topic in the entire consumption space.
Got that. Amnish, stay on. We also have with us on the show Sandeep Agarwal of Sovilo Investments. Yesterday, we saw all the IT stocks rally in trade. In fact, the Nifty IT index was up close to about 2.5%. So some signs of life in the beaten down sector. Sandeep Agarwal, fund manager, is now with us. Sandeep, you've consistently held the view that these are tough times for large cap IT companies. They're only going to grow in mid-single digits, 4 to 5% best case. AI is deflationary. But keeping all that, even assuming that's true, IT companies grow 4-5%, at least at the large cap level. Are valuations still turning fairly attractive, maybe for a 10-15% kind of stock price return for the next 1 year, given the fact that the dividend yield, the yield, free cash flow yield, they give you buybacks, etc.?
Yeah, hi, good morning, and thanks for having me on the show. So, Rima, if you recollect, every time we are saying same thing that, large cap 5-6% growth is also good growth, and we don't see more than that. But as you rightly mentioned that, when we are now speaking to a lot of fund managers and others, they are saying that, it is the new defensive for us. So many of them are replacing actually FMCG because for similar growth, rather than paying 50-60 multiple, they are good at paying 20-25 multiple. Same dividend distribution, buyback support is also there. So I think, it is more of a tactical move by many of the funds and many of the investors who are simply replacing, lower, higher multiple with lower multiple stock with similar outcomes. So that is what is happening in large cap. And I think that will continue to happen. And maybe because of that, you can see some upside. But structurally, the things are a little deflationary. As you rightly mentioned, on the AI side, the efforts are going down. So it will take some time for the reset to happen.
Tell us about the positioning. You spoke about how investors are now tactically turning bullish on IT. They're replacing consumption with IT. There was this Phillip Capital sales note last week which said that the FIs have been selling IT. We've seen outflows of $4.1 billion in IT since March of 2024. The assets under custody have fallen from 10.3% at the start of this year to 7.4%. Even domestic ownership in IT is at an all-time low, which means that there is a case for some weight increase. Would you concur?
So, it is very tough to say why the weight increase should happen. But yes, because, if you are shifting from some other sector to other, then there could be some increase. And there is a peak of pessimism also, to be honest, right now. Because And because of that, you can see some reversal and some uptick. But structurally, you know, the industry is in a very different mode right now. We saw the wave in 2022 when mid caps did phenomenally well, all this persistent KPIT, Coforge, Mindtree and all, because earlier the contract sizes used to run in hundreds of millions of dollars. They got broken down into smaller when digital came, and that's the reason the mid caps, which generally did not get the benefit of large contracts, started getting benefit of small mid-sized contracts, and that you saw the massive re-rating which happened in the mid-size. I think now in this wave with AI, the contract sizes have even gone much smaller, and you will see a lot of money to be made in very, very small size companies, because for them that $50,000, $100,000 contracts will also be game changing. So I think this is the wave in which you will see similar kind of money which mid caps made in 2022. This time in 2025, very small size companies will make tremendous amount of money in a very short span of time. That is what my call is. And large cap will remain 5-6% growth, mid cap will remain 10-12% growth, and the small one will be 20-25% growth, and they are at really lower multiples. So big money is there in terms of percentage returns.
Okay. So the thing to do is forget about the large caps as an investor, Sandeep, as a strategy, right? As we go through the next couple of, and this is a trend which will be with us for a while. You're saying forget about the large ones, focus on the small caps in the ITs. That's a strategy investors should pay attention to?
Yes, absolutely. Because Prashant, this is the reason, you know, everyone is taking out money. Also, if you see the FIIs, they get the trends right very early. So I'm telling you, the nature of the contracts are shifting in a way that you will no more have 500 million, 1 billion contracts. Means there could be one or two cases. There are no more so much of transformational deals and all. They got broken down to 100, 150 million dollar in 2022. Now they are broken down into, you know, 1 million, 2 million, 3 million. So obviously now the small caps are the one which will be able to participate in those deals. So I'm saying even the large caps will take their model to do this transaction. Mid cap will also do, but for them to see a meaningful change on their overall scheme of things will be taking 3-4 years. But for the small caps, it will immediately start showing in 2-3 quarters. So I am extremely positive on the very small size companies which are doing niche work, and there are a lot of them. And you will be surprised the way they will make returns, the same returns which Mindtree and everyone has made in 2022.
Okay, just list out 3 names. Top absolute return ideas.
So we run a PMS and we hold some of them, so I will not be able to tell you the names, but I'm telling you a simple scan on a screener or any other software will give you those names. Just need to check what kind of, you know, growth is there, what kind of margins are there.
Sure.
I'm very positive that the small caps will make tremendous money.
Sandeep, quick word. Even BPO companies, the small BPO companies are good buys?
Yes, I think so, because they are using a lot of tools. Even the large BPO companies you should look at there, you know, there is a lot of business coming in.
All right. We'll leave it there. Sandeep, thank you very much for joining us. Really appreciate it. So I think it's a pretty clear view coming in from Sandeep in terms of what you should do and how which names, which at least parts of the IT services space you should approach. And he's saying focus on small caps. That's where growth and money will be made. Well, let's just focus on some more. Actually, let's just put up some stock stacks. And this is stocks we put out earlier on with news, etc. Aditya Birla, Tata Motors, Protein Ega. Protein Ega was the big one, right? 6% rally on the order with regards to Aadhaar services. I think it's 1,000+ crore order. ONGC, IRB Infrastructure are the other ones. NHPC, Sona, BLW, Precision, etc. come up. Tariff impact. We'll just take a look at this as well. Gokuldas, of course, was the big loser yesterday. Wellspun Living, Indocount are some of the others. So, of course, more coming up. Vodafone Idea, 4% lower. Yesterday was up about 5-6%. From 6-6.5, it had moved to about almost 6-7.5 rupees. So, a little bit of pullback after the comments from the Minister of State. Sai Life Sciences block, and we'll see what's happening there. 3% lower, about 380,000 shares at this point. What are the calls coming in at this point? Just 2 minutes before market open. Sudarshan is here with that. Sudarshan.
Well, it's Sun Pharma. Consider buying Sun Pharma with a stop under 1624.
All right, you speak about Sun Pharma. Sachi, your thoughts? All right, let's get to Sachidanand in just a bit. But Sudarshan did speak about Sun Pharma. Ekta joins in. She's got some important news coming in for both Zydus as well as Sun Pharma. Ekta.
Well, yes, I'll start with BofA Securities, which is written on Sun Pharma. They've downgraded the stock to underperform with the target price cut to 1570 versus 1730. According to them, specialty-driven earnings provide some medium-term visibility, but they expect slower revenue ramp-up from new launches compared to consensus. Sun may pursue further specialty acquisitions, but the upside is already priced in. Most favored nation clause on news flow continues to weigh on their drug Illumia, which is Sun's largest specialty drug. It's trading at around 32 times FY27 PE versus 10-year average of around 25.5 times. Investec on Zydus Life Sciences, they have a sell with a target price of 940. It's up around 6% in the past month versus the Nifty Pharma, which is down around 2%. Now unfavorable given valuations and earning risk. Mirabegron, ER and Revlimid generic together contribute around 35% of FY26 EBITDA, but both face risks of disappearing without backup products. It trades at around 28 times FY27 EPS and peers trade at around 24 times.
Okay, all right. Let's just look at what Ekta, thank you very much for that. We've got market open coming up in just a bit from now, just a couple of seconds away. We'll look at indices as we always do. At least the open on the Nifty 50 stock stack, and then we'll get down to individual names and see what's happening. So 24,899, about a 0.25% lower. The Nifty Bank is down about a quarter. The small cap index is flattish. This is all, of course, as markets open up. First rates, so 24,900. So it's about a 0.25% cut there. Bank Nifty is unchanged. Although Nifty Bank, of course, has been the big underperformer as compared to the Nifty. I think it is a little lower now, 0.2 lower on the Nifty Bank. Mid-cap index is down 0.4. And I think the small-cap index will come up on your screen. I think there also, there perhaps is a bit of a cut coming through. So 0.3% lower. So across the board, uniform 0.2, 0.3 on the 4 indices. Nifty heat map, how the Nifty 50 stocks opening, how many in the red, how many in the green, and what is that picture looking like? Overwhelmingly in the red. So Titan on one end, and on the other side you've got Sun Pharma, which Ekta has been, of course, talking about, which is starting lower. So that's the picture, at least as far as the Nifty 50 is concerned. It's a 50-point lower start on the index. Rima.
Well, both brokerage calls. So on the way down, Sun Pharma, Ekta spoke about the BOFA downgrade to underperform. Target price 1570. The stock currently is at 1630. So from here on, after the near 2% fall, there is limited downside, but that's your top loser right now. And other pharma names like Dr. Reddy's, Apollo Hospitals also trading in the red. ICICI Bank is struggling a bit. This month, ICICI Bank is lower by nearly 4%, and that's dragging the overall banking complex index with itself. Reliance Industries has opened trade on the softer side. It's got a cut of about 0.4%. Bharti Airtel is reeling with some losses, but this is after a big outperformance year to date. Bharti Airtel is up nearly 20%, and some of those gains are being given up. You've got softness in a couple of global-facing companies like Tata Motors, Tata Steel, JSW Steel too in the metal universe is weak in trade. On the way up, not too much, but some buying has emerged in Nestle, Titan, where Bernstein likes Titan. They say that this company has been delivering an EPS growth of 23% CAGR for the last 2 decades. Target price set by Bernstein is 4,200. Some auto names, two-wheelers, Eicher Motors, Hero Motor Complex are in the green. Nestle India too, higher. But all in all, not big moves either side.
Not big moves either side on the frontline end of things, but in the broader markets there have been some big movers. So for starters, we have Sai Life Sciences, which are down about 4%. That large trade that Vivek was alluding to has taken place already. 874 rupees per share, 15.4% equity. But more importantly, remember the floor price was 860. So let's see whether there is some recovery from the lows on that stock or not. Protean eGov is up 9.5% on the back of the order win that it has gotten from the Aadhaar centers. The other company that got an order win from the Aadhaar service center is BLS International Services. That stock too up around 4%. Yatra Online is doing well this morning. We have Edelweiss Financial as well, up around 5.5%. But interestingly, after a big move yesterday, JK Paper opens 3.5% lower. So the question is whether there is some purchase at lower levels on these paper names or not. We have Kitex Garments, which is lower by 5% as well. So the textile sector, obviously, on the notification of the 25% tariff, not doing too well. Just one stock I'd like to point out, that is Vedanta, which is optically showing a 17 rupee downtake. But remember, the stock goes ex-dividend today. The dividend on Vedanta was 16 rupees. So if you adjust for that, the stock is down just about 1.5 rupees. So absolutely flat for Vedanta, as against the optical downtake of 4% on account of the stock going ex-dividend.
Okay, I think we've got the rates coming up across the board. 100 points lower is where the Nifty is now starting at 2:1. I mean, it's still very, very early right out of the gates, but 2:1 declines to advances ratio on the Nifty. But as I said, is early. Now, what else? Guys, Karur Vaisya on my screen is showing a big downtick. I'm not sure if it's accurate. We should just put up, okay, nothing. Apologies, that's, I thought so much. Well, Sai Life is the biggest. Of course, there's that block which has gone through. It's down 4%, 871. And Mazgaon Dock is down about 1.6, 1.7%. PG Electroplast has come up, from the recent lows of about 480 or so. It basically rallied about 100 rupees from the lows. So it's down about 2.5. Indus Tower. So there's, of course, Voda Idea, which is lower. But Indus Tower is also down about 2.25% at this point. And so on and so forth. Zydus Life is down about 2%. So that's another one, right? 1,003 odd rupees. The paper names, right? JK Paper is down about 3.5% after yesterday's 13-14% move. So we'll see where that one goes. Hyundai is down 2%, 2418. Action Construction Equipment was up 10% yesterday. That is down about 2.25% as well. I'll go down the list, but volumes then will start to thin out. So I guess we will just wait here and not move down. Protean, I think we already highlighted, full 11% higher on Protean eGov. I mean, of course, it came off from 1,600 rupees or so to the recent lows, which was about 750, and stocks back at about 900 now. Edelweiss is another one, Mangalam, which is up about 5% as we start today's
There's
session.
a large block deal in Edelweiss. 6 million shares have changed hands. So that's the reason why it's moved up on very large volumes.
And just a word on Karur Vaisya, because you thought, it may have been lower on your screen. It's because it's gone ex-bonus, 1:5. So there must have been that adjustment. Just for that, the stock is up around 1.5%. Meanwhile, Rima did speak about a couple of these FMCG names which are picking pace. Look at Britannia. That one's moved about 2% higher at the high point. Colgate too, after a very poor performance in this first quarter, and no, improvement in the outlook as well. That stock's found some takers. And we have Avenue Supermarts. CLSA is written on Avenue Supermarts. They maintain their high conviction outperform call on the stock. That's up around 1%. So a lot of stocks are in focus. Overall, the mid-cap index is down about 0.75%. The advanced decline ratio much in favor of declines. But we still have a lot of these stocks which are showing big moves.
Absolutely. And we'll touch upon more as we go along. 130 odd points lower now, 24,830. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, good morning. Great to have you with us here. Thanks for joining in. Quick word, Karthik. How is the setup? How are we looking? Running into these tariffs over the last 6-7 days, we've had a nice 6-7 day up rally higher. Where does that leave us as these tariffs kick in now?
I think in terms of just the setup, it is quite constructive in the medium to longer run. For a couple of reasons, we've underperformed emerging markets by almost 20% over the last 1 year, as a result of which our valuations compared to emerging markets have gone down. They were trading at a premium of almost 90-95%. That has come down to average levels of 45-50%. Granted, a lot of that is because emerging markets are catching up in terms of growth with compared to our own markets, but one could argue it is in the prices. The next thing is that while earnings were kind of tepid, the earnings cuts have the breadth of earnings cuts have kind of moderated versus last quarter. So for instance, this quarter, we've seen earnings cuts of around 1.5% as against 3.5% last quarter. So the range of the extent of earnings cuts is decreasing, and our earnings expectations around 10 to 11% for this year, which is in line with longer term averages. And I would argue we had taken a lot of that earnings cuts upfront because of the uncertainty that was induced, especially the policy uncertainty that was induced by West and US in particular. And so I think for all those reasons, expectations have kind of moderated, valuations have moderated, and the government has done a fair bit, as we all know, be it in terms of central bank action or policy action. So I think from a market setup perspective, it looks positive in the medium to longer run.
But in the near term, you expect markets to continue to consolidate? I mean, what is the setup positioning looking like, and how would you position your portfolio right now?
In terms of near term, I expect market to consolidate because, as we said, the earnings revision, there is still pressure of earnings revision, especially downward earnings revision, and we need clarity on, especially the GST policy. We need clarity on what is happening with tariffs and so on and so forth. So all of these things will remain an overhang. To that extent, we will be. I expect the market to be range bound in the near term, and our preferences even prior to the change in the announced change in GST and so on and so forth was we continue to remain bullish specific consumer themes, including specifically tourism, be it hotels, airlines. We are overweight specific areas within industrial cap goods like T&D, and that is specifically at a house level, and with particular to quant strategies, I continue to remain selectively bullish on PSU banks, and also have reasonable exposure to telecom as well.
Karthik's beaten down sectors like textile apparels, right? Stocks have corrected because they are hit. I mean, there's a clear big earnings hit. But of course, I mean, if one takes a view that eventually it'll be brought low, these tariffs will be brought lower. There is FTAs being signed with the UK, etc. What's your sense? I mean, are any of these viable?
Right now, in terms of my process, it looks like there's still time where you can call it a buy, despite the correction that we've seen in these stocks. And as long as the overhang is there, I would argue that it'll, in terms of US tariff policies, that it will continue to remain a drag on that sector. Now it comes down to timing, and that is the big question there with these stocks and sectors.
What about defense? Do you own any defense stocks?
We have fair exposure to defense stocks. We have exposure in selective areas. So that's another area. And those companies have also reported decent numbers over this quarter. So that's something that we continue to remain bullish on.
Based on your channel checks, which are the segments or pockets where earnings disappointment will continue, say for the next 2 or 3 quarters, where things still haven't improved? And that's a segment you would completely avoid.
So this is where I think market is at its inflection point, where we've seen, let's say, consumer staples, selected areas within consumer discretionary that have reported negative numbers, or that have reported disappointing numbers compared to expectations. But having said that, within staples, you've seen kind of consolidation in volumes, and volumes kind of sequentially improving. And with what has come through in terms of GST revisions or expected GST revisions, that's something that we need to monitor on. So while there may be sectors that were kind of looking negative, going forward, these need to be monitored because the regulatory environment around us has changed to a fair extent.
What would make you positive on staples? Because you are looking at a lot of these discretionary themes. You like hotels, airlines, you like the entire travel and leisure space. But from a staple standpoint, where a lot of the regulatory push is likely to happen, and there are hopes of revival at the rural end and the lower end of consumption in urban as well. Do you think that would provide a pocket of outperformance, say, over the next 6 to 12 months, especially after the recent underperformance that we've seen in the FMCG stocks?
Certainly an area that we are keeping an eye out for, but as of now, we still think we need a few more data points, positive data points, to kind of make that call in terms of having a bit more exposure there. So that's certainly something that we are keeping an eye out for. But I think the stocks have rallied since the announcement of GST revisions. What now matters is the details in terms of timing, in terms of the rollout, and so on and so forth. And then I think we'll be in a better position to make that call.
But what what is possible? It's been all over, right? And I'm sure you've discussed this as well. If there are bulk of everything is moved into that 5% bracket, say, I mean, even for sectors like cement, etc., rate goes down from 28 to 18. What are where do you see the maximum traction in terms of demand picking up and then consequently businesses doing better?
So As I said, within consumers, we are still more inclined towards more discretionary rather than staple names, be it value fashion, be it tourism-related themes. There we think structurally there is a tailwind as well, and then GST just adds another level of fillip to it. That's an area that we are positive on within consumer as a space. And as you touched on, cement is another area that we do like, and we think that while the cement demand is relatively inelastic to small changes, but small changes in GST rates, but we still continue to remain bullish that space.
Which are the cement companies that you like right now?
I can't talk about stock names, so I'll just leave it at the sector level. Sorry for that.
All right. So cement is up. And you said PSU banks, not private sector banks, in your preferred list.
I'm saying we do have fair exposure to private sector banks and NBFCs at an AMC level, but specifically to quant related strategies, I also like PSU, large PSU banks in addition to what I've just kind of reiterated.
And tech, is it an overweight, neutral, underweight? In tech, what would you be looking at if at all you hold anything?
Tech is more of closer to neutral, slightly underweightish to neutral, but it is more bottom up. It is a good mix of actually large and mid cap names. So I wouldn't call it a sector call, but more of a bottom up stock selection process here.
All right, we take that point. Thank you so much for joining in and giving us your view on the market, individual sectors, and your preferences right now. But the sector on our radar right now has to be Vodafone Idea and Indus Towers, the telecom space that is Vodafone Idea. It's opened lower. In fact, after a few days of a big up move, Vodafone Idea, the individual stock, the intraday comes up for you, had opened lower. Let's see whether that dip has been bought into. No, still down about 6%. We have Indus Towers, which is taking down the chin as well. Rima, what's happening? Is it the end of the road as far as any sort of relief which is likely to come?
So, you know, on Friday early morning, there was a paper article in Mint which spoke about some relief, the DOT having submitted some relief package to the government, and now it's up to the government to decide whether it wants to provide any sort of relief. So since then, there was a rally in Vodafone Idea shares. On Friday, the share price rallied from about 6.5 to 7 rupees. Then yesterday, in Monday's trade, it rallied further from 7 to 7.5 rupees. And now what you're seeing is that rally getting undone to some extent. This is on the back of the Minister of State of Communication conversation with Ashmit Kumar, where very categorically he sort of said that the government is no longer going to intervene. There is no relief coming. And now the government has done what it could. It owns about a 49% stake in Vodafone Idea. From here on, it can't do anything more. And therefore, it's now up to the company to fix itself. The problem is the company has been unable to do that. They've been seeking some sort of a bank fundraising for a very long time, more than about 2 to 3 years. They did that QIP. The QIP price was about 11, 12 rupees thereabout. And at that point also, despite an overwhelming response on the equity side, they were still unable to close any sort of a debt fundraise. Now they're looking at some non-banking channels to raise that money. But it's basically now up to the company to, fix itself right now. And what you're seeing right now in the share price is just the rally over the last 2 days. Seeing some getting undone, seeing a bit of profit booking, and it's taken Indus Towers along with itself. Remember, Indus Towers, the street was hopeful that once Vodafone Idea fixes itself, Indus Towers will give you the dividend. Yeah. But, despite, it's been 2 quarters now. The company even set up a committee where they said we will look at, some sort of a share return back to, some sort of capital return back to the shareholders. But they've been unable to do that because Vodafone Idea itself is not fixed right now.
All right, take that point. For the market itself right now, it's the Nifty is down around, 173, 172 points. Remember, this after a gain of 97 points that we saw yesterday, but over a 200-point fall that we saw on Friday's trading session as well. So the Nifty now with this near 200-point fall is pretty close to where we were at the start of the August series, give and take everything. So, it'll be very important to see whether we bounce back from these levels or not, because a lot of these put writers were positioned at support coming in for the frontline index at 24,750 to 24,800. So very crucial levels for the frontline index. The Nifty Bank not helping its cause. In fact, was an underperformer yesterday as well, and today down by about 500 points, 54,500 thereabouts be an important support for the Nifty Bank as well. But amidst all of this, there are a couple of stocks which are surging, Protean, eGov and BLS. They've gotten orders coming in from the UIDAI for Aadhaar centers, nearly 1,500 to 2,000 crore worth orders. Protean, eGov, a bigger gainer out there because it had seen a bigger gash as well, as the stock, saw a big decline on account of PAN 2.0 orders not being renewed for them. So that's Protean, eGov, up around 11%. Vinny joins in with the developments in this space. Vinny.
Hi, good morning. So like you mentioned, we have Protean eGov as well as BLS International, both these in focus. Now, Protean eGov, they've received a work order from UIDAI for 1,160 crores. This is going to be for establishing and running district-level Aadhaar Seva Kendras. Time period is 6 years. So every year, approximately 200 crores is what the revenue would come in. Now, do not forget, we had seen earlier this year that PAN 2.0 order didn't come in for Protean eGov. That time the stock had seen a sharp fall coming in, almost 20-30% fall in just 2 sessions. Now, in the last 5 days, that's what the stock has recovered as well, right? Last 5 days, 20% uptick that we're seeing coming in from Protean eGov. And this order size is also similar to what would have come in for PAN 2.0. The PAN 2.0 outlay was 1,400 crores. This order is of around 1,200 crores. So at least covering up in terms of the losses over there. But moving on to the next one, BLS International, that has also received an order from UIDAI, and the order size is 2,055 crores. Time period is again 6 years, and similar service that is for establishing and running district level Aadhaar Seva Kendras. Both these stocks are buzzing on the back of this order win.
Thank you. And we will talk about Narayana Healthcare now. Thank you, Vinny, for joining in. Let's shift our attention now. Sandhya J, the group CFO at Narayana Health, is joining in, and our conversation will be focused on 3 main points: concerns over Bajaj Allianz's cashless facilities, the outlook on integrated care and Cayman Islands, and finally, the company's expansion plans. Thank you very much for joining in. First, let's just get to the news about how some of the hospitals are no longer allowing the cashless facilities by Care Enterprises, which is owned by Religare and Bajaj Allianz. What exactly has happened, ma'am, if you're aware?
So it's an evolving situation, and typically any engagement between a customer and a vendor, when it comes up for renewal, it goes through a certain pressure. Now, this is accentuated in the current situation, and I don't want to specifically talk about what's happening on Bajaj. We have a reasonably working relationship with all the insurance companies, but I do want to talk about generally the challenge that both sides are facing.
Hi, good morning. Apologies to interrupt. Just one clarification, and then please continue. Has Narayana also sort of taken a decision to with regards to Bajaj Alliance?
It is an evolving situation. I don't think any hospital has at the moment taken a decision. Conversations are in progress. And I think it's too early to comment.
Right. If you could give us a sense of what your current payer mix is, how much of that comes in from, insurers, and would you have any sort of breakup on who contributes the most when it comes to insurance companies?
Sure. 1/4 of our payer mix comes in from insurance payers. And like every other organization, we have all the insurance players who... so our mix is very similar to how the market share of the insurance companies are. So it's not a public information that we share our customer composition. So I'm not calling out specific names, but it is very similar to the market share.
Ma'am, just getting back to that earlier point about Bajaj Allianz. So you're saying you're in talks with them. As of now, no decision has been taken by your hospitals to stop accepting Bajaj Allianz insurance, right?
At the moment, yes. The conversations are in progress.
But are you facing some of the issues that APHI has spoken about, delay in payments, etc.?
So I'm not wanting to single out any specific insurance provider at this point in time. But in general, there are issues that both sides face. So from a hospital point of view, yes, we would benefit from renewals happening because typically prices are locked in for 2 to 3 years, which means we are serving at older prices for a long period of time. So if the renewals are not happening on time, then our realization gets impacted. The second aspect is that sometimes we have to engage on deductions and have the conversations to understand why deductions have happened. And based on explanations, there is a lot of effort that is involved for both parties to come to the table to understand the bills and the deductions. So there are issues that get faced there. I would still say that this is typical to how a relationship works. But there is a point that a larger point that I want to talk about here is that maybe what is happening is that there are a lot of inefficiencies with the insurers, and somehow we are conflating them just into hospital charges. Now, modern healthcare is expensive, and we have to deliver with latest medicine, international quality standard, and I think
Ma'am,
last time also.
Yeah, Sandhya, but let me just come in here. We all, and hopefully we won't have to go we won't have too many hospital visits, but all of us do, right? And most of our viewers do as well. You would absolutely agree that healthcare charges have skyrocketed over the last couple of years, over the last few years actually, right? Narayana, of course, and I want to make that mention that you're in that sense much more transparent, and we've spoken about this in the past, and I think even cost of treatment, etc., maybe relatively is a little lower across procedures compared to others. But I don't think you would disagree with the basic thing, basic premise that quality healthcare is, for the vast majority is absolutely unaffordable in that sense. And it's a question which comes up when we speak with investors about hospitals, etc. They say, well, at some point the government's going to come in and just cap this because it's getting to be a big problem now. Right now we're talking about from an insurance angle. Are hospitals talking among themselves? You said, well, there are inefficiencies on the insurance side, and that's being conflated with demands for hospitals to fix their side. But are hospitals at least discussing openly what can be done?
So just to go one step back on your previous point in terms of healthcare costs going up, you would also see that the underlying cost profile itself has gone up. And when we spoke last time, I think we had spoken in a reasonable amount of detail on the various costs that are adding up to what hospitals have to charge. Now, the other aspect is that we all know that India is one of the lowest cost of healthcare. Now, while of course it does feel that the cost of healthcare is high because it has gone up over time, but cost of manpower has gone up, cost of imported equipments have gone up, a lot of underlying costs have gone up. But I do think that many times we are confusing the inability of this country to pay for healthcare with the cost of healthcare. We do need a more universal insurance framework for the country. Any cost, whatever be the cost, let's say whatever we are charging today, tomorrow the hospitals decide to charge, say, 80% of that. It is still going to be expensive because the country does not have the ability to pay for its healthcare. So I do feel that we have to pivot into how to make the country able to pay for its healthcare, and which is where insurance and government universal healthcare schemes, etc., play a part. So it's very easy to say from a distance that costs are going up for healthcare, but underlying costs also are going up. And yes.
Yeah, so we take that point, but on this issue itself, you did say that you were facing some of the issues across all the insurers that you were working with, and some of them include the likes of delay in payments, unilateral deductions, a high time in pre-authorization and pre-discharge approvals. For Bajaj Allianz in particular, were any of these issues more than the others?
I don't think it is fair of me to single out a partner. Bajaj Allianz, like every other insurance company, is our partner. And together, between insurance and hospitals, we are serving a customer need. So it is not fair of me to single out one partner and call out issues.
No, but this is something that the APHI has said. So we just wanted to understand from the other side, while you have been facing issues from across the board, has this particular one been a little more accentuated than the others?
I don't think when the matter is under discussion, both through AHPI and on a bilateral basis, I don't think it is fair of me to comment. What I can definitely say is that we are having ongoing engagements with Bajaj Alliance, as well as HPI has also created ongoing engagement platforms with Bajaj Alliance, and I'm hoping that we will come to a meaningful outcome on those conversations.
What is a meaningful outcome as per you? What is a meaningful outcome as per you? And when you are engaging with them on, these issues, what is it that your side of the discussion is saying or proposing?
Sure. A lot of it has been highlighted in that AHPI note, I think, which is public. But if you look at us, I started speaking about it. We need to renew on time. B, we need to have a mechanism by which our cost inflation is taken care of in the contract. C, we need to have a seamless way of working at the time of claim settlements. Both from a customer experience point of view, because even customers are facing deductions at the moment, and therefore they're having to co-pay. Different insurance companies are at different levels, anywhere between 10% of the bill to 50% of the bill customers are having to co-pay. And after a claim is approved, sometimes we also get deductions. So we need to have a way of working sorted out on those areas. So it is like I said, some of these are bilateral. On a transaction by transaction basis, we do discuss. And at the overall framework level, I think HPI is engaging with the insurance company.
Ma'am, just one more point, coming back to that earlier argument that you were saying, that while the cost of healthcare has gone up, the cost of healthcare has gone up while we're paying more, even for you at your end. You are paying a lot more. The cost has gone up. I was just looking at your margins, ma'am. In FY24, 10 years back, your margins were about 10%. And now when you end FY25, your margins were 23-24%. So while in an absolute terms, yes, costs have gone up, but you've also benefited. Your margins have doubled.
Okay. I want to answer this question in two parts. One is that you are reading our overall margin, including Cayman. Our India margin is around the range of 20%. When I gave my interview to CNBC just, I think, 1.5 months back, the first question that you asked me was that, we were expecting you to be at X margin and you are at Y margin. And why are you not at X and why are you not able to sustain X? But the reason why you are asking that question, it's a fair question, because there is a certain margin threshold that we will need to work with to generate adequate cash flows so that we can reinvest. If you see, healthcare is probably the only sector which reinvests all its cash flows into capacity. You take any hospital, all of them have a model by which as and when they generate cash flows, it goes into new capacity, and new capacity is what is needed for the country. So if you just take EBITDA as a number and say, oh, your EBITDA is so much, I think it's not a real representation of what the sector is doing. You have to see what the sector is. For example, I will take our example. I can't comment for other hospitals. Every third patient we treat in our hospital comes either on a subsidized scheme or on a government, which actually pays many times low cost. Yeah. Now, I cannot do that cross-subsidy if I am not making healthy cash flows and have a balance sheet or P&L that can support it. We are investing, I think your third question, which is our expansion question. We cannot deliver that expansion until we have a cash flow that can support it. So we'll have to look at the health of the industry also, and what the industry brings value to the customer in such issues that we bring to the table.
Well, it's a complicated issue. It's a bigger question, and I think it'll require many more debates, discussions, etc. Sandhya, thank you very much for now, for being with us here to talk us through your point of view at Narayana and, of course, hospitals overall. Stocks at about 1800, 1812. Markets are sold off. 200 points lower on the Nifty, 24,770 is where we are at the day's low almost. We take a break. We're back. And of course, we focus once again back on the tariff, the Trump tariffs which kick in, the secondary tariffs which kick in from tomorrow morning. Amitendu Palit, Senior Research Fellow, ISAS, NUS, will be with us. We'll also connect with former Commerce and Industry Secretary Ajay Dua to talk about all of this. Stay tuned. Welcome back. 200 points lower on the Nifty. 24,770 is where we are at the day's lowest point. Market breadth is negative. So 500 stocks are higher, 2,000 stocks are lower. So a day to go for the US tariffs to kick in. And the tariffs are 50%, 25 base plus 25 additional secondary tariffs. We'll, of course, we've been tracking this, and as I just said, we will be speaking with some experts in just a bit. But here's Mark Mobius, chairman of Emerging Opportunities Fund. He's an emerging markets veteran. Has said that his belief is that India perhaps is the best performing, is going to be the best performing emerging market in the world. Listen in.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous. India's got an incredible domestic market, and more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the US, which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the US, I think the Indian economy will still be doing very, very well. We've actually reduced the cash. It's about 25% now, but thank God we've been having this cash, because with the markets at these uncertain terms, particularly India, we're being more cautious, and we have to be careful in putting money in. Of course, if prices of the stocks we like come down dramatically, we'll be putting more money in the market, because at the end of the day, we like prices that are depressed. At the end of the day, India is still going to do very, very well from a longer term perspective. And if you look at the Nifty 50, it's still at a high point and probably going higher. I can see the Nifty 50 going much higher than where it is now. And of course, once this trade war is over, you'll probably see a lot more good news coming out of India. By the way, one of the interesting aspects of this whole thing is that as a result of the pressure that the Indian government is having, you're going to see them making more and more changes in the, let's say, the GST, the tax system, to make it simpler for businesses to operate. And there'll be a lot of reforms which will help the Indian economy grow at a better rate. Because a lot of things that are holding back the Indian economy, of course, is the bureaucracy and the complicated tax system.
All right, an all-time India bull saying that very near term he's a little cautious on putting more money in India, has raised India cash levels by around 25% as well. That's Mark Mobius, even though he believes that the long-term prospects for India are good. The near-term concerns around the tariffs are something that, everyone's a little jittery about. So let's discuss this and more. We do have Amitendu Palit, who is a senior research fellow at ISAS NUS, joining in. Thanks a lot, Mr. Palit, for joining in. The obvious question, what happens now? 25%. The street was expecting in the long term India would be favored versus other nations. Not only has that flipped, but now 25% with the threat of that going to 50%, give or take the exemptions. It's definitely not in our favor so far. Do you think there could be something that could flip it?
Firstly, thank you for asking me to join you on this show. I was going through the executive order that's been brought in by the White House. It's actually a very complicated order in the sense that, as you said, there are certain kinds of exemptions in the sense at least there's one relief that the Indian industry will be happy to have. There's not going to be any stacking of the Section 232 tariffs, which are already effective on steel and aluminium and automobiles with these tariffs. So that part is clear. Second, there are a large number of exemptions over and above the items that were already exempted in the Annexure 2 of the first reciprocal tariffs order that was issued on the 2nd of April. So there's a bunch of items which are going to face these tariffs, and some of these clearly are items which are among India's major exports to the US. But having said that, the order mentions something interesting, and that's the provision of a drawback. Now, it's not yet clear what this drawback is supposed to be. How can there be a duty drawback effective? All those details are not coming out. But I think, largely speaking, the couple of industries that are taking center stage at this point in time is basically garments, which is expected to go under the radar for some time in terms of the hit that it might take in the short run. There's leather, there's jewelry. But having said that, again, let me come back to the point that these are essentially sectors which, even without a 25% Russian tariff, would have been impacted in a relative sense, because India's reciprocal tariffs at 25% are by and large higher than most of its competitor countries in these industries. But on the other hand, I think the global financial and investment community, particularly since you guys are clued into the market, you'll be able to sort of back me up on this, I think, much more resolutely. That I think the markets continue to retain their faith in the long-term prospects of the Indian economy. Those, I think, have been confirmed by the ratings that have been recently released by Fitch and S&P, and also from what Mark shared with us earlier in the meeting. I think the long-term growth prospects of the Indian economy, and along with that, the returns on long-term investment, which investors are planning for the economy, all remain stable, not just because of the domestic economy fundamentals, but also I think there is this faith in the ability of the Indian economy to also maintain its exports. And finally, I'd like to draw your attention to one point. We have been talking about the India-US economic relationship having taken a hit. There is a very significant section of the India-US economic relationship, which is the trading services. That till now has not been affected because that has not been the target of tariffs. But the latest pronouncement from President Trump on Truth Social is that his focus is now going to shift to the quote-unquote behavior that different countries mete out to the US tech companies. And he's particularly going to watch out for digital taxes in this regard. Now, my sense over here is that the US tech, and particularly the big tech, is very deeply invested in India, and they are likely to become a very crucial group of actors in maintaining that part of the India-US economic relationship, which over time can also eventually lead to slowly certain other tariffs being taken off on India.
So the leverage that India has is actually its IT services exports. Just the way, for instance, the leverage China has, which is why negotiations with US have been still ongoing, is to do with rare earth magnets and so much other. You think what will help India eventually get a reasonably favorable deal would be its IT services exports? Or is there any other leverage that we have?
Yeah. It's not just the IT services. I think there's a huge amount of leverage India enjoys insofar as the patented services, the legal services, the professional services that the US disburses in India, and the revenues that its service providers earn from India. And there's already this talk about whether these services might be the subject of retaliation on part of certain American trade partners. India hasn't yet come into that conversation, but there are countries like Brazil, which in the past have taken steps on, notifying their actions on US patented services, so much so that the US revenues from those markets come under threat. But the bigger point that I'm trying to make over here is that it is in the United States business interest to actually maintain this services trade in as robust a fashion as possible, the way it is going and the momentum is being maintained. So I think that is where the ball is actually in the American court. And I think President Trump and his group of people are sensible enough to understand that.
Point taken. I actually want to flip that question on its head, Mr. Palid. Good morning, Prashant here. We also have Mr. Ajay Dua joining us. Mr. Dua, good morning. Just coming to you, sir. But Mr. Palid, if I can come to you, the way you began that the answer before the last, which is on the last post, he said, well, he's going to pay attention to what countries do on the digital tax side. Yeah, I mean, is there a bit of a threat there that he's so far not mentioned services? I mean, and I really hope that's never on the radar. That's going to be a huge one. But is there a risk at all that you were referring to?
Good morning, Prashant. You'll recall that 3 months ago he had mentioned that countries which create barriers to Hollywood films will be slapped tariffs on. Now, at this rate, if he's trying to slap tariffs on every possible action that countries enter into, I don't really think that is practical. That threat is running out of its power. And at this point in time, if you discover that a country like India maintains a digital services tax, which many other countries of the world do, and which are all going to get eventually amalgamated under the BEPS minimum value of taxation, tariffs are not really going to make much of a difference at all, because even this current order on the Russian tariffs that has come is an order which is not comprehensive. It is actually selective, if I can define it that way. And if you take a look at it vis-a-vis the earlier precedent orders that are over there, I think there is no further new cause for India to worry as far as the hit on the exports are going to be taken. The older worries remain, perhaps to some extent, those sectoral impacts increase. As far as the new threats are concerned, I'm pretty sure there are going to be threats, and this is something which is going to be of bigger concern to the countries which have already signed deals with the US. Because by now, they should understand that no deal with the US is good enough. So I think that's the point which needs to be noted and then move forward. Perhaps that puts India in a better position than the others.
No, you're absolutely right. I mean, who knows how all these promises of investments to avoid tariffs, I mean, take the case of semiconductors and chip companies, how much of this will materialize in the next 3.5 years? What after? I mean, it's all up in that sense. And even all these deals, we don't have details of, right, with other US and other countries. They're all so far just headlines in that sense. Mr. Dua is with us. Mr. Dua, your thoughts, sir, as these tariffs kick in, go into effect? How should I mean, our viewers look at this? The general feeling, of course, has been that it's 25 plus 25, but this is, of course, can't be permanent. Maybe it'll be negotiated lower, but timelines are unclear. How do you think about this, Mr. Dua?
I think, thank you first, Shant, for having me. I'm sorry I'm joining a bit late. I think for the time being, we do have a situation in hand which we will need to boldly face, which means that from tomorrow, we are liable to pay a 50% duty on all our exports to the US, which at about 55% of the $90 billion means on about as 52 or $53 billion, we would be required to pay an additional duty of 25%. But that shouldn't bother us too much and for too long is what I would like to emphasize. We are nothing but a collateral damage of Russia and the US not seeing eye to eye on Ukraine. It's no more than that. The oil, our continuing to import oil from crude oil and LNG from Russia is merely an excuse to put pressure on the United States, pressure on Russia. Mr. Trump feels hurt, feels disappointed that he had promised the world well before he was even elected as the president for the second time, that within no time he will have the war in Ukraine stopped. He finds himself helpless, and a little bit of belligerence from President Putin post the Alaska summit has, I think, egged him on to take the action against the weakest possible link in the chain, Otherwise, why not action against China? Why not action against the EU, which also have continued and are continuing to import the Russian oil?
You're absolutely right. Mr. Palit, have you looked at numbers, sir? The cost benefit, savings on Russian oil vis-a-vis hit to exports because of these 25% tariffs. If you can, I'm sure that kind of scenario analysis exists with the government, right?
At my end, Prashant, I think, no, I haven't gone into a detailed estimate of that. But what I can share with you is that, Prashant, in this respect, the focus should actually be on the kind of sanctions that have come from the European Union as opposed to the US ones, because the US ones are talking about tariffs. The European Union sanctions are actually talking about lifting oil at a particular threshold price. If that price or anything below that is the price for buying oil, then that is acceptable. But anything above that is supposed to add to the Russian revenues, and that is not acceptable. And that is a threshold which has been calculated. The $60 per barrel appears to be the mark, and 20% below that is the threshold, which or anything below that is acceptable. Now, from an Indian perspective, these prices are varying very, very significantly. But on the other hand, if the trade-off is that you start buying more and more of the American barrel as a one-for-one substitution, which right now is at $65, then obviously the costs are significant. But I think I'd like to go back to the larger point of, taking a look at the GDP and the contraction that is expected. I think I'm pretty confident that it's not going to be a significant part. Otherwise, by this time, we would have had the Reserve Bank of India coming out with some feelers in this regard. They have held the GDP growth unchanged at 6.5%. And at best, a 0.5 percentage point this way, that way might be the aberration, which depends much upon how the dollar behaves, how the inflation in the economy shapes up.
All right, we take that point. Thank you so much for joining us and giving us your views. Let's hope, for a better, sentiment both in the India and the US, better prices for them. This actually gets to a level which is a lot more acceptable to both the nations and a lot more favorable from a market standpoint as well. Good time to get in, the market checks as well. We do have the Nifty still hovering below the 24,800 mark. We do have Mr. Shetty, Nagaraj Shetty, who's the Senior Technical Research Analyst, HDFC Securities, joining us now. Nagaraj, over the last month or two, the Nifty has been consolidating. In fact, even if you take into account the big move that we've seen over the last 5 or 6 days, for this series, the Nifty is up just about 23 points. So the range keeps moving either higher or lower by a couple of 100 points. And within that 100-point range, the market has been oscillating. What do you think the charts are suggesting from a near, medium and long-term standpoint in the frontline indices? And any sectors that you would like to call out?
Hi, good morning, Mangalam. No doubt, Nifty has been a short-term downtrend from the higher levels. Selling pressure has emerged. The initial support of 24,800 just on the verge of breaking. I think the way Nifty has moved up recently, after that, before coming into this recent correction, it has changed the sentiment of the market, and the gap that has opened on 18th of August. I'm expecting that is going to be a crucial gap support for the Nifty from any decline from here onwards. Currently, the gap has been entered on the long side. At the lower level, the gap support is placed around 24,700, 650 odd level. I think that is going to be a strong support for the market, and we could see Nifty bouncing back from the lower levels by today or tomorrow in the next 1 or 2 sessions. There is a higher possibility of Nifty showing upside recovery from the lows of around 24,700 to 24,650 levels in the near term.
Thank you for joining in. Any quick stock calls?
I have 2 stocks. One from auto side, that is Bajaj Auto. Technically, Bajaj Auto was moving in a larger range bound action. Recently, it has broken above the range and currently showing some consolidation, showing some resilience during this week. Broader markets currently trading around 8786 levels. One can look to buy at this point of time. An upside target would be around 9,300, 9,300, and one can place a stop loss of 8,500. And second one is SJVN. Chartically, SJVN has been in an accumulation phase over the last many weeks. We have seen some good outperformance recently. It is currently placed at the edge of breakout of the 200-day EMA. It has been a strong resistance over the last 1 year. And I think the overall chart pattern is indicating a decisive upside breakout of this hurdle in the near term. Currently trading around 100.70, one can look to buy at this point of time. The immediate upside target would be around 107. One can place a stop loss at 96.
Thank you. We leave it here, get into a break. On the other side, Manisha Gupta will join in to focus on the commodity space. Stay tuned.
Welcome back. Markets, of course, are not doing all that well. Nifty is down 160 points off the lows by a bit. Commodities in focus with Manisha. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm talking about a couple of sectors which do not like the kind of tariff increase that we've seen coming in for the country. 25% tariffs were done on 7th of August, and we have a total of 50% coming in from the 27th of August. Now, I'm talking about the gem and jewelry sector, first of all, and this is going to be really badly hit. $48.2 billion of Indian merchandise will will attract tariffs going forward from here. And when you look at the gems and jewelry, well, we are looking at higher numbers here as well. So gem and jewelry sector, US accounts for nearly 30% or $10 billion worth of export is what we've seen in FY25. Now, this sector is going to be very badly hit because when you look at the other peers and other competitors, India does turn incompetitive rather, in the international markets there. So while India will be staring at 50% from 27th or 28th of August, take a look at the other countries on what they are looking at in sense of tariffs. You have Turkey at 15%, Vietnam 20%, and Thailand at 19%. So other countries which are in direct competition with India will be looking at 15 to 20%. While India stands at a very tall 50% on this one. Well, diamond jewelry is one part of it, and diamonds is yet another, because the world's largest hub for diamond cutting and polishing is India. 9 out of 10 diamonds are cut and polished in India. So when these diamonds go to US, which is, by the way, a 50% for Indian market, this is going to be heavily tariffed. So this is something that the industry is pushing for, treating diamond as an input or a raw material and perhaps exempting it at this point in time. The tariff impact will, of course, increase the cost for India. The Indian products will become less competitive. That could lead to lower sales. The calculations for the month of August, in any case, have been on the weaker side. And going forward is Christmas and holiday season. This is a season that the industry says perhaps would be completely amiss. This could threaten livelihoods, stall exports, and disrupt supply chains as well. The street also is looking for A lot of employment being hurt as well. The industry is calling for government intervention, including strong diplomatic talks with the US. It also is about asking for relief schemes from the government in sense of supporting exports, exporters and the smaller units as well. In addition to that, the industry is asking for duty drawback schemes. There also is an ask for market access initiative scheme, deferment of interest on working capital. There's a lot of manufacturing that perhaps is getting shifted to Dubai, Mexico. The industry has already started visiting these countries, understanding licenses laws there, so that perhaps manufacturing units for export especially could be shifted out of India. Industry also is warning of a potential job losses for nearly 5 million workers if this extends any more than 3 or 4 months. The next 3 or 4 months is going to be about domestic demand. This is another thing that the industry is asking for. If the stuff that was perhaps going to be exported now can be sold into Indian retail stores. That conversation, we understand, is going on right now. A lot of labor in any case had shifted to lab-grown diamonds, but that also is looking at a tariff impact at this point in time. The other important area to look at is SEEPs, where Mumbai hosts 200 exporting units and employs 50,000 people. We also do understand from the gem and jewelry segment that they are in conversation with chief ministers of UP, Gujarat and Maharashtra. This is where you have major employees coming in for or units being set up as well. So in case if that can be really worked on and the losses in sense of EMIs, etc., that these employees are paying can be taken use of. So that's about gem and jewelry sector. But $10 billion worth of exports is what India also does from textile industry in the US. FY25 did show those kind of numbers there. So when you look at the total overall exports, $37 billion is what we did, and $100 billion is a target for 2030. That industry feels perhaps is not going to be get fulfilled. That really is the number, because, you know, when you look at woven apparels or textiles, there are different tariffs already there. So this is going to be in addition to 50%. So when you look at knitted, it's perhaps going to attract 64%, and woven could be looking at 60%. So when it comes to tariffs, India does stand to lose with its peers, which is Bangladesh, Vietnam, Pakistan, Turkey for that matter. So these are dire sectors, these two of them, gems and jewelry and textile, where there is an expectation that the government perhaps will do some hand-holding, whether it is about working capital or it is about job losses, because these are very labor-intensive sectors as well. So with 50% staring in face now, there are a lot of expectations coming in from the government.
All right, those are very high numbers. One just hopes that they don't last for very long and they are negotiated lower. Manisha, thank you very much for that detailed explanation. Time for a quick commercial break here. We're going to come back. It's the economy with Lata. She'll talk about the impact of exactly the tariffs on Indian goods exports to the US. Santanu Sengupta of Goldman Sachs and Saumyakanti Ghosh of SBI join her for that discussion. Stay tuned.
Happy Ganesh Chaturthi to everyone. The mighty Lord Vignaharta is the destroyer of obstacles. And at the moment, India is facing a rather big obstacle in the form of the 50% tariffs. Well, let me start with the good news. Some goods like pharmaceuticals, autos, auto parts and metals like iron, steel, aluminium and copper continue to attract 25% tariffs. The Global Trade and Research Institute, or GTRI, calculates that out of India's $86.5 billion exports to the US last year, $60.2 billion of exports are going to face the 50% tariff. Now, of course, what can be the impact of the possible loss of markets on India's GDP? Most economists assess the impact to be about 1%, but with only half the year left, the impact is probably 0.5%, but there are other countervailing issues like the GST cut. These are all rough estimates. To understand the macros, the macro implications, I'm joined by two stalwart economists, Soumya Kanti Ghosh of State Bank of India, also the economist for the Finance Commission, and Shantanu Sengupta, the economist from Goldman Sachs India. Gentlemen, good morning and thank you very much for joining us. Soumya, to you first. What should we assess? We are going to get one GDP number on Friday, but nearly 6 months of the year is left. What can be the impact?
Oh, thank you, Lata. I think there are two things to this. Yeah. And the first quarter GDP number on I think this Friday and the overall GDP estimates, I think there could be two different narratives. The first quarter GDP number will be quite strong, but look into the nominal GDP numbers because that will give an indication of how the economy is doing in terms of an declining domestic demand. So our sense is that the real and the nominal are likely to converge significantly in the first quarter. So, but the good news from that is that while the numbers of real GDP will be strong enough, the overall for the full year, that may cushion the impact of a fall in the second half because of the tariff impact. Now coming to the downside, I think with the US tariff now kicking in from today, and India, as you know, has an export surplus to US of around 45 to 46 billion. Overall exports is around, I think, 86 to 87 billion. Yes. So even if 50% of that is supposed subjected to tariff, there are varying estimates, but I take the ballpark estimate of 50%, which is closer to our estimates. That means the trade surplus which we had with the US will be eliminated over a full year. But given the fact that if you actually look into the exports to India, USA in April and May this year, that has been actually grown faster than last year because of front loading. And this could have continued till August, I think till the mid of August, when the exporters were actually exporting to take advantage of this, not for the tariff to take impact. So overall, I think there will be, of course, an impact, but there are many ponderables, moving ponderables. Hopefully, if we get a trade deal when there is a visit by the Honorable Prime Minister at the end of September to US, I think that will be good enough. But in our sense, there will be, of course, some impact on the GDP. How far that is cushioned by the cut in GST, that remains something which we need to explore.
Okay. Well, I know for everyone, this is too many moving parts and work in progress. But Shantanu, the average I got from my poll, which I did for the Friday numbers, the average for the full year is coming at around 6.2, 6.3%. What kind of a further downside? Are we staring at sub 6%, assuming that we have to pay 50% for the remaining 6 months of the year?
Yeah, Lata, we are already at 6.1 for the fiscal year 26. Okay. We haven't baked in the incremental, which is going to come into effect from tonight. If the incremental comes in, or if on the initial part, our assumption was that the elasticity would be somewhere in the region of 0.5. It's also backed by some research at the sectoral level by the IMF in over the last decade. But if the incremental 25% is to come in on ballpark 60 to 65% of overall exports, it's very likely that the elasticity will be closer to 1 and not really 0.5. At 50% tariff, it is very difficult to export. And therefore, we think that some of these sectors like textiles, gems and jewelry, marine products, etc., will be quite impacted. So, the risk is that you have a number sub 6% for the fiscal year 26. Again, the big uncertainty is, as Soumya said, when this gets rolled back quickly. If you have a deal by the end of next month, this all could be rolled back quickly, and therefore you can again have a growth upside. But as of now, if this stays, just the first round arithmetic tells us that growth would go sub 6%.
Okay. Yeah, that is the fear. But Shaumya, obviously the government will try to do some hand-holding. Now, some of the things that the exporter organizations are asking is, the best they can get is the full 25% reimbursed to them for 1 year till they find, alternative markets. There are others who are asking for not the full 25%, but at least say 20% being reimbursed. There are yet others who are asking for, just interest mitigation through a CGT, MSC or some such package. So, first of all, should we be prepared for a higher fiscal deficit or a higher fiscal spend? Because it's a large number of employees, textiles plus gems and jewelry plus leather, plus shrimps.
I think as of now, I think fiscal deficit at 4.4%. I don't see any significant upside risks, although I think there will be clamor for more support to the exporters. I think the one way the government is already looking into cushioning the impact. I think one way the government could actually look is that, I think if you remember last year in December 2024, the export credit, the interest subvention scheme was discontinued. So one way is to bring it back and only for a limited period to the sectors which are impacted, specifically the textiles, gems and jewelry, marine products and others. So that is one way of looking into the thing. The other way actually just to ride over the current storm and see how the impact plays out. I think the government is also trying to assess the situation to see whether we are able to strike a trade deal. Maybe later now, not sooner, because it's already the end of August. So even if you're able to strike a trade deal, maybe by the end of September with some giveaways here and there, I think that's the idea which is going on in the government mind. So in my sense, I think maybe for the next couple of fortnights, the government will actually wait and watch to see how the things are spanning out. And then it will announce the impact. And then it could announce a package. Regarding the impact on fiscal, we are open that the fiscal deficit, which is a 4.4%, even if it slips by a 5 to 10 basis point impact, which is possible given the GST implementation, but also that could be offset by higher consumption. I think that is still better than taking a GDP hit of larger GDP hit over the next year or so. As of now, I think again the impact on GDP will be significantly uncertain. We have already been around 20 to 30 basis point impact, but this 50% tariff could actually hurt the GDP a little more if it continues.
Okay, the impact on bonds is at the moment 6.61 is the 10-year. Remember, the 10-year end May was 6.17. There are other reasons why, of course, the yields have gone up, simply because everyone is staring at the end of the rate cutting cycle. But Shantanu, what kind of a fiscal impact? You're not looking at a package. You don't think the yields are reflecting the fear of higher fiscal spend and maybe lower fiscal earnings as well?
I would say, Lata, that there are risks to the fiscal deficit from multiple factors. By our estimate, the income tax cut of 30 basis points of relief for the consumer was not really fully budgeted for when the budget was announced. The budget announcement was about 10 basis points of GDP higher for the income tax collection, which would have assumed then job growth or something like that, which we don't think is really happening. Second, nominal GDP growth, Shaumya made this point earlier, nominal GDP growth will be lower. And three, now you have the question that you're asking, which is these sectors, mostly MSMEs, will need some form of support. Now, the support can be through a direct subsidy, in which case it is a direct hit to the fiscal for this year, or it could be through what you saw during the pandemic, maybe a credit line or something on those lines. So it depends on at what point of time you take the hit and through what instrument. But I would say that already that is reflecting, as you correctly pointed out, in the back end of the yield curve where yields have backed up. So the market is, I would think that the market is aware of the fact that some of the fiscal risks are brewing because of not just the tariff, but also nominal GDP growth being lower and the income tax cuts.
Yeah, and the dollar is more expensive by 20 pice overnight and about 50 pice if you take last 48 hours. Shaumya, are we going to stare at 88 very soon?
Yeah, just one point, Lata, I want to mention. I think the feeling in the markets is that the impact on the states could be even more than the centers. That's why I think, as you know, the SDL, I think there's significant upside, the borrowing SDL estimates. And in fact, I think as of now, we are holding our gun and we believe that things could actually get better before it gets worse. But our sense is that there will be an impact on GDP by around, say, 20 to 30 basis point as of now. But beyond that, to speak about an impact when we are actually getting back to an era of protectionism of 1980s, what used to happen in 1980s, that infant industry argument, I think is very difficult to say at this point of time what was the overall picture. But as of now, there are, of course, the downsides could outweigh the upsides to some extent.
Well, truly spoken like a Finance Commission member that the states are going to be impacted more and the SDL yields have risen. Gentlemen, completely out of time, but I will invite you all for a more thorough discussion when, things get clear a bit. Also, Shantanu, apologies that we couldn't discuss your excellent report on financial savings, which states that India is probably staring at about a 13% of household financial savings from the current 11% odd. And that will mean some, $10 billion flowing into financial assets over the next 10 years. We will discuss those reports at a time which is more opportune. Thank you very much, Shaumya and Shantanu. Wrap up on Bazaar. Chart Past is coming up.
US President Donald Trump passes an executive order to impose 50% tariff on Indian goods effective tomorrow. The Nifty opens with a gap down, giving up 24,800 as well as most sectors trade with losses. Pharma stocks the worst hit on fears of higher tariffs.
Sun Pharma is the top loser on the Nifty as Bufa Securities cuts its target to 1,570 rupees. A share on expensive valuation is what it highlights. Zydus Life also trades with cuts as Investec issues a sell rating with a target of 940 rupees a share.
Ola Electric surges as it obtains a PLI certification for its Gen 3 scooter range, making it eligible for incentives for 13 to 18% of its sales value. The stock surges 4%.
Protein Eagle secures a 1,160 crore rupees order from UIDAI as well as BLS International also wins an order worth over 2,000 crore rupees from UIDAI. Both stocks surge and trade on the back of order wins.
And Vodafone Idea slumps as the government refutes news reports that telco could receive some relief on the AGR dues. The stock now down by 10%. You're watching us here on Chartbusters. I'm Mangalam Malu. With me, Vinny Motiwala. We come to you from the CNBC-TV18 Motilal Oswal studio on a day where the markets are actually selling off. We have the Nifty sub that 24,800 mark. The Sensex not doing too well, led lower by a cross section of all the sectors, right from the Nifty Bank and some of the frontline indices. So what we'll do is we'll get tracking on the markets, but meanwhile we do have Vikram Solar, one of India's largest photovoltaic module manufacturers, saw subdued debut on D Street in line with the market, minor gains to its issue price, which is still an outperformance given the market mood. But the question is, where does it go from here? Currently holding nearly 10% up from its issue price. We do have Chairman and Managing Director Gyanesh Chaudhary joining in to discuss the company's post-listing strategy. Thanks a lot, Mr. Chaudhary, for joining in. Congratulations on the listing. It's a near double-digit listing on what has been a subdued market day. So the street believes that there is growth potential. So let's put numbers to that growth potential. You know, you've earlier said that your current capacity is 4.5 gigawatts. Stated objective is to take to 7.5 gigawatts by FY27. By the end of FY26 itself, it'll be 6.5 gigawatts of capacity. So in line of that, what are the kind of revenue and EBITDA growth projections that you have for the next couple of years? If you could give us a sense.
Our revenue and EBITDA growth are well in line with our overall capacity expansion. What our numbers project is the fact that with a 15.5 gigawatt of capacity addition that we're doing overall in this current fiscal will lead to a phenomenal jump in our overall revenue, along with cell capacities coming in next year. So we are very excited about the kind of market share that we currently have, and our order books speak very loudly of it.
Right, Mr. Chaudhary, you know, if you could give us some numbers, right? So last couple of years, you've managed to see a growth of in the range of 20 to 35%. Is that something that we'll see, 35% growth in FY26, FY27? Is that what we're anticipating? And also in terms of margins, you know, where would that stand at? 14, 15%, is that a range we could be watching out for?
So the revenue growth will be in line with what you just said, 30 to 35%, given the additional capacity that we are looking at adding. As far as EBITDA is concerned, we will maintain the healthy EBITDA levels that we have maintained so far, given the fact that the order books are there. Next year, we look at improving the EBITDA marginally, considering that we will have our cell capacities in line.
Okay, also, you know, if you could tell us about, in terms of your impact that comes in of what the government has imposed in terms of that domestic ALMM, right? So what does it mean for players like you? How do you stand to gain from this as well?
So the government has already imposed the ALMM List 1, which has been in play for the last couple of years. What that has done is deterred any unqualified Chinese products to be dumped into the domestic market, while domestic capacities have been able to cater to this market very effectively. As far as the ALMM list 2 is concerned, which is expected sometime middle or end of next year, this will provide a level playing field for cell manufacturers who are also module manufacturers like us for domestic content based products. So further expanding the domestic manufacturers' reach and network.
Right. If you could give us a sense on the latest technology which is available. You said the overall percentage of high quality latest technology is just 20% of your total capacity. Going forward, how much higher do you think can this be as a proportion of the overall market? And what is the marginal differential between this one and the others? Because I suppose latest technology would imply lower costs and better output, which would be an operational improvement for you, right?
Absolutely, Mangalam. The play of technology is very, very important in this sector. We started 20 years ago with a 200-watt solar panel, which is now in excess of 600 watt, which is 3x given the same form factor. So the idea is to get more bang out of your buck because you have limited area to consume and limited space to deploy the solar panels in. As far as the technology is concerned, the current front-running technology is TOPCon technology, which occupies more than 80% of the market share for us. We are primarily producing TOPCon products today, while we have in our stable an HJT, a G12 and other technologies, which will going forward become more desirable. But today, given the levelized cost of energy that an IPP desires to achieve, TOPCon achieves significant improvements.
Mr. Chaudhary, if you could just highlight in terms of what is the current pricing trend that we're seeing in India? Any indication, especially for cells, modules, analytic indication that comes in there? And, some analysts have highlighted that maybe there was a bit of a supply glut that came in as well. Is that the case? If you could give us any signs on that front.
Absolutely. As far as the supply-demand situation is concerned, we've always seen, while there is a lot of capacity that could be available, but they're all different generations in terms of technologies. So while, as I said, an IPP would want the highest efficiency product so that they can put a 1 megawatt solar plant in a 3 or 3.5 acres rather than a low efficiency product which would take up 5 acres. And you can very well understand that with this additional land that is required, there is additional balance of system, so the levelized cost of energy goes up. So it's always important to use the highest efficiency product and to ensure that it penetrates the market adequately.
All right. And finally, on the movement beyond cells and modules, if you could give us a sense on what are the pricing trends for both cells, modules? Analysts are saying that there could be a bit of a supply glut, which may have an impact on your margins going forward.
So, because technology plays prime role in this, there are, if you look at the overall capacity, there is a certain utilization which is far below the nameplate capacity, and from there we come to the technology piece, which is another, 50% basis points. So, as far as TOPCon capacity is concerned, there is a limited number of manufacturers who are able to achieve highest efficiency TOPCon, which is the most desirable. And Vikram is one of the prominent players in the TOPCon space, and our order book says that there's adequate demand for us. So there is in this big market, we are gunning for the big spot with the highest efficiency product. So we feel that there is always an opportunity for manufacturers like us and customers to collaborate to come up with large projects effectively.
All right, we take that point. Thank you so much for joining in. Once again, good luck on your listed market journey. We will keep speaking to you post your quarterly numbers to get a better sense on where you are on that journey that you have shared with us. 25 to 30% growth is acceptable for you, is actually possible with the margins staying at current levels. Take a short break, come back on the other side. We'll get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back to Chartbusters on CNBC-TV18. A quick check on the market, right? After that gap down start, we're seeing that the market is holding on to 24,750. About that mark is where it's managing to trade at. Advance decline ratio clearly in the favor of declines versus advances, and that is why we're seeing a sharper fall coming in the broader end of the market. So Nifty mid cap, small cap also clearly under pressure. Most of the sectors are trading in the red, except some bit of a respite coming in on that Nifty FMCG side. We're seeing some bit of a gainers and green for some of the names over there. But let's also welcome on board Somil Mehta of Mirai Asset Share Khan for a technical check on the market. Somil, good morning. Thanks so much for joining us on the show. What are we watching out for? Now, obviously, today what we're seeing coming in is mainly as a move because the tariff announcement that was there, that 50% tariff, that comes into play, right? And we're seeing the fall coming in for the market. Now, what are the important levels on the downside that we should be keeping an eye out on for the Nifty as well as the Nifty Bank?
Hi, good morning. Good morning, Winnie. Markets have been sliding down. It has started, closing below 40 daily moving average today. And we are very close to 20 daily moving average, which is very crucial. Now, 24,700, 24,600 levels where there is a gap, those levels are extremely important, very crucial now from these levels. If it closes below these levels, let's say 24,600, then we are sliding to 200 daily exponential moving average, which is 24,260 levels. So these are some very crucial levels on the downside. However, what I feel is that markets will take support. Nifty very specifically should take support around these levels, 24,700, 24,600, and again start the bounce back towards 25,000, 25,200 levels. We may just say we may just stay around these levels, but looking positive in the short term and in the medium term outlook. So it should be more stock specific and more sector specific approach. Bank Nifty, on the other hand, has already cracked some very important levels on the downside, and I'm expecting 53,800 levels, which is the 38% retracement of the entire rally which we saw in the last 4 to 5 months since March, April levels. So I think that level, 53,800 would be very crucial and very close now. Only 600, 700 points left in Bank Nifty. So that will be a little crucial, and 100 points stop loss for Nifty. And I'll be expecting Nifty to be around 25,000 level itself.
And individual stocks, what do you have your trades on today?
I'm expecting IT, auto, these two sectors to perform well. So I have Bajaj Auto on my list. Bajaj Auto has broken out of a good consolidation and has a very huge inverted head and shoulder pattern. So I'm expecting a good rally on the upside. Stop loss would be 8630. Targets would be 9150 for Bajaj Auto. This stock can be a positional call as well. TCS is my preferred pick from the IT sector. Short-term bounce is expected. This stock has broken out of an ending diagonal pattern, and I'm expecting a good rally here. Stop loss would be 3090, and the targets would be 3300.
Okay, keeping an eye out on those stocks as well. So, Amal, thanks so much for joining us as always and giving us your insight in terms of markets as well as individual stocks. But on that note, let's shift focus to a special segment where we get you all a few ideas of profit from a Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk to us about the stock he's tracking closely today. Sachin?
Bias Cables company RR Cable delivered a very strong set of numbers in the first quarter of FY26, driven by a strong revenue growth of almost 13% year-on-year. The operating margins of the company also expanded by almost 170 basis points from a favorable base and reached around 7% in the quarter gone by, which resulted in the operating profits growing by almost 50% year-on-year. The top line growth of the company was primarily driven by a very strong volume growth in the core business of the company, which is the wires and big cables business. However, the company witnessed some challenges in the FMEG business, which is challenging to scale up, primarily due to the early arrival of the monsoon season, which really had drag on the overall sales of the summer-focused products. Nonetheless, the company aspires to grow its overall portfolio by 15 to 18% on a YoY basis for the next 3 to 4 years, and has also outlined a capex of almost 1,500 crores to be able to expand its wires and cable capacity by almost 70% by the end of FY28. Overall demand environment in the power and transmission space continues to remain very strong, primarily aided by government spending in the sector. That said, the company trades at around 35 times FY26 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, before we slip into a short break, just keep an eye out on the market. The Nifty is now down 200 points, more than twice of what it gained in yesterday's session. And actually, it is the entire gains of August series so far as well. At the low point of trade was actually at the high point is the India VIX. So as we slip into that short break, the intraday chart of the volatility index comes up for you. And we've seen a sharp gash on the frontline index, which is reflecting in the increase that we've seen in volatility as well. We'll focus on the markets and stock-specific action on the other side of this break. Welcome back. Weakness continues to the market. No two ways about it. Pull up Avenue Supermarts. That stock opened fairly higher. There was a positive note that came in from CLSA as well. And now as we speak, it's actually given up all those gains, moved into the red. And similar is the case for a lot of the other stocks as well, which were earlier holding up and now at the low point of trade. Case in point, PG Electroplast exited FNO band today, is now down about 5%. In fact, this month, the stock is down about 30%. And we have Page Industries as well. Page Industries has moved to the low point of trade after being at higher levels, mildly in the green earlier, and now has moved back into the red as well. We do have a bunch of other stocks on our radar. Vodafone Idea is case in point at the low point of trade for that counter as well, after the Minister of State for Telecom has said that the government has done all of it can do to help Vodafone Idea, speaking to Ashmit Kumar. And he did rule out any further measures, saying nothing is in the works.
Whatever we could do, we have already converted into equity. Right now, our focus is to how to rebuild BSNL. So make the BSNL. You know, Vodafone is up to their management. They are all business people. They know how to manage. It's up to them how they want to take it forward. From the government side, there is nothing that's being discussed at this time.
Okay, now let's move on and talk about Ola Electric. The two-wheeler EV maker has extended gains on the back of the news that came in, that PLI certification for its Gen 3 scooter portfolio. Let's go across to Sudarshan, who is joining with us to give us details on this one. Sudarshan, good morning. And Ola today surely buzzing in trade.
So in a weak session, Ola Electric is higher. It has moved higher up to 5% after the company has announced that it has secured PLI certification for its Gen 3 scooters. It had already PLI certification for Gen 2 scooters. Now, Gen 3 scooters PLI certification is important because it forms almost 56% of its total volumes. Now, this certification will allow company company will be eligible for incentives, and that would be in the range of 13 to 18% of the total sales value that company generates from the sale of the products. Now, how will this help positively? So if you remember, after Q1 earnings, company had told that from Q2 profit is going to improve, and also auto business EBITDA will turn positive in Q2, and in FY26 company is targeting auto EBITDA business of 5% or more. Now it's saying this after this PLI certification, profit in Q2 is going to move higher further. So we'll have to see how the Q2 earnings pan out. But for now, stock is up almost 4% on the back of this news.
All right, that's Ola Electric having been doing well over the last few trading sessions itself among a bigger gainer, and then now it's got the PLI Phillip, which has taken the stock higher by about another 4%. With that, we'll wrap up on this edition of Chartbusters from Millie, me and the entire team that put this show together. Thank you so much for watching. Stay tuned. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia. With me is Sonal Bhutra. Sonal, good morning. The tariff deadline looming, but before that, festive greetings to you. Festive greetings to all of our viewers as well. And the bulls would be hoping that Lord Ganesha could, as they call it, Vignaharta. So you'd hope that their pains are alleviated for sure, at least for today's session, definitely.
Oh yes, but you know, if we talk about the markets, let's get to that, because yesterday we did see those gains come by 100 points in the Nifty, but all of it, they have been pared down today. So 170 point cut on the Nifty is what we are witnessing right now. It is at the 24,800 mark. 25,000 continues to be that important level which has been resisted so far. If we talk about mid caps, that's the one which is underperforming, 1% lower on that one. Bank Nifty too not supporting the index today, so that's where we are seeing a lot of cuts as well. Across the board, be it Nifty Realty, be it Nifty Pharma, be it Small Cap Index, all these indices are lower in trade as we speak. In fact, all the sectoral indices, barring FMCG, are in the red currently. There was a little bit of recovery from the lows on the Nifty as well, but it's important to be seen whether this continues or not. Tomorrow is a trading holiday and the tariffs kick in as well from tomorrow. The expectation was maybe there could be some more negotiations and this would be a different rate, but that's clearly not something that's happening. So the entire market, which was in wait and watch mode, reacting to this news of these tariffs coming into being from tomorrow. But we are talking about markets right now. We have to talk about individual names as well. Hormuz has gone across to that big wall and we'll be talking about all the top movers in the market right now. Hormuz, tell us more.
Some obvious names here and some not so. And Protean eGov, of course, the news-driven move that we are seeing in today's session, of course, after that win from the UIDAI. Now, the volumes today, now 3 of the most traded volume days on record for this stock have taken place since May. So in the last 4 months, we've seen 3 of the most heavy volume traded days for Protean. And even in today's session, almost 80 lakh shares of the company have already changed hands in today's session compared to a 20-day average of just close to 2 lakh shares. And this is almost well over 80% of last Thursday's volumes, which was around 95 lakh shares, is when the stock was up 15% in last Thursday's session. So 81% of last Thursday's volumes already done in the first 2 hours of the trading session. On the downside, of course, there is Vodafone Idea down 10%. It has already given up half of the 6-day move that it had seen when the stock had gained 20% in the last 6 sessions before today. And today the stock is down 10%. And today's volumes were 60 crore shares have already changed hands compared to a 20-day average of 11.6 crore. Remember, the last 2 sessions, the stock had already had 100 crore shares each trading in the last 2 sessions. And with this fall, the stock has already declined below its 50 and its 100-day moving average. A stock that is bucking the trend in the broader markets today is SH Kelkar, and among the top gainers in the broader markets today, 8.5% higher on the stock, the biggest single-day gain that the stock has seen since the month of May. And this stock has also gained in 5 out of the last 6 sessions, and it needs to move above the level of 246 in order to turn positive on a year-to-date basis, and that is SH Kelkar for you. And the last on the list, of course, is another obvious name, JK Paper, and seeing some profit booking today after it saw the biggest single day gain on record yesterday with that 18% up move. And in today's volumes as well, almost 20 lakh shares have already changed hands compared to its 20-day average of around 4 lakh shares. So even today, volumes are on the higher side. There is some profit booking taking place. But over the last 3 years, the stock has done precious little. From the end of 2023 till date, the returns for the stock are a negative 3.5%. So there are some movers, obvious ones on the upside, and there are some that are seeing some profit booking in today's session.
All right, that's an interesting list. And you spoke about JK Paper. That stock was buzzing. The entire paper sector was buzzing, in fact, yesterday. We'll speak to the management as well later in the day, but also get a sense of the industry as well. They were on a roll yesterday. Government tightened import conditions for certain paper and paperboard products. To discuss the impact and understand the development, we are now joined by Naveen Kumar, who's the Associate Associate Director, CareEdge Ratings, joining us now. Mr. Kumar, good morning. Thank you so much for joining in. Well, government has tightened import conditions for import of certain types of papers. There are concerns as well that some of these are sold below cost as well in the industry, and it is impacting the domestic industry. First up, if you can tell us which kind of papers are covered under this, and what kind of imports are we seeing so far? Is it that big that it would actually threaten the domestic industry?
Yeah. Thank you. See, first of all, I just thought of, presenting a little bit of, industry market on how actually the dynamics works out here. About 55% of the entire market comprises of the paper board. And this is a segment where actually the government has imposed a minimum import actually price. So what we see is that the last 2 years of trend I'm just explaining to you, the net sales realization for this paper board has come down from 79,500 rupees per metric ton to 66,300 rupees per metric ton. And in the Q1, if we see, it has come down further to 64,000 rupees per metric ton for the domestic market, for the domestic players. So whereas the one which we are seeing of the imports, it is further lower than that. So what is happening is that on the one side, actually last year we have seen a significant increase in the wood pulp prices, about 19%. And on the other side, that these realizations are coming, and it has significantly impacted the margins, where we see that the margins of across the industry has come down by about 500 basis points. Now, in order to protect the domestic manufacturers in the paper and the paperboard industry, the government has now introduced the minimum import price, and they marked it at 67,220 rupees. So now the current domestic sales price realization is about 64,000. So this particular gap which is there is actually, about 5% gap is going to get benefited by the domestic players. That is one part. And second part, what we are seeing is that now we are seeing that the wood pulp prices are moderating. The kind of an escalation in the wood prices which we have seen in FY25 in the Q1 and in the Q2, it has moderated to a significant extent. So both of these, to a great extent, are going to protect the margins of the industry. So overall, what we are going to see is that the margins for the entire industry is expected to grow by about 300 to 350 basis points. And now this is also, one more, concerning point which was there behind this minimum import, what's the price to be installed by the government is that if you see, like, in FY25, the total imports have increased across various countries by 11%. Whereas from China, it has increased in terms of the value by 24%, whereas in terms of volume, it has grown by 33%. So what we are seeing is that now year on year, these imports are consistently increasing, and it's significantly hurting the margins and also the operating performance of the domestic players. And this move by the government is very much welcomed, and we hope that it is going to give some kind of respite for the domestic paper manufacturers. So especially the board manufacturers are going to get benefited.
So can you share the names of the key players in this segment, particularly this virgin fiber paperboard business, Naveen, and what is their total TAM, if you could address that as well?
I'm extremely sorry. Actually, we actually remain ourselves, quiet when it comes to actually disclosing about the company details. However, we see that now about, if we see top 20 players, probably like, about 10 to 12 players are in the paperboard industry, whereas remaining 8 players are purely into paper. So the paperboard industries, or the companies which are in the paperboard, they are going to get benefited. Whereas the remaining companies, are going to get some kind of impact. But now when we see the moderation in terms of the raw material prices, it is going to benefit them also.
Okay. Just to follow up, Mr. Kumar, you mentioned that 55% of the total paper market is from the paperboard industry. Can you confirm that? So that's
Yes,
a big chunk
correct.
of the market which is going to get a big benefit then.
Correct. Yes.
Okay, all right. If you cannot name the players in the listed space or unlisted space, I just wanted to understand how big of the Indian manufacturers market is, what my colleague asked as well, in the paperboard industry, and what was the volume that we were importing so far? You mentioned China was higher. There was other places as well where we were importing from. If there is a number of how much imports we were doing of paperboard?
Yeah. So total in terms of the value, India was been exporting, like last year in FY25, India has exported 6,188 crores of the total amount, and out of it, the China itself was contributing 31%.
You know, Naveen, the industry is not out of the woods yet. You know, the first quarter also was nothing to write home about when it comes to the results of these paper companies. But with whatever you have highlighted so far and with these measures announced, do you see that the second half is going to be better? May not be this quarter itself because we are already almost coming to the end of this one as well. So we are 2/3 of the way in. But maybe from the second half of FY26, do you expect the tide to turn, if not materially, at least a slightly better performance compared to H1?
See, I would like to tell that now Q2 also we are going to see some kind of, uptick in the margins part. Why? Because when we see the wood pulp prices, which are the domestic wood pulp prices, which are there, they have remain stable. That's one good thing. Second thing is that the imported pulp, which is that is that has now come down by 9%. And whereas waste paper prices were there, they are also remain like same, maybe like 5%. It has increased. So overall, when we see these aspects, so on the other side, the domestic demand is also increasing because we see that growth in the FMCG segment, e-commerce segment, pharmacy, and all. So this is going to aid in terms of the volume part. So and this imposition part of the minimum import price is going to aid from the Q3 onwards. What you said is right, but Q2 also we are going to see some kind of uptick in terms of the margins.
All right, take that point, Mr. Kumar. Thank you so much for joining us and explaining to us the dynamics of the industry overall and how this minimum import price could impact the industry overall. So that's the word coming in from Care Edge. They say the industry will tend to benefit. Prices have fallen sharply, so there could be an improvement in margins. 5% benefit to the pricing overall for the domestic manufacturers right now. We'll slip into a short break. Up next, we'll put focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we have Mridul Gupta, who's founding partner at CoinDCX. Mridul, hi, thank you so much for joining us. And it's a growing number and a growing market when you look at cryptos. 2 crore plus is what you have on CoinDCX as a platform. How is that number growing? Is this a bull market or is this maturity finally coming here?
I think we are very far away from the bull market and the market's tapping out, Manisha, on this one. We see a lot of early signs of India rising. We see a lot of participation from tier 2, tier 3 cities in India. We see a lot of women participants now coming on the platform. We also see people's age shifting from roughly 25 years to 31 years average age on the platform. So these are all signs of market maturing, but we are still at 2 crore, market is 100 crore. We are still a very, very small portion of the portfolio of people. It's still not reached a place where people are talking about Bitcoin on their chai, right? So I think we are very, very far away from the market maturing. All of this feels like it is a bull market phenomena, but bull market happened a few months back. Market has been very stable after that. Sure. But we're continuing to see the market, the new participants coming into the CoinDCX platform and in the market at an increasing pace.
Mridul, as you mentioned, the overall portfolio of people investing into crypto has changed as well. It's not a retail FOMO anywhere because you have bigger participants, investors, even family houses, institutions coming into this space. Are you looking at a better diversification, one? And is there this whole comparison with equities and gold still continuing?
I think equities and gold comparison is going to happen. We have to live with it because if you look at Indian households, people have really, really invested in gold ever since they were young.
Thousands of years.
Right? And India continues to have that edge as the markets are continuing to rise in the gold ecosystem. Equities has been new and people end up invariably comparing equities to either gold or an FD, and we have not seen that comparison go over in the past 20-30 years. I don't see that comparison, and it's a healthy comparison. I actually like that comparison because if you look at gold, it's super low risk and the returns are in proportionate to the risk it carries. It's global. People are bought into a vision of gold being a safe haven. If you look at equities, equities has multiple risks attached to it. It is a country risk, it is the company risk, it is the consumption risk. And because of that, it's slightly higher risk profile, but slightly higher return profile as well. When you look at Bitcoin, the nature is completely different. It's more global, it's scarce. So the thesis is that of digital gold, that over the next 10 to 15 years, the market cap will grow as much as the gold's market cap. And hence, the risk profile changes completely. I think it's a very unique opportunity to participate in an asset class which could be like a gold asset class, but right now it's so infant that it's volatile. So what I urge people typically is that you compare the three asset class, but you don't get into crypto for a short-term view. Okay. You get into crypto with a more long-term view after doing all the comparisons, because in a longer-term view, the risk goes away, the returns stay, right? So that's I think the only short line description for this.
Sure. You know, January 2024 is when it all began, Mridul. We saw the ETFs come in, the best ETF launch ever in the global markets when you compare it to traditional asset classes. And then 2025 brought about this whole new surge of real world asset tokenization. Between the two of this, where does India stand?
I think India is, to be really honest, India I think is lagging behind in terms of crypto evolution, adoption and innovation. We have seen a lot of participants coming into crypto, but we have not seen major capital come into crypto yet or major talent come into crypto yet. Now, if I go back to those two events, 2024 was a big event because ETFs launching, the Bitcoin ETF becoming the single largest, fastest growing ETF, and multiple corporates and multiple financial institutions adopting it. They were all very, very positive signs for Bitcoin in the US, in Europe, in Southeast Asia, which triggered some kind of a mini activity around bull run. We saw the market speaking later then, and with especially Trump winning, the market peaked even more. So if I compare that to what's happening in India, India is looking at it with a slightly, opinionated view. Is it good? Is it bad? That discussion is still going on. While in the rest of the world, the discussions have moved from is it good, is it bad, to what more can it do for me, right? Can it be a store of value? Yes. Can it help me do transaction processing better? Yes. Can it help me build financial markets better? Yes, right? So if we see action in Dubai, where 30% people own some kind of crypto, the market is moving to actual transactions happening in crypto. Sure. If we see US, the money markets are being built on crypto. So I think India is slightly lagging behind. We hope India will, leapfrog this and do better. But right now it is slightly lagging behind. When it comes to real world assets though, I think customers are ready, supply is not ready. So customers are ready because we see a huge adoption of stable coins in India. But supply is not ready because there is no compliant or a regulated framework around digitizing real world assets, putting it on chain and putting the governance right. So I think it's more of an industry problem than the customer problem. India is definitely ready for RWAs.
From for it being legal to trade but not regulated, the markets think that it's a very thin line there. How, as an exchange, or your conversations with regulators or your conversations with associations, how are you really dealing around with it at this point?
That's a good point. I end up telling so many people even now that it's legal.
It's legal, yeah.
But it's not regulated, and there's a difference. And I think the common janta, the common man in India does not understand the technicality. Legal, regulation, all of it is the same thing for him. So,
are we looking at a new regulator for this, by the way? I mean, that's a conversation that also is ongoing.
So I think if you look at crypto, it's a technology, and there hasn't been, and there are multiple implications of the technology. There's a financial implication, there's a trading implication, and then there's an innovation side, new use cases coming up on the implication. So we believe as an industry that existing regulators cannot regulate crypto because it falls outside their, some of the use cases falls outside their regime. So we believe that there will be a cross-coordination body or a cross-coordinated regulator which will have to create the guardrails around the industry. And then depending on the use cases, as the use cases go deeper, maybe it falls under the kitty of an RBI or a SEBI or someone else. But the cross-coordination and the guardrails has to be done by an independent party versus it fitting into the criteria of the existing regulators.
Oh, well, yes. And as somebody mentioned recently, that you can make a rule or a regulation and then keep defining it or redefining it, refining it perhaps as well as we move forward from there. Mridul, as always, thank you so much for coming by into our studios. And that's all the time that we have on this edition of Crypto Corner.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Now, on the second day of his visit to his home state of Gujarat, the Prime Minister Narendra Modi today inaugurates two major projects at the Suzuki Motor Plant in Hansalpur. Now, this includes the inauguration and the flag off of the e-Vitara, which is Suzuki's first global strategic battery electric vehicle. The Made in India battery electric vehicles will be exported to more than 100 countries, including advanced markets such as Europe and Japan.
Okay, all right. That's the big update. Of course, we'll keep getting you visuals from that visit. But for now, let's quickly take a look at the markets again. We have seen some recovery from the lows. The Nifty is at 24,814. But yes, it's the mid-cap side of things which are not doing so well. So the advanced decline ratio is in favor of the declines, 1:2. That's the ratio that we are working with currently. Let's talk about some stocks as well, which are in focus. Sai Life Sciences, after that block deal, that stock is down around 5% as we speak. We do have Easy Trip Planners, which is down around 2%. Vodafone Idea on the commentary coming in from the government that there'll be no further support for the company overall. That stock is down around 9%. Remember, the stock was up around 7% yesterday. Day before yesterday as well, we saw a big surge on that name. So that stock is down 10% as we speak. But we do have an important story that we need to talk about. Sources tell CNBC-TV18 that Bajaj Alliance will be meeting Association of Healthcare Providers India tomorrow. There's the issue of revocation of cashless treatment. Yash is joining us with more details on this. Yash?
Well, that's correct. So, of course, the matter still stands, undecided in terms of what's going to be the final outcome. As far as that conversation itself is concerned, AHPI, which is Association of Healthcare Providers India, threatening revocation of cashless facility for customers of Bajaj Allianz Life. They've even written a letter when it comes to care health insurance, warning them on similar lines and taking similar action. But there could be a big breakthrough on this particular matter. What we've been given to understand from our sources is that representatives of Bajaj Allianz General Insurance as well as AHPI are expected to meet tomorrow to discuss the issues which AHPI has highlighted and somewhere try to find a middle ground and resolve those issues so that cashless facility can be introduced again and that revocation could be withdrawn as far as Bajaj Allianz customers are concerned. But there's a flip side to this as well, what we've been given to understand. If the matter does not get resolved in tomorrow's meeting, AHPI is talking about some serious actions which they could take as far as insurance companies itself are concerned. What sources tell us is that AHPI may look to seek CCI, or Competition Commission of India, investigation against general as well as health insurance companies for alleged cartelization. The allegation from AHPI is that insurers, both general and health, are enforcing fixed tariff model, which is a violation of competition rules. They are saying that, they're being threatened on delisting from common empanelment and punitive action by the insurance companies which are entering into a cartelization model. They've also sought the insurance regulator IRDA's intervention for, putting a punitive action on insurance which enter into a cartel-like behavior and misuse the dominant position. So a lot depends as far as tomorrow's meeting between the two parties is concerned. A resolution could lead to revocation of or withdrawal of that revocation of cashless facility. But if not, there could be more action coming from AHPI is what we've been given to understand from our sources.
Indeed, Yash, thank you for that update. By the way, the recovery continues on the index, now almost 70 plus points higher from the lows of the day of 24,755. We are now at 24,830 on the index and predominantly led by the FMCG names, be it HUL, be it Britannia and be it Maruti as well, which are now moving higher. The FMCG index at the highs of the day, as is HUL and as is Britannia, now almost 3% higher on that stock. Take a short break. On the other side, we put the focus on our big story on the other side. Stay tuned, we'll be right back.
Welcome back. You're still tuned into Trading Hour. Well, the big story today has to be the tariff regime which has kicked in, and they're set to kick in from tomorrow. Let's go across to our colleague Parikshit. He'll get us a quick recap of the development that has taken place. Parikshit?
Well, indeed, a setback for India, so to say. Till now, negotiations were on to avert that 25% additional penalty, and those negotiations are still underway. In fact, all efforts are being made to get a pause on these tariffs. Now, what happens immediately? The US has issued a notification essentially for importers to know that these will be the tariff lines that will be effective from 12:01 a.m. 27th of August, which is 9:30 a.m. India time on Wednesday. So that's when the tariffs kick in. It will be a 50% tariff, that is 25% reciprocal tariff that came into effect on the 1st of August, and also the 25% additional penalty that was announced. So it's a 50% tariff on Indian goods. What does it really impact? Well, $48.2 billion worth of India's merchandise exports to the US will be subject to the 50% tariffs. And many analysts have said that this is almost like a blockade, and this will stop the export of these items to the US. Which sectors will be the most impacted? Textiles, footwear, leather goods, labor-intensive goods exports to the US will be most impacted in the months to come. But a lot of the exporters have already sent a lot of consignments, huge quantities of consignments, anticipating these high tariffs. So possibly they'll have a cushion for the next few months at least. Having said that, goods already subjected to Section 232 tariffs, that is 50% tariffs on steel and aluminium, 25% tariffs on automobiles, that stays, and that is not impacted by the reciprocal or the additional penalty tariff. So that remains as it is at 25%. Then you also have certain exemptions such as iPhones, copper, pharmaceuticals, semiconductors, timber, energy products and minerals. There is no change in tariffs on this, either in the form of reciprocal tariffs or additional penalties. These are products that will continue to be tariffed at the rates that were being tariffed before any kind of reciprocal announcement happened in April this year.
Parikshit, thank you for that update, but also tell us more on the details on what is the latest with regards to the negotiations front, because they were supposed to take place this week. That has not transpired. So what are you picking up on that front?
Yes, the trade negotiators are not coming to India. Those formal talks are not being pursued, but we're given to understand that trade negotiators, officials from across the government are in touch with officials in the White House almost on a daily basis. Efforts are being made to avert this 25% additional penalty and find a way out, have some sort of understanding and deal with the United States. In fact, an important point, in the run-up to August 27 deadline, industry bodies in the US have written to the White House seeking a 90-day pause on this additional tariff so that there is room for negotiation between India and the US. They've also said that US should understand the amount of energy, oil and gas that India is buying from the US, and this is only going to increase further. Having said that, the government here, according to sources, is reiterating that we'll continue to protect interests of our farmers, MSMEs, workers, entrepreneurs, and we'll do whatever it takes to work in national interest. The government will continue to take steps necessary to mitigate the impact on trade through export promotion schemes and also trade diversification measures. The External Affairs Minister has said recently that the arguments used to target India are not being used against China. The External Affairs Minister also said that the US additional tariffs on India are unjustified and unreasonable, and India is sticking to this stand. In fact, the Indian envoy to Russia said that we will buy oil from wherever we get the best price. So this seems to be India's stand. We're told that the government is not looking at retaliation. The effort would be to try and resolve the situation at the earliest, get a reprieve from India, get a pause on these additional penalty tariffs.
All right. Thank you so much for all those details, Parikshit. In fact, let's listen into what Mark Mobius, chairman of Emerging Opportunities Fund, had to say on the US tariffs that come into effect from tomorrow and get his outlook on the Indian markets.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the US. The garment industry, of course, will be hurt because a big portion of their exports go to the US. Jewelry, gems, that sort of thing will be hurt. So those are the three industries I would say which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous.
All right, so it'll not be that big an impact that the industry is thinking, but yes, there could be some impact because of that 50% tariffs that has kicked in. To take this discussion forward, we are now joined by Rohit Sadaka, who is the Director, India Ratings and Research, and also Prerna Jhunjhunwala, who is the Vice President, Equity Research at Elara Capital, to understand the sectors which would be impacted by this tariff number that has kicked in from tomorrow. Rohit and Prerna, thank you so much for joining in. Rohit, let me come to you first up. First, was there an expectation that negotiations could yield a lower tariff? And secondly, if not, which are the major sectors which would be impacted? And what kind of demand hit are we already seeing? Or what is the ground reality with some of these sectors when it comes to the demand impact?
Yeah, actually, with this 25% additional tariff, there will be impact on some of the sectors, definitely like gems and jewelry. Textile would be the other sector which will get impacted, because India, if you look at the overall export of textile from India, it would be around 28% of the textile export is to US, which forms a very big market for Indian textile players. So that would be one of the key sectors which will get impacted. And the other competing nation like maybe China, Vietnam, Bangladesh, Sri Lanka, Cambodia, they have a lower tariff. So in that case, India's import would be costly for the US market. So that will have some impact, and overall inflation increase in US can also lead to some slowdown in the orders.
Let's also bring in Prerna into this conversation. Prerna, good morning. Thank you for joining in. You would have spoken to a lot of these corporates that are having exposure to the US markets and their preparation with regards to these tariffs. Now with 25% already in place, another 25% kicks in as well. We've spoken to the management earlier of companies like Bharat Forge as well, and they had mentioned that at 50% you may as well not be in business, is what Baba Kalyani had mentioned to us. But what are your on-ground channel checks suggesting with regards to what is the feedback that you're hearing from companies with regards to these tariffs and the way to navigate these?
So the companies negotiating with the retailers and the brands to in the form of 20% tariff only. Everyone in the supply chain, including buyers, were hopeful that this additional 25% tax rate would be avoided, and eventually only 25% tariff would remain. But now that additional 25% tariff comes into effect from tomorrow, we foresee that there will be a significant market share loss in the interim till this additional 25% share is revoked by the US. Because this is a very high tariff rate for sectors which are not into very high value addition, plus high technology involvement is not there. So it is the cost of switching over to other countries is not very high, and that is the reason that these textiles and garments will definitely face some pressure for volume loss in the near term. To mitigate this risk on an annual basis, the companies were negotiating with buyers to ship higher volume before this additional 25% tariff is being implemented. So we will see higher volumes going out in Q2 for most of the companies, while the margins would remain under pressure because we have higher tariffs as compared to other competing countries. So negative for companies who are exporting to US and having high exposure to US.
Which are those companies, Prerna? Can you list that for us? Let's get a little stock specific. Which are the names which would be impacted the most and the exposure that they have to the US in percentage terms?
Yeah, so Welspun Living around 60% exposure to US, Indocount around 70% exposure to US, Gokaldas exposed around 70% exposure to US, Pearl Global approximately 60% exposure to US landing products into the US. So these four companies at the forefront are having very high exposure to the US. As otherwise also companies exporting to US around 50%. For example, Arvind at 35% exposure to US will be negatively impacted because of either margin pressures that they will have to share with the retailers to maintain business or avoid higher loss of business to other countries.
Okay, all right. Thank you so much to both our guests for joining us today and telling us what the impact could be. Of course, so far the expectation was maybe negotiations could yield a lower tariff rate, but that hasn't come about. So this is what we have in terms of the impact on the different sectors because of that 50% tariff rate coming in from the US on Indian exports. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned.
Welcome back. Still trying to hold on to that 24,800 mark on the index, and the FMCG stocks are the ones that are lending support to it. There was a slightly higher recovery that we saw from 24,830 levels. The index has slightly slipped from those levels, but the FMCG index continues to remain at the highest point of the day. But will this recovery sustain as we go into the second half of the trading session? Sudarshan is here with the latest trends from the F&O space. Sudarshan.
So recovery looks very tough at this point if you go through the data, but overall it's a weak day of trade, and it's mainly because of the US government's notification related to additional tariff that's going to be implemented on India effective August 27, and that will be implemented from 9:30 a.m. on 27th of August, and total tariff on India will increase to 50%, and it's a broad-based fall. You take a look at the Nifty Bank, it's down 1%, even IT index is down 1%, and even mid-cap index is down almost on the similar line, and that's the reason even market breadth is still in favor of declines. Ahead of expiry, volatility index has jumped and now it's more than 4%. It's currently around 12.31. Put call ratio, if you take a look, it slipped to 0.78 versus 0.91 that we saw yesterday. So if there is any positive news flow, we might see recovery, but we'll have to see if there is any. Now talking about Nifty Bank, which has been under pressure continuously on a daily basis. Today it has slipped to lowest levels in the last 3 months, and now support for Nifty Bank has fallen to 54,108. And now if we manage to hold on to that levels, then it's fine. But if we slip below that level, the next support comes around 53,483. And resistance remains around 55,396. That is also 100-day moving average. Now coming to the Nifty. Take a look at the call options. I have taken 3 options, 24,800. 24,900, 25,000. All these options have seen a huge option build-up, but there's a sharp fall in the premium. For 24,800, premium now stands at 73 versus yesterday's level of 212, 24,900, 34 versus 133, 25,017 versus 73. Now come to the put options. 24,800 premium has risen to 63 from 21, and 24,700 premium to 29 versus 11. So it tells you that recovery looks very tough at this point. Support for Nifty 24,737, resistance 24,970. One stock that I have taken, that is Britannia, that's seeing fresh longs because we are seeing buying in the FMCG names.
Oh, yes, we are. And that is something which is supporting the markets today as well from the lows. Thank you so much, Sudarshan, for joining us and telling us what's happening in the F&O space. That's about what's happening in the secondary market. But let's put focus on some primary market action. Vikran Engineering's IPO has opened for subscription today. The 772 crore IPO price band is set between 92 to 97 rupees with a fresh issue of 721 crore rupees. We are now joined by Rakesh Markhedkar, who is the chairman and managing director at the company, to make us understand the company's outlook and the business profile as well. Mr. Markhedkar, good morning. Thank you so much for joining us today.
Good morning.
You know, a typical EPC project or a typical EPC company, it has a lot of things: design, civil works, equipment purchase and installation. You have commissioning as well. So in the entire life cycle, where do you stand? Do you have vertical integration for raw materials as well? How would it aid margins? If you can tell us the entire value chain.
Okay. See, in the EPC, since we are in the 3 very important segments where the government of India is focusing their investment plan, that is more on the power, transmission line and substations, and we are in the railway infrastructure and water. So right from the design and engineering, so then the purchase, erection, testing, commissioning and contracts management. And the most important is the timeline of the project management. So the Vikran, we are very much focused on each and every element of this complete business cycle of the project management. We have our own design and engineering team. That dependency on outside is almost 0. Then, and coming to that, in 9 years of our operations, not a single project got delayed, and Vikran is known for our execution strength. And that is the probably where we are continuously gaining the respect and response from our customers, repeat orders, etc.
So what is the execution timeline once you take an order?
Execution timeline, that all depends. Somewhere it is 18 months, somewhere it is 24 months. But we keep set target to close that minimum 2 months ahead of the schedule internally.
Mr. Markhedkar, welcome. Thank you for joining in as well. You know, most of your order book is of the power EPC space, right? 60% around about
70%.
70%. So does that remain constant going forward? 1, and 2, a lot of your listed peers that we speak to, they have called out the fact that there is a shortage of labor and there is a shortage of key skilled workforce, more importantly. But since you mentioned that you're known for completing projects on time, do you face such a difficulty?
No. Let me give you first of all, though we got our strong technical credential in all the 3 segments, sub-segments of the power, like substation, transmission line, power distribution, smart metering, up to the highest system voltage in the country, 765 kV. So apart from that, see, we are also strengthening the team building, including our workforce. Say we have 3,500 registered vendors and the subcontractors on our kitty. So they are just one call away. Number two, that the execution strength of the Vikran, for our business size of 1,000 crore, we are approximately 800 workforce. And that design engineering is our biggest strength. 170 is alone centralized at our Thane, the corporate office.
Okay. I just want to understand, after the three segments that you have, you said water, there's railways, there's power, which is the highest margin segment for you? And will this pivot the way you're looking at the three segments?
Okay, this is a very, very good question. Actually, if somebody asks me, I will say there is a margin in all the three segments. That is individual project that gives the margin, not the segment. That opportunities are available, there are the projects available in each segment, profitability is available, but most important is that internal discipline what we are maintaining. We are selecting the project with the better margin, number one, with the proper funding arrangement and the cash flow of that particular project. This is making us the confident. So we are making margin in all the three segments.
So no, what I wanted to understand is, I was looking at your margins, FY23 at 17.5%, which has come down to 15.2% in FY25. Has it happened because of change in the mix? What is the margin outlook going forward?
I'm just correcting. The FY25, our EBITDA margin has improved now.
Okay, what is that number?
So that is 17.5%.
Okay.
So starting from the 15, then 16 and 17.5%. In fact, we are continuously improving our EBITDA margins with our continual the improvement in our execution capability, our our materials management, the improvement in our timelines, improvement in our design methodology, etc.
So it will improve from here on, 17.5, or is it the number that you'll be looking at?
Since we have already developed very robust mechanism of execution, processes, systems are very strong, internal financial control is strong, I have no any doubt further for any reduction of the profitability henceforth.
Have you, as a company, since you mentioned water as a segment, right? Do you have any exposure to the Jal Jeevan mission? Because a lot of companies have raised concerns over the viability of these projects as well.
We have very limited our exposure to the Jal Jeevan mission, and then that whatever the projects we are executing in Madhya Pradesh and some projects in Uttar Pradesh and Chhattisgarh. So since our volume is very less, the payments we are receiving but little delayed. But it is not that is the reason our complete focus, 80% is now from the power transmission and substation. And power-wise, we have a strong credential also, and that is the reason we are focusing more on the
So are you looking to bid for any such Jal Jeevan projects?
No, we have not bid for last 1 year.
Oh,
okay. I wanted to understand and confirm whether it's right or not. Are you banned from railway projects for 2 years? Is that correct? Or what happened here?
What happened, the railway, that they were tracking one of their employee, and whomsoever come into the contact, they are suspecting our one employee. But the company is nowhere in, company is not at all involved that. And that is the reason immediately we have gone to the court and we got to stay on that.
Okay, so you're not banned from railway projects?
No, that is not banned, and the portion is just approximately 2% of our business operations. So it is not at all affecting us.
Okay.
All right, Mr. Mankedkar, thank you so much.
Thank you very much.
For joining us. Wish you good luck for your IPO, and we look to have you
Thank you very much.
when you have become a public company on your listing day as well as the management there of Vikran Engineering as their IPO opens for subscription today. Take a short break. More on the markets on the other side. Stay tuned. The Nifty back at that 24,800 mark. Stay tuned.
Welcome back. 24,800 on the Nifty. There was some recovery that got sold into, but again, it has been quite stable from the start of the trading session. Mid-caps underperforming. FMCG and autos batting it for the bulls, but we'll have to see which way things go. For now, we'll take your leave on this edition of Trading Hour. Thank you so much for tuning in. Halftime Report is up next.
Stocks lose ground as the US presses ahead by notifying additional tariffs on India. Realty and metals are the big losers, while FMCG ekes out some gains.
Minister of State for Telecom says that there is no additional package being discussed on Vodafone Idea, and whatever had to be done has been done. He adds that the government will not up stake and make Vodafone Idea a PSU. The stock slips.
Starting Wednesday, Indian exports to US will attract an additional 25% tariff, taking the levy to 50% on several products. Players in textiles, leather and gems and jewelry will feel the heat, even as experts expect reform measures to help offset the impact.
The 50% tariff is expected to hit two-thirds of India's exports or to the US, or nearly $60 billion worth of goods. Economists see a 0.5% hit to the GDP this year, which may lessen given the GST cuts. Most experts see India's current GDP growth dropping to 6% or lower if the 50% tariff prevails.
Trump says he is firing Federal Reserve Governor Lisa Cook for a false statement in mortgage agreements. Cook fires back, saying that there is no cause and Trump lacks the authority to fire her. The face-off has financial markets concerned.
You're watching us here on Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Ekta Batra and Vinny Motiwala. Currently, we're doing not so good for the market, holding on to that 24,800 mark, 50 points off the lows of today, but definitely well off the highs that we saw in the earlier week itself. The only, sector that is doing extremely well is the FMCG pack, which is eking out serious gains right now. We have Britannia, which is up 3.5%, HUL up 2.5%, Nestle up 2% as well. So all these consumer stocks doing well, understandably ahead of the beginning of the festive season and proposed GST rate rationalization. So barring all of that, there is a fair amount of weakness. Hello.
Hi guys, yes, absolutely. There's definitely that trepidation which is seeped into the markets at this point in time, the broader markets which are underperforming as we speak. That additional 25% tariff to be implemented from 9:30 a.m. tomorrow morning is what is spooking the markets at this point in time. Remember that tomorrow will in fact be a market holiday for us as well. The India VIX has also spiked up, so maybe that should come up for you. It's up around 3 to 4% the last time I checked, and just about cooled off, so up around 2.3%. So that's always a good sign. It's a sign that there is some amount of volatility which the market is factoring in at this point in time. FMCG stocks, as Mangalam mentioned, are bucking the trend. So that is the only index which is actually in the green this afternoon. Hi, Vinny.
Hi, good afternoon. Apart from that, just Nifty Auto right now has just moved a slight bit in the green. So keep an eye out on that as well, right? We're seeing Ola Electric today on the back of news flow that is buzzing in trade. But Nifty Auto has swinged into the green side as well. Now, obviously, whether this sustains going forward is something that we'll be watching out for. But clearly, most of the sectors are under pressure today. Individual few names that we're seeing buzzing in trade. And we'll take you all through that through the show as well, whether it's Protein Eager, BLS, Ola Electric, all this later on in the show in detail, why they're buzzing in trade. But let's talk about Titagarh Rail. That's the stock that we're keeping an eye out on. Couple of things and couple of points that we want to discuss with the management. One is the worst over in terms of the wheel set availability, which is an issue that is going on for the company. The next one, the company's order book has remained strong. But will that lead to better growth for the company going forward from here on? As well as recent order wins. They've had a big order win that's come in from GRSC. A strategic diversification, is that the deal now coming in for the company? That is what we'll be discussing with Umesh Chaudhary, Vice Chairman as well as Managing Director of the company. Mr. Chaudhary, good afternoon. Thank you so much for joining us and giving us your time. Firstly, I'll start with that point that is coming for GRSC, the order win that's come in there, right? And that is what you've been talking about in terms of diversification, the shipbuilding as well as that maritime segment of the company. So talk to us about, one, this order win. What will it mean for the company? Also, you've spoken about, spinning off that side of the business as well. So how will that shape up for the company? What is the timeline for all this as well?
So good afternoon, and thank you for having me with you. So let me explain to you about the shipbuilding. So we have announced earlier this month that the board has approved demerging the shipbuilding business into an SPV, into 100% SPV to start with, which will then focus on the shipbuilding and maritime systems. And we have been in this business. We have delivered more than 35 vessels to the Indian Navy, Coast Guard, NIOT, etc. So, there are credentials, there's enough credentials and eligibility we have under our belt, and we would like to leverage upon that. And one of the biggest constraints that we had of being on the north of the Havra Bridge, which was kind of limiting our capacity and capability to make different types of vessels, has been corrected by our acquisition of the land of Precision Shipyard, which we did a few months ago, maybe a year ago.
So now with that, this business, which is already seeing a huge amount of tailwind in terms of the government focus and the government impetus to grow, we would like to be in that business, but grow it either with or with a strategic partner or by ourselves, but in a separate company so that the core business, which is the rail business of the company, remains unimpacted.
Could you, Mr. Chaudhary, could you narrow down on when you talk about a strategic partner, what are you considering when it comes to the naval business? Are you in talks? Are you exploring at this point in time? Could you define that for us as well?
So it's more a statement of intent at this point of time. Of course, this is something that we will be working upon. The first step was to create a shipyard, to segregate it into a separate company, to grow the business, to build up the business for which the order has come. We've got a very strong management team in place for the business. With all of this, now the statement of intent is that we are looking at or we are open to inducting a strategic partner into that so that the business can grow on its own accord.
What is your revenue mix likely to be going forward? From this vertical, what is the contribution likely to be? Because you are a rail systems company. So far, you've done a lot of the freight and then passenger comes in, as your order book split has suggested. This new vertical, how much do you expect it to contribute in the near and medium and long future?
So I would say that it's more of a medium to long-term future, because in the near future, it would be not significant. But as we have announced that we will be creating a capacity of doing between 16 to 20 vessels a year. And on a ballpark, of course, the order that we have got from GRSE, which is indirectly from the Ministry of Earth Sciences, is about 225 crores a vessel. But on a ballpark, let's say between 100 to 150 crore a vessel should be what our sweet spot of the vessel size would be. So it is a business that can potentially see us go up to 1,500, 2,000 crores of top line over a period of time.
What would that period be?
Maybe 3 to 5 years. I mean, that's something which will develop as we go along. But our focus in the next 1 year is going to build up a strong order book. And also, this is not a business where the time from order to execution is overnight. It takes almost a couple of years for the vessel to completely get delivered from the time you get the order. So therefore, anything between 3 to 5 years is the timeline, I would say.
Okay, 3 to 5 years is the timeline. 15.
And of course, in terms of the order book or the business mix inside the rail business, till now, 95% of our business used to be the freight rail business. And if you see the order book, now the freight rail business is only just about 25-30% of our order book. So the passenger rail business is actually going to start contributing from the coming quarter or this quarter onwards. And is going to, the year of inflection is going to be FY27 to a large extent, but the main year of inflection is going to be FY28. That is the year where we will be able to deliver all the Vande Bharats and all the metro coaches parallelly and get the real advantage of the passenger rail systems.
Right. Mr. Chaudhary, that's the point that I also want to understand in terms of the rail system side, right? Where freight rolling stock now has started contributing lesser to your overall order book. What does this indicate in terms of margins for the company? How do we see that moving then?
So the margins in both the businesses are similar. So we do not see a big change in the margin. And we are in a business where the top line actually drives the bottom line. So, the customers are government customers, and you do not have so much of pricing power with the customer because there is the benchmark already set. So what can really help is you have to grow your top line, and secondly, because of the growth of top line, the operating leverages kick in. So that's what we are focusing on. If you see what we have done the last couple of years, 3,700, 3,800 crores, or let's say ballpark of 4,000 crores, has been primarily from the freight. And what the capacity we are creating in the passenger is much larger than that. So we're looking at, while on one side, the freight to be like a annuity business or a stable business, I would say. not an annuity, probably that's the wrong word, but a stable, more stable business. The passenger is the one that is really on the takeoff point.
Right. So, because passenger rail side, I just wanted to confirm in terms of margins. Last year, the EBIT was around 6%, 6-7%. This year, it's moved up to 11%. So now this 11% is what you're saying is sustainable overall basis, even for the company, that means.
That's right. So the freight, we are at about 12.5%, about a ballpark of 12%. And if you see the total, the numbers, you see the break-even point to achieve that 11-12% EBITDA in the passenger rail system is about there. I would say we are not fully there, but about there. So the margin also better because we also had the contract mix, in the sense we were doing the Bangalore metro train, which was flagged off by the Honorable Prime Minister earlier this month, where the material part of it does not come to our revenue. So therefore the EBITDA shows higher. But on a ballpark, I would say that to get to the same EBITDA levels, we need a revenue of between 1,000 to 1,200 crores, which we should be able to get by the end of the year on a quarterly run rate basis.
Just quickly, before we let you go, Mr. Chaudhary, if you could just apprise us of what's taking place with regards to the wheel set supply shortage, impacted your FY25 and Q1 numbers?
Yeah, so fortunately, touchwood, that problem is behind us now. The wheel sets have normalized from the last week of July, I would say first week of August. And, we've seen this in the last 27 years. Wheel sets has been a perennial or a cyclical problem ever since. So I would say there are two ways of looking at it. One is the short-term solution, which is now the wheel set problem has been sorted out. The rail wheel factory has started giving us adequate wheel sets from the beginning of this month. And the long-term or the permanent problem is our own joint venture coming into production, which should happen in the beginning of 2026. So that would really take care of the wheel set problem on a permanent basis.
All right, Mr. Chaudhary, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Titagarh Rail. The stock is up around 1% at this point in time. We need to take a short break, but as we do that, a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Let's cut across now to the Prime Minister addressing the audience at the Maruti Suzuki event in Gujarat.
हमने मारुति सुजुकी को हंसलपुर में जमीन अलॉट की थी। विजन उस समय भी आत्मनिर्भर भारत का था, मेक इन इंडिया का था। हमारे तब के प्रयास आज देश के संकल्पों को पूरा करने में इतनी बड़ी भूमिका निभा रहे हैं। साथियों, मैं इस अवसर पर स्वर्गीय ओसामू सुजुकी-सान को हृदय से याद करना चाहूंगा। हमारी सरकार को उन्हें पद्म विभूषण से सम्मानित करने का सौभाग्य मिला था। मुझे खुशी है उन्होंने मारुति सुजुकी इंडिया का जो विजन देखा था, वो आज हम इसके इतने बड़े विस्तार के गवाह बन रहे हैं। साथियों, भारत के पास डेमोक्रेसी की शक्ति है और भारत के पास डेमोग्राफी का एडवांटेज है। हमारे पास स्किल्ड वर्कफोर्स का बहुत बड़ा पूल है, इसलिए कि हमारे हर पार्टनर के लिए विन विन सिचुएशन बनाता है। आज आप देखिए, सुजुकी जापान भारत में मैन्युफैक्चरिंग कर रही है और जो गाड़ियां बन रही है वो वापस जापान को एक्सपोर्ट की जा रही है। ये जापान और भारत के रिश्तों की मजबूती तो है ही, भारत को लेकर ग्लोबल कंपनियों के भरोसे को भी ये आपके सामने प्रस्तुत करता है। एक तरह से मारुति सुजुकी जैसी कंपनियां मेक इन इंडिया की ब्रांड एम्बेसडर बन चुकी है। लगातार 4 साल से मारुति भारत की सबसे बड़ी कार एक्सपोर्टर है। अब आज से ईवी एक्सपोर्ट को भी उसी स्केल पर ले जाने की शुरुआत हो रही है। अब दुनिया के दर्जनों देशों में जो ईवी चलेगी उसमें लिखा होगा मेड इन इंडिया। फ्रेंड्स, हम सब जानते हैं ईवी इकोसिस्टम का सबसे क्रिटिकल पार्ट बैटरी है। कुछ साल पहले तक भारत में बैटरी पूरी तरह इंपोर्ट होती थी। ईवी मैन्युफैक्चरिंग को मजबूती देने के लिए ये जरूरी था भारत बैटरीज का भी निर्माण करे। इसी विजन को लेकर 2017 में हमने यहां TDSG बैटरी प्लांट की नींव रखी थी। TDSG की ही नई पहल पर इस फैक्ट्री में 3 जापानी कंपनियां मिलकर भारत में पहली बार सेल मैन्युफैक्चर करेगी। भारत में बैटरी सेल के इलेक्ट्रोड भी लोकल लेवल पर तैयार होंगे। ये लोकलाइजेशन भारत की आत्मनिर्भरता को नई शक्ति देगा। इससे हाइब्रिड इलेक्ट्रिक व्हीकल्स के कारोबार में और तेज गति आएगी। मैं आपको इस ऐतिहासिक शुरुआत के लिए अपनी अनेक अनेक शुभकामनाएं देता हूं। साथियों, कुछ साल पहले उस समय तक ईवी को केवल एक नए ऑल्टरनेट के तौर पर देखा जाता था, लेकिन मेरा मानना रहा है ईवी कई समस्याओं का ठोस समाधान है। इसलिए पिछले साल मैंने अपनी सिंगापुर विजिट के दौरान कहा था, हम अपनी पुरानी गाड़ियों को, पुरानी एम्बुलेंसेस को हाइब्रिड ईवी में बदल सकते हैं। मारुति सुजुकी ने इस चुनौती को स्वीकार किया और केवल 6 महीने में एक वर्किंग प्रोटोटाइप तैयार कर दिया। अभी मैंने वो हाइब्रिड एम्बुलेंस का प्रोटोटाइप देखा भी है। ये हाइब्रिड एम्बुलेंस पीएम ई ड्राइव स्कीम में पूरी तरह फिट बैठती है।
All right, so that is the Prime Minister talking in Ahmedabad at Maruti Suzuki's manufacturing plant. He has inaugurated it. It is going to be a plant which will be manufacturing the e-Vitara, the EV, and will be exporting it to 100 countries. Quite a proud moment considering that will have the Make in India tag on it. And it comes at a critical time as well.
Comes at a critical time, and the street likes it as well. Maruti Suzuki, the stock has moved to the high point of trade, was fairly well bid. Consumption stocks doing well. Speaking of consumption, you know, one of the spaces that we will definitely watch out for is the central government proposing to simplify the country's GST system and keep items under only 2 slabs, 5% and 18%. Remember, for all the multiplex movies that we watch, for tickets sub 100 rupees, it's currently 12%. And for tickets above 100 rupees, it is 18%. We do have Kamal Gyanchandani, who's the President, Multiplex Association of India, also works with PVR. Kamal, thank you so much for joining in. Now that the rates are 5% and 18%, for cinema theatres or exhibition theatres, there are, 2 slabs. One is the 12% below 100 rupees, 18% above 100 rupees. And for food that you sell, it's 5% without the input tax credit. What is it that the industry's ask is from the GST Council? And what do you think would be a fair number that would come by?
So the industry ask is that this slab of 100 rupee, where anything higher than 100 is being taxed at 18% GST and below 100 is at 12%. This was decided in 2018 January. And when that decision was taken to keep the slab at 100 rupee, there was a lot of representation which the industry had made that the 100 rupee was a low amount and it was slightly impractical, if I could call it that. So to start with, this amount was low and it's not been revised for the last 7.5 years. The threshold has remained the same since the first announcement in January 2018. So our request to the government is that this threshold should be increased to 300 rupee. There has been inflation in the last 7.5 years. There was COVID. COVID has been, a widespread impact on our film and entertainment business, and more specifically on the cinema exhibition sector. This is a fantastic opportunity for the government to, in one sweep, not just reform the GST tax structure, but also give a lot of confidence and conviction to the industry players to give an impetus to the growth and to accelerate the growth rate in terms of screen additions. in all political discussion and economic discussions, we keep discussing the low screen penetration in India. This is a fantastic opportunity to correct that and increase the screen penetration in this country.
All right. So, Mr. Gyanchandani, just to make it clear, 5% for tickets up to 300 odd rupees, that's the GST demand. What about tickets above 300 rupees, which is more in the premium category? What is your demand there?
Because there are two GST slabs, 5% and 18%, which is what has been widely reported in media. Anything higher than 300 will have to be at 18%.
Okay. Do you think that this would be enough to spur up demand, or is there a structural issue that the multiplexes are facing in any way, with the onset of OTT platforms as well as possibly the content part of it?
Well, industry definitely has had challenges since COVID. There have been issues. I wouldn't call them structural issues, because if you were to look at the last few months, July especially, which has been the second highest month in terms of admissions post-COVID, these sort of months would tell you that the structural issue is not there. I mean, of course, we had a big disruption because of COVID, and content, cinema exhibitors, customers, their behavior, all of these factors have taken their own sweet time to come back to the usual. But things are coming back to the usual. Going back to your question, whether this GST optimization, rationalization would be enough to spur demand, we absolutely think this will add to the confidence of the sector. This will not just give confidence and conviction to the existing incumbents, players like PVR INOX, Cinepolis, and the other players operating in the business, but this will also encourage new players to enter the sector.
True. Kamal, a quick word in terms of, you've requested ITC on food and beverages as well. So, do you think that benefit is something that will be passed on to the consumers? Will it be retained? Margins could lead to better margins as well, right? If it's retained. So what is the word there?
Well, on F&B, the current GST slab is 5% with no input tax benefit, input tax credit. But currently our demand is more focused on the movie tickets. And there we are saying the GST rate should be 5% and 18% with full input tax credit benefit.
All right, take that point. Thank you so much for that. Let's see whether, it comes by or not. All of us will keep our fingers crossed. And hopefully, this also alleviates some of the concerns that a lot of the multiplex players are facing right now, though the street would like better content as against better ticket prices immediately for the multiplexes to go ahead and get better footfalls as well. Kamal, thank you for joining in. Take a short break, come back, get you more on the markets and stock-specific action. Stay with us.
Welcome back to Halftime Report on CNBC-TV18. As of now, we're seeing markets are back below the 24,800 levels. 24,787 is where the market is at. But let's move on and talk about some of the stocks that are moving around in trade today. We have Vivek to give us those details. Vivek, good afternoon.
Well, thank you so much for that. Overall, a very muted session on the back of the overhang as far as tariffs are concerned. But a few stocks, a few sectors are bucking the trend. The first set of stocks that are doing quite well in the session is the entire auto pack. Of course, Maruti stands out here. You just saw the news flash in terms of export opportunity there. That stock high by almost 2% today. But the rest of the stocks too, especially some from the broader end of the market for the auto pack, names like Ola Electric, these stocks too doing quite well in the session today. Along with that, the FMCG pack seeing a bit of buying, some defensive buying seeing as far as the entire consumer staple space is concerned. Britannia up almost 3.5%, Colgate, Nestle, HUL, all of these stocks too doing quite well in the session. The other stock that's doing quite well is Protein EGOV. Large order win coming in from UIDAI. That stock higher by almost 9% on strong volumes. But overall, more laggards than gainers in today's session. The first set of negative stocks, of course, has to be ones from the telecom space. Vodafone Idea, no relief coming in from there. That's been made quite clear. That stock low by 8%, and Indus Tower on the back of that derivative impact seen almost 4% lower as far as Indus Tower is concerned today. Sun Pharma earlier today we highlighted a downgrade coming from BofA Securities. That stock lower by 3%, and similarly Zydus Life Sciences Investec initiates a fast sell on this particular name on the back of elevated valuations. That stock too lower by 3%. Sai Life Sciences, another stock on very high volumes. Remember, almost 15% equity change hands today. That stock lower by 5%. And Policy Bazaar, select insurance names on the back of multiple regulatory worries. PB Fintech, that's Policy Bazaar, that stock too among in the F&O space down by almost 3% today.
Okay, all right, Vivek, thanks very much for that. So those are a lot of the buzzing stocks in today's trading session. In fact, the mid-cap index just about holding with a cut of around 1%. We'll take a short break, but on the other side, we'll connect with Nilesh Shah, MD of Kotak Mahindra EMC, as the US notifies additional 25% India tariff. Stay tuned. Welcome back. Well, for the markets, it is weak, so down around 100 odd points currently for the Nifty. Good time then to have a conversation with Nilesh Shah, MD Kotak Mahindra Asset Management, joins in now. Nilesh, hi, welcome to the show. Well, we just spoke to you around 2 weeks ago, and at that time we were talking about the inflows that we saw in the previous month, the SIP inflows as well. At this point, we're sitting at a point where the 25% additional tariff is going to come into play tomorrow at 9:30 a.m. What's your sense in terms of what the impact could be to the economy?
Undoubtedly, there are sectors which will get adversely impacted by 50% tariff. A 25% tariff hit is on the volume and margin. At 50%, it is trade embargo. Sectors like aquaculture, textiles, chemicals, auto components will have to find other buyers. They will have to find other markets. And government also will have to step in to either provide them credit or some sort of incentive to survive this down period. Undoubtedly, tariffs will have impact on certain sector. But is it a death knell for Indian economy? Answer is no. By stimulating our domestic economy, and we have already taken steps by talking about GST rationalization, the overall impact on economy can still be managed.
Right. So overall impact on the economy can still be managed. No more than about 50 basis points in terms of a GDP hit is what all the experts are saying as well. But Nilesh, the question is, what about EPS growth in general? There was an article this morning as well. It said that the Nifty is not likely to see an EPS growth of over 10% in FY26. And this at a time when we're trading at valuations as we are, makes it a lot more unfavorable for a lot of the foreign institutional investors to invest in our market as well. Like we were speaking about 2 weeks ago, the domestic inflows have been at a record high. What's also important is that the FII ownership is at a near record low as well. What do you think will change the favor or tide in favor of India from an FII flow standpoint?
So let's remember that many of the FPIs are underweight India. They are also short India as derivative positions have confirmed. Are you expect them to say that India is a great market when we missed out the opportunity? I don't think so. They are bound to say that India is an expensive market, FPIs are selling, why are domestic investors buying into this expensive market? Everyone talks based on their position. Let me give you some data. In 6 years or 5.25 years of this decade, FPIs have invested 3,45,226 crore. 3,45,226 crore. Of course, some money has come from equity, roughly about 1,28,767 crore. And some money has come from debt, roughly about 2,14,290 crore. So please remember, data is showing one thing, positions are going to say another thing. Now, people are talking about slowing profit growth. Is this 10% profit growth for Nifty suddenly discovered? Or was it available 6 months ago, 8 months ago? Answer is, the first quarter results at about 8 to 9% growth in Nifty and higher growth in mid-cap was as per the expectation. Markets are driven against expectation, not on just absolute number. Yes, India's PE premium is higher than all the peer group, but we deserve that valuation premium because our governance is better, because our earnings growth over longer term will be better. So we have to differentiate between facts and opinions which are driven by position. Do we believe markets will deliver returns like last 5 years? Answer is no. Last 5 years have delivered exceptional return. Returns will moderate. Will there be volatility and correction? Undoubtedly, yes. But if you are investing for long term, India is still a market where you can invest, provided you can withstand the volatility.
Okay, long-term story still stays intact, right? If you can wither the volatility, it's fine. Nilesh, what about overall earnings growth, at least in FY26 now, right? Q1, we managed that 8 to 9%. But Is that something that is going to be a doubt now? And then should one only look at domestic facing companies as of now?
So market obviously keeps on discounting news. Now, the tariff will come and hit our economy. But isn't that discounted into the market as market was cognizant that these tariffs are coming? The government is taking steps to stimulate domestic economy. In terms of top-down macro, India is one of the most stable macros in probably the whole of world. Inflation is in low single digit. Growth is in mid single digit. Fiscal prudence is visible. We are the only major economy in the world which has reduced its debt to GDP ratio between subprime crisis to COVID crisis. So our top-down is still good. And yes, as tariffs have been levied, it will make sense to invest into domestic-focused economy rather than companies which have direct exposure to US.
Right. And do you think the tide has turned from capex to consumption, given the push from the government, not only in the budget, but now the Prime Minister's speech on the Independence Day as well, on account of GST rationalization? Tomorrow starts Ganesh Chaturthi. Also, the festivities begin. All these factors imply that consumption looks a little better now than what it was earlier?
So we have been saying for some time, thanks to the income tax rebate, potential GST rationalization, potential petrol diesel price cut, as well as reduction in interest rates, which helps reducing EMI burden on borrowers, and finally 8th pay commission coming into play, consumption will outperform the market. However, within consumption, you have consumer staple, which are unlikely to outperform the market. And then there is consumer discretionary space. In simple language, as your disposable income goes up, you're not going to buy more soaps and shampoos and detergents. You're more likely to spend this on experiences. The 6th pay commission was more for automobiles where entry-level cars took off. The 7th pay commission was more for consumer electronics and stuff like that. 8th pay commission, who knows, it could be for experiences like home improvements, traveling, tourism, education, healthcare, airline, and so on and so forth. So we will be positive on consumer discretionary space rather than consumer staple space.
Okay, all right, Nilesh, thank you very much for joining in and speaking with us. So that is Nilesh Shah talking to us about the 50% impact of the 50% tariff impact which comes in to play tomorrow, and domestic focused stock sectors would be something that he is saying one should probably look at. We'll take a short break, but we'll get you more on the markets, lots more stocks in focus on the other side.
Welcome back. You're watching us here on Halftime Report. Around $50 billion of India's merchandise export will attract tariffs when it takes effect from tomorrow. Manisha caught up with Kirit Bhansali, who's the chairman of Gem and Jewellery Export Promotion Council, GJEPC as we know it, along with Devansh Shah, who's the partner at Venus Jewels, and began by asking them about the tariff impact, of which gems and jewellery would be fairly hurt.
It's very tough time, very challenging time. It's very difficult to work with US. As I mentioned in my previous interview also, 25% also very difficult to ask. 50%, so there is no point of discussing anything. We'll have to explore new markets. We'll have to negotiate. My team, GJPC, is also working very hard with Commerce Ministry. 27th, US is given the deadline. But still, I'm hoping for the best. As IDMA chairman, if you remember, met their counterpart day before yesterday, and he has given little hopes. So we are just crossing our fingers. Let's hope for the best.
Oh, well, absolutely. Mr. Bhansali, even more important is the point that, this is a holiday season, especially in the US markets. Have we seen any front loading at this point in time? Has a lot of export already been done?
So before this 10%, a lot of people have taken that chance. According to my source, there is sufficient goods in pipeline in US. So I'm hoping this season will not be wiped off absolutely, but the road ahead is very, very tough.
The concern really is about the employment, because this is one of the labor-intensive sectors. What is it that you're having a conversation, especially with Gujarat and Maharashtra governments, because major work facilities are here?
So if I talk about the ships, Andheri, 70% plus exports happening only in US. So the major impact will be on ships. Same will be in Surat. I'm meeting Maharashtra CM tomorrow or day after tomorrow. Meeting Gujarat CM also after Paryushan. Our festival is going on. And we are asking for some relief from both the government. I'm hoping they will definitely help in this tough time to the industry.
Devansh, I'll come to you as well. And what is the scenario that you guys are working with right now? Have the exports happened, and are you looking at other different markets also?
Yes, I think we have to look at different markets to try and keep our supply chain steady. It is an absolute sudden event, and there is no easy way to absolutely feel normal about it. So we have to work very hard to ensure that even our own people and our own environment that we're working is least affected. But it's impossible to say that nothing is a problem. And I think the situation is also very quickly evolving. Situations in April were very different from those in July and those today in August. And looking ahead also, I don't see any clarity on how the situation will evolve and where it will reach in another month or 2 months. So we have to wait and see how things evolve and take decisions after we have some clarity on how the medium term to long term is looking.
Devansh, what are you telling your employees here? And I understand there's just too much uncertainty at this point in time. So how are you taking your business decisions right now?
For us, US was of course 30 to 40% of our business in terms of sales, and that is definitely an impact that we will have to look at. Temporarily, of course, we are taking this wait and watch approach. We have to absorb the impact a little bit, but it's not too far that we can keep the impact only on ourselves. We have to try and evolve the market to absorb more and more of our production that comes in, maybe Indian consumers, maybe consumers in other regions around the world that will grow, and we have to ensure that we are reaching out to as many as we can to mitigate as much of the impact as we can.
So if the US markets do not work out in sense of tariffs, what are the other markets that you are exploring?
In terms of the US market not working out, one important aspect is also that the US businesses are also very heavily dependent on imports as an important part of their business. So there has to be some solution that has to be workable for businesses around the world as well as businesses in the America. We have not already lost hope for everything to go away. We believe that the governments are working together together to find a solution for the people of both countries. And we hope that there is a nice, amicable, mutually agreeable solution that is reached. But until that is reached, there is nothing much that we can do other than either wait and try our effort in other markets, but those are long-term,
Absolutely. Devansh, I want to understand, because this is labor-intensive. There are no layoffs or pay cuts right now. How long do you think you can hold on with that?
I think this is a scenario that we can't take any quick decisions in because it's evolving already so quickly. So we will have to wait for there to be certain clarity for the medium term to long term, and then take calls that we might be forced to. But for the short term, we have to hold on and wait for the situation to get more stable.
Mr. Bansali, I think everybody right now is looking for some support, some hand-holding, some incentives from the government. You told us about on how you're talking to the various state governments right now to ensure that there is some support on labor. But for the industry itself, what are the conversations that you're having with your ministry?
So in my last meeting with Niti Aayog, we have demanded in SIPs to allow us reverse job work, which is good market, domestic is doing good. And they've taken our point very seriously. I'm hoping in a couple of days they will allow us to do reverse job work in SIPs. And that will be a very, very big relief as far as the Andheri SIPs is concerned.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty 24,790 levels is what it's trading at. Clearly not much of a move that we're seeing. Very range-bound in terms of the decline that we've seen since the get-go. So yes, after that gap down, that's where it's roaming at 24,750 to 24,800 range. Mid and small cap continue to underperform, and most of the sectors continue to trade in the red, except the FMCG side. A lot of movers in the last 1 hour. We've seen Bata see a fall as well. We've seen Ola Electric from the day's highest point. It's come down a bit, so keep an eye out on that one. These are the stocks that are off the day's highest point. But with that, we'll wind down this edition of Halftime Report. It's a goodbye from Mangala, Mekta, me, as well as the team who put this show together. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks lose ground as US presses ahead by notifying additional tariffs on India. Realty and metals are the big losers, while FMCG ekes out some gains. The mid-caps are underperforming.
Minister of State for Telecom says there is no additional package being discussed on voter idea and whatever had to be done has been done. He adds that government will not up stake and make voter idea a PSU. The stock slips in trade.
Starting Wednesday, Indian exports to US will attract an additional 25% tariff, taking the levy to 50% on several products. Players in textiles, leather and gems and jewelry will feel the heat, even as experts expect reform measures to help offset this impact.
The 50% tariff is expected to hit 2/3 of India's exports to the US or $60 billion worth of goods. Economists see a 0.5% hit to the GDP this year, which may lessen given the GST cuts. Most experts see current year's GDP dipping to 6% or lower if the 50% tariff prevails.
And Donald Trump says he's firing Federal Reserve Governor Lisa Cook for false statements in the mortgage agreements. Cook fires back, saying that there is no cause and Trump lacks the authority to fire her. The face-off has financial markets concerned. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Festive greetings to you all. I'm Hormuz Fatakia. With me is Vamakshi Dhoria as always. Vamakshi, good afternoon. Well, it's some recovery from the lows of the day, still managing to hold that 20 DMA and still managing to hold that 24,750 mark. So some positives that the bulls can take in an otherwise down day.
Well, absolutely, Hormaz. Festive greetings to you as well. You know, the biggest obstacle for India for now is the 25% tariff deadline, which is set to take into effect from tomorrow onwards. The markets resultantly are sulking. The Nifty is down almost 161 points, although off the day's lowest point by just a tad bit. But nevertheless, it is still red on the screen. The broader markets, though, they also continue to decline in trade. The advanced decline ratio is largely in favor of the declines. The mid-cap index is down almost 1.1%, much lower as compared to what the benchmark indices are doing. And so is the small-cap index, because that too is trading with a cut of almost 1.5%. As far as sectors are concerned, most of them are in the red. There's no support coming in from the benchmark indices. Two main pillars, IT as well as bank. Both of these sectors are declining in trade today. The only positive this time around, Hormaz, is the FMCG pack, because these are the stocks that continue to gain in today's trading session. Take a look at Britannia, Hindustan Unilever. All of these counters are doing extremely well in an otherwise weak market.
Indeed, and FMCG is the one that has been providing some support for the indices, even though the index is up around 50 points from the lows of the day. And there are, of course, specific movers within the broader markets as well. Ola Electric is one of them, 5% higher on that stock. But on the losing side, though, take a look at PG Electroplast. The stock is out of the FNO ban, is at the lowest point of the day, now 5.5% lower there. Vedanta, of course, you say that the stock is trading ex-dividend and is adjusted for its dividend today, so that's lower around 4.5%. Look at Angel One, that's down 4% as well. Capital market names not doing well, defense names not doing well. And just before we move on, you take at Vodafone Idea as well. At one point, the stock was down well over 10%. At the start of the trading session, still around about 9% for Vodafone Idea as well. But the big story today, nothing else but tariffs. And I say it's set to kick in from tomorrow morning. First up, Parikshit is here to get a quick recap of all the developments that have transpired so far. Parikshit.
Well, indeed, a setback for India, so to say. Till now, negotiations were on to avert that 25% additional penalty, and those negotiations are still underway. In fact, all efforts are being made to get a pause on these tariffs. Now, what happens immediately? The US has issued a notification essentially for importers to know that these will be the tariff lines that will be effective from 12:01 a.m. 27th of August, which is 9:30 a.m. India time on Wednesday. So that's when the tariffs kick in. It will be a 50% tariff, that is 25% reciprocal tariff that came into effect on the 1st of August, and also the 25% additional penalty that was announced. So it's a 50% tariff on Indian goods. What does it really impact Well, $48.2 billion worth of India's merchandise exports to the US will be subject to the 50% tariffs. And many analysts have said that this is almost like a blockade, and this will stop the export of these items to the US. Which sectors will be the most impacted? Textiles, footwear, leather goods, labor-intensive goods exports to the US will be most impacted in the months to come. But a lot of the exporters have already sent a lot of consignments, huge quantities of consignments, anticipating these high tariffs. So possibly they'll have a cushion for the next few months at least. Having said that, goods already subjected to Section 232 tariffs, that is 50% tariffs on steel and aluminium, 25% tariffs on automobiles, that stays, and that is not impacted by the reciprocal or the additional penalty tariff. So that remains as it is at 25%. Then you also have certain exemptions such as iPhones, copper, pharmaceuticals, semiconductors, timber, energy products and minerals. There is no change in tariffs on this, either in the form of reciprocal tariffs or additional penalties. These are products that will continue to be tariffed at the rates that were being tariffed before any kind of reciprocal announcement happened in April this year.
Well, thank you so much for that, Parikshit. But do stay on with us because you need to fill us in with details on what is the latest developments, especially on negotiations. Go ahead, Parikshit.
Yes, the trade negotiators are not coming to India. Those formal talks are not being pursued, but we're given to understand that trade negotiators, officials from across the government are in touch with officials in the White House almost on a daily basis. Efforts are being made to avert this 25% additional penalty and find a way out, have some sort of understanding and deal with the United States. In fact, an important point, in the run-up to August 27 deadline, industry bodies in the US have written to the White House seeking a 90-day pause on this additional tariff so that there is room for negotiation between India and the US. They've also said that US should understand the amount of energy, oil and gas that India is buying from the US, and this is only going to increase further. Having said that, the government here, according to sources, is reiterating that we'll continue to protect interests of our farmers, MSMEs, workers, entrepreneurs, and we'll do whatever it takes to work in national interest. The government will continue to take steps necessary to mitigate the impact on trade through export promotion schemes and also trade diversification measures. The External Affairs Minister has said recently that the arguments used to target India are not being used against China. The External Affairs Minister also said that the US additional tariffs on India are unjustified and unreasonable, and India is sticking to this stand. In fact, the Indian envoy to Russia said that we will buy oil from wherever we get the best price. So this seems to be India's stand. We're told that the government is not looking at retaliation. The effort would be to try and resolve the situation at the earliest, get a reprieve from India, get a pause on these additional penalty tariffs.
Important points there from Parikshit. Thank you for that update. And just as we speak, there were some flashes on your screen with regards to our External Affairs Minister, S. Jaishankar, who's mentioned that India does continue to remain in touch with the US on tariffs, and Prime Minister Modi is expected to hold some bilateral meetings on his visit to China. Meanwhile, speaking of Prime Minister Modi, he has vowed support for Indian farmers and small entrepreneurs as US's additional 25% tariffs come into effect tomorrow morning. Listening to what he had to say.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगी। दबाव कितना ही क्यों ना आए, हम झेलने की अपनी ताकत बढ़ाते जाएंगे।
Well, strong comments coming in from Prime Minister Narendra Modi. Let's also listen in to what Mark Mobius, who's the chairman of Emerging Opportunities Fund, had to say on this.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the US. The garment industry, of course, will be hurt because a big portion of their exports go to the US. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous. India's got an incredible domestic market, and more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the US, which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the US, I think the Indian economy will still be doing very well.
Mark Mobius on the future of the Indian markets once the tariffs take effect tomorrow morning. We also spoke to a number of other experts, listening to what they had to say.
We have basically reached out to the president and asked him to at least delay the implementation. We need a runway to find a solution between the two countries itself. And it's important that to understand that, yes, the secondary tariff are unjust and they shouldn't be put in, but we can't just keep on going on the media and keep on calling it just. Let's keep on working and finding a solution. So I think by postponing this by 90 days or 120 days, it's like US has done with China, it will give us a runway to sort things out. But more important is I think a call between the Prime Minister and the President can untie the knot which we have got ourselves into it, so at least both countries can work in a positive manner.
My sense, I think maybe for the next couple of fortnights, the government will actually wait and watch to see how the things are spanning out, and then it will announce the impact. Then it could announce a package. Regarding the impact on fiscal, we are open that the fiscal deficit, which is 4.4%, even if it slips by a 5 to 10 basis point impact, which is possible given the GST implementation, but also that could be offset by higher consumption. I think that is still better than taking a GDP hit of larger GDP hit over the next year or so. As of now, I think again the impact on GDP will be significantly uncertain. We have already been around 20 to 30 basis point impact.
Take a short break then. More news and updates on the other side, so don't go anywhere. Well, thanks for staying tuned into Business Lunch on CNBC TV18. From Yes Bank getting a rare foreign investor green light to Paytm's freeze being lifted, the Reserve Bank under Sanjay Malhotra is signalling a shift in stance. Here the governor, in his own words, speaking at FIBAC yesterday on this, and then Ritu Singh breaks down what this means for the financial sector.
We have not hesitated in relaxing a stringent rule once deemed necessary if the context changes and the cost-benefit balance reverses.
Well, that change in context is showing up across the financial sector, with the Reserve Bank under Governor Sanjay Malhotra signaling an important shift from strict guardrails to selective easing, and their actions tell the story. At Yes Bank, for instance, RBI gave Japan's Sumitomo Mitsui the green light to buy nearly 25% stake, which is a rare exception to the ceiling for single foreign entities and a strong vote of confidence, which is why you saw the stock spike up more than 5% intraday on the back of this yesterday. For Paytm, a near 2-year freeze was lifted with the approval for its payment company to act as a payment aggregator, and that pushed the stock up 14% since. But perhaps the most significant move has been the granting of a universal bank license after nearly a decade, where AU SFB became the first small finance bank allowed to graduate into a full-fledged bank, a regulatory milestone which saw its stock jump 8% intraday. Even Innocent Bank, where RBI had stepped in earlier this year, appointing an executive committee after the lapses of the spate of exits, now sees normalcy return, with Rajiv Anand approved as the new CEO. Earlier this year, we also saw the tech embargo on Kotak Mahindra Bank getting lifted after 10 months. Before that, the curbs on Arohan, Ashirvad and DMI were also eased. Beyond individual institutions, RBI has also been easing liquidity rules, restored lending flexibility for NBFCs, MFIs, expanded co-lending rules, relaxed project finance, and so on. And the thread across all of these moves has been the regulator shifting gears. Strict scrutiny where lapses do emerge, but pragmatic relief also, in the governor's own words, when the context changes and the cost-benefit balance reverses.
Ritu, thank you for that update. Now, on the second day of his visit to his home state of Gujarat, the Prime Minister today inaugurated 2 major projects at the Suzuki motor plant in Hansalpur. Now, this includes the inauguration and the flag-off of the e-Vitara, Suzuki's first global strategic battery electric vehicle. The made-in-India EVs will be exported to more than 100 countries, including advanced markets such as Europe and Japan. Let us listen in to what the Prime Minister had to say.
भारत की मेक इन इंडिया इस यात्रा में एक नया अध्याय जुड़ रहा है। ये मेक इन इंडिया, मेक फॉर द वर्ल्ड हमारे उस लक्ष्य की तरफ एक बड़ी छलांग है। आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे। सभी राज्यों को कहता रहा हूं कि हमें प्रोएक्टिव होना होगा, हमें प्रो डेवलपमेंट पॉलिसीज बनानी होगी, हमें सिंगल विंडो क्लियरेंस पर बल देना होगा, कानूनों में रिफॉर्म्स को बल देना होगा। और ये कंपटीशन का जमाना है। जो राज्य जितनी तेजी से अपनी पॉलिसीज को नीट एंड क्लीन रखता है, इफ्स एंड बट्स के बिना रखता है, तो इन्वेस्टर का विश्वास बढ़ता है। रिफॉर्म की स्पर्धा करे, गुड गवर्नेंस की स्पर्धा करे, प्रो डेवलपमेंट पॉलिसी की स्पर्धा करें, और हम 2047 विकसित भारत बनाने के लक्ष्य को तेज गति से पार करने में अपनी भागीदारी सुनिश्चित करें।
Well, let's slip into a very short break, but don't go anywhere because more news and updates follow on the other side.
Welcome back. Let's now focus on a major development in the US. Amidst his tussle with the Federal Reserve, US President Donald Trump has fired Fed Governor Lisa Cook. This next report tells you more.
Donald Trump has taken the unprecedented step of firing Federal Reserve Governing Board member Lisa Cook. In a letter to her, he said, "I have determined that there is sufficient cause to remove you from your position. At minimum, the conduct at issue exhibits the sort of gross negligence in financial transactions that calls into question your competence and trustworthiness as a financial regulator." The move follows allegations made by Federal Housing Finance Agency Director William Pulte, a Trump ally. He says Cook is guilty of mortgage fraud, claiming she listed two different properties as being her primary residence on mortgage applications. That could have allowed her to secure lower rates on her borrowing. However, Pulte has provided no public evidence for the allegation, and Cook is defiant. She had said she would not be bullied into stepping down, and has vowed to gather evidence to answer all questions over her mortgages. Cook was appointed to the Fed board in 2022 by then-President Joe Biden. She is the first African-American woman to serve as a Fed governor. Now her dismissal could be challenged in court amid legal uncertainty over whether Trump has the power to fire her. It also comes amid Trump's fierce criticism of the central bank's leadership. He's regularly accused Chair Jerome Powell of being too slow to cut rates.
People aren't able to buy a house because this guy is a numbskull. He keeps the rates too high.
Trump has frequently threatened to fire the Fed chief, but has backed away from that as the end of Powell's term approaches in May.
Well, moving on to other news then, the Supreme Court has ordered an inquiry by a special investigation team into the affairs of Vantara Wildlife Rescue and Rehabilitation Center. The Apex Court has directed the SIT to examine and submit a report on the number of issues, including compliance with the provisions of Wildlife Protection Act and the acquisition of animals from India and abroad, particularly elephants. Now, in a statement issued in response to the order, Vantara says that they remain committed to transparency, compassion and full compliance with the law, and their mission and focus continues to be the rescue and rehabilitation and care of animals. They have also said that they will extend full cooperation to the SIT and has requested to avoid any speculation during the inquiry process.
With that, we call time on this edition of Business Lunch. We leave you with the Nifty still above the mark of 24,800 from Amakshi and me. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer, and we stay at the opening levels. It's been quite range-bound today. So at 24,800, that continues to remain the crucial level. Mid-caps underperforming, and only the consumption theme seems to be working right now. FMCG supporting the index.
Absolutely right. Good afternoon, Sonal. So, we woke up to the news of the tariffs, and that's something that's kept the market under pressure throughout. Autos and consumption, that's the only set, that's managing to do quite well. Rest, in fact, even the pharma pack amongst the top laggards today. But we have a lot lined up on the show, an important management conversation as well. So let's start off with the top headlines. Stocks lose ground as US presses ahead by notifying additional tariffs on India. Realty and metals are the big losers, while FMCG ekes out some gains. Mid-caps underperform.
Textile stocks like Wellspun Living, Arvind Vardhman Textiles, Pearl Global all trade lower ahead of the August 27 tariff deadline, as Indian exports now to US will attract an additional 25% tariff, taking the levy to 50%. These companies have majority exposure to the US markets.
Vikram Solar made a subdued debut on D Street, listing with minor gains to its issue price, but it's currently trading near the day's high, up over 11%.
Vodafone Idea slumps as the government refutes news reports that the telco could receive some relief on AGR dues. The stock is lower by 8%.
Protean eGov Securities secures a 1,160 crore order from UIDAI. Stock surges over 8%, while Ola Electric surges after the company secures PLI certification for its Gen 3 scooter portfolio.
Okay, so 160-point cut on the Nifty. That's been status quo since the time we started trading. It continues to be in the red at those levels. Mid-caps are the ones which are underperforming, down 1.1%. We have the Bank Nifty as well, not doing so well, so 1% gone there as well. In terms of individuals, in the indices, as I said earlier, it's Nifty FMCG, which is batting it for the bulls. That one is up around 1%. Nifty Auto did see some recovery. In fact, now it's at the day's high, so the recovery that we would see will come in from the FMCG space. Nifty Auto, after being in the red for a while, did see that recovery come by around 12 p.m. and that continues to be the case as well. In terms of losers, Realty continues to lose. We have Pharma Index, which is not doing so well. PSU Banking Index, you name it, and most of these sectoral indices are in the red currently. But when we talk about individual names, so let's get to our special segment, Mid-Cap Movers. Vivek has gone across to the big wall. He's going to take us through the mid-caps that are moving around in trade. Vivek.
Well, like you mentioned, the mid-caps, especially the broad end of the markets, they're sulking today. The advance decline ratio is very weak. And this is mainly on the back of the fact that throughout the trading session, we've seen significant selling pressure. Now, in terms of individual gainers, first up, we'll start off with the name that made its debut on D Street today, Vikram Solar, a good 10% pop. So listing gains of 10%. It'll be interesting to see whether this entire pack, remember, quite a few companies will come up with ITOs in this particular space itself. The auto pack, the large cap auto names are doing quite well. And even within the mid cap and the larger universe, you are seeing auto stocks, auto ancillary is doing quite well. Ola Electric up 5% and Ather Energy too up over 5% today. We spoke about Protean eGov, during the headlines. We spoke about how the company had received an order. We'll do a deep dive into it later on in the show. But that stock higher by over 8% on very good volumes. And KSP Limited, this particular name on strong volumes continues its move higher. Order book remains quite steady over there. On the other hand, quite a few laggards as well. Clear indication that no relief is underway as far as the telecom space is concerned. That has made Idea sulk almost 8.5% lower today. PG Electroplast, this particular name, has been under significant pressure ever since its results. Been quite volatile, but today down 4%. JK Paper, remember, the entire paper pack yesterday was doing very well, but seeing a bit of profit booking today. So JK Paper down 4%. Angel One, not only Angel One, a whole host of capital, the capital theme stocks seeing quite a bit of selling pressure. Angel One over 4% lower, and KFin Technologies today under significant pressure, over 4% lower as well for this particular name too.
All right, so those are some stocks which are on our radar. In fact, we'll take forward JK Paper and Protean Gov from that and discuss that in greater detail. But before that, let's welcome Shrikant Chauhan for a technical check on the markets. Shrikant, good afternoon. Well, we've continued to be at that 24,800 mark. Will we see levels below that by the time we end this session? What are the charts suggesting now?
Good afternoon, everyone. As far as Nifty is concerned, it has broken its important level at 24,850 and 24,800 also. Yes, we are seeing some recovery, but the most important part is that we need today's close somewhere close to its opening levels. I'm going to say somewhere around 24,900. If we see the market is recovering today, even though there is like tomorrow holiday and we are very close to the expiry pressure, if we see the market is gaining in today's date, then only we can say that today's breakdown was false breakdown and market is again on the path of recovering from lower levels. So that will get confirmed. But for the time being, we are still on the downside. We can see maybe 24,500 in the near term. That's my view, as the market has broken its important level. So we need just recovery towards the end.
Okay, Srikanth, so recovery towards the end is what you're hoping for in today's trading session. In terms of individual stocks, do you like anything today?
Yeah, Vivek. Yes, there are like number of stocks which are like today showing some strength, recovering from their lows. And yes, value buying is happening in the market. Today we saw good amount of buying interest in SH Kelkar, which is currently trading around 240, 41. It was around 230 levels. From there, all the way it recovered. And while looking at its entire technical pattern, I think the stock is heading for the levels of at least 300 in next maybe few weeks or months. So it will take some time, but it's a buy at current levels. There is a decent upside from current levels that we can see based on its technical pattern. And if somebody is interested in buying the stock with a short-term view, then they can keep a stop loss around 220 for the same. But we like SH Kelkar around at current levels. We also like Eternal, which is around 319, 320. The stock is forming higher top, higher bottom series since last so many weeks. And when looking at its entire pattern, and even though there was like weakness in the market, we are seeing good amount of resilient activity in Eternal. So at these levels around 320, it's a buy with a target of 345. And in the long run, we may even see the levels of 400. So at this level, it's a very strong candidate to buy for. And if there is any correction, then one should look for adding more. We can keep stop loss around 305.
All right, take that point. Thank you, Srikanth. The stock is at the day's high, but that disclaimer will come up for you on the screen as well. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back to Midcap Radar. Well, today is also an important day, especially from a passive index point of view. Remember, today is the day in which the MSCI's August review changes come into effect. So in the last hour of the trading session, a couple of names, remember, will get added to the MSCI. There will be a few weight changes as well. And there are 2 deletions as well. Overall, this particular event is a net equity outflow event as far as Indian equities are concerned. So which are the 4 names that have made their entry into the MSCI this particular review? Hitachi Energy, close to $220 million of inflows. Swiggy, close to $280 million of inflows today. Vari Energy, $220 million of inflows. Vishal Mega Mart, close to $250 million of inflows. So these are the stocks that will see inflows in the last hour of the trading session today. And on the other hand, 2 stocks have exited the MSCI index. So Thermax, close to $110 million of outflows, and Sona BLW Precision, remember that particular stock, close to $160 million of outflow. All of these estimates or flows are estimates of brokers. But moving on, remember this is our special segment, Midcap Spotlight. Winnie is standing by, and today she's focusing on the UIDAI orders for Protean eGov and BLS International Services. Winnie, over to you.
Hi, absolutely. So we're keeping an eye out on these orders that have come in this morning, what we saw. One was for Protean eGov. Now, this is an order of around 1,100 crores for Protean eGov. This is for Aadhaar Seva Kendras from the UIDAI that they have received. The similar order, it's a tenure of 6 years, right? Now, similar orders received also by BLS International, same one. But this value is of around 2,000 crores. Now, you know, what is it in terms of positive? Obviously, for Protean eGov, do not forget that PAN 2.0, they didn't get that order. That time it's seen a sharp fall coming in the stock price, right? Now here, this actually compensates. That order was around 1,400 crores. That outlay was expected to be of around that value. Now, this is of around 1,100 crores approximately, 6-year time period. But the concern that comes in now, what is the main impact that we could see coming in? While it's a compensating order, but the impact is that there is already a lot of competition here, right? You can go to any Aadhaar Seva Kendra, right? You can go to banks, post office, get your Aadhaar done. So yes, there are certain districts where they have received these orders for, but there is already too much competition. So that is a concern, and volumes now will play a bigger part. So how many people actually go to, Protean eGov on the site over there or through them and get the order Aadhaar done is important for them. So that is key to watch out for. Nonetheless, today, both these stocks are buzzing in trade on the back of this order win.
All right. Thanks for explaining that. Both these companies got a similar order, but how the volumes will pan out going forward will be important to track. Let's quickly take a look at the markets again. There is some recovery that we are seeing, but again, it's not massive to talk about in greater detail as well. From the broader markets, if we talk about some stocks which are on our radar, Edelweiss Financials, that stock is up 5%. We have CESC, which is up 1.8% as we speak. And there's Ola Electric as well, which has got that PLI boost. So that stock is up around 5%. Linde India is up 3.3%. Granules too is doing well, so 2.5% higher there as well. Some of these broader market movers that we wanted to talk about. But for now, we'll slip into a break. When we come back, management of JK Paper will join us next. Welcome back. Paper stocks were on a roll yesterday. The government tightened import conditions for certain paper and paperboard products. Now, we want to understand the three top talking points that we'll discuss with the management of JK Paper. What percentage of revenue comes from virgin paperboard, the pricing power tailwind for sector, and industry price hikes as well. So to discuss this, let's get in Mr. A.S. Mehta, the President and Director at JK Paper, to understand what this move means for the industry and specifically for JK Paper as well. Mr. Mehta, good afternoon. Thank you so much for joining in. Can you explain to us what was the imported price earlier and what has led to this change that came by? What would the impact of this change be for JK Paper and industry be?
Thank you. Very good afternoon to you as well as the audience. In fact, this was troubling the paper market from last almost 12 months, particularly the category what we are talking in the context of the MIP. This is the virgin packaging board on which the MIP has been imposed. In fact, in Indonesia, there was a huge capacity created, and the capacity was the new capacity was equivalent to the demand in the country. I mean, in the whole of the India's demand is equivalent to the new capacity created in Indonesia. So, in fact, they started dumping, and I would say that the import was taking place at something around $600 a ton, which is very, very cheap rate as far as any global trade is concerned, because the pulp prices are at around $500 and $550, and when the processed the board, if that comes at $600, I mean, there is no way that this can be a price. So that was troubling the Indian manufacturing sector, and this is where we represented, we requested the government, we filed the petition. Of course, it took almost 6-8 months for government to investigate and the process and do all kind of a consultation and the analysis, and finally now the MIP has been imposed. This will help the paper industry. I would say that the paper, particularly the packaging board, when we talk, in fact, the prices have crashed something around 15 to 20% from a decent level of pricing a year back or 1.5 years back. And it was the paper industry was not making any margin on this particular category. Okay. So now there must be some correction in the pricing after the MIP.
Okay. Mr. Mehta, thank you so much. You've explained clearly, what was happening as far as the industry was concerned and how exactly this will help you going forward. Now, coming to JK Paper specifically, what is the percentage of total revenue this particular segment contributes? What is the current pricing at which you are selling the paper in the domestic market? And what is the kind of upward correction, like you mentioned, you can take? And could you confirm for our viewers, this particular MIP imposition has been done for a period of 1 year?
Let me tell you that the imposition of the MIP right now, as per the notification is concerned, it is up to 31st March 2026. It is not for 1 year. It is up to March 26. And of course, we have a window to approach the government again for a further period of 6 months or so. So that's a later part. So this MIP is for the period up to March 26. This is one. As far as our sales mix is concerned, right now the virgin packaging board is close to 35 to 40% of our total the paper revenue.
Okay. So I also wanted to understand, Mr. Mehta, how will it impact margins overall? We were having a conversation in the morning with CareEdge. They said 55% of the total industry volumes come in from VPB. It would improve margins. For JK Paper particularly, what kind of margin improvement would you see?
No, 55%, did you say about the sales mix of virgin board?
For the entire industry, that was the number that was told to us.
No. See, the virgin packaging board total, when I talk about the volume for the industry, it is something around 20 lakh ton.
Correct.
20 lakh ton is the total virgin board, is the demand in the country, and the size of the total paper market in the country, it is something around 250 lakh ton. So it is not even 10% of the total volume of the paper sector. But when we talk about the total packaging board, which is recycled and virgin both, then it is something around 35% is the virgin board, and something around 65% is the recycled board.
Okay, Mr. Mehta, two questions. One comment on pricing, I missed asking you that particular part. And secondly, in terms of market share, you explained clearly to us about how paper was being dumped, especially from Indonesian players. Now, what is the current market share rate currently in this particular segment, and what do you expect for it to increase up to?
See, you are asking about the JK paper market share. So we are close to 18 to 20% market share we have. Okay. And it will remain more or less the same because we are not adding any capacity right away. And whatever the market will grow, so we will have the same kind of a volume from our operational efficiency and debottlenecking. So our market share will remain at the same band of 18 to 20%. As far as the prices are concerned, after the MIP, certainly the whole purpose of this is that there must be a reasonable pricing where the industry can have some kind of a margin. So, I mean, in over a period of time, we will have to see how the market behave, what is the market affordability, and I mean, that will define, but certainly there will be some price correction in time to come. It may happen in 15 days or 30 days, but there will be some price correction.
Understood. So we are all hopeful of a price hike that will be done by paper companies going forward. Sir, a couple of key points that industry continuously talks about, especially in terms of demand triggers. The first one, of course, is the kind of growth seen from the e-commerce space. Could you put a number to that as to what exactly will be the growth there? Number two is, what is the kind of incremental demand you are seeing from the new education policy? And what is the kind of trend you're seeing in the writing and printing part of the demand trend?
So, right. So, as far as the demand in the growth is concerned, I will divide this into the different segment as you asked about this. So, as with the writing and printing paper is concerned, I would say that in view of the whole digitalization and the digital classrooms and the digital boards, and also particularly the habits, the children habit, and also the parents, I mean, they are also not insisting too much on the writing and reading. So what we are expecting that writing and printing paper is likely to grow at something around 3%. It's not going to be the growth, the same what it used to be 6% or 7%. We are expecting that it will be in the band of 3 to 4% or 2.5% to 3%. But please understand that globally, the writing and printing paper is degrowing. And that too, the degrowth is predominantly when you talk about the Western world, they are degrowing at something around more than 5%. So even if we get a growth of something around 3%, I would say that this will be a decent growth.
Okay.
But when we talk about the packaging related paper, whether it is board or whether it is kraft paper or any other packaging related paper, this is likely to grow at something around minimum 7 to 9%. So overall, when we see the paper industry, we expect that it should grow at something around 6%.
Okay. Thank you so much, Mr. Mehta. Some good news coming in for the paper industry after a while. We hope to see much better results from Q2 onwards. Thank you so much for your time, and wish you all the best from Q2 onwards. Thank you once again. Well, that was the management of JK Paper. Remember, the imposition of the MIP is something that aided a significant stock up move yesterday. And today, we did see the management talk about how exactly this will aid price realizations as well as capacity utilization. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinny Motiwala. And just ahead of the holiday, let's talk more about allocation of your portfolio and what you should be doing, considering there's so much happening in the global scenario. And that's exactly what we are going to be talking about today.
Absolutely. Given that uncertainty of tariff we have seen through the year, now what we're seeing doing well is multi-asset funds, your allocation into funds as well. How important is it to have a flexible portfolio right now in terms of a strategy? That is key, right? And to discuss all of that, we have Dalen Pinto, Senior Fund Manager at Bandhan Mutual Fund, joining in with us to talk to us about that and coming to the studios as well. Dalen, good afternoon and thank you so much for coming in. Now, this is a very important point right now, given that we're seeing so much of an uncertainty that comes in. At such a point of time, how important does asset allocation actually play in someone's portfolio allocation? Overall, how should they go about it? And how should one actually navigate these market cycles that you see coming in? How should they effectively allocate their portfolio?
So, good afternoon. Thank you guys for having me on the show. I think that's a very pertinent question today. Two common mistakes that we all tend to make, while looking at investing. The first is the recency bias. So we tend to try and clutch on to asset classes that have typically done well in the recent past because that's fresh in our memory. But I think the second and most important mistake that we tend to make is trying to second guess what could be the next best asset class performer over the next 6 or 12 months. And in such uncertain times, that asset class has pretty much changed every 3 to 6 months, right? So when you think of the last 12 or 18 months, we've had a couple of wars, we've had 2 large elections, the India and the US election, and now we've got these tariff measures that, keep changing every month, if not every week. And I think in such a scenario, navigating through a multi-asset sort of approach has actually served investors very well, right? The second, part of multi-asset investing is to try and keep all our behavioral biases behind us, right? A lot of us tend to come with preconceived notions of where we should allocate our money. And in our opinion, based on the studies that we've done, having a more strategic allocation with a wide variety of allocation towards equities, fixed income, commodities, help navigate during these times much more efficiently, right? And the third part is that people do believe multi-asset allocation sometimes doesn't provide the growth impetus that you typically get by just investing in equities. And I think that's a bit of a myth because I think by having multiple asset classes, you get the growth potential that each of these asset classes, kind of offer. But at the same time, and more importantly, you get low volatility because many of these asset classes are not really correlated to one another or they have low levels of correlation. And I think that's the really powerful part of multi-asset allocation products.
So there's one product which is giving you benefits of all the asset classes together. But Dalen, what would the advantages be of, say, investing in a pure multi-asset fund versus a pure equity, pure debt, or any other asset class for that matter? Why would you say this is more advantageous versus all of them put together?
I think of it as putting all your eggs in one basket. If you were to go to a pure equity product or a pure bond product, you have to take the whipsaws that product offers, right? Both positives and negatives. I think here the idea is to get an ideal outcome of return to achieve your long-term goal potential with the lowest volatility that you can possibly get, right? And I think that's where the sweet spot lies for products like this. And these products are much more relevant in today's uncertain environment, as you guys started off by saying.
Absolutely. Then what sort of investors should actually look at multi-asset? Is it for everyone or should they have a specific risk profile? How does it work here now?
So, I think that's a great question because most of us actually think that multi-asset kind of products are meant for novice investors or first-time investors. But I think it's a product for everyone. And I think we all probably don't pay enough attention to our asset allocation actually as individuals. And even, people like me make the same mistake. So I think multi-asset allocation products are extremely useful for the first-time investor. I think it provides the right balance of growth, liquidity, and low volatility. But I think all of us need to, at some point of time, think about what our overall allocations are. And either we are over-invested in debt or in equity or in real estate most of the times. And I think having a balanced exposure to equities, international equities, commodities, real estate, all under one roof could potentially be a wise way to go about doing things.
Okay, so even a novice investor can go ahead. It's not related to anybody who's experienced in the markets or has higher risk as well. So suppose somebody who's new has come and wants to invest in a multi-asset fund. What are the factors that person should be considering while doing that? How do you align that with your overall portfolio strategy? You want to diversify? Is it the only tool you should be looking at? When we talk about the overall scenario, what are the factors we consider?
No, wonderful. I think a lot of people that we talk to when we speak about this product, the first thing is, they say, I can do this myself, right? And you can, but the question is it efficient, both from a taxation perspective as well as from a knowledge perspective? I think the second aspect is the cumbersome nature of you being able to actually go and buy each of these asset classes individually. Do you have the capacity to do that on an individual basis? Here you're getting a product where you press a button, your money gets automatically allocated into a minimum of 3, if not more, asset classes in the most tax efficient way. Do remember that most multi-asset products would come either under the definition of long-term taxation for equity or debt, as the case may be, and that is something that is fairly seamless. The third part is rebalancing your portfolio. When you rebalance your portfolio individually, you are taxed on every single asset class individually. Here, rebalancing is seamless because a professional fund manager will be doing that on your behalf, and under the garb of being a mutual fund investment, the fund doesn't actually incur any tax. And I think that's a very, very powerful weapon that we tend to oversee.
No wonder we saw that move towards hybrids or multi-assets when that change in debt taxation was announced. And that was the time everyone was talking about how multi-asset could be the next theme, considering it allows tax benefits and diversification as well.
Absolutely. Ellen, one question that I have, we have flexi cap also, which is there. Multi-asset is also there. If someone had to pick between factors, right, that also invests in different funds. So this is also similar to that. But why multi-asset over flexi?
So flexi cap as a category is primarily focused on the domestic equity markets. I think most flexi cap funds predominantly own domestic Indian equities. I think there are a few that have some international exposure, but really that's an equity product, which invests across market caps, primarily in India. A multi-asset product, on the other hand, is investing in domestic equities. Some of us are investing in international equities. We're definitely putting money in commodities, especially precious metals like gold and silver, and fixed income. So that's a minimum of 4 asset classes in some sense, which would have a very different outcome in a volatile environment that we've been seeing as compared to putting money in a pure India-based domestic equity product like the flexi cap fund.
Okay, so it works as a cushion for each other. When one doesn't do well, the other one does. We have a lot more questions on how these funds really have performed. Is it lower than pure equity funds, so to say? But yes, all of that after this short commercial break. We'll just be back and continue our conversation on the other side. Welcome back. You're still tuned into MF Corner. We still have with us Dalen Pinto, who is the Senior Fund Manager at Bandhan Mutual Fund. The discussion today has all been about multi-asset funds, how they perform in volatile environments and why that should be in your portfolio as well. And you know, we started the show talking about the geopolitical risks. Yeah. There's been a lot of chatter about tariffs which kick in soon. Considering the current trends in 2025, what would your suggestion be? How have how have multi-asset allocation funds performed vis-a-vis a pure equity fund, a pure debt fund? And is this the category to go to when the situation is quite volatile?
Yeah, no, I think that's a great question. What we've seen on an average over the last 1 year, and if I just take a 1 year period, I think the median return of the multi-asset category is in the range of about 7.5%. Whereas the Nifty is pretty much given no return for a year. So clearly diversifying, and that goes back to your question about flexi cap as well, clearly diversifying across asset classes, has helped an investor grow their wealth by that amount, despite the equity markets not really doing much in the last 1 year. And that's really the power of the product, in real life, so to speak, rather than, us having a fancy model that we typically show, on how asset classes perform over periods of time. This is a real life example of a product doing what it's supposed to do.
Absolutely. What about when you talk about financial goals, right? We talk about everyone should have a goal, short term, long term. How will multi-asset allocation funds actually start playing, whether in your retirement goals or whether you have for your education, you're saving for your kids' education, wealth creation? How important is it in that strategy and how will it work there?
So, as I mentioned earlier, I think when we think of multi-asset funds, it's not about betting the house on a single asset class. So while one should not probably expect outsized returns from a product like this, I don't think the product design is really to actually get something like that, right? The fact that you're diversifying yourself across multiple asset classes means that you're trying to reduce risk. And that comes at a bit of a cost.
But then if I'm going for retirement, then I'm going for such a long time period, right? So I can still go for my equity funds or just individual funds as well,
You could,
right?
but I think different types of investors have different perspectives in terms of what is the length or horizon that they want to invest in. They also have different appetites to see drawdowns in their portfolios. And that's where most of the mistakes are actually made by all of us. So I think a product like this, really achieves to give a return, in our opinion, of close to Nifty over a long period of time, but with volatility that's much lower than the Nifty. Right? So you're getting a product that would probably beat inflation over a long period of time and therefore give you that wealth creation journey, but at the same time at a much lower volatility than the Nifty would potentially give you. The second part is it also hedges you against any long-term, low return expectations that one might have with domestic equities. I mean, there could be a period of time, and I'm not saying there will be, but there could be a period of time where we have a 2 or a 3 year period where equity returns are not as exciting as what we've seen in the past decade. And that's when this asset diversification in a multi-asset product will hold you in good stead.
Every investor should have that expectation. It's not always that the markets will work in your favor. There will be times you will not see the best returns coming by. And
I think this is the year that we're going to see that, right?
No, I think last 5 years have just spoiled everyone in terms of return expectations. So everyone should try to keep it low when it comes to return expectations. But when we talk about investing in multi-asset funds, how much should it be as percentage of your overall portfolio? Of course, when we talk about investing, say 20-30% of your portfolio into that, or should it be more than that?
Yeah, so I think that really depends on the kind of investor and where you are in your journey. For a first-time investor that potentially doesn't have much exposure to equities in general and has more of their portfolios in, in gold and real estate and fixed income to some extent, I think maybe going into multi-asset with an aggressive allocation of even up to 40-50% should be fine. Because you are getting into a product that is lower vol, and since you're getting into a product with some equity exposure, it's better not to see large drawdowns in some sense. For the more evolved investor or I would say medium to conservative investor, I think an allocation of 20-25% is also pretty good. But again, every individual needs to understand what their appetite is, what their long-term goal is, what their long-term return expectations are before deciding on their allocations. But I think that's a fair range for us to kind of work with.
You know, what about that overlap that one may see also, right? Like this does have the equity, but there's a possibility of an overlap that if you are individually having an equity fund as well, where you've invested, then how do you compensate that? Like, does that merit, like we have 40% here, and then how do we go about equity fund allocation as well? Or do we completely just have multi-asset? That's the best way.
Yes, I think the easier answer would be just to have a multi-asset product. And I don't say that as being a fund manager for multi-asset fund, but I think about that myself as well. But I think when we think about asset allocation in general, I think we've got to sit with a planner if we don't do it ourselves. We've got to pool all our asset allocations together and then see where the right balance fits in. So this is just a product that fits into that overall balance, but it must be there. And I think a lot of us don't have it. And I think that is the point we're trying to drive through today.
But then is this the best time to actually go for it, right? At such a period of time when there's so much volatility, is the right time to start for someone who's new in a multi-asset fund?
I think so. I think these are the products that really do well in volatile environments. And I think the last 1 year or 2 year returns have kind of, only vindicated, that belief in some sense.
So, you have been in the industry for so long. There was a point in time where we would just see inflows into the equity funds. The other categories are now coming up, especially, as I said, after the debt taxation change, we saw that move coming into multi-asset funds as well. Do you think this is a trend which would continue? The investor appetite for such categories have increased over the last couple of years? Or do you think there will still continue to be that volatility inflows coming in from one place, going to the other? What's your sense been with the flows that we've seen so far?
So I think in general, flows are cyclical. They tend to move to categories which kind of show you performance. Having said that, multi-asset is a relatively new category that's, come out there. It used to be more popularly known as balanced advantage in some form. And this is, with more asset classes, and therefore it's a little new. But having said that, the category has been gaining popularity. In the last 1 year alone, I think if we look at AMFI data, almost about 35,000 odd crore has come into the multi-asset category. So clearly it's being noticed. Clearly advisors are being, educated more and more about the power of the product. And I think investors are starting to notice and get more comfortable with allocating, towards the strategy as well.
Okay, that's interesting. Overall now, one has to see multi-asset allocation funds. What are the key factors we have spoken about, right? But are there some risks? I know you are managing those funds, but what is the biggest risk that an investor who's starting out right now in a multi-asset allocation fund has to watch out for, or a factor that is maybe a red flag? So now you have to give the case on the other side as well. You've spoken about all the positives.
Absolutely.
But what is that one factor we should keep?
Well, hopefully, all asset classes are not so correlated that they all go down together. I think that's the biggest risk, and that's what we're trying to avoid here. But I think in general, when you're thinking about multi-asset allocation investing and you're trying to choose a product out there, I think there are 2 or 3 things you need to keep in mind. I think one is to try and find out whether the product and its allocation strategy fits your personal investment strategy, right? So does it match the goals that you're trying to set out for yourself? So pay more attention to what's the manager doing? What is his thesis? In our opinion, we like a more strategic asset allocation where about 50% is in equity at all times, about 25% is in fixed income at all times, and the remaining 25% is in dollar-based assets, so be it commodities or international equities. That's the asset allocation that we prefer, which we've kind of, in our view, that works well. So I think you need to figure out what is that asset allocation strategy that your manager is following. The second is to find out whether the product suits your tax requirements, right? Because there are some funds out there that have debt taxation, and there are some funds that have equity taxation. So you need to try and match that, whether your holding period was 1 year, 2 years, or more than that. I think that's the second thing that you need. And the third and most important thing I always say with any mutual fund industry is your manager walking the talk? Which means that when they say they're doing something, are they actually rebalancing that portfolio every month or every quarter for you so that your asset allocation stays in check and your long-term goals are met, right? I think these are the 3 most important things that you need to worry about. Apart from the return aspect, of course, that goes without saying.
Yeah, it's because it's not always about returns. When it comes to any category that you invest in, there are other factors, and we've discussed that in greater detail. Fund manager being one of the most important things. But it's always a pleasure speaking with you. Thank you so much for bringing in your insights. Today, it was a lot about multi-asset allocation. The category has done really well. and we now know why, because of the balance it provides to an investor's portfolio. We'll keep discussing that over the next shows that we do, but for now, that's all we have on MF Corner today. Thank you so much, Dylan, for joining us, and thanks to the viewers for tuning in. But with that, we will take your leave. Stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei, which is actually the top, loser, at least in the Asian markets, down almost 1%. Kospi 2 is trading with a cut of almost 0.8%.
मोदी के लिए आपके हित सर्वोपरि है.
25,153 on the upside, 24,702 on the downside.
So hopeful that very soon they will come on a negotiating table.
24,900. So it's about a 0.25% cut there.
A 0.5% to 0.75% cut in the growth rate of the Indian economy.
This will provide a level playing field for cell manufacturers.
Lord Ganesha could, as they call it, Vignaharta. So you'd hope that their pains are alleviated for sure, at least for today's session.
Effective from 12:01 a.m. 27th of August, which is 9:30 a.m. India time.
The government is taking steps to stimulate domestic economy.
In fact, now it's at the day's high, so the recovery that we would see will come in from the FMCG space.
Well, that was the day so far. Things are looking weak for the markets. We're now down 200 points on the Nifty. The Nifty is at 24,750. The Sensex is staying close to about 700 points. But we've got 1 hour to go. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima, with me, Nigel and Manglam. Hi, boys.
Well, hi. It's a truncated week, but the bulls clearly are very, very nervous getting into that midweek holiday. And then you have expiry-related factor as well. So that's compounding the problem, right? And getting into the past weekend, there was that optimism. Maybe we'll see some kind of deal. That's not come about. So I think this trade tariff worry continues to weigh.
You call it the truncated week. It can be called a Trump-gated week as well, given the sort of uncertainty that we're seeing right now and the tariffs that have increased. But amidst all of this, one trade is definitely playing out, which is that of domestic consumption.
Yes.
Even yesterday, we had some of these export-facing names do well, only flattered to deceive. Right now, we have Britannia, which has moved higher. We have Maruti Suzuki, which has moved higher. HUL has moved higher. ITC, Hero MotoCorp, Asian Paints. So all the domestic consumption-focused names are actually at the higher end of today's trading range, even as the others are seeing extended sell-off. So it's an action-packed closing bell coming up in the final hour of trade. The stocks are feeling the heat on the back of Trump's tariff tirade. Nifty consistently hovering around 24,000 levels. Broader markets underperforming sharply. Meanwhile, it's red across sectors, barring the consumption pack, with the likes of Sun Pharma and Zydus Life reacting to bearish brokerage notes from the house of BofA and Investec. Details coming up just a bit, and the spotlight on MSCI Index reject likely inclusion for the likes of Vishal Megamart, Swiggy, Wadi Energies, Sona BLW and Thermax could be on their way out. You'll get the estimates on flows and outflows, inflows and outflows. Two-wheeler maker Ola Electric revs up its PLI incentives, an impact analysis on how this would benefit their financials.
And it doesn't help that Europe is also down now. So the CAC, that's the French index, has plummeted nearly about 2%. But here there is country-specific news. The government potentially faces a no-confidence motion, so that's hurting the French index. There is a possibility next month for a no-confidence vote in the government. But even the other markets, that's the DAX and the FTSE, are down close to about 0.5%. So global cues today have been muted. And, as we said, there are a lot of important cues lining up, starting with 9:30 a.m. tomorrow. We will have the Trump tariffs, 50% coming into effect, additional 25%. Then NVIDIA earnings. Then on Friday, you've got Reliance AGM plus the Q1 GDP print. And then some, U.S. economic data as well. So all that's hurting. Mid-cap index is down close to about 1.3%. Ashish Kyal is now joining in with a few closing strategies. Ashish, headed lower, 200 points gone. What would the approach be?
Hi, afternoon to you and all the viewers. Yes, we can clearly see that since morning, Nifty has not managed to give any kind of a positive hourly close above the prior candle high, and that's keeping the tone on the sell side. And also we are in the gap area. So there was a very big gap which was created on 18th of August, and post that price have been consolidating. So we are in that gap area. If we break below the low of 24,740, then there can be some short-term selling pressure towards 24,650 odd levels. And I think right now the approach is sell on rise, given that we are not managing to sustain that gap as of now.
And when does this negative trend get cancelled out, Ashish? If you could help us out with levels. If you're shorting the index, what is the level you're looking at? And if you were to put a stop loss, what level would you, change this sell on rise approach?
On the upside, I think 24,890 is where the hourly 20 average is lying. So I think 24,890 to 24,920 is the zone. If price manages to move back above that, that's also the opening tick where we saw in today's opening hour candle. So if we manage to move back about 24,890, 24,920, then we can expect some kind of positivity. Until then, so the strategy can be very simple. Use pullback towards 24,800, 24,820 as a selling opportunity, 24,920 as a stop loss, and then aiming for around 24,650 odd levels.
All right. Any individual stock picks that you have at this live?
Yes, on individual stock picks, there are still stock-specific action that has continued. One stock pick is Granules India. We can clearly see huge volumes since morning. There is going to be a 10 DMA crossover happening, 20 DMA support, and prices are bouncing back. Good reversal pattern. Risk reward looks good. One can create long positions here. Expecting a move towards the level of 490 on the upside and maintain a stop loss of 460 on the downside. And the next stock pick is going to be on Linde India. Again, it has found support multiple times at 6,200, bounced back from there, forming a good bullish candle. Volumes are huge right now, and we can expect a move towards the level of around 6,900 on the upside positionally. And on the downside, one can maintain a stop loss for the stock at 6,320.
All right, Ashish, thanks a lot for that. So those are a couple of stock picks that he's put out for us. I'm just putting the spotlight once again on the FMCG pack, and there are a couple of reasons for that. The biggest one is the GST rationalization that will happen. We have Britannia, which is up by around 4%, HUL, Nestle, all of them doing well. Amidst all of this, Colgate is the one which is not doing too well. And these are not my news lines. This is something that Timsy has gathered from her sources in the finance ministry. And she's found out that maybe the GST rate on toothpaste remains at 18%, does not come down at 5%. So that may come across as, a softener or a weakener for something like a Colgate. Whereas on the other hand, biscuits, which are considered to be items of mass consumption, out there the GST rate could go down from 18% all the way down to 5%. And that would actually make a difference because, these products actually are fairly price sensitive. And immediately as the prices come down, you could see a volume uptick, and that's what the street is betting on as well. So the current rate on toothpaste, 18%, proposed rate is 5 to 18. Remove that 5, as Timsy tells us, it could be 18 itself. Biscuits would be 5, soaps, hair oil, all the others could be anywhere between 5 to 18. But be that as it may, for the consumption space itself, things are improving. We had heard from all the managements. And amidst all of this, the one stock that really stands out on the way up is ITC. Why do I say that? Because all parts of their business are doing well. In the first quarter, the tobacco business margins were lower. But turns out that maybe the current crop cycle is indicating that those leaf tobacco prices would moderate going forward. Their FMCG business would benefit from the uptick in consumption, but at the same time, there is early signs of recovery because of all the factors that we are talking about. The interest rate cuts that have come in, the income tax rate cuts which have come in, the proposed pay cycle that will come by as well. So those things would benefit. And finally, paperboards, which was a business which was underperforming for ITC for the last 8 or 9 quarters, I remember. They have around 80 to 85% of their revenues coming in from the virgin paperboard business, which is the one that benefits from the minimum import price that has been imposed on virgin paperboards. So those factors doing well for ITC, all things coming together at a time when the stock is trading at 19, 20 times 1 year forward earnings. So a lot of these consumption stocks actually doing extremely well. Also because the focus now moves domestic. Tomorrow is Ganesh Chaturthi, the harbinger of all the other festivals that we see from now on. So there will be Ganesh Chaturthi, thereafter Navratri, Dashera, Diwali, going all the way up to Christmas.
Okay, all right, Maglam, thanks a lot for that. Dharmesh, good afternoon, good to see you in Dharmesh. You're looking forward to the holiday, but it's going to be a little tensed on, right, going by today's finish. That said, how are you going to be, how are you viewing the consumption basket and what do you like?
Yeah, good afternoon, Nigel. Getting so the festivities. Yeah, definitely. I mean, it would be a tough holiday to go into, sensing how the entire, geopolitical and the tariff saga is panning out. Coming to the consumption basket, I think incrementally, definitely it's going to be a bit of a volume booster because in rural area and semi-urban area, this slight decline in the prices does help consumption volume, maybe a 1.5 to 2% kind of a volume uptake can be seen out the entire space. Having said that, let's not forget that, I mean, all the stock prices are at a very elevated, higher multiple levels of the valuation count. And most of them are trading anywhere between 55 to 70 times of PE multiple on a trailing basis. And on your forward, it can be 10% lower at for 50 to 55 times PER. See, one thing one has to answer in this environment, one can get an upside of 5-7%. But if you can look at these companies as a, say, 15% kind of a CAGR on stock price for the next 3 years, then you have hardly any choices out there. And here I go by Banglam. ITC, I think, looks fairly valued, quite cheap compared to the other competitors in the play. And all the valuation vectors which goes into the valuation of ITC is working fine with them. Cigarette, I think the GST after the rationalization 2.0 should be tax neutral. There should not be any, tariff related issue out there. And let's have this in mind that in cigarettes in India it's still allowed to be sell, whereas vaping is not. So, but definitely government has an eye on the kind of taxation which comes to them from the cigarettes. So, ITC to my mind looks pretty attractive, and I have recommended this on your channel earlier as well. And here you can see 25-30% kind of stock price appreciation in next say 1 year or so. So ITC is the stock which we are recommending to our clients.
Right, ITC is a stock you're recommending to your clients. What about some of these domestic automakers as well? Maruti is a stock which has hit a record high today. We are also seeing some traction in Hero MotoCorp. Eicher Motors is up around 3.5%. Do you think the consumption boom will actually extend to the automakers as well and early entry-level two-wheelers?
Yes, Mangalam. If you see, I mean, July numbers of most of the two-wheelers, especially, and Hero MotoCorp, which caters to the entry-level segment, it was 21% kind of a volume growth, and 20% of that volume growth came from the domestic sales. So things were, picking up, but just because of this GST announcement, what we are getting a feel from the dealers is that, there has been a delay in the purchasing. I mean, it's shifted to now. Post the GST announcement will come through, then people will go in for buying their new bikes or cars, because it's a substantial kind of a reduction which will happen in the net cash outflow which you are going to have when you are buying your assets. So there we are constructive, and there I think the topic still remains Hero MotoCorp, though the price has moved up quite significantly, but still I think 10-15% kind of a scope is there in Hero MotoCorp along with TVS Motor. So these two picks are looking well. We are avoiding Bajaj Auto because of its exposure to the international market, and it's in the premium segment. One caveat which I would like to highlight, it's a general assumption of the market that things which are falling in say 28% category will come to 18%, and 12% category will go to 5%. So you don't know, I mean, like premium cars can go to sin of like GST rate of 40%. There can be premium bikes which can migrate to that level. So that's somewhere some compensation has to be made for this tax forgo which the government is doing. So Bajaj Auto we are not very constructive on, but yes, Hero and TVS looks fairly placed to capture this opportunity.
In fact, today, Ather and Ola are also higher in trade. Both the stocks are up nearly about 5%. And Ola Electric has said that the company has secured a PLI certification for its Gen 3 scooter portfolio, which forms over 50% of their portfolio. And once you get that certificate, you are eligible for PLI benefits, which range between 13 to 18% of the overall value. But let's talk about pharma. Sun Pharma is under pressure. Zydus is in news. Ekta joins in with the details.
Well, yes, pharma stocks are in focus because there were some comments which came in from the US President Trump as well, mainly focused towards innovative drugs, but maybe it could have perturbed a little bit of sentiment. So the US President has said that he will look to slash drug prices between 1,400 to 1,500%. Quote unquote, going to do a number on costs of drugs in the US. And remember that the statement comes a month after Trump sent letters to pharma companies such as J&J, Novartis, Merck, Pfizer, etc. It's also set a 29 September deadline to lower drug prices. The demand is to extend the most favored nations pricing to all Medicaid patients. Earlier this month, remember that the US President Trump said tariffs on imported pharma products can reach as high as 250%. So that's probably shaken a little bit of sentiment, because the move is to eventually move manufacturing back to the US. Now, BofA Securities separately has written on Sun Pharma. They've downgraded the stock to underperform. They've cut the target price. According to them, they expect slower revenue ramp up from new launches compared to consensus. Sun may pursue further specialty acquisitions, but the upside, according to them, is already priced in. Most favored nation clause could continue to weigh on Illumia, which is one of their key drugs in the specialty portfolio. Investec has written on Zydus. They have a sell target price of 940. According to them, the valuation is now unfavorable, and the valuation, and it's an earnings risk as well. Mirabegron, ER, and Revlimid generic, two drugs together contribute to around 35% of FY26 EBITDA, and both face risks of disappearing without backup products, according to them.
All right, Ekta, thanks a lot for that. So those are a couple of these stocks which are lower right now. Dharmesh, Do you track Sun Pharma and Zydus? Do you have a view on them?
Yes, Sun Pharma we do track, but I mean the numbers were not that great for the Q1. And going forward, I think it would be a steady state of around 12 to 15% kind of a compounding on the top line side with stable margins, because input prices have been quite benign for Sun Pharma. The only problem is this news flow of Mr. Trump coming in and going out regarding the tariff levels, and the fear psychosis which he is creating is a disturbing news. So I think stock price action would be a difficult. It will be reacting to the news flows. But pharma as a whole space, most of them are either into generic or API or CDMO kind of a player. So I think with the steady state of 17-18% kind of a growth, most of the pharma companies came out with a very good set of numbers, be it Ares Life Sciences, Mankind Pharma, and others in the same bracket. Lupin is one of the counter which came out with a strong set of numbers. So that's likely to continue. So the strategy here is for trading purposes, whenever there is a decline of say 5-7% on stock prices, it's a good opportunity to get into it. And then again, because news flows will keep on surrounding them, you should take your profits on 10-11%. We don't see it as a as an investment bet for next 1.5 to 2 years, given the context in which these stocks are trading.
What about Protean eGov? The stock is higher. In fact, it skyrocketed after the company won a 1,160 crore mandate from Aadhaar UIDAI for establishing Aadhaar Seva Kendras across 188 districts. I think this is for a period of 6 years. Now, do you think, Dharmesh, the stock is attractive? Because in the past, when that, just before the fact that the company didn't qualify for PAN 2, it didn't get shortlisted, the stock was at 1,400, 1,600. And since then, the stock is now down to 900 rupees. At this juncture, is this attractive, and how big could this order be? Today you've got nearly about 1,200 crore of an order win, but could it expand in size?
Hi Rima, I mean the problem with Protean eGov has been, if you look at last 10 years number, it has been a serious decline in the margins from 23% 10 years back to 10% kind of operating margin this company has now. And this order of 1160 crores has to be served over a period of 6 years. So 190 crores is the annual run rate which is coming. And the top line, it's been languishing around 755 crores to 855 crores on an annual basis. So last 10 years is the same story. It has been surrounded by good news flows, and because of that you see stock price traction happening time and again. But I think it's a small company, market cap is also pretty small. So first the proof of the pudding has to be tested. Let it come out with 2-3 order flows, and when book to bill ratios more than 5x, that is a time when one can look at seriously looking at this company. Second is, for such companies the business moat is too low. Anybody who can have a good software in place and good connections can get the business running. So dependency on the government order coming in and getting checked out, as we have seen earlier with the same company, is also pretty high. So to my sense, such rallies are specific day, news flow based kind of a rally. It's not a good investment to my mind.
Okay, all right. Stay with us, Dharmesh. For the time being, let's hop across to Vivek. He is here to tell us about the MSCI changes and the kind of outflows we're expected for today itself. Vivek?
Well, that's right. So remember, MSCI adjustments will happen in the last hour, half hour of today's trading session. So elevated volumes are what you can expect, especially amongst the inclusions as well as exclusions. Remember, the announcement was made on August 8, 2025, and today is when the adjustment will take place. There are 4 additions this time around and 2 deletions. However, with the weight changes, it's actually a net outflow event as far as Indian equities are concerned. The 4 additions are Hitachi Energy. Analysts are expecting inflows of close to $220 million. Swiggy, close to $280 million of inflows. Wari Energy, close to $220 million of inflows. Vishal Mega Mart, almost $250 million of inflows. On the other hand, the 2 exclusions from the MSCI Standard Index are Thermax, expecting close to $110 million of outflows, and Sona BLW Precision, close to $160 million of outflows. So, given the fact that this was announced well in advance, a lot of it may already be priced in, but definitely you can expect elevated volumes in these names, especially in the last half hour, 45 minutes of the session today.
Right, Vivek, thanks a lot for that. So those are a couple of stocks which will be in focus today on the back of the MSCI rejig. Meanwhile, just keep an eye out on Edelweiss Financial. That stock is up 7%. There was a large trade on that counter this morning as well. Cello World is the other one which is higher. And Swiggy, it's recovered from the lows a fair bit, currently at the higher end of today's trading range so far as well. So pull up Swiggy. For a large part, it was in the red, between around 11:30 to close to 2. Now it's recovered, moved by about 1.5% from the lows today. Dharmesh, do you track the quick commerce space? Do you have a view on Swiggy versus Zomato? Obviously, everyone speaks about the valuation gap between the two, and basis what one's assumption is, they prefer one over the other. What is your preference here?
Yeah, we do track, both the companies and the space as well, but the problem is the valuation part. So Zomato has run its course. Now it's a highly valued company, more than 3 lakh crores of our market cap. And there the things looks pretty difficult to justify the valuation multiple. And most of the profit is coming because of the cash and investment book they are having also sitting on. So the path to profitability may be there. It's look very much visible in the case of Zomato. And Swiggy has been a follower. Whatever they do, they try to replicate. One-off cases can still be there when they have come out with a new product, but essentially it's more of a follower kind of a company. We do feel that though the space look attractive, but given the valuations at which they are trading, the justification of that over a period of time would be difficult. So more or less for next 2-3 years, I think the stock prices will languish in the range. There won't be a wealth creator from here on, and if the profitability does catch up, then they will come back into reckoning. So till that time, it's more of a avoid, and maybe a trading place can still be there. So we are not now recommending any of the companies, though we have recommended earlier in the past, but now we have recommended for our clients to take profits and be out of the space.
Got that. Thank you very much for that. Lots of other consumption names. Vishal Mega Mart is up in the green. Devyani International has surged 2.5%. Nykaa has gained about 1.25%. So this entire consumption theme continues to be very active. Get into a break. We'll come back on the other side. Vikas Khemani of Carnelian Asset Management will join in on the other side. Stay tuned.
Welcome back. Well, market's not able to actually pull back from the low point of the day, but Swiggy is the one that's swigging it away. That's seen a bit of a recovery from the low point of the day. I think we should get the intraday chart of that particular name up for you on the screen. But there are plenty of stocks buzzing around. Hormuz joins in to turn the spotlight on all the movers this hour. Hormuz, tell us more.
Well, some interesting movers in today's trading session. And start off with some names like Ratan India Enterprises, and this is the biggest single-day gain that the stock has seen since the month of June. 9% higher on the stock today, among the top gainers in the broader markets. It has gained in 5 out of the last 7 trading sessions, and it has moved on strong volumes as well. Over 6.5 crore shares have changed hands today, compared to a 20-day average of just 3 lakh shares. And courtesy of this move, the stock has trimmed its losses down for 2025, down to around 10%. The other mover in this list today is Lumax Industries, and that too has seen gains of around 8% in today's session, snapped a 3-day losing streak today. And the volumes here, before this 3-day losing streak though, the stock was up for 3 days, and during which it had gained around 18% as well. So after this 3-day move, the stock is higher today, and almost 2 lakh shares have changed hands so far, compared to a 20-day average of just 18,000 shares. Now, courtesy of this move, this is the volumes that you have seen today are the highest in a single day since November of 2022, and the stock has been an outperformer this year with gains of around about 75%. And the last time it had gained in such an extent was around back in 2017. Now, Kolte Patil Real Estate has continued to outperform. It's the 4th day of gains for Kolte Patil. The last 6 sessions have seen volumes consistently higher than 1 lakh shares in a day, and has consistently moved higher in terms of volumes. 8 lakh shares today, compared to a 20-day average of 1.5 lakh. And after this move, the stock has broken above its 50-day moving average and is up 30% so far in 2025. The other mover in this list on the downside is Aegis Vopak, and its latest listing, down 4% today, is declining on low volumes. So the movers on the upside are on higher volumes. This stock is declining on lower volumes, and this is the second lowest volumes in a single day that the stock has seen since listing in June. And in fact, the lowest volumes that the stock has seen was last Friday. Now here we have seen almost 2.5 lakh shares change hands, compared to a 20-day average of 5 lakh shares, and the stock continues to hover around its IPO price of 235 rupees a share. And rounding off this list with Vodafone Idea, is given up half of the 6-day move that it had seen. It had gained 20% in the last 6 sessions, down 10% today, and this is the 3rd consecutive session of 100 crore and more shares trading in a single trading session. The last time this happened for 3 consecutive sessions was back in November of 2024, and 124 crores shares today, compared to a 20-day average of just around 41 crore shares. And the stock has moved on the lower on the downside on very high volumes now in today's session.
All right, Hormaz, thanks a lot for that. So those are a bunch of buzzing stocks. In fact, to that list, we can also add Unichem Labs, the stock at the bottom of your screen, as ticker told you that, one of the closures for one of their plants has come in from the US regulator, indicating that all is well with that plant, and the stocks surged on the back of that. But two-wheeler EV maker Ola Electric is extending gains on the back of that PLI certification that it has gotten for its Gen 3 scooter portfolio. Sudarshan joins in with more details on that one. Sudarshan.
So Ola Electric today at one point was up almost 7%, still currently up almost 5%. It's on the back of the company's disclosure regarding the PLI certification that it has secured for S1 Gen 3 scooters. And now with this, its entire portfolio of Gen 2 and Gen 3 scooters are PLI certified. PLI certification for Gen 3 is very important because Gen 3 scooters form nearly 56% of its total volumes. And now company will be eligible for incentives, PLI incentives, and that would be in the range of 13 to 18%, and that would happen till 2028. Now, on the back of that, company is saying that profit is going to improve, and that may happen in this quarter, that is in Q2 FY26. After Q1 earnings, company had told that auto business EBITDA will turn positive in Q2, and in FY26, auto business EBITDA margin is expected to be 5% or more. So we'll have to see if company's comment about the profit fructifies or not. But as of now, stock is higher.
Thank you very much for that. Vikas Khemani, founder Carnelian Asset Management, is now joining in. Vikas, thank you very much for joining in. You know, we knew that that 50% tariff, that additional 25% is coming, but it's come. And it's hurting now on the markets. We've anyway underperformed many of the emerging markets. Some would say there was a catch-up because we had outperformed, so therefore it's okay if 1 year you don't get any sort of a returns. But even today, 24,750. How do you expect all this to play out from a market point of view for the next 6 months?
I think if you just take this current events, from a next 6 months perspective, I'm quite sure that in 6 months time down the line, there will be some solution to it either way. Either we will get used to 50% or it will be rolled back, right? And given the fact that it's not a very significant part of our economic growth, unlikely to derail, as we've been hearing very clearly from the establishment and the government and today RBI governor, or yesterday RBI governor also made a comment that they will all do what it takes to stimulate the economy. So I think, in my opinion, it's not that bad. All the bad news is very well known. So the markets are holding on very well despite all the bad news being known by the market. I think everybody's been talking about earnings slowdown, tariffs for last 3-4 months. And despite that, markets are holding on. That's telling you something. So in my opinion, there's more upside risk than the downside risk to the market. And in this kind of situation, given the fact that there are no structural fault lines to the Indian economy, growth drivers would come in place, whatever little bit slowdown people are talking about. And as and when that plays out, there will be quick run up in the market. Now, whether that happens 3 months down the line, 6 months down the line, I don't know. As far as our view is concerned, we believe that second half of this year, corporate earnings are likely to pick up, backed by interest rates cut, liquidity infusion, and GST move which government is planning to take. So all those things are going to help corporate earnings in general, and hence it's wise to remain invested into the market. Which point in time market will run and outperform, nobody knows. And if you try to time it out, you will miss that first big up move.
Hi Vikas, good to see you in, and you're very, very optimistic on India's prospects as well as the equity market in the longer term. But in the near term, this earnings recovery is not yet visible. And, both fiscal as well as monetary policy support has come about. You think enough has been done now so that the second half of the year will be, we'll see some kind of recovery? Because the good news is our regulators have seen, yes, there is some softness and they're doing something about it, which is very encouraging. Do you expect more measures, or do you think bulk of the measures are already done?
It's never, switch. It's a dial. I think government and the regulators kind of do their job, as the need is. And I think a lot of heavy upfronting or heavy lifting was done by RBI, beginning of the late last year or early this year, in terms of infusing liquidity and interest rates cut. That obviously takes 2 quarters to 3 quarters before it reflects to corporate earnings. Just like this, when the tightening happened, it took 2 quarters to impact the earnings negatively. It takes 2 to 3 quarters to impact positively. And that's what I'm saying. And on the top of it, you are, this current crisis, in my opinion, will also, open the door for significant reforms, including GST being talked about and many more, which in some sense is good for medium term to long term, because in these kind of times only bold reforms gets urgency and gets done. So I'm quite hopeful that government will put some act together and push a little bit more in terms of the reforms which can be boosting the growth. So I'm quite optimistic. Like I said, downside seems to be limited. Upside, as and when that comes, could be very fast and quick. Timing one does not know.
Okay, all right. Well put then. What about a couple of sectors and themes? Pharma is a space where in a couple of funds, I think you'll have an overweight out there. Laurus is one stock that's done very well for y'all. Is that a theme that you like? And do you think that will continue to do well from here on? I'm looking at some of your portfolio stocks, and you have GSK Pharma, you have Biocon, Laurus Labs as well. Tell us, how do you approach the pharma theme?
I can tell you that, we have not made any change given the last 3, 4 months, 5 months of uncertainty, because we think there's nothing which big time has changed in the Indian story. It continues to remain same way. CDMO and pharma has been our, theme which we've been playing for 2 years, and it's done very well for us. And we think it's here to stay for a very long time. So, nothing per se change. Of course, there will be always short-term noise here and there. You got to ignore that. But structurally, we find it is a very, very promising opportunity for India. I have said many times in our previous interaction that it's kind of similar to what IT was in mid-90s. So when you have this kind of big opportunity, you just kind of buy stock, high quality leading stocks, and just stay put.
Vikas, I was just reading a recent note which was written by Carnelian Capital, where you flagged a new fad FOMO wave in unlisted and preferential allotment space. So you're basically revisiting 2021 warning, where market cycles often begin with a fad, a hype narrative. It's followed by FOMO, fear of missing out, and they end in fade, where excitement disappears and prices crash. And you're giving some examples, for instance, in HDB Financial, because pre-IPO it was trading at, it was being offered and bought and sold at a much higher price, and now it's trading at much lower levels. And even in others like Swiggy, Vari Energy, etc. In the listed universe, are you seeing any overhyped sectors?
Like the reason why we wrote that note, Rima, you brought it very well, that time and again these kind of fads do come. In last 12 months specifically, we have noticed that being unqualified investors who don't understand, buying private has become a fad. Everybody wants to buy out, and without understanding the company, its business, I think most of the time people know only the share price. If you ask them, even market cap would not know, and very, very reasonably large wealthy people. But the reason why they're buying is because everybody's buying, and there's a lot of fat. And I think we've seen significant amount of value getting lost and eroded. Otherwise you will not buy. The price discovery is to be done by the qualified people, not by the retail. And that's the kind of big point. So I think right now, 2021, we saw same thing was happening under the name of new tech, and every company was getting listed, and a lot of people lost money in that. We have seen in after 5 years also, they haven't generated kind of good returns. Today, similar thing is happening in the private space, preferential allotment. So that's a note which is basically warning or kind of giving early warning to our investors that be careful, protect your capital, don't be part of these fads. And these things do happen very often. In preferential allotment is like in the listed, typical template is stock goes up and you're offered at a discount. People think it's a discount. Actually, this is a manipulated stock price. So this is happening, especially in a very smaller market cap companies. And one has to be very, very careful about these kind of, sort of setups in the market. We think that investing, you have to keep risk reward in mind. You have to try to protect your capital. You have to avoid these kind of mishaps. That's the kind of aim of this note.
Thank you. So very broadly, yes or no, should one stay away from IPOs because they are being offered at a higher price to begin with?
No. Again, this is a very broad base. It's like this that do you think everything in the market is bad? So IPOs, see, we don't disrespect IPOs. IPOs are a great place to get new access to the great companies, right? Only problem is that when they come in a good market, they come overpriced and they come hyped. So in fact, we generally start with a negative bias. Only we invest into IPOs which are coming, in exceptionally good businesses at a reasonable valuation. And most of the time we start with the no, and then we see why we should be investing, because they are hyped, they're overpriced. And if you see, you go back and look at companies got listed in last 2-3 years in the hype time, and you will find them, once the hype settles down, either you see prices correcting. So those are the times when you revisit some of the companies, because those companies could be very good companies, no doubt about it, but they may not be good price to get in or right way to get in. So you got to kind of evaluate completely fundamental bottom up basis, whether should I invest into that. Per se, you can't say, IPOs are bad or IPOs are good. It is about a company. It is about a business. But yes, in general, in good markets, IPOs tend to get overpriced, overhyped.
Indeed, there is no blanket rule that one can apply. Thank you very much for joining in. Let's talk about Maruti Suzuki. They've launched the latest electric vehicle, e-Vitara, in Ahmedabad today. R.C. Bhargav, the chairman of Maruti Suzuki, spoke to the media after the launch. Listen in.
What we saw rolling off today with the PM flag, that's going to get exported.
But when do we see India sales start, sir?
When do you see the export date? Does anybody know the export date?
All within this month.
Well, it can't be very long, because we don't want to keep the cars in inventory for a long time.
Okay, that's gotten Maruti excited today, this development. But Nigel has now moved over to the big wall, and he's going to tell us about all the futures and options trends from the F&O desk.
Well, extremely weak trading session, Rima. And if you look at the screen, the last few minutes we've gone ahead and we've breached the 20 DMA on the Nifty. All through the trading session, we managed to defend that level. And the last few minutes, we've just breached that mark. By the end of today, you'll hope that maybe, in fact, you see a 20, 30 point bounce up. At least you defend it on a closing basis. Moving to the Nifty Bank, that's where the problem pocket is. We broke that 20 DMA. The fear is that if we're going to be seeing a sharper correction, then there's another 1,500 points thereabouts to go, which will take us to around the 200 DMA. So for the time being, breaching the 20 DMA has already signaled that the Nifty Bank, that's the one that is seeing some kind of weakness. Moving to the options data. Now, the call writers, they are back in the game today. If you just take a look at the 24,800 call, just take a look at the premium out there. It's gone down by close to 80% in a single trading session because the bears believe that these higher levels are going to get protected. For those that are writing this strike, well, they'll be looking at the 24,950 as a level, which can, get protected. The 24,900 call as well, just take a look at the premium. From around 130 rupees, it's down to around 22 rupees. So there's a writing that we're seeing at those levels. Going by the options data, 25,000, 24,950 level is what the bears don't want to see, and we have expiry that plays out on Thursday. On the downside, this 24,750 put, it was seeing some writing, but there's a mix of activity now. Because at the start of today, the premium was only around 15 rupees. Now it's moved up to around 70 rupees. So those put writers, well, they'll be making some good amount of money. So that explains why the PCR has come down drastically to sub that 0.8 odd level. Moving to individual stocks then, massive shorting is what we're seeing on Sun Pharma. Take a look at it. The stock is down, open interest build-up has swelled up. There's an element of rolls as well that we're seeing out there. But on the buying side, you have ITC as well as Nestle India. Both those two stocks are holding on to their own, and both of them are seeing a good amount of open interest build-up. And finally, Titagar, that's the one that you should keep an eye out on. There is an element of rollovers there towards the end of the series as well. And also there is some shedding of open interest. So Titagar is likely to be the stock that comes out of the FNO ban, which explains why that stock is holding in the green. Back to you.
Thank you very much for that. And markets have slipped some more. We were down 200 points when we started the trade. Now we're down 250 points and closer to 24,700. Asian Paints has extended itself into the red. Trend is now down more than 2.25%. So these are stocks which are at the day's low. Look at that fall that you're seeing in some of them in the last 10 minutes or so. Reliance Industries too is down close to about 2% Bajaj Auto, IndusInd Bank. So the selling pressure has picked up. Expiry, remember, is on Thursday, and tomorrow Indian markets are shut at 9:30 a.m. The additional 25% tariffs on Indian goods to the US come into effect, taking the total tariff to 50%. Get into a break. On the other side, we'll get you a few BTST calls from our technical experts.
Well, there's a sudden bout of sell-off that has come in the market. In the morning, it was threatening to break the 24,800 mark, and now it's slightly below the 24,700 mark as well. And this last, 10 or 15 minutes of selling have been extremely sharp. They've come in names like Reliance. So pull up the intraday chart of Reliance. That heavyweight has slipped to the low point of trade. Alongside that, we've seen a fair amount of selling in names like L&T as well. So L&T comes up for you. And the consumption stocks, which are actually doing well, pull up something like an Asian Paints. That has come in for some profit booking. Trent is lower. And alongside that, we have a couple of these two-wheelers as well, Hero MotoCorp and Bajaj. Both of them, which were doing well in trade, have now slipped into the red and fairly well around the lower end of today's trading session so far. So pull up Bajaj Auto. There you have it. A sharp gash is what we've seen. Below 24,700 for the Nifty right now. Ashish Kayal joins us back again for a tomorrow trade. Ashish, before that, it was a 24,740 mark that you were looking at. The Nifty has broken that, and an accelerated sell-off that has taken place thereafter as well. What does one do on the frontline index? And then you can tell us your tomorrow trade.
Hi, Mangalam. See, like we discussed, use pullback to sell, and we were expecting a target of around 24,690, 24,650. We are already at 24,690. I was expecting it for tomorrow, but it happened now itself. And when we were talking, Nifty was somewhere around 24,780 odd marks. So overall undertone as of now is bearish. We are attempting to fill the gap. Shorting now is not going to give a good risk reward because there is not much room. There is a support kicking in around 24,650 odd levels. If you get an index around 24,750 odd marks, 24,770, 780, that's where you can look forward to sell. On the upside, again, 24,900, 24,880 is the stop loss, and then aiming for 24,650. Sell on rise is the strategy on the index as a whole. But there are certain stocks that are outperforming, and the BTST idea is going to be from, we can clearly see Swiggy. Swiggy has shown a very smart move on the upside. And even in today's session, we can see that the stock is managing to sustain positive by 1.5%, and it can move higher from here as well. Zomato, we can clearly see, has done exceptionally well, and Swiggy has a lot of room to catch up. So one can go long on Swiggy, maintain a stop loss of 418 on the downside, and on the upside for Swiggy, we can expect a target of around 455 levels.
Okay, all right, Ashish, thanks a lot for joining in and filling us in with all of those details. Well, Rajiv Anand has taken charge as MD and CEO of IndusInd Bank. Ritu Singh joins us to tell us about the challenges that Anand may face while rebuilding the bank.
Well, it is official. Rajiv Anand has finally taken charge as the MD and CEO of IndusInd Bank with the Reserve Bank of India's approval for a 3-year term. We were the first to report that he was the front runner back in June, and now the financial markets veteran with more than 35 years of experience has stepped into the hot seat. A chartered accountant and commerce graduate, he's best known for his expertise in capital markets, from starting as a trader at HSBC to becoming the CEO of Axis Asset Management back in 2009 to more than a decade at Axis Bank, where he rose to the DMD position before retiring earlier this month. Rajiv Anand brings with him both retail and wholesale banking experience. But at IndusInd, he inherits a bank at a crossroads. After its worst ever quarterly loss in the fourth quarter of the previous fiscal, triggered by the accounting lapses, the lender did bounce back in the first quarter of this year with a profit, but there have been casualties in the form of top-level exits. The bank's chairman, Sunil Mehta, though, has assured investors that legacy issues are behind and irregularities are fully absorbed, and laid out a 5-point focus plan which includes profitability first, tighter cost discipline, and so on. But for Anand, the task is very steep: to stabilize the bank, rebuild its reputation, fix internal controls, and restore investor confidence. He must also steer a 30,000 crore rupee capital raise to shore up the bank's balance sheet while managing regulatory scrutiny, including the ongoing investigative probes. So the near-term focus is clear: reconstitute the leadership bench, even as the longer-term test is going to be the execution of the strategic roadmap that he lays out.
All right, Ritu, thanks a lot for that. So that's a profile of Rajiv Anand and his plan for IndusInd Bank. For now, just watch out for the frontline indices, and that's because of the worry, the uncertainty around Trump's additional tariffs on India, which kick off tomorrow morning. Let's listen into what Mark Mobius, the chairman of Emerging Opportunities Fund, had to say on how this could impact the Indian market and economy. For a usual India bull, Mark Mobius was fairly cautious this time around. Here are his views.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous. India's got an incredible domestic market, and more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the U.S., which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the U.S., I think the Indian economy will still be doing very, very well.
Welcome back. Well, as promised, let's get Jay Bala of Catch the Chaos, who joins us on the show. Jay, what's going on? Markets today at the low point of the day. Do you think we are forming a bottoming out process? And do you believe we bounce from here? Tell us the levels you're tracking.
Hi, Nigel. Thanks for having me on the show. I think the markets moved from 24,337 to 25,153 was the first leg of the bounce. I would have wanted market to already be about 25,330 at least on intraday basis, but the fact that markets have come down is a little bit of caution, not too much. But I think the markets, the August low of 24,337 is likely to hold. In the unlikely event that the markets were to go below 24,337, we are looking at a deeper correction somewhere close to 23,500, but that's not the primary case. So as long as the markets can hold about 24,500, I think the 24,337 low of August is likely to hold, and we are looking at fresh record highs in any case from a 6 to 12 months perspective.
But it's looking quite worrying, Jay. Just look at the screen. It's looking quite worrying out there. But you're saying that we're forming that kind of process where we actually bounce back from here. We got that correct, right?
That's right. That's right.
What about the Nifty Bank? That's been the
and FMCG, Nigel.
Yeah.
They are showing they are coming to bat for the bulls. So that's a positive sign. IT has been a laggard. The fact that IT is trying to turn around itself, and stop falling, that itself is a positive. And autos is extremely strong, even with today's pullback. It's on a very strong wicket. So the markets are, on intraday basis might look shaky, but I think it's likely to get resolved higher very soon.
And what happens to some of the other heavyweights? We have the consumption stocks which are doing well over the last few sessions. So if you have a call on the FMCG index, and the second one is Reliance. Ahead of AGM, brokerages are getting slightly positive on it. The stock's done decently well this year as well, up nearly 14-15%, but nowhere near its record highs right now. Where do you think that one goes?
Yeah, the FMCG is having its counter-trend bounce. There are outliers like Colgate, which are actually could be outright bullish. But when it comes to Reliance, the support at 1364 to 1350 is very crucial. And that's the important player for the market. As long as Reliance can stay up, I think the markets can do pretty well. And again, just like the Nifty, or in fact, the Nifty is just like Reliance, the move from the August low to the recent high of about 1431. That looks quite bullish for Reliance. Let's see what it does. But as you pointed out, Reliance is very crucial for the overall market.
Okay, all right. Let's talk about, a couple of stock picks then. What do you have for us?
I have two stocks, one from the cement space and one from the capital space. So basically, Shree Cement's I'm quite bullish. It's had a reasonable correction of the 52-week highs. And I think the low at 29,300 is likely to hold, possibly heading to fresh 52-week highs past 33,500. The second stock is Linde India, formerly VOC India. This I had picked up for CNBC in the month of May, to be precise, around middle of May. From 6,600, it went to 7,800, and now it's pulled back from that 7,800 high to 61.8 Fibonacci retracement and starting to bounce from here. And the longer-term picture for the stock is also very good. So if the low support at 6,100 is going to hold, I think we are looking at a very strong move, initially past 7,800. And if it goes past 7,800, I don't think it's going to stop there, possibly heading to fresh all-time highs.
Just looking at two stocks, Jay, before we step into that short break and go into market close, we have Deepak Nitrite, which at a time when the market is actually moving towards the lower end of trade, that stock spiked to the high point. So pull up the intraday chart of Deepak Nitrite. That stock's actually gained most of its numbers this week. Today itself, it's up 2.5%. Obviously, the last couple of days, it's not moved much. And the other one is Dodla Dairy. That's the other stock which is up nearly 5%, 6% off lows. Even as the market's moving lower, we have these stocks which are doing well. And we have Vari Energies as well. Vari Energies has too surged to the high point with a gain of almost 5.5%. Any of these names that you like? There's Dodla, Vari, as well as Deepak Nitrite. If you track them, like them?
Let's see, Deepak Nitrite is trying to put in a huge base. It's forming a base around 1780 odd levels. But the structure isn't too good. But if it can manage to hold about 1780, it's developing into a huge price structure. But Vari is a very illiquid name. I'm looking at Vari Technologies. So I don't track it so closely. Dodla again. That's a much better looking chart, and it's got short-term higher highs to come through. As long as the stock can hold about 1250, I think that's looking good for fresh 52-week highs.
What about gold? Will gold continue to shine from here, or is silver looking better?
Silver is looking a shade better than gold. Gold has been stuck in a range for 12 weeks now. Watch the London fixing. If it can cross about 34.40, gold will also start getting bullish. But if London gold, spot gold, were to drop below 32.67, 32.50 odds levels, I think there'll be a downtick first, a sharp downtick first to somewhere about 2,900, and then fresh 52-week highs. So the range is very tight for gold. It's been stuck there for the last 12 weeks.
What about some of these paper names? Yesterday we saw a big spike, and today there is a sharp bout of profit taking. So pull up, something like a JK paper and the others. JK paper is now down 8% after a near 13-14% rise yesterday. The reason why it's lower is because, the MIP, which has come, the minimum import price which has come on virgin paperboards, as the management told us, accounts for just 10% of the overall market. So the overall market in India is close to 250 lakh tons, of which virgin paperboards is just about 20 lakh tons. So less than 10% of the market, of which the leader is obviously ITC. But the others as well, they have about 20-25% sort of market share, but not too big in terms of their overall contribution. So that's about JK paper. Jay, actually, we'll continue this conversation with you on the other side in Markets Forward. But for now, let's wrap.
Yeah, that's right. Let's wrap up on today's trading session. It was week one. The Nifty goes home with the cut of around 250 points. We breached the 20 DMA on the closing basis. Structurally, things not looking very good. A whole host of factors played out today. Trump's tariffs, you had a truncated week, you had the weekly expiry that will play out, and you had the MSCI selling as well. Sentiment seems to have taken a little bit of a hit, and that's why the markets were down. Breadth of the market, you had just one stock that was advancing for around 3 stocks that were declining. But mind you, from the broader market, there were a few stocks that did do well. Case in point being Protein eGovern on the back of an order win. You had BLS as well that did do well because of the order win. Vare Energies towards the end of trade, that did surge up in trade. Vikram Solar was the other one that was up close to around 7.5%. And Ola Electric as well. That one said that PLI benefit will gradually flow through, and that's why those stocks did do well. Today, we did see that a lot of these domestic-facing FMCG names did do well. So you had HUL, Nestle, and ITC that held up. From the auto pack, Maruti rolling out their first electric vehicle from Gujarat, so that stock did well. And the Royal Enfield was thumping ahead in today's trading session. But sentiment did take a hit.
Sentiment did take a hit, Nigel. I'm looking at a couple of these names like Sun Pharma, which was lower on a brokerage comment. We had Tata Steel, which was lower. Bajaj Finance as well ended lower from the frontline pack. Vodafone Idea giving up nearly all the gains that it saw in the last few trading sessions on hopes of some sort of relief coming in from the AGR dues, but that's not the case to be. That stock down by about 9%. And a big gash is what we saw in Balrampur Chini as well. And Zydus Life too on the back of a brokerage note. We were talking about the paper stocks, which opened lower and thereafter continued their slide downwards. So JK paper, for instance, ended about 8-9% lower. We had West Coast paper, which was lower as well. And in the commodity space itself, we had Balrampur Chini, which was down by about 6%. But on the way up, we did see Edelweiss Financial on the back of that large trade doing well. Protein eGovernment, you did allude to that, and we did see some traction in names like Dodla Dairy and Britannia as well, which ended with a gain of almost 3.5%. So some stocks gaining a lot more, losing, and a lot more taking place when it comes to the overall sentiment in the market, international news, and domestic news. With that, we wrap up on this edition of Closing Bell. You stay tuned to CNBC-TV18 as Markets Forward comes up next.
Dalal Street remains under pressure ahead of Trump's 50% tariffs on India. A broad-based fall saw the Nifty and the Sensex end over 1% lower, recording its biggest single-day fall in 3 months. Except FMCG, all the sectors end in the red. Pharma falls the most as Trump pushes for a cut in drug prices.
A couple of stocks doing well. Protean E-Government secures a near 1,160 crore order from UIDAI. The stock surges over 8%. BLS International too gains 1% after it got a 2,000 crore order from UIDAI.
Vodafone Idea tanks nearly 9% after the Minister of State for Telecom says there is no additional package being discussed for the company. Adds whatever has to be done has been done. Also says the government will not up their stake and make Vodafone Idea a PSU.
Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Mangalam Malu, with me Reema Tendulkar. Well, it was a down day today for the Nifty, ended very close to 24,700, below the 20-day moving average. And there were a lot of elements of uncertainty, right from Trump's tariffs, which go into effect from 27th. Along with that, we have the monthly expiry playing out, and a lot more in terms of outflows coming in from the MSCI as well. All in all, the markets were jittery. Hi, Reema.
Hi, you can see that. The mid-cap index down over 1.5%. The small-cap index ending with a cut of nearly 2%. The advanced decline ratio had more than 2,000 stocks declining for about 600 stocks advancing. The capital market index, the defense, realty, PSU banks, pharma, reeling with deep cuts. We'll talk more about individual stocks. Let's also tell you what we've lined up for you on our show. We start with the top movers and shakers. The stocks which are in focus today are Sun Pharma, Maruti Suzuki, Vodafone Idea. We'll tell you why these stocks were in the news, and then we'll get to the key market events to watch tomorrow. But tomorrow, of course, is a holiday, so we'll apprise you of what's on the tap on Thursday. But let's get to our first segment then. Vivek is now at the big wall with the big movers and shakers. Vivek.
Well, thank you so much for that. Well, like you mentioned, the breadth, especially in the broad end of the markets, was extremely weak. More declines than advances throughout. A few sectors, managed to buck the trend. The auto pack clearly standing out in terms of the kind of strength it displayed throughout the trading session. Names like Hero Moto, Maruti, Ola Electric, Ather Energy, these are the stocks from the auto pack that continue to see gains throughout what is a very weak trading session. The FMCG pack too, clearly today some defensive buying was seen. In the FMCG pack, most of the stocks, while they cooled off in the last hour of the session, did manage to end the day with marginal gains. Britannia clearly standing out on the back of the GST-related news flow. That stock ended higher by over 3% today. Protean E-Government, we've been speaking about the stock throughout the trading session. A large order win coming in from UIDAI, over 1,100 crores, and that stock ended higher by almost 9%. But a whole host of laggards is what we were looking at throughout the trading session. Top on the list was the telecom pack, both Vodafone Idea and on the back of that Indostar. No further relief likely for the telecom space, especially Vodafone Idea, and the back of that, both of these stocks under significant pressure today. Zydus Life, you saw a note coming in from Investec. They initiated a fast sell rating on the stock, elevated valuations. They see further downside from current levels, almost 4% lower for Zydus. Sai Life, we had intimated earlier, prior to market open, that there was a large trade likely. Almost 15% equity change, and the stock ended lower by 6%. Policy Bazaar, select insurance stocks continue to witness selling pressure throughout the trading session, and over 3% lower for PB Fintech. And the entire metal pack today, especially steel stocks, all of them, including the metal index, under significant pressure. Tata Steel low by almost 3%, JSW Steel 1%, JSPL 2%. So the entire pack was under pressure in the session today. Overall, a weak trading session, more declines than advances.
More decliners than advances. To be precise, 2,200 stocks which were ending on the way down, as against 620 stocks which were higher as well. Thanks a lot, Vivek, for that. Let's get in our experts to join us on the show. We have Jay Bala of CashTheChaos.com and Sudeep Bandyopadhyay at IndiTrade Capital joining in as well. Jay, we were speaking to you, just moments ago on Closing Bell. The question obviously is, do you think markets have turned a corner on the way down? If not, then what are the levels that we need to watch out for as support from where we can look at high levels from here on?
Yeah, the August low of 24,337 is very important, and I think the move from 24,337 to 25,153 has already put in an important trend change. If I'm going to be wrong about it, the August low needs to get taken out. But even if that were to go, which is quite a low chance, the Nifty would probably drop to 23,500 and resume its uptrend post that. But even breaking 24,337, in my opinion, is quite low. So the support in between 24,337 and now is at 24,645 and 24,500. I think these two levels are likely to hold, and we are likely to see markets to turn strong when we come back from the holiday.
Okay, let's talk about Maruti. That's a stock which touched record highs. This is after the company launched its first battery electric vehicle, e-Vitara, at the Hansalpur facility in Gujarat. In addition, the Maruti CEO has also announced plans to invest 70,000 crore rupees in India over the next 5 to 6 years. Sudarshan joins in to tell us the news and the implications. Sudarshan.
So over the last few days, Maruti has been outperforming all the other stocks in the auto sector. And today also the stock was up almost 2% and has hit record high. It was up almost 2%. Now it's on the basis of two news flows. First, company has rolled out its first battery electric vehicle, e-Vitara, from its facility in Gujarat. And second news is it has begun production of lithium-ion battery cells and electrodes for its hybrid vehicles. So first, talking about its battery EV, company is looking to start deliveries in the next few months. And the first focus would be the export markets, looking to export in almost 100 markets, including Europe and Japan. And the target in the units is 50,000 to 1 lakh units on the annualized basis. But for the domestic companies, yet undecided when exactly it's looking to launch in the domestic market. Second, about batteries and electrodes production, companies say the new battery plant that is set up in joint venture with Toshiba, Denso and Suzuki, it will enable local manufacturing of hybrid battery electrodes, and over 80% of it will be manufactured domestically. So basically, it's a boost for Make in India that PM Modi has been talking about. About the capex plan, Suzuki has announced the capex plan of almost 7,000 crore that company is looking to invest over the next 5 to 6 years in India. Lastly, Maruti Suzuki chairman R.C. Bhargava has talked about policy shift, especially for hybrid vehicles. It has requested government to tax hybrid vehicles on the line with EVs, because he believes that except Indian market, if you look at other global markets, EVs and hybrid vehicles are taxed equally. So he has made a request to government. Let's see what exactly the government's response would be to the Maruti chairman.
Take that point, Sudarshan. Thanks a lot for that. In fact, Prime Minister Narendra Modi, who flagged off the first unit of the e-Vitara in Gujarat's Hansalpur, has vowed support for Indian farmers and small entrepreneurs as US's additional 25% tariffs come into effect tomorrow.
मेरे देश के लघु उद्यमी हो, किसान हो, पशुपालक हो, हर किसी के लिए मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगी। दबाव कितना ही क्यों न आए, हम झेलने की अपनी ताकत बढ़ाते जाएंगे।
All right, let's get Sudeep in. Sudeep, your thoughts on Maruti, the consumption space, and the likely impact of tariffs on India, and as a result of which on individual stocks?
Well, of course, consumption definitely is an interesting space as things stand today. Of course, the multiple things have happened. One is good monsoon, interest rates have come down. We are in the onset of the festive season. Income tax rates, there have been relief given to common man. So consumption was expected to get a boost. On top of it, the Prime Minister's announcement of GST rationalization will definitely act as a big push for the consumption story. I'm very hopeful on the consumer durables picking up momentum in the festive season. We already have seen FMCG getting excited on the back of all the GST rationalization talk, particularly items which expect significant GST relief, like biscuits. Beyond that, I think, as far as exports are concerned, obviously the tariff is a matter of big concern for textiles, gems and jewelry, as well as leather goods exports. I think these are the three segments overall from an economic perspective which gets impacted the most, as they involve a lot of people who are working there. They also get impacted. So we'll all look forward to government coming out and giving some incentive or some structure which can, to an extent, mitigate the imposition of this significantly higher tariff, because at some stage government has to intervene if this continues, and which is likely to continue from tomorrow. Beyond that, I think GDP will definitely take a hit if this continues, and the hit may be anywhere up to 0.5%. And we have to, incentivize and support many sectors so that this damage done by this tariff is to an extent taken care of by domestic consumption and exports to other markets.
Sudeep, particularly Maruti, there is a possibility that the GST on small cars comes down. And considering that the small car entry level was struggling for Maruti now for the last couple of years, do you think that can revitalize that segment for Maruti, which can boost the share price? Or is it already, the stock being at record highs already, is pricing in the good news?
I'm very confident, Rima, that there will be incentive on small cars in terms of GST reduction, and that definitely will push up the small car sales. That's one segment which has not been doing well for quite some time. All the factors which I was talking about earlier, including the festive season, interest rates coming down, and GST reduction will help that. But having said that, I'm not very hopeful of share price going up even further, because to a great extent all these have already been factored in the price. I think Maruti at 14,700 plus does factor in most of this. So I'll wait and watch. I won't jump to buy shares. If I have to buy some automobile company share, probably I will go for Hero MotoCorp. I think that stock does look poised for a further upside from current levels. Also, some of the auto ancillary companies can definitely be looked at. Motherson Waring is one company, which is a small company, but has a significant potential with facilities booked. And with Maruti launching EV, because it's into electric wiring and wirings. Some not Motherson, some other Motherson, but Motherson Waring. I think that's one company which one needs to look at.
All right, we take that point. So that's one company that one needs to look at. Look at Vodafone Idea tanked nearly 9% in today's trading session, and this after there was clarification that is coming from the regulators or the Minister of State saying that it may perhaps be the end of the road for them, largely because there is no additional package coming in for Vodafone Idea. The government said whatever they've done has been done already, and they don't also intend to increase their stake in the company and call it a PSU. In fact, our colleague Ashmit spoke with them, and this is what he had to say. Ashmit.
Well, I had a detailed conversation with the Minister of State for Communications, that's Dr. C.S. Pemasani, and we tried to put across to him various questions, multiple questions on if at all there's any relief in the works, if there are any options being considered, what the future trajectory of the government position can be, what about the government stake here. On all these aspects we came across to him. However, the response that fell from the Minister of State, Dr. Pemasani, has been clear, is that whatever the government had to do is already done, that they've already done equity conversion to the extent of 57,000 crore rupees of dues, that has taken the government stake to as high as 49%. They don't want Vodafone to turn into a PSU, going on to say that there's nothing on the table right now, there's nothing on the platter, there's no consideration of any relief package underway as far as the government is concerned, as far as the DOT is concerned, going on to say that this is an issue that is perhaps best dealt by Vodafone Idea itself, by its management. We also asked him if there is some consideration that perhaps in the future can be taken at, can be looked at, for instance, maybe a tweaking of the payment schedule, increasing the timeline, maybe waiver of penalties, waiver of interest dues, and all those aspects. Again, the minister clarifying that as of right now, there's no relief being considered for Vodafone Idea, and that does put the company in a slight spot of bother. Bear in mind, they are currently operating under the AGR moratorium period. It runs out in March of 2026, and then subsequent to that, they will be looking at annual payments only with respect to AGR, those annual payments will stack up to about 18,000 crore rupees a year. So big news is what AGR is looking at. For now, the government saying nothing on the table.
Got that. Thank you very much for that. And you can see the stock price under pressure. Sudeep, Vodafone Idea, would you skip it completely?
Oh, absolutely. I've been saying for this for quite some time. It's a completely speculative bet on some support coming from somewhere. That's what people were playing on. Look, beyond all this, operational performance also hasn't been anything great. Post the fundraising, which they did last year, we were expecting at least the operational performance will improve, but they're still bleeding customers month on month, quarter on quarter. There is absolutely no reason for that, but that's what is happening. So under the circumstances, operationally, things are not looking good. And as far as funding is concerned, there is a huge challenge for this company to kind of get fresh funds unless they get some support from the government or some other sources, which now looks unlikely.
All right, that's the point on Vodafone Idea. Let's get into the pharmaceutical space. And Sun Pharma and Zydus Life, both of them were lower in today's trading session after they got a ratings downgrade from brokerages, as well as Trump's comments that weighed in on these stocks because of the cut that he intends on drug prices. Ekta, why are brokerage firms downgrading Zydus Life and Sun Pharma?
Well, yes, pharma stocks are in focus because there were some comments which came in from the US President Trump as well, mainly focused towards innovative drugs, but maybe it could have perturbed a little bit of sentiment. So the US President has said that he will look to slash drug prices between 1,400 to 1,500%, quote unquote, going to do a number on costs of drugs in the US. And remember that the statement comes a month after Trump sent letters to pharma companies such as J&J, Novartis, Merck, Pfizer, etc. It's also set a 29th September deadline to lower drug prices. The demand is to extend the most favored nations pricing to all Medicaid patients. Earlier this month, remember that the US President Trump said tariffs on imported pharma products can reach as high as 250%. So that's probably shaken a little bit of sentiment because the move is to eventually move manufacturing back to the US. Now, BofA Securities separately has written on Sun Pharma. They've downgraded the stock to underperform. They've cut the target price. According to them, they expect slower revenue ramp up from new launches compared to consensus. Sun may pursue further specialty acquisitions, but the upside, according to them, is already priced in. Most favored nation clause could continue to weigh on Ilumya, which is one of their key drugs in the specialty portfolio. Investec has written on Zydus. They have a sell target price of 940. According to them, the valuation is now unfavorable and the valuation, and it's an earnings risk as well. Mirabegron, ER and Revlimid generic, two drugs together contribute to around 35% of FY26 EBITDA, and both face risks of disappearing without backup products, according to them.
Thank you, Ekta. We'll slip into a break. On the other side, top corporate voices and the big events to watch tomorrow. Stay tuned.
Well, the markets were lower today on account of a truncated week and the uncertainty around tariffs, but we did speak to a lot of corporate voices, and let's get you all of them. Titagarh Rail's board had approved the demerger of its shipbuilding arm into an SPV earlier this month. While the core business remains unaffected, the company is building capacity for 16 to 20 vessels per year, and they expect the shipbuilding business for them to be almost 1,500 to 2,000 crore rupees in the next 3 to 5 years. They focus on the next 1 year is to build a strong order book in this business. Add to that, passenger rail also likely to add to their revenues over the next 2 to 3 quarters with EBITDA margins of around 12%.
Vikram Solar expects 15.5 gigawatt capacity expansion in FY26, is confident of strong overall revenue growth. The company sees revenue rising 30 to 35% with margins remaining healthy. EBITDA margins are set to improve from next year as well as new cell capacities come online. The company also said the ALMM List 1 is helping deter Chinese dumping in the domestic market.
JK Paper fell over 5% after a sharp rally yesterday following the government's move to tighten import conditions for certain paper and paperboard products. Speaking to CNBC-TV18, the company's management said the step would benefit the domestic paper industry, which has been facing heavy dumping of VBP from Indonesia. JK Paper, with a market share of 18 to 20%, expects that its share will remain steady and indicated that there could be a price hike in the industry over the next 10 to 15 days.
And before we wrap, we'll bring you the key market events to watch out for tomorrow. Riaz joining in.
Well, yes, plenty of events to watch out for over the next couple of days. On the 27th of August, the 50% tariff rate imposed by the US on Indian goods comes into effect. Indian markets will also remain shut tomorrow on account of Ganesh Chaturthi. In terms of economic data, we'll be watching US crude oil inventory numbers as well as UK inflation figures. On the corporate side, Acme Solar's board meets to consider a fundraise, while Vedanta has its record date for an interim dividend tomorrow. Looking ahead to the 28th of August, it's a heavy date for macro data. We will get US GDP and weekly jobless claims, India's industrial production numbers, along with PMI prints from the European Union as well as the UK. And in terms of key events, Bitcoin Asia 2025 kicks off in Hong Kong, while Europe hosts an informal meeting of EU defense ministers on the 28th of August.
All right, take that point, Ria. Thank you so much for joining in. With that, we'll wrap up on this edition of Markets Forward. We'll be back with more news and updates on the other side. Stay tuned to CNBC TV18 and wishing all you viewers a very, very happy Ganesh Chaturthi.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The US doubles the tariffs on India to 50% starting tomorrow. Exports worth $60 billion to the US will be hit. India and Brazil are the only countries that face the highest tariff rate of 50%. Stalled exports, disrupted supply chains, threatened livelihoods. India's gems and jewelry sector braces for a tough ride with higher US tariffs set to come into effect. The industry warns that nearly 1.7 lakh workers could stand to lose their jobs, asks for special relief schemes. The textile sector also seeks special financial assistance. A sell-off on Dalal Street. The Sensex and the Nifty post the biggest single-day decline in 3 months. 42 out of the 50 Nifty stocks close in the red. President Trump says he's fired Federal Reserve Governor Lisa Cook for allegedly committing a mortgage fraud. Marks the first instance of a U.S. president firing a central bank governor in the Fed's 111-year history. Cook hits back, says Trump does not have the authority to fire her, adds she will not resign. Prime Minister Modi flags the first unit of the e-Vitara from Maruthi's plant in Gujarat. It's the company's first battery EV and will be exported to 100 nations. Prime Minister also inaugurates a lithium-ion battery manufacturing facility. At least 3 people are dead after flash floods hit Jammu and Kashmir's Dora district. A red alert in Himachal as heavy rain sparked flooding fears in Manali and Mandi. Israel faces worldwide outrage after bombing a hospital in Gaza, killing 20 people, including 5 journalists. The hospital was bombed twice, and the second attack killed rescuers and journalists. Prime Minister Netanyahu apologizes for what he calls, I quote, as a mishap. Elon Musk files a lawsuit against Apple and ChatGPT maker OpenAI, accusing both companies of joining hands illegally to stifle competition. Musk takes aim at Apple's decision to integrate ChatGPT into its smartphone through an exclusive arrangement. Well, let's start with the day's market action. The market recording its biggest single-day fall that we've seen in the last 3 months. Ahead of Trump's tariff implementation, we saw the pressure building up. Financial stocks remained weak. The Nifty Bank closing at its lowest level since the 9th of May, down by about 700 points. Today, the Nifty Mid-Cap Index lost 1.5%, a 900-point cut there. 850 gone on the Sensex, and the Nifty dropped by about 255 points. All sectors closing in the red, barring FMCG. More than 40 Nifty stocks closing in the red today, registering losses of up to 4%. Nigel is standing by with the day's market action. Nigel, market under pressure today.
Well, it was a weak trading session today for the Indian markets. Trump's tariffs, well, that's clearly weighing on markets. It's a truncated week. And also the expiry-related jitters, that's what was weighing on sentiment. In addition to that, you had an MSCI reaching, and that was net-net, it called for some outflows to the tune of roughly around 250 to around $300 million. Now, for the Nifty itself, you had a lot of, financials that came under pressure. So you had Shriram Finance, that was one of the top losers. Bajaj Finance as well did see some selling. And add to the list of Sun Pharma as well as Tata Steel. So all those 4 were the top losers on the Nifty. However, domestic-facing themes, that was the place to hide. So Eicher Motors was one of the top gainers from the auto pack out there, and one of the top gainers on the Nifty. Maruti Suzuki as well, they rolled out their first battery EV, e-Vitara, from their Gujarat plant, and the street liked that. So that stock as well was up close to 2%. Street is factoring in this GST rationalization could potentially be good for autos in the second half of the year or towards the end of September. So that's why those stocks did well. A lot of these FMCG names as well, that was the pocket to hide in. So today you had HUL, Nestle India, ITC, more domestic facing in nature. They have been relative underperformers in the past as well, and there was some buying that we saw in all those names. Now, from the broader markets, the losers included Vodafone Idea. The street fears that's the end of the road for them, so that's why that stock was under pressure. And obviously, Indus Towers normally moves in sympathy with Vodafone Idea, and since it was low, you had Indus Towers as well that did see some selling. But from the broader markets, though you had a very, very dull day, you had Vikram Solar, that was a new listing, went over with gains of more than 8%. Protein eGovern as well as BLS International, they won orders from Aadhaar, pertaining to Aadhaar. Both those 2 stocks, in fact, were up in trade. And Ola Electric, out of nowhere from the recent low, the stock is up more than 20%. There's this PLI benefit that they're now factoring in. So that's why those were the stocks that actually outperformed the market. Towards the end of trade, though, you had their MSCI impact. Net MSCI outflows is what we saw from the Indian markets. However, stocks like Hitachi, Swiggy, as well as Vishal Mega Mart, all of them did perk up towards the end of trade. What's the way ahead? Trump's tariffs are clearly weighing on sentiment, weighing on investor appetite as well. But the real trigger is going to be earnings recovery and recovery in the domestic economy as well. That's something that's high because there has been some monetary policy support as well as fiscal support. Now, all eyes are on the domestic story, whether or not a recovery is in store.
Nigel, many thanks for joining us. The market's under pressure today, and that is the big story this evening. Come tomorrow, India will face a 50% tariff on its exports to the United States. The Trump administration has now notified India about the imposition of the additional 25% tariffs, blaming it on India's oil purchase from Russia. However, the US has not penalized China, which is the largest buyer of Russian oil. India's tariff rate is now higher than all of its peers in Asia and the neighborhood. Countries like Vietnam, Malaysia, Indonesia and Philippines all have tariffs in the range of 15 to 20%. Only Brazil and India face the highest US tariff rate of 50%. South Africa and China also face levies of 30% currently. In fact, China has also levied reciprocal tariffs on the US. So how will all of this impact India? According to data from the Global Trade Research Initiative, 66% of India's good exports are set to be impacted on account of the higher tariffs. This is the big one: gems and jewelry, textiles, seafood, steel and aluminum are set to be the hardest hit. The jewelry sector has already warned that nearly 1.7 lakh people could potentially lose their jobs. However, pharmaceuticals, some copper items, autos and certain auto components, among other items, are exempt from the additional US tariffs. Now, if no steps are taken to reduce tariffs, GSTRI estimates that goods exports to the United States will be scaled down to nearly $50 billion in FY26 from $87 billion currently. That's a decline of nearly 42%. However, GTRI expects India's overall exports to remain largely stable as it predicts a 10% rise in services exports to offset the impact of the higher US tariffs. So this is now a reality. From tomorrow morning, 50% will be the effective tariff rate on our exports to the US. Industry bodies from both India and the US have sought a 90-day pause in a bid to give more room for trade negotiations. The government has reiterated that it will always put the interests of farmers, exporters and MSMEs first and will look at ways to mitigate the trade impact. Parikshit is standing by now with more. Parikshit, what is it that we're picking up in terms of talks that are currently underway, negotiations that are perhaps still underway? What can we expect? What can we hope for?
Well, negotiations have been on in a very hectic manner over the last 20 days or so. But so far, there is no solution. The fact that the White House has notified the 50% tariff rate is an instruction to importers that if you're getting goods in from India, this is the tariff rate that will be implemented. It's a top-line rate of 50%, starting 12:01 a.m. Eastern Daylight Time on the 27th of August, which is 9:31 a.m. India time. Definitely, this is going to be a setback for India's textile sector, footwear, leather, apparel sectors in a big way. The hope is that many of the exporters, many of the large and small exporters have already sent a lot of consignments to the US in the last few months, and therefore there will be a cushion for the next few weeks. Even now, there is talk on the part of the government and also on the part of industry bodies. Everyone is appealing to the White House to somehow put a 90-day pause, just the way there have been a 90-day pause for tariffs on China, extended by another 90 days. Similarly, here you have top industry bodies requesting the White House that give a reprieve for some time. Let there be room for negotiation. Even if you want India to purchase more US oil, how would you expect India to buy more oil if you impose tariffs in this manner on a very close ally? So that is the level of conversation that is taking place. Lots of back-channel negotiations. Even now, there is hope that even if these tariffs come into effect on 27th of August, in the next few days and weeks, possibly something can be done or some sort of breakthrough would be achieved with the Russia-Ukraine war, and there will be a positive ripple effect. For the moment, India has made it very clear there will be no compromise on India's red lines on agriculture and dairy. We're also making it very clear that we understand this is not just about Russian oil, because you cannot be singling out India. China is a bigger buyer of fossil fuels. In fact, the Indian ambassador to Russia went on to say that we'll buy oil from wherever we get at the best prices. Having said that, India continues to negotiate with the US with an open mind. At the same time, top-level meetings taking place in Delhi to see how to cushion and mitigate the impact of these tariffs? Because almost $48 to $50 billion worth of exports from India will be impacted.
We have basically reached out to the president and asked him to at least delay the implementation. We need a runway to find a solution between the two countries itself. And it's important that to understand that, yes, the secondary tariff are unjust and they shouldn't be put in. But we can't just keep on going on the media and keep on calling it just. Let's keep on working and finding a solution. So I think by postponing this by 90 days or 120 days, just like US has done with China, it will give us a runway to sort things out. But more important is I think a call between the Prime Minister and the President can untie the knot which we have got ourselves into it, so at least both countries can work in a positive manner.
Well, industry is still hoping that there will be some sort of a breakthrough. But as I mentioned, India's gems and jewellery sector is bracing for a tough ride, as is the textile sector. Manisha joins us now with more. Manisha, explain to us the impact both the gems and jewellery as well as the textile sectors are likely to face on account of the 50% tariffs coming in.
Well, absolutely. As you mentioned, India's gem and jewellery industry will be amongst the worst affected due to the US tariffs. US is the biggest market for the sector, accounting for 40% of its overall exports, which is worth $10 billion. The 50% tariffs make India far less competitive compared to countries like Turkey, Vietnam and Thailand, which face tariff rates less than 20%. And the jewellery industry has issued an SOS warning about potential job losses to the tune of 1.7 lakhs. The industry has also written to authorities seeking relief, including special schemes and a duty drawback scheme as well. The industry is also seeking market access initiatives and deferring of the interest cost on working capital. The industry is also looking at government approval to offloading the stock in the domestic market. The president of the Gujarat Jewellery Association did not mince his words, saying that 50% tariffs effectively make it unviable to trade with US.
Very tough time, very challenging time. It's very difficult to work with US. As I mentioned in my previous interview also, 25% also very difficult to ask. 50%, so there is no point of discussing anything. We'll have to explore new markets. We'll have to negotiate. My team, GJPC, is also working very hard with Commerce Ministry. There is sufficient goods in pipeline in US. So I'm hoping this season will not be wiped off absolutely. But the road ahead is very, very tough.
Another sector that will feel the brunt of the tariff is textiles. The US accounts for 35% of India's total textile exports. The value of these exports last year was nearly $11 billion. The industry is also asking for government intervention. Textile exporters are calling for a special financial assistance to tide through the crisis. Many textile units in Tamil Nadu's Tirupur have been shut as consignments are put on hold. The industry is fearing job losses, even though has not happened so far. The industry fears that the exports to the US could decline by anywhere between 28 to 40%. The Federation of Indian Exporters remains hopeful, though, that both nations are engaging in talks and that would ease the tough tariff burden going forward.
We are also hopeful that very soon they will come on a negotiating table. As and when the BTA is finalized, please bear in mind that the top two leadership has given a terminal date of fall of 2025, which is still is few months away. And therefore, we have time till October to finalize the deal. To bridge in, they don't have that much of profit margins. And therefore, I'm pretty sure that in September, we will see export to US dropping down drastically. The good thing is that 45% of the export, which is under Section 232 or in the exempt category, that may continue for some more time.
Well, tough times for India's exporters and now seeking government assistance and support. Mark Mobius, chairman of the Mobius Emerging Fund, has said that India will be okay despite the tariff impact and that only certain sectors, including pharma and garment industry, will be hit. In fact, pharma is exempt. Speaking to CNBC, Mobius said that despite these high tariffs, India's economy will continue to do well. Take a look.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the US. The garment industry, of course, will be hurt because a big portion of their exports go to the US. jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous.
Well, that's Mark Mobius. Moving away from tariffs, Prime Minister Modi flagging off the first unit of the e-Vitara in Gujarat's Hansalpur. This is, of course, a car from the Maruti Suzuki stable. He also inaugurated a lithium-ion battery manufacturing facility. The auto giant will start deliveries of its battery electric vehicle within few months, and the target is to emerge as the country's largest electric car maker in the first year. Maruti will also export its battery EV to nearly 100 countries, including Europe and Japan, with the aim to export between 50,000 to 1 lakh units on an annual basis. Speaking at the event, Prime Minister Modi has said Maruti Suzuki's project in Gujarat is a big leap towards the Make in India target.
भारत की मेक इन इंडिया इस यात्रा में एक नया अध्याय जुड़ रहा है। ये मेक इन इंडिया, मेक फॉर द वर्ल्ड हमारे उस लक्ष्य की तरफ एक बड़ी छलांग है। आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे।
Well, you must be wondering, where is the steering wheel of this car? Well, this is the e-Vitara, which is going to be made in India and exported globally. So, for the Latin American markets and a lot of other abroad international markets, the steering wheel is on the left side of this car. I am sitting, you have guessed it right, in the newest e-Vitara, which is going to be manufactured in India in its Hansalpur plant in Gujarat, and will be exported to over 100 countries, including high-tech markets like Europe and Japan. And it's rolling off the production line right here at the plant, making India a global EV manufacturing hub. Now let me show you the car. Now this car was showcased by Maruti Suzuki in the Bharat Mobility Auto Expo this year. So there is nothing new in this. However, it is a spacious car. Look at the controls. It's very much similar to the current e-Vitara. It's spacious, very luxe interiors. Nothing new and major over here. However, it has some modifications for the international market, especially for other Latin American markets, which has different tonalities and different things in their car.
So our effort is to localize the supply chain as much as possible. Maruti Suzuki stands for deep localization. And the other inauguration that you saw today, our fellow subsidiary TDSG, they achieved deep localization from the battery to the cell and from the cell to the electrode. So they are manufacturing the electrode for hybrid batteries, and that has been inaugurated today. So the effort is to localize as much as possible.
Well, that's Maruti Suzuki's new electric vehicle, the Vitara. Up next on Business 360, the government has done all it can to help Vodafone Idea, says the Minister of State for Telecom in an exclusive conversation with CNBC-TV18. That and more when we return. The Union Minister of State for Telecom, Chandrasekhar Pemasani, has said that the government has done whatever it could to help Vodafone Idea. In an exclusive conversation with CNBC-TV18, Pemasani ruled out any further measures for the cash-strapped company. He also added that there are plans for a nationwide 4G rollout by BSNL, which is likely to cost 1 lakh crore rupees. Take a look.
I just want to get clarity because there's so much speculation in the market. Is there a relief package in the works either for Vodafone Idea or for the sector-wide approach that would address these financial issues that the company appears to be dealing with?
No, whatever we wanted to do has already been done. At this time, we are at the ministry level, we are not discussing any additional packages for Vodafone.
But is there a need felt, sir, if not for Vodafone specifically, then across the sector, at least in terms of maybe options being considered, such as advancement of the tenure or maybe waiver of some penalty interest dues? Is that something that can be?
No, whatever we could do, we have already converted into equity. Okay. Right now, our focus is to how to rebuild BSNL. Sure. So make the BSNL. You know, Vodafone is up to their management. They are all business people. They know how to manage. It's up to them how they want to take it forward. From the government side, there is nothing that's being discussed at this time.
And the government, sir, enjoys a 49% stake. That's a sizable shareholding. Any view on what that shareholding could look like going forward? If not increase, then is there a view on perhaps monetizing it? Any timelines that you?
No, increasing will make it like any other PSU. Sure. So at this time, we do not have any plans to increase.
Staying with BSNL, very recently in the Parliament, in the just recently concluded Parliament session, you had informed the Parliament that there's a capex of nearly 7,000 crores that's been approved as far as 4G deployment for BSNL is concerned. Tell us, given that it is inherently a local domestic technology, indigenous technology, you mentioned is what 4G, what BSNL is relying on. What will a nationwide 4G rollout for BSNL cost you in terms of what would be the capex required to undertake a 4G express 4G services across the country?
See, right now that 7,000 crores and everything is for combination of these 100,000 4G towers plus 20,000 4G saturation project where the rural villages where there is no Airtel, Jio, no connectivity, to deploy those remote, far-flung areas, northeast. Sure. So that will cover total 100 plus 20,000, 120,000 towers. Next is, if you look at Jio, Airtel, they have close to 4 lakh, 5 lakh towers of all of these. How to generate that kind of, it requires much more capex. Maybe another 100,000, 100,000, I would say, crores is what is required. But there are effective ways you can do with technology. See, now what BSNL is working on is enabling Wi-Fi calling. If we get the Wi-Fi calling, most of the people have internet facility, Wi-Fi access. And if we can do that, then that will be, every Wi-Fi spot can become like a BTS tower. So our goal is to get that within the next 2 to 3 months for the large extent. So that itself can replace large number of towers. That's number one. And number two, we have asset monetization plan, so we can get internal accruals. Second, as the revenue increases in BSNL, we get additional revenue. In combination of these three things, then we will see what else we need. So it will be a continuous incremental increase in the number of towers. So, it's reinventing the BSNL in an upward trajectory.
I think the name Elon Musk catches on as far as headlines are concerned. But given that he has deep pockets, is there an expectation or an apprehension that perhaps he could undercut some of the existing players using some of these deep pockets that he has?
See, this I can only tell you hypothetically, and based on history, they have not done in any other country, including in a country like Sri Lanka. They have not given any subsidy or whatever you call it. So history hasn't revealed that. So it is very hard to see that they will do differently here. But as I said, these entire satellites are given by ITU in a coordinated International Telecom Union. Even if somebody, Elon Musk wants to put some satellite, it's just not possible without the coordinated effort.
Sure.
So the total satellite is around 12 to 13,000 that was given.
Right.
So the entire world may not have more than 1 crore or 1.5 crore connections, entire world, if you talk about it. So, and these satellites have to be replaced. LEO satellites, low Earth orbit satellites, are prone to damage due to heavy weather-related events. So every 4 to 5 years or 5 to 6 years, you have to replace these low Earth orbit satellites. So it's a very expensive process. So it's not so easy to build massive number of satellites, to keep them and to serve everyone on the Earth.
Sure.
So this is something a lot of people may not understand, technical limitations. Just because Elon Musk or anybody has money doesn't mean they can take all the customers because of these technical limitations and how much investment it needs for recycling the satellites.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Come tomorrow, India will face a 50% tariff on its exports to the United States. The Trump administration has notified India about the imposition of additional 25% tariffs and has blamed it on India's oil purchase from Russia. India's gem and jewelry industry will be among the worst affected due to the U.S. tariffs. U.S. is the biggest market for the sector, accounting for 40% of its overall exports, worth $10 billion. The 50% tariffs make India far less competitive compared to the countries like Turkey, Vietnam and Thailand, which face tariff rates less than 20%. And the jewelry industry has issued an SOS warning about potential job losses to the tune of 1.7 lakh people. The industry has written to authorities seeking relief, including special schemes and a duty drawback scheme. The industry is also seeking market access initiatives and deferring the interest cost on working capital. The industry is also seeking government approval to offload the stock in the domestic markets. I headed to Bharat Diamond Bourse in Mumbai to find out the road ahead for the sector. I caught up with Kirit Bansali, chairman of the Gem and Jewelry Export Promotion Council, and Venus Jewels partner Devan Shah. I began by asking them on how the U.S. tariff will impact the industry. Let's listen in.
It's very tough time, very challenging time. It's very difficult to work with U.S. As I mentioned in my previous interview also, 25% also very difficult to ask. 50%, so there is no point of discussing anything. We'll have to explore new markets. We'll have to negotiate. My team, GJPC, is also working very hard with Commerce Ministry. 27th, US has given the deadline, but still I'm hoping for the best. As IDMA chairman, if you remember, met their counterpart day before yesterday, and he has given little hopes. So we are just crossing our fingers. Let's hope for the best.
Oh, well, absolutely. Mr. Bansali, even more important is the point that, this is a holiday season, especially in the US markets. Have we seen any front loading at this point in time? Has a lot of export already been done?
So before this 10%, a lot of people have taken that chance. According to my source, there is sufficient goods in pipeline in US. So I'm hoping this season will not be wiped off absolutely, but the road ahead is very, very tough.
The concern really is about the employment, because this is one of the labor-intensive sectors. What is it that you're having a conversation, especially with Gujarat and Maharashtra governments, because major work facilities are here?
So if I talk about ships, Andheri, 70% plus exports happening only in US. So the major impact will be on ships. Same will be in Surat. I'm meeting Maharashtra CM tomorrow or day after tomorrow. Meeting Gujarat CM also after Paryushan. Our festival is going on. And we are asking for some relief from both the government. I'm hoping they will definitely help in this tough time to the industry.
Devansh, I'll come to you as well. And what is the scenario that you guys are working with right now? Have the exports happened, and are you looking at other different markets also?
Yes, I think we have to look at different markets to try and keep our supply chain steady. It is an absolute sudden event, and there is no easy way to absolutely feel normal about it. So we have to work very hard to ensure that even our own people and our own environment that we're working is least affected. But it's impossible to say that nothing is a problem. And I think the situation is also very quickly evolving. Situations in April were very different from those in July and those today in August. And looking ahead also, I don't see any clarity on how the situation will evolve and where it will reach in another month or 2 months. So we have to wait and see how things evolve and take decisions after we have some clarity on how the medium term to long term is looking.
Devansh, what are you telling your employees here? And I understand there's just too much uncertainty at this point in time. So how are you taking your business decisions right now?
For us, US was of course 30 to 40% of our business in terms of sales, and that is definitely an impact that we will have to look at. Temporarily, of course, we are taking this wait and watch approach. We have to absorb the impact a little bit, but it's not too far that we can keep the impact only on ourselves. We have to try and evolve the market to absorb more and more of our production that comes in, maybe Indian consumers, maybe consumers in other regions around the world that will grow, and we have to ensure that we are reaching out to as many as we can to mitigate as much of the impact as we can.
Mr. Bansali, I think everybody right now is looking for some support, some hand-holding, some incentives from the government. You told us about on how you're talking to the various state governments right now to ensure that there is some support on labor. But for the industry itself, what are the conversations that you're having with your ministry?
So in my last meeting with Niti Aayog, we have demanded in SIPs to allow us reverse job work, which is good market, domestic is doing good. And they've taken our point very seriously. I'm hoping in a couple of days they will allow us to do reverse job work in SIPs. And that will be very, very big relief as far as the under SIPs is concerned.
What about working capital, your interests? Are you asking for those helps as well?
Yes, we have demanded, and the government knows this sector very well. They've taken all my points very seriously, and hopefully we will get all positive from various governments. We have asked from Rajasthan government, Gujarat government, Maharashtra government, UP government. Why we approach UP government? Because a lot of UP's workforce in Surat. So we have spoken with Mr. Yogi also.
Mr. Bansali, we all understand that Surat is the largest hub when it comes to diamond. The concerns have already been there. Now with 25 and perhaps a 50%, what is it that diamond industry is looking at Surat in sense of workforce there?
So I have not given up. I'm still hoping that something will come out, as my colleague Devan said, that something will come out, because it's you'll have to see both the sides. 70,000 plus small or big outlets are in US, and major supplier is Indians. So it's not only that India is going to suffer. Their season is December is around the corner. So it's both the sides, and their counterpart, like I said that International Diamond Manufacturers Association President Mr. Rob have already approached the Commerce Minister of US. And both the associations are working hand to hand, and I'm sure that we'll come out with some good solution.
One more question, and with US creating so much of uncertainty, what other countries are you looking at? Where is the council working now, spreading its wings?
This month we are going to hold a big show in Saudi Arabia, 11, 12, 13, 8, 9th. I'm going with GGPC team. That's one market. We have seen good result in UAE also. After this 5 FTA, Britain is on the line. We are doing 1 billion business then. I'm hoping in next 2-3 years it will be triples. So we will not sit down. We'll have to explore new markets.
I also caught up with Praveen Shankar Pandya. He's director, Shankar Group of Companies. I began by asking him if the jewelry sector can overcome the impact of Trump's tariffs in the months to come.
This industry 50 years ago started with nil. And we have, experienced all kind of things, and we have created the market. In fact, America, which is roughly about our 40% market, was not there at all. So since we gave them the product that was, most competitive, and Americans like jewelry, so they took our diamonds and they continue to take it, and it's our best market. So I think, yes, it's uncertain times, but I see that in near future we'll be able to overcome all these things.
At this point in time, with the kind of tariffs that we are working with, how long do you think that the industry can hold on with perhaps losses or continuing to pay employees?
Yes, we will have some crisis of liquidity. But there is no cause of worry because, our 60% market is still intact. And even in America, because nobody else can take this market, because we are into the smaller goods, into the medium goods, into the larger sizes, and no other country can immediately manufacture these diamonds. So either they will have to absorb the duty, which I don't think it's a fair thing that, the consumer should absorb it. So I think I look forward to a good negotiation by our Commerce Ministry. and their ministry, so that, you know, they come out with a quick solution to this problem. But till then, I think we will continue to have some difficulty, but there still would be some businesses going forward.
There also are various reports, Mr. Pandya, that we perhaps could be looking at some Indian companies moving base when it comes to manufacturing. Is there a serious thought on this?
There are some people trying to do an early advantage, but I think that's not going to work, because in other countries, teaching them, especially in diamond manufacturing, it's not possible. You see, we have manufactured everywhere. We had factories, Indians had factories in China, but there are not enough workers there. So to teach them and to do this will take a long time. But yes, jewelry manufacturing would have an impact, and there are many countries like China, Mexico, and who are manufacturing jewelry. So they may take advantage into the jewelry manufacturing, but their products have to come from India, the diamonds have to come from India.
So one more question, Mr. Pandya. So how long are you ready to give this uncertainty before you can take a final call on business? And what really is the plan B here?
I would say something around 4 months.
Okay.
I see that before the end of the year, we would definitely have some solution to this. Otherwise, people will be we'll have to take our long-term solutions. And I'm looking forward that at least in diamond manufacturing, there is no alternative to India. And it will take a long time for anybody else to come up and challenge our production. So there I'm not worried, but I'm really worried a little bit about jewelry, which, you know, there are other countries, if they get a preferential treatment in terms of duty, then of course they will have an advantage. But overall, I don't see this thing. But yes, we need a definite support from our government at this time. You know, there in terms of subventions, in terms of, you know, interest subventions, which have been taken away, should be given back. And there are other kinds of things which we will be negotiating with the government. We'll be asking, because they are also seized with the matter. And they would definitely, you know, come. And then in the past also they have, in 2008 and other times, they have definitely supported the industry. Without that support, our industry would have not been here. So the Commerce Ministry is our main ministry, and they would definitely support us.
Well, there's a lot of hope going forward onto the markets there, but on that note, it's time for a short break. When we return, we catch up with Akshay Shah of Dharmanandan Diamonds and Sabyasachi Ray of GJPC to find out what sort of tariff levels is the country looking at and can actually absorb. Welcome back. You're watching Commodity Champions. Akshay Shah of Dharmanandan Diamonds has said that tariffs in the range of 5 to 10% would be reasonable for the industry. Meanwhile, Sabyasachi Ray of GJPC expressed optimism that the ongoing India-US trade talks will conclude with a positive outcome. Let's listen in.
So definitely US has been a major exporting partner, and a lot of India being the major diamond producer. So there is a big trade happening in diamond, gem and jewelry industry between India and US. Definitely US retailers, channel partners, everyone is thinking how to get the imports. It's their season time in August, September, October is the best time for the year for them to have a wedding season and do businesses. So they are also figuring out, we are also figuring out. Of course, we are in support with the government, and we are trying, even GJPC, even diamond manufacturers, associations, everyone is working in a very close knit to get the best solution for the two countries. I think it's a matter of patience and the time. It should be resolved soon. But definitely, eventually, with minor taxations or import tariffs, I think it will be absorbed in the industry. Eventually, people want to buy, even we want to sell. People will find the best solution. But currently, the business has been staggered, and 2 months has been like more like a waiting game. But we see, I think things will improve and the closures will come soon. We are hoping for the best, and I'm sure Indian government is taking good care about the exporters. It can be textile or gem and jewelry or any fields which is hit hard.
Akshay, what is the level of tariff that you would say industry is ready to work with and can absorb?
So, you know, in cars, imports, everything, India has also been paying heavy duties on American or European cars or being any industry. So I think with the luxury, especially gem and jewelry, which is a very high value items, I think between 5 to 10% can be absorbed at level. But of course, 25, 50 will be a challenging thing, because American consumers maybe will buy from other countries the finished jewelry. The other countries will have a better, more manufacturing or more establishments, like people can go fly down to Europe and buy. So I think eventually things will settle down, but I think anything between below 10 can be understandable and adjustable, I feel.
You deal with bigger diamonds.
Yes.
Do you see, apart from US, any other country be able to absorb that?
Yeah, so basically these diamonds are only 2 or 3% manufactured in the world in the total quantity of diamonds. So those diamonds, I think, can be absorbed anywhere. It's more with a billionaires club and millionaires club, and it's in every country. So, and they have offices every country. So I think eventually that segment may be okay, but if we see the overall diamond, yes, US been the major consumer and India being the major producer. So between India and US, things have to be resolved fast.
Sabya, at this point in time, most of the jewelry guys that I'm talking to, while there's a lot of uncertainty, but they are hopeful that 25 and 50 is a number that you can't work with. So what is your conversation right now with the ministry? I know there are a lot of conversations at various levels happening right now.
See, as I have told you always, this percentage in our industry does not work, It is not a percentage because it's a very high valued goods, and when you put percentage on that, it can subsist. And jewelry per se, is a finished product. So when you have differential tariff, like us has a different tariff, Thailand has a different tariff, Vietnam has a different tariff, then of course this manufacturing may shift, or there are always chances of goods getting, shifted, the manufacturing getting shifted from there. But one of the things also we need to understand that things are not very clear, that how much is the base manufacturing, whether 80%, 60% will be manufactured in a country to get that status of origin. All these things are not clear. So let that clarity come into the whole system, how the executive order will come out. Because of that, you have seen that India has already suspended, the movement of goods through post and aircraft till that clarity comes. This is one part of the business. But when you talk about the government, what you are told, as you have heard already, Akshay has told, that we are also believe that this cannot sustain 50%, and India being the sole manufacturer of diamonds, this duty cannot sustain. So a lot of talks are going on. We are hopeful that these talks will end into some positive thing. Till that time, we have to hold the fort. To hold the fort, we have already told Indian government to take two very major decisions. One decision, what we have told is that you have to see that this packing credit, whatever is being given by the banks, if this period is getting prolonged because of this or elongated due to this whole scenario or whatever the US tariff scenario, so you have to give a moratorium on the interest rates till that time when the people are suffering. For that, you have to give support to the bank so that the interest component should not come. This is one of the things. And then also what you are told that you have to keep some additional credit. Let's say if they are trying to look at some other market, they have to buy new products, etc. For that also some additional ad hoc credit may be given. Third thing what we have told is that you see most of our products are export intensive because diamond jewelry, that there is not that much demand in India, so that was export intensive. But as the Indian economy is doing well, what we have told that whatever is manufactured in SEEBs or SEZ, you should allow that to be sold in the domestic market to take at least absorb this, this whatever impact has happened, at least for the time being during this festive season, you should be trying to. So we are very hopeful that the government will give us this kind of facility so that from SEEBs or from Sitapura in Jaipur or from SEZ in Surat, you can sell some diamonds or diamond jewelry in the local market so that you can at least sustain with this impact.
Sabya, what are the other things in sense of incentives, subsidies, hand-holding, wavering? Is there more that you're asking from the government right now?
See, I have already told interest subsidies is that moratorium. That itself is the interest subsidy. But what we are also telling is that for promoting the diamonds, for generic promotion of diamonds and diamond jewelry, at least in this part of the world, whether it is the Middle East, whether it is here, whether it is the Far East, which are the new markets, which is developing very well, let us try to promote Indian diamond jewelry and diamonds in this part of the market so that they can take some kind of hit or some export growth. Like I'll give you an example, like Saudi Arabian jewelry exhibition, SAJEX, what we are doing. We have seen that in Saudi Arabia, it is now currently a $4 billion of jewelry market, which is going to be $8 billion. So there, if we do promotion right from now, then as Saudi market is opening up, that can be a good one. If you see our export, the way it has grown to the Middle East, also MENA countries doing very well because of the oil prices are stable and etc. So their economy is doing well. There also we have told that certain kind of promotion. We are already doing generic promotion in India, in China and in the Middle East with De Beers, and also we are working with other, let's say Platinum Guild and etc. So that way in the promotion also government can help. That is what we are trying to tell. And till the time being some type of relief to the workers, like I will give you one type of example, what we are talking for relief for the workers. A lot of workers, because when you have a salary, based on that you have taken EMI to buy the white goods and etc. So at least for the EMI, if some sort of benefit or some sort of subsidy can be given to them for the time being, at least this season, then that will work. So that for workers we have told that the government should give, and also the education of their kids, whether they can support their education for this time being when they are suffering, that will also help. These are some worker specific benefits also we have told to the government to give to our sector.
Well, that is the council and the industry exporters talking to us. But how will the US's 50% tariffs impact traders and brokers and employees? I caught up with them at Mumbai's Bharat Diamond Bourse to find out. Let's listen in.
ऐसे देखें तो मार्केट में ऐसा कोई फर्क पड़ने वाला नहीं है, क्योंकि इधर का जो हमारा व्यापारी है ना, इतना पुराना है और सबको मालूम है उसको कैसे हैंडल करना है. तो ये मार्केट में जो मंदी का माहौल तो है ही पहले से, तो मंदी का सामना तो कर ही रहे हैं, लेकिन जो लोगों को ऐसा भय जैसा माहौल है ऐसा कुछ नहीं है. व्यापारी अपना काम कर रहे हैं, थोड़ा एक्सपोर्ट में फर्क पड़ेगा, लेकिन दूसरे देशों में काम करेगा, लेकिन ऐसा लोकल ज्वेलरी अच्छी चल रही है, कोई प्रॉब्लम जैसा नहीं है.
भय नहीं है, लेकिन एज ऑफ नाउ किस तरह का काम है? कुछ नीचे आया है, कुछ मंदी नजर आती है?
20-25% आया, ज़्यादा नहीं आया, कोई फर्क करेगा ना यार. आप प्रधानमंत्री ऐसा है तो क्यों घबराने का ही नहीं है.
मोदी है तो मुमकिन है, लेकिन टैरिफ नीचे लाना जरूरी है, क्योंकि धंधा बहुत मंदा हो जाता है. मोदी जी है तो
नहीं है, सामना करने का.
तो जरूर कुछ मंदी यहाँ पर जरूर देखने को मिली है, आप कहेंगे?
बहुत सारी
मंदी तो होगी क्योंकि मार्केट में फ़र्क पड़ेगा, लेकिन सब ऐसे मंदी बहुत आई है, पहले भी आई है, 2008 में भी आई है, लेकिन कुछ ना कुछ रास्ता निकल जाता है और निकल जाएगा, इसमें भी निकल जाएगा. ऐसा नहीं है कि मंदी पकड़ के बैठेंगे सब, कुछ ना कुछ और और भी रास्ते हैं, डायमंड में और भी रास्ते निकल जाएंगे और बहुत सारे
रास्ते तो काफ़ी है। जैसे कि यूएस से टैरिफ लगाया 50% का, तो एक ही कंट्री पे डिपेंड नहीं है, हमारा दूसरी जगह भी एक्सपोर्ट होता है, तो उससे भी कवर होता है काफ़ी। तो टैरिफ का कुछ इश्यू यहाँ पे इफेक्ट नहीं पड़ेगा ज़्यादा हमारा को, और लोकल भी काम चालू है वैसे। हाँ, तो वो हिसाब से कोई इशू नहीं बढ़ना चाहिए, और ज़्यादा वैश्विक मंदी है तो वो हिसाब से ज़्यादा फर इफेक्ट नहीं पड़ेगा। सब आत्मनिर्भर के हिसाब से काम कर रहे हैं यहाँ पे भी इसी हिसाब से।
तो आगे जाकर अगर ये मंदी चलती रहेगी तो कितना लंबा ये मंदी आपको लगता है झेल पाएगा ये सेक्टर?
नहीं, ठीक है, काफ़ी टाइम से मंदी चल रही है, बट थोड़ा बहुत चल रहा है, तो वो इश्यू नहीं आनी इसमें। आज 6 महीने बाद तो वो तेज़ी आनी है। मंदी तो परमानेंट तो रहने वाली नहीं है, बस सबका सपोर्ट होना चाहिए, कि एकता होनी चाहिए, तो मार्केट प्लस आना ही है।
आप कैसे देखते हैं?
अभी तो मंदी लगता नहीं है कि ख़त्म होगी। ख़त्म जब
दिवाली आ जाएगी,
क्या महीने के बाद दिवाली आ जाएगी। तो मार्केट को चलना है तो इंटरनेशनल लेवल पे भी तेज़ी आनी चाहिए, और ये टैरिफ वगैरह इससे तो बहुत ज़्यादा मंदी होगी। तो यहाँ पे जो पहले कम से कम 55,000 आदमी आते थे, वो घट के अभी 35-40 हज़ार हो गए। तो इतने सारे आदमियों की या तो नौकरी गई हुई है, या तो फिर उन्होंने कोई और बिजनेस में अपना ध्यान लगा लिया है।
आप कैसे देखते हैं, क्या लगता है आपको, ये मंदी खत्म होगी? क्योंकि दिवाली तो अब 1-2 महीने ही दूर है।
नहीं, ये मंदी खत्म होने वाली लगती नहीं है, क्योंकि हीरा बाजार की हालत तो 2008 से भी भ्रष्ट हो गई। अभी ये 2008 में जो मंदी आई थी ना, उससे भी खराब स्थिति है, लोगों के घर खर्चे नहीं निकल रहे हैं इस बाजार में। आगे क्या होगा मालूम नहीं।
All right, there's a lot of uncertainty and there's a bit of a decline that we've seen coming in sales as well, but that were traders and employees still keeping hope that there would be some resolution that we'll see in coming few months. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to Global Eye. I'm Parikshit Luthra. Tomorrow, India will face a 50% tariff on its exports to the United States. The Trump administration has notified India about the imposition of additional 25% tariffs and has blamed it on India's oil purchase from Russia. However, US has not penalized China, which is the largest buyer of Russian oil. India's tariff rate is now higher than all of its peers in Asia and the neighboring countries like Vietnam, Malaysia, Indonesia and Philippines all have tariffs in the range of 19 to 20%. Only Brazil and India face the highest tariff rate of 50%. South Africa and China also face levies of 30% currently. China has also levied reciprocal tariffs on the US. So how will this impact India? According to data from the Global Trade Research Initiative, 66% of India's goods exports are set to be impacted due to higher tariffs. Gems, jewelry, textiles, seafood are set to be the hardest hit. The jewelry sector has already warned that 1.7 lakh people could potentially lose their jobs. Trump has imposed 50% tariffs on steel and aluminium worldwide. Now, that's part of the Section 232 tariffs. However, some pharmaceutical products, copper, autos and certain auto components, among others, are exempted from the additional US tariffs. If no steps are taken to reduce tariffs, GTRI estimates that goods exports to the US would be scaled down to nearly $50 billion in FY26 from $87 billion a year ago. That's a decline of nearly 42%. However, GTRI expects India's overall exports to remain largely stable as it predicts a 10% rise in services export to offset the impact of higher US tariffs. Meanwhile, industry bodies from India and US have sought a 90-day pause in a bid to give more room for trade negotiations. Prime Minister Modi has reiterated that it will always prioritize the interests of farmers, exporters and MSMEs.
मैं आपको बार बार वादा करता हूं, मोदी के लिए आपके हित सर्वोपरि है। मेरी सरकार लघु उद्यमियों का, किसानों का, पशुपालकों का कभी भी अहित नहीं होने देंगे।
We're now joined by former Indian ambassador to the US, Arun Singh. Thank you very much for being with us on the program. Ambassador, is it now certain, now that these tariffs have been notified, is it certain that they will now come to effect and there is not going to be any deal before tomorrow or before 27th August?
With Donald Trump, you never know. But, and according to some reports, industry is requesting for, on both sides for some pause in the imposition of tariffs. But other than that, as of now, there's been no clear indication that there will be a postponement or that they would not be enforced. And the US has issued an order to that effect. Therefore, let's see. I think for the moment, we should be prepared for the fact that as of tomorrow, they're most likely going to come into effect. And do our plans accordingly.
What could possibly break the ice right now? Is there still a window for diplomacy?
Look, there's always a window for diplomacy, but I think the way the tariffs have been imposed on India for this additional 25% is part of the domestic politics of Donald Trump. He has projected that he would resolve the Russia-Ukraine conflict in one day, in 24 hours. And then he had this meeting with President Putin. He's come under criticism that he's not been able to take any effective action to resolve the Russia-Ukraine conflict. Also, he has not taken any additional measures against Russia since becoming president. So he's coming under criticism for that. He doesn't want to take any action against China, because China, as you mentioned, imports much more energy than India does, because China has shown countervailing power and China has imposed reciprocal tariffs, as a result of which, when they had gone above 100% in each case, the US bond market had got destabilized and Trump gave a 90-day pause. China has also shown countervailing power through imposing export controls on rare earths, critical materials, which US needs badly for its industry. So at this stage, Donald Trump does not want to take any action against China. And so since he was coming under criticism and he felt that he needed to take some action, he's decided to take action against India, levying this additional tariff. Because
Arun Singh, it is also being said, and this is something that External Affairs Minister Jaishankar alluded to, that this cannot be just about Russian oil, because if it was about Russian oil, then why single out India and not go after China? Is there any other reason that is upsetting Donald Trump?
No, I'm giving you the reason. It's because they are using this argument. He's under pressure. So this particular 25%, there's a separate 25% levy that has been done because the bilateral trade agreement could not be worked out. But this particular 25%, they have cited that India is buying from Russia. Now, which is not justified, because as we've discussed, China is buying more from Russia than India is doing. Europe overall, if you add all that they're buying from Russia, not just energy, is buying more from Russia than India is. Turkey is is among the largest buyer of petrochemical products from Russia. Now, he's taken no action against those countries. So for what other reasons, he doesn't want to take action against them. And he needs to show domestically that he has taken some action targeting Russia. So for whatever reason, they've decided that they could take this additional action against India when they're not prepared to take action against other countries. But the consequence of this is that in India, it will be interpreted as US being a coercive and unreliable partner. It will also be interpreted that Donald Trump, for his own domestic political reasons, is prepared to throw the India-US relationship under the bus. And so there will be consequences flowing for that. And we have to keep that aspect in mind.
What do you think could really help India at this juncture? Can India do anything which will help put a pause on these additional 25% tariff? Or you feel that too much water has flown under the bridge now?
Ultimately, no. I think ultimately US has to make an assessment that the India relationship is important for them. They've said, if you saw recently, for example, when the new US ambassador to India, his name was announced, in the tweet that Secretary of State Rubio put out, he said India remains one of the most important relationships for Russia, for the United States. So they have to understand that if the India relationship is important to them, then they have to handle India differently. For example, with China, as we've discussed, they have not imposed the additional tariffs. There are reports of Donald Trump possibly going on a visit to China. It can't be ruled out that they will do a trade deal with China, because they need that, given, again, the power that China has shown and export control. But despite that, US will remain in a deep economic, technological, and military competition with China. There's no other country that can provide that competition to the US. And US wants to retain its preeminent position globally. Now, if they want to do that, they will need the India partnership, because it's the technology partnership with India in many areas that has enabled many US companies to maintain their global lead in innovation. You will hear about 1,700 global capability centers in India. 20% of the global talent in semiconductor design is in India. So if they value the India relationship, they'll have to treat India differently. So when they make that assessment, that they're damaging the US-India relationship and they need to change their approach, that's when things will change.
Right. Is there a threat of higher secondary sanctions against India? Currently, we're looking at secondary tariffs, but could there be secondary sanctions as a next step if Trump does not attain success with the Russia-Ukraine war?
Look, if they don't attain success with Russia-Ukraine war, they cannot use India as the only leverage. They have to look for other leverages. And again, even from the perspective of US, even from the perspective of Donald Trump's domestic politics, it doesn't make sense for them to impose anything additional. And already in the US, there are voices being raised arguing that this kind of policy of the US is self-defeating. So they have to make that assessment and revise their approach.
Right. And finally, I'm sure negotiations are still on. One of the suggestions that have come from industry bodies is for a conversation between Donald Trump and Prime Minister Narendra Modi. There could possibly be a meeting at the UNGA as well. There is no confirmation on whether the PM would be going there to the UN General Assembly. But what is your sense? Will a conversation between the PM and Donald Trump sort out things at the moment?
That's really a call for the government to take as to what would be the best way to approach. And even if there is to be a high-level conversation, you have to prepare well for that. Because Donald Trump has shown the proclivity that after conversation, he comes out with a social media post claiming benefit entirely for the US and no benefit for the interlocutor. So that could in itself be challenging. So I think those are things that have to be carefully thought through and worked out.
All right, Ambassador Arun Singh, thank you very much for joining us on the program with your view. And you're saying that it's time for the US to make an assessment whether they want to cause long-term damage to the India-US partnership or salvage it at this point. We're taking a break, but don't go anywhere. We'll be joined by Ram Singh, RBI MPC member, to decode the impact of additional tariffs and what will be the monetary policy approach that the RBI should take vis-a-vis the tariffs. That's coming up on the other side. Hello, welcome to Global Eye. I'm now joined by Ram Singh, Director at Delhi School of Economics and RBI MPC member. Thank you for joining us on the show today. I want to begin by asking you, Professor Singh, that what's the larger impact that you see on India's GDP, economy, India's MSMEs as a result of these 50% tariffs?
Thank you, Parikshit, for having me on your show. As a result of US tariffs on Indian exports to the US, we are expecting non-trivial impact in terms of its effect on GDP growth and also employment prospects in some sectors. Our exports to US are about $90 billion, and about two-thirds of our exports are going to be hit by these tariffs. In terms of the export loss, we are looking at 20 to 30 billion US dollars of exports loss. That this is the estimate thrown up by several industrial bodies and export houses. This would amount to a 0.3 to 0.4% of GDP loss for GDP growth rate loss for us. This will be the direct loss. In addition to this, it's going to have indirect effect on our GDP growth rate. The indirect effect will play out as a result of the tariff imposed by US
on other countries, and subsequently its effect on global growth rates. The second channel would be that to the extent several sectors, export-dominated sectors in India are going to be hit by US tariff, to the extent earnings, employment and earnings in those sectors come down, that will have indirect channel effect on demand and GDP growth rates. MSMEs happen to be as you know that MSMEs are the major driver of our exports. And in the sectors like gem and jewelry, textile, apparel, diamond, fisheries, many units happen to be MSMEs, and therefore, as you said, they are the hardest hit.
All right. Now, when it comes to what kind of policy interventions would be needed to support sectors which are the most impacted, according to you, what are some of the things that the Monetary Policy Committee will have to factor in and do in the coming months?
So, first of all, we should note 2-3 things. In such a situation, this is an unusual situation, not entirely unexpected, but certainly unusual. In such a situation, monetary and fiscal authorities will have to work together in tandem, because these tariffs are going to impact not only our GDP growth rate, but also have a direct bearing on inflation. Therefore, there is a case for monetary and fiscal policy coordination. Fortunately, both the monetary policy and fiscal policy fronts have ample firing power, ammunition. We have, in a sense, prepared ourselves for the rainy day. Now rainy day has arrived, and we need to work to roll out various measures. Some of these measures will have to be sector specific. For example, giving specific concessions to exporters in the sectors that have been hit the hardest. The fiscal incentives could be temporary tax breaks or giving specific concessions, duty drawback enhancements for exporters. It could also be the case of cutting down on the custom duties on import of raw materials temporarily. From monetary policy point of view, the major factors or supporting hand is going to be in the form of providing credit along the lines of guarantee that was provided during COVID era. COVID era monetary interventions and fiscal interventions were self-limiting, did not harm, did not compromise our fiscal prudence or macro fundamentals. We can take a leaf out of that book and basically replicate some of the measures we had taken back then to support MSMEs and exporters in this case.
Right. You know, one of the big reforms that is being worked on right now is rate rationalization. That is underway. But if you were to be asked about some certain big bang reform measures which are needed at this juncture, because it is always said that you should not waste a good crisis, what should be done according to you?
So there are 3 factors that have a direct bearing on prospects of businesses in any country, and specifically for exporters. First set of factors relate to the logistics cost. We have made significant advances on that front. So our logistics costs have come down significantly. They look decent by international comparison also. The second factor is the regulatory cost. And third factor is the financing cost. We need to make significant advances, progress on these 2 fronts. There have been several interventions, simplification, rationalizations of regulations that impact MSMEs and exporters and business houses in general. Still, a lot more needs to be done. The GST reforms underway are part of that picture. The regulatory burden on MSMEs in terms of land use regulations, in terms of other regulations that they have to comply with, in terms of the clearances that they have to sort and secure before they can start their businesses or start exporting, remain burdensome.
the funding cost is also high in India. So our primary channel is through non-banking financial corporations, and that form of intermediaries has its advantage, but the result is that funding costs are very high for exporters and MSMEs and business in general. So we need to make, this is an opportunity, as you said, for us to go beyond GST rationalization. GST rationalization is a significant step forward. It will have direct bearing in boosting demand and also reducing business cost for many businesses. But we need to look beyond in terms of land use regulations, in terms of other regulations, in terms of the ranking, the credit ranking of business corporations, specifically small entities, and in terms of their abilities to borrow directly using the bond market.
Right. Do you feel that the setback in the form of 50% tariffs, is this going to be temporary, and will India tide over it in the next couple of months?
So I have two-dimensional views on this. In the interim, things could get worse for us before they become better, in the sense that now we are talking only about US tariffs, indirect tariffs, because of the Russian oil that we import. Now, the Russian oil import is not going, this issue is not going to stop here. There could be additional restrictions on our imports of Russian oil, either in terms of the changes in the ceiling rate at which Russia can sell its oil, or there could be country-specific quotas that can have bearing on our import oil and therefore on inflation, also growth. But I feel that everything considered, looking, if we have horizon of, let's say, 6 months to 1 year and beyond now, this is a crisis. If we use this as an opportunity, we can overcome not only the setback, which in my view is temporary, but we can emerge with a better house in better order. Our economy can emerge stronger in final analysis.
Right. Of course, there is an impact on India's growth in terms of the GDP, in terms of export growth as well. But if you were to be asked about inflationary risk, especially if we have to stop buying Russian oil, which for the moment India is saying we are not going to stop, and buy more US oil, buy more oil from other countries, what are the larger inflationary risks that you foresee?
So if we can make an attempt to quantify the inflationary risk. If we assume that the crude oil is going to be costlier by, let's say, $10, according to estimates, it is going to increase inflation from 30 to 40 basis points. So that will be its first order impact. It will have its effect on fiscal deficit also, because government will have to cut down on taxes imposed or adjust administrative prices. But in any case, it's going to have fiscal implications. And the fiscal deficit, in turn, will have impact on inflation. So this scenario, the scenario I just discussed, it's about increase of $10 per barrel of crude. My view is that regardless of what is being talked about in terms of our import of Russian oil, whatever is done by European and Americans on this count is going to be self-limiting for two major reasons. One is that for hypothetical situation, even if we assume that we cut down on most of our purchases of Russian oil, China is likely to pick up some of that.
Right.
That would mean that Chinese demand in international market will come down, and that will have self-limiting impact on oil prices. Other major reason, even more important, is that neither Europe nor US government would want a situation where they have to deal with very high crude, petroleum, diesel, and LPG prices. So the estimate of 10 USD is kind of upper limit in my view. So more likely scenario would be 65, 66 USD per barrel at the cost situation. That's the situation. Increase of 5 to 6 US dollar increase is the very likely scenario that we might have to deal with in next 6 months. Now,
all right, thank you.
But as I mentioned early on, Parikshit, so our monetary, we have ample monetary space and fiscal space to deal with this situation. On fiscal front, our fiscal deficit for this year, for this financial year, is estimated to be 4.4% of GDP. We have enough cushion to absorb this shock and not let it multiply to show up as heightened inflation. On monetary policy, also, we have ample scope. We played it safe in last monetary policy meeting, and we have both the bandwidth and space. RBI also, I want to add that RBI is equipped with enough reserves to make sure that rupee follows a trajectory that is decided by the RBI, and we do not run risk of imported inflation significantly. And very finally,
all right, we've run out of time.
This last 10 seconds,
Professor Ramsingh,
as you know that our inflation trajectory is very, very comfortable in the near future for next 2-3 quarters. So we can take this hit. It's a hit, but we can take it.
All right, it's a hit, but we can take it. Thank you so much, Professor Ramsingh, for joining us with those very important views. You're saying that we have enough monetary and fiscal bandwidth to deal with the present situation and absorb it. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Goodbye.
Hello and welcome to Finding Alpha. On today's episode, we dive into the cement sector, a sector that could see a major shakeup from the GST rationalization. What are the re-rating triggers and what are the stocks to invest in at this point of time? Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. With me today is industry veteran Anil Singhvi, who's joining us. He's also the executive chairman of Sri Digvijay Cement. And we're also joined in the studio by Jashandeep Chadda, the Vice President Equity Research of Nomura. Well, thanks a lot, gentlemen, for joining in. Well, in the next 20 to 30 minutes, we'll explore the possible benefits of the GST cuts, what could spark a re-rating for the cement companies, whether it makes sense to bet big on the players Or, in fact, look at the takeover candidates and what are the expectations we're building up for FY26. Well, thanks a lot, gentlemen, for joining in, and thanks, Jashandeep, for coming down to the studio as well. But Mr. Singhvi, let me come across to you first. You've been rallying for this GST cut. Could you tell us this GST rationalization, probably from 28% to 18%, will it bring real affordability, or is it at best a sentiment booster?
Well, look at this way that today industry is paying perhaps one of the highest GST in terms of total collection. According to me, this year should be about 75,000 crore on cement alone, which is, according to me, even exceeding cigarettes. So that definitely 28% per se is a very high rate. Now, if it is brought down to 18%, would it spur demand? Answer is yes. For simple reason that prices which are about 325 rupees, 350 rupees will come down to about 325 rupees if the industry passes on the entire reduction in the GST, which I think, according to me, industry should do it for the larger benefit of both industry and the consumer. So the short answer is yes, it will spur the demand, because in the rural areas, cement still is perceived to be a little more expensive on account of GST being at 28%.
All right, Mr. Singhvi, so you're impressed with that, but Jashandeep, let me come across to you. What do you think? A GST rationalization, will it be enough, to boost up sentiment, push through volumes as well, or do you think at best you leave it to sentiment?
So, first of all, thank you, Nigel, for having me here. So, I believe, GST cuts will largely not impact demand as much. Okay. We believe, cement demand is inelastic to prices. It's not that the prices go down, people will start consuming more. The cement is consumed as per the project requirement, right? Okay. However, what I believe is that instead of, demand increasing, there will be an increased share of premium and category A producers. Okay. So, right now, what category A producers are selling at post GST, they will be selling at, closer to the level of what category B are selling at. So the price decline in category A gives an opportunity to the customers to upgrade themselves in the same budget. So I believe while the demand will, flow as we are expecting, but the share of category A and premium products will improve. Okay. So that's how we look at GST.
All right, Jashandeep, just explain this to us then. Because as you're saying, in cement, you have broadly three categories. Category C, which is cheaper than category B, and category B, which is cheaper to category A. Right. Now, you're telling us because of the GST rationalization, those that were earlier buying category C could probably move to category B, and those who are buying category B could probably move to category A. Could you tell us what is the pricing difference as of now if I look at category A, B, and C?
Right. So, Nigel, largely it's four categories broadly. Okay. There's also one premium product which comes above category A, but however, their penetration is less than, let's say, 3% right now. So, the price difference on an average is around 25 to 30 rupees between category A, B, and C. Okay. Right. So let's say if there is a 10% decline in GST, which gives you around 27 rupees decline in the cement, retail prices, which means category A, after GST cut will be trading at what, currently category B is trading at. Okay. So hence, without spending much more, increasing your budget, a customer will be able to buy a better category, brand. And normally, we believe that customers are price sensitive in India. I believe they are value centric. So, in their budget, they would like to have the best brand available.
Best brand at the least cost, and GST rationalization will help you get
Yes. There. So, right now, category A is around 40% of India market. I believe, if the complete, cut is passed through, we can see 55 to 60% penetration of category A by FY30.
Well, that is important. And if you could break it up for us as well, which are the players typically that come in category A, B, and C? I think there's a geographic element to it as well. So if you could just explain to us with a quick example.
Yes. So, it's a regional business, but there are two companies or two brands which are category A pan-India, Ultratech and Ambuja. Ambuja and ACCI combined, so Ambuja Consol and Ultratech both are category A players pan-India, but then there are regional dynamics. For example, in South, Ramco is category A, whereas in East, it will be a category C or category B player, right? Dalmia is category A in both the regions, East and South, but Nuvoco is category A, in fact, even higher than category A in East, but a category C player in North. So they are regional dynamics, but Ultratech and Ambuja are pan-India category A player, and they have the highest penetration in premium products also. So I believe they will be the biggest beneficiary if GST cuts happen.
Got it. So you're saying premiumization and better value product at a lower cost is something that could play out. And as you said, Ambuja as well as Ultratech, they are mostly category A, while others it differs from region to region. On Shree Cement, I think In East, they're in the low category, but I think in the North, they are in the top category.
So she, historically has maintained a view of volume over value.
Yeah.
So they have always indulged in, having a better utilization and asset sweating than focusing on pricing, right?
Okay.
So they are category B in North. However, since last year, they have been doing a lot of work on their rebranding, launch another, Bhangur brand in the premium segment. And our channel check suggests, since the start of this financial year, there has been the acceptance of their premium or category A brand has increased. So they are able to, narrow down the price gap between category A and them from 25 to around 10 rupees.
Got it. And actually in the recent past, Shree Cement has suddenly started focusing more on profitability rather than on volumes as, they have pivoted.
So value over volume.
We'll talk about that in just a bit. But let's get Mr. Singhvi back into this discussion. Mr. Singhvi, in your career, you have seen it all, right? If you could tell us, because a lot of investors would like to look at this old economy sector, which is cement, tell us what is that pivotal moment for a cement company which helps the company re-rate?
I think twofold. One is demand, definitely. Last year demand was just about 4-5%. I expect the demand to spur, and maybe it is looking for a trigger, and GST reduction could be that trigger. Demand should come to about 7-8%. So, and secondly, the consolidation. I think the consolidation journey has been very good. It got accelerated only in 2022 because hitherto Holcim, as you know, was not, participating into the industry's growth, either for consolidation or for organic growth. But I think 22 was, according to me, a complete change in the industry's profile. Today, the top 5 players own almost about 65% of capacity. I expect the consolidation to still accelerate, and that will be the trigger for industry's re-rating coming in. Though, of course, EBITDA per ton or ROE and ROC continue to play in terms of what the valuation game should be. But the trigger for the industry, according to me, could be the GST reduction from 28 to whatever it is, 18, 15. And secondly, the demand impetus, which will come on account of rural market really opening up. With good monsoon and reduction in the prices, I think we're going to see some very, very high demand coming from the rural pockets. And consolidation still is an ongoing process. It's not complete yet.
Mr. Singhvi, I want to ask you a little bit more about that consolidation process that you're talking about. But Jashanti, let me come across to you. According to you, what is that big re-rating event? We have seen it in the past. Suddenly you saw Dalmia coming into favor. We have seen how Shree Cement has got those premium multiples as well. So according to you, what is that re-rating trigger? And if you could delve a little bit more.
Yes.
Cost structure is obviously important. That's what helps ratings as well. And I think those that are backward integrated and they have that clinker advantage, they as well stand to gain. So if you could particularly dwell on both these two aspects.
Sure. So, cement is a commodity business at the end of the day. In any commodity, especially in cement, the industry is price taker. So for the industry to have a re-rating argument, there should be a trigger that shows that there is increasing pricing power in the industry, right? However, the utilization remains very low in this industry, so we do not believe an industry-wide re-rating is quite possible right now.
Okay.
But however, when we come to specific companies, there are certain events which cause re-rating. For example, an expansion of capacity into multiple region, or a company from a multi-region becoming a pan-India player. For example, for instance, in Ultratech, from FY16 to 18, their capacity, cement capacity, grew at a CAGR of 20% versus 6% for the industry, which led to their re-rating happening. They expanded, they bought, it was also supported by a lot of inorganic expansion, but they enter into multiple regions.
Yes.
Similar case we can see in Shree Cement from 13 to 16, they expanded a lot. And in Dalmia's case, if we see, there was a slight re-rating when they announced that they will be acquiring JP. So they will be entering center. Again, a step forward to becoming a pan-India player. But when that did not play out, the re-rating happened. So I believe for a company, the first thing is how much, geographical presence you have. So multi-region or a pan-India player will always have a higher rating than the other. Second, as a commodity, at the end of the day, it's the cost structure that governs it, right? The lower you are on the cost curve, the higher incremental ROC you will have. And that's why Shree Cement, despite when they had some, market share loss or reduction in their volumes, their multiples continue to rate higher because they are one of the lowest cost producers.
I just want to come on to that point before you move on to the clinker aspect. When you're talking about low cost producer, better ROC, Could you tell us for Shree Cement, what are the numbers? What is the industry average, and what is Shree at in terms of ROC? Because that is one of the reasons why Shree gets those premium multiple.
Sure. So if I take 10 years from FY22 back, the industry the average ROC post tax was around 10% for the industry.
Yeah.
Around 10%, 9-10%. But at the same time, Shree was around 12-13%.
Okay.
So that's a big difference, and that is largely because they have worked on their cost. They are one of the company with highest green power mix in the world right now in cement industry, around 58%. They have worked on a lot of other things that has resulted in them being on the lowest end of the cost curve.
Yes.
So that advantage they have when even the pricing unfavorable, their EBITDA per ton largely sticks.
Yes.
Whereas other fines is difficult.
So got that. ROC of 13-14% in comparison to the industry average of around 10%. So Shree, one is the cost aspect. It translates into better ROC historically. These are the details. And in the clinker aspect?
Yes. So, when I say multi-region presence, I am talking about clinker. So at the end of the day, clinker or limestone reserve, to be very honest, are the key ingredient for cement. So,
Yes.
So every cement company is basically a limestone miner.
Yes.
Because they have legacy mines. So if you have clinker plants at different locations, you can set up grinding units near the market. Hence, you have a couple of things. Firstly, your freight cost to the market goes down. So you have a cost advantage. For example, Dalmia, I'll take. In East, most of the clinker reserves or limestone reserves are in Chhattisgarh.
Yes.
Everyone has a clinker plant there. However, Dalmia and Shiva Cement, which is a subsidiary of JSW, have clinker plants in Odisha. Now, what happens is because of this, they can provide cement to places like West Bengal or Bihar at a lower freight rate. So hence, their profitability increases in that. So multiple, when I talk about regional presence, I'm talking about clinker and not cement.
Got it. And just on the cost aspect, the cheapest cost cement producer is who? Shree.
So it is, Sagar and Shree. So very close, but Sagar has also been a low-cost producer. But in larger players, players above 20 million ton, it's Shree, definitely
Shree and Sagar Cement, they are the lowest cost producer. Got that. Mr. Singhvi, let's come across to you. Elaborate a little bit more on that point you made about the consolidation theme. And are we due to hear something about the company that you're heading? Shree Digvijay Cement, is there something in the near future with regard to this consolidation drive?
I am right now talking about larger picture. So let's not talk about the micro and small picture which is there, which is not going to move the needle of the industry at all. In fact, when you look at the total capacity of the industry today of 650 million approximately tons and demand this year of 500 million tons, still the large players are, I think, just about close to 400 million tons, which is of the capacity is just about 65%. I expect this 400 million tons by the top 5 players to go at least up to 500 or 550 million tons before we start seeing the real benefit of consolidation coming in. So according to me, the consolidation is a journey, and I think we're going to see it much more in next 1 or 2 years' time. And I would stop it at that as far as consolidation of the industry is concerned.
We'll be waiting back to hear from you, Mr. Singhvi, whether or not Shree Digvijay Cement, there's a deal in the offing. But as you said, we'll keep that aside for now. All right, before we let you go, Mr. Singhvi, could you tell us when do investors need to be a little bit cautious on cement companies? Sometimes, over-aggression, wanting to expand everywhere. I've seen that in the past as well. Tell us more.
I think two things very clearly, perhaps you answered the question itself, is that aggression in volume game. You cannot create the demand. The demand will take its own course. So there's no point in pushing the volume just because you want to have a market share. That's actually just a very, very nominal push one can have it on that. But oftentimes we are seeing that just you're getting a 1% or 2% additional market share, you're dropping the prices by 10%. Cement is actually, to that extent, is a highly competitive landscape. In that, if you try to gain the market share in the shortest possible time, I think that takes the toll on the market and the pricing. I for one, have seen in the last 40 years that finally you are a long-term player. You don't have to look at one quarter or 2 quarters for your market share gain. Gain will come definitely because the industry itself is going 7-8%. But if you wait and watch and see and don't spoil the, so to speak, the market sentiment, I think that then it's a long-term haul. And I'm glad that with the consolidation, now the serious players are emerging. Those who are to create a moat for the investors, they can't just look at capacity and the capacity utilization. Both of them are actually at the two ends of the spectrum. So look at what your capacity utilization is. It has to be in excess of 80% for you to create really good value for the shareholders on that. So I'm sure, I think going forward, this will be played out in a much better manner than what we have seen in last 1.5 years. Demand definitely played the spoil sport. I hope and expect the demand post, maybe that's a trigger which I'm still hoping the GST reduction should be the trigger for the demand to spur down.
You're extremely happy with this GST rationalization, Mr. Singhvi. We thank you for joining in and filling us in with your views on the show. Jashandeep, coming across to you before we take a mandatory break. The street is divided. Should you look at the big boys, the ones that are ruling, Ultratech, Ambuja, Shree, Dalmia, should you look at them? Or should you look at the smaller ones, which trade at a sharp discount in comparison to replacement cost? And they could possibly be takeover candidates. Where are you placed out there?
So I'll answer this in a different way. How basically that's the question is whether the consolidation will increase or not.
Yeah, Mr. Singhvi believes it's going to go on.
Yes, I believe the consolidation in any industry, especially where the utilization is low, will happen. But what we have to think about how the pace will be from here on.
Yeah.
I think the pace will temper from here. The pace will decline from here. It will not be as aggressive as we have seen in the last 2 years. So just to give you an instance, from FY14 to 17, around 12% or 51 million ton of the cement capacity exchange hand. Since the entry of Adani from FY24 to 25, already 63 million ton have exchange hand. So that's roughly 10% of the industry. I believe from here on the consolidation pace will go down, because if we look at two metrics, right? Firstly, the we look at share of top 6 and top 3 players across the regions. So if in the case of top 3 player share, it's already above 50% in all the region except South and East.
Yes.
And in case of top 6 players, it's already above 80%, way above 80% in all the regions except South. So I believe any more inorganic, significant inorganic expansion might result in Competition Commission, coming in and checking in. Plus, there are not many, stressed assets also that companies will be looking to buy at a discount. So I believe the consolidation will happen. Companies like Ambuja, still have to expand their capacity by 20 million ton, and inorganic is a easy way to do that. Sorry, not easy, but it's a quick way to do that.
Yeah.
But the pace will not be as we have seen in FY25, 24 and
So
25.
consolidation will slow down. It could happen, but it will slow down. So you rather stick to the big boys.
Yes, I'll stick to the large caps.
Got it. We got some more questions for you, Jashandeep. For the time being, we'll take a short break. You come back. We've got a lot of queries as well because you'll have written in. Stay with us. Jashandeep will answer all of them. Welcome back. You're tuned into Finding Alpha. You're on CNBC-TV18, and we are in conversation with Jashandeep Singh of Chadda of Nomura, who joins us. Jashandeep, two numbers I want to get out of the way. One is on volume growth. Mrs. Singhvi is sounding quite optimistic that volumes are going to recover in the second half of the year. The first half actually has been soft. What volume growth are you factoring in for the industry? And EBITDA per ton is expected to improve. How much it improves for the industry in 26 versus 25?
Yes. So talking about volume, I think I am also very positive. The fact is that around 55-58% of the total volumes come in the second half. So there's a majority chunk of volumes which is still yet to come. Okay. I believe this year, FY26, the industry should grow between 7 to 8%.
Okay.
YOY. And on the EBITDA per ton, I believe last year the EBITDA per ton was a little suppressed because there was, pricing were very weak. Yeah. Prices have recovered, strongly. Even in a monsoon quarter, we are seeing pricing being resilient. So I believe around 200 to 250 rupees per ton for the large players, it is quite possible. On an industry-wide, I think 100 to 150 rupees per ton is quite possible.
Got it. Okay, Jashandeep, we have a couple of viewers who are listening to what you have to say, and they're looking at the charts and they're saying you have buys on a couple of stocks. So Rohan Sharma is writing to us from New Delhi. He's saying between Ultratech and Shree, he wants to know which is the better placed company according to you. You have a buy rating on both of them. What's your take?
So yeah, so to answer between Ultratech, so right now both the companies are, doing something which the other company used to do earlier. Yeah. So Shree Cement is on a path of improving their realization. Ultratech is already a category A player who's, on a path of cost reduction. I'll say that, very close, but I'll go with Ultratech because I think in a commodity business, cost reduction will provide you, sustainable EBITDA per ton reduction. Shree Cement is on a path. The absolute the total volumes to be upgraded will take some time.
Okay.
So I believe Ultratech will see better delta in EBITDA per ton than
Got it. All right. So Ultratech over Shree, it's buy rating on both, but preference Ultratech comes first. Ravi Kumar as well has written to us from Chennai. He has around 500 shares of ACC at 2,300 rupees. Wants to know what's the outlook on this one. Valuation comfort, large player, but still that's been a big underperformer. What's your view?
So we have a structurally negative view on ACC. We believe there are a lot of structural challenges in the company.
Okay.
I'll not, the prices are at 2,300 he has booked, right?
Yeah.
So what I'll suggest is to wait for, some price increase and then shift. If he wants to play in the Adani group only, then shift to Ambuja or, switch to some of the large cap players.
Ambuja over ACC, and I think that's what the street as
Yes.
well, and that's why it's been getting those multiples. So we got that. But there's another interesting, query that's come in from Riaz Khan, who's written to us from Hyderabad. He holds around 225 shares of Deccan Cement at 628 rupees. Wants to know the outlook on the stock. I have my ear to the ground. And I try to find out who's visiting Deccan, who's interested in, what kind of assets they have, what is the capacity expansion. What do you believe? What should he do? He's nearly doubled his money, but that bride is still out there. The groom has not yet been found.
So, Nigel, I think you are at more liberty to talk about Deccan Cement. We don't cover that stuff, so I won't be able to give my opinion on that.
But what's your view on South India? And South India, do you like anything? Because these valuations give you comfort. The problem is capacity utilization level is so low. Now there is hope that, utilization will improve and pricing has improved after being a big underperformer for the last 12 months.
So what I'll suggest, to the viewer is that if they want to play in South India, I think Aramco Cement and Ultratech or even, Ambuja might be a better because they will see sustainable increase in their EBITDA per ton because their volumes will expand more than, I think Ultratech and Ambuja's volume will expand more than the industry. And Aramco, once the pricing come back, is closest to the highest price market of Kerala and South Tamil Nadu. So there's one advantage over there as well. So either, play with, if they want to do a mid-cap player, Aramco, otherwise Ultratech and Ambuja.
Okay, all right. Final question, Jashandeep, before we let you go. What is the risk to this entire thesis? That cement, people are quite positive actually because Q1 for the market on the whole has been soft. But cement has been showing that, maybe the second half is going to be much better. It has a low base effect as well. So what do you think is the risk to this thesis?
So for any commodity industry, right, these stocks react to how the pricing is going, but the structural risk is always the demand.
Yes.
Right. So I think if now we are also seeing the government stance is changing from more of, more towards consumption, right? So if the government demands, declines,
yeah,
I believe then we might, all the price hikes might not be able to sustain. So the failure in demand is the biggest risk than any pricing, I'll say.
Okay, all right. Well, Jashandeep, it's been a pleasure having you on the show. Thanks a lot for joining in, telling us about the various aspects, not just pricing, but within pricing, there are various categories, the way you're looking at the industry with regard to the cost focus as well. And GST could in all probability at least help, on the volume parameter, hopefully. But more importantly, it'll help in premium use of cement. Thanks a lot for joining in. Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching.
Welcome to Standard Chartered presents CNBC-TV18 Leadership Collective, where we bring together the minds rewriting what leadership looks like in a changing India. Thank you for joining us this evening. We open the evening with a keynote from someone who has witnessed India's transformation across finance, education, policy, and private capital. Please welcome TV Mohandas Pai, Chairman 314 Capital, co-founder and Chairman Iron Capital.
The big challenge for India today is to grow the economy from 4 trillion to 10 trillion. Can we do it? The answer is an yes, and let me tell you why. 1991, our GDP in rupees was around 5,32,000 crores. It's grown to 331 lakh crores today in 31st of March 2025. That is 12.2% a year for 34 years in rupee terms. In dollar terms, it grew from $275 billion to $3.94 trillion. That's 8.1% a year in dollar terms, CAGR for 34 years. And from here, to grow to $10 trillion, we need to grow the GDP from around 331 lakh crores to around 9 lakh crores, possibly by 34-35. That's about 11% CAGR in rupee terms. Of course, the big zinger is the rupee-dollar rate. The rupee-dollar rate, if you assume at 85 and assume it stabilizes at 90, we should be able to do that. Out of 14%, 7% could be the nominal rate, 4% could be the inflation, with the rupee possibly depreciating to 90 and stabilizing to 90. I remember when I joined Infosys in 1994, the rupee was 27 to a dollar, went to 33, now it's come to 85, 86. So even though our GDP has grown, it doesn't reflect in dollar terms, primarily because the rupee depreciation of 3.5–4% a year for the last 34 years. But in rupee terms, it's very clear. And the rupee terms is reflected in the PPP GDP. We are $17.5, $17.6 trillion in PPP. Across all areas of industry, traditional industry, we are number 2 or 3 after China, and we are going to be number 2 after 3 of China, because China today is about $20 trillion nominal and about $36 trillion in PPP. So can we be a China? No. There's room for only one China in the world, which is 30% of the world's manufacturing capacity, the largest exporter, possibly the largest importer, the largest holder of foreign currency reserves. But we can grow the economy in our own way, because we have to grow at 11% and we have to make sure it reflects. So I want to end by saying, we are on a great wicket. We are going to build this country to 10 trillion with the 85–90% probability by 2035. We are investing adequately. We are midst of the digital revolution. We have young entrepreneurs coming up. Country is becoming efficient, and entrepreneurship is going up, and corporate profitability is at an all-time high, and that's going to continue. We have a great future. Go for it, and we'll all do well. Thank you very much.
At a time when speed, trust, and integration define the future of finance, our next conversation brings us to a space where institutional depth meets the startup drive to build fast and at scale. To take off from where we are today in Bengaluru, the startup ecosystem, the startup ambition, bank financing has not been part of the picture, part of the story so far. Do you see a greater link now between banks as well as the startup ecosystem?
So banks have been closely associated with the startup ecosystem for a very long time. If I can say, in the first phase, providing them the banking rails, providing some of the tech startups, the banking rails was the first phase that we saw. During that phase, we also learned about how this ecosystem is growing and what the startups require. Each one had a slightly different requirement. So for example, a very fast growing tech startup would require a B2B platform, or would require someone who can do the reconciliation for them. So that's where I think the bank stepped in, and the bank could do a good job of that. In the next phase, there was a mismatch between collections and payments, and that's where probably working capital, etc. came in. As I think these startups have matured, there's also been acquisition finance, there's also been long-term finance, and selectively some of this has also taken off. So setting this context, if I look at our own journey in the bank and take an example, like I told you before we had a chat that, I love giving examples. So if you look at how a fintech player was eventually scaling up and the requirements that they had. So it was a requirement for very fast payments to happen, setting out the payment rails. In one of the cases, they required a sponsor to be part of the Bharat Bill Pay system, and that's where the bank could add value. In every phase, I think there is a role that banks can play with this ecosystem.
You laid out very well the phases that we've seen so far. But as we step into the next phase, as we look at scale, as we look at the possibility of many of these entrepreneurs also looking at global markets, what specifically do you believe the role that a bank like yours can play to fuel that ambition, fuel that fire?
So as the ecosystem grows and as the startups achieve a certain scale, they want to acquire other companies, so you need an advisor to help them.
In addition to that, you had an MSCI reaching, and that was net, it called for some outflows to the tune of roughly around 250 to around $300 million. Now, for the Nifty itself, you had a lot of, financials that came under pressure. So you had Shriram Finance, that was one of the top losers. Bajaj Finance as well did see some selling. And add to the list of Sun Pharma as well as Tata Steel. So all those four were the top losers on the Nifty. However, domestic-facing themes, that was the place to hide. So Eicher Motors was one of the top gainers from the auto pack out there, and one of the top gainers on the Nifty. Maruti Suzuki as well, they rolled out their first battery EV, e-Vitara, from their Gujarat plant, and the street liked that, so that stock as well was up close to 2%. Street is factoring in this GST rationalization could potentially be good for autos in the second half of the year or towards the end of September. So that's why those stocks did well. A lot of these FMCG names as well, that was the pocket to hide in. So today you had HUL, Nestle India, ITC, more domestic facing in nature. They have been relative underperformers in the past as well, and there was some buying that we saw in all those names. Now, from the broader markets, the losers included Vodafone Idea. The street fears that's the end of the road for them, so that's why that stock was under pressure. And obviously, Indus Towers normally moves in sympathy with Vodafone Idea, and since it was low, you had Indus Towers as well that did see some selling. But from the broader markets, though you had a very, very dull day, you had Vikram Solar, that was a new listing, went over with gains of more than 8%. Protein eGovern as well as BLS International, they won orders from Aadhaar, pertaining to Aadhaar. Both those two stocks, in fact, were up in trade. And Ola Electric, out of nowhere from the recent low, the stock is up more than 20%. There's this PLI benefit that they're now factoring in. So that's why those were the stocks that actually outperformed the market. Towards the end of trade, though, you had their MSCI impact. Net MSCI outflows is what we saw from the Indian markets. However, stocks like Hitachi, Swiggy, as well as Vishal Mega Mart, all of them did perk up towards the end of trade. What's the way ahead? Trump's tariffs are clearly weighing on sentiment, weighing on investor appetite as well. But the real trigger is going to be earnings recovery and recovery in the domestic economy as well. That's something that's high because there has been some monetary policy support as well as fiscal support. Now all eyes are on the domestic story, whether or not a recovery is in store.
Nigel, many thanks for joining us. The market's under pressure today, and that is the big story this evening. Come tomorrow, India will face a 50% tariff on its exports to the United States. The Trump administration has now notified India about the imposition of the additional 25% tariffs, blaming it on India's oil purchase from Russia. However, the US has not penalized China, which is the largest buyer of Russian oil. India's tariff rate is now higher than all of its peers in Asia and the neighborhood. Countries like Vietnam, Malaysia, Indonesia and Philippines all have tariffs in the range of 15 to 20%. Only Brazil and India face the highest US tariff rate of 50%. South Africa and China also face levies of 30% currently. In fact, China has also levied reciprocal tariffs on the US. So how will all of this impact India? According to data from the Global Trade Research Initiative, 66% of India's good exports are set to be impacted on account of the higher tariffs. This is the big one. Gems and jewelry, textiles, seafood, steel and aluminum are set to be the hardest hit. The jewelry sector has already warned that nearly 1.7 lakh people could potentially lose their jobs. However, pharmaceuticals, some copper items, autos and certain auto components, among other items, are exempt from the additional US tariffs. Now, if no steps are taken to reduce tariffs, GSTRI estimates that goods exports to the United States will be scaled down to nearly $50 billion in FY26 from $87 billion currently. That's a decline of nearly 42%. However, GTRI expects India's overall exports to remain largely stable as it predicts a 10% rise in services exports to offset the impact of the higher US tariffs. So this is now a reality. From tomorrow morning, 50% will be the effective tariff rate on our exports to the US. Industry bodies from both India and the US have sought a 90-day pause in a bid to give more room for trade negotiations. The government has reiterated that it will always put the interests of farmers, exporters and MSMEs first and will look at ways to mitigate the trade impact. Parikshit is standing by now with more. Parikshit, what is it that we're picking up in terms of talks that are currently underway, negotiations that are perhaps still underway? What can we expect? What can we hope for?
Well, negotiations have been on in a very hectic manner over the last 20 days or so. But so far, there is no solution. The fact that the White House has notified the 50% tariff rate is an instruction to importers that if you're getting goods in from India, this is the tariff rate that will be implemented. It's a top-line rate of 50%, starting 12:01 a.m. Eastern Daylight Time on the 27th of August, which is 9:31 a.m. India time. Definitely, this is going to be a setback for India's textile sector, footwear, leather, apparel sectors in a big way. The hope is that many of the exporters, many of the large and small exporters have already sent a lot of consignments to the US in the last few months, and therefore there will be a cushion for the next few weeks. Even now, there is talk on the part of the government and also on the part of industry bodies. Everyone is appealing to the White House to somehow put a 90-day pause, just the way there have been a 90-day pause for tariffs on China, extended by another 90 days. Similarly, here you have top industry bodies requesting the White House that give a reprieve for some time. Let there be room for negotiation. Even if you want India to purchase more US oil, how would you expect India to buy more oil if you impose tariffs in this manner on a very close ally? So that is the level of conversation that is taking place. Lots of back-channel negotiations. Even now, there is hope that even if these tariffs come into effect on 27th of August, in the next few days and weeks, possibly something can be done or some sort of breakthrough would be achieved with the Russia-Ukraine war, and there will be a positive ripple effect. For the moment, India has made it very clear there will be no compromise on India's red lines on agriculture and dairy. We're also making it very clear that we understand this is not just about Russian oil, because you cannot be singling out India. China is a bigger buyer of fossil fuels. In fact, the Indian ambassador to Russia went on to say that we'll buy oil from wherever we get at the best prices. Having said that, India continues to negotiate with the US with an open mind. At the same time, top-level meetings taking place in Delhi to see how to cushion and mitigate the impact of these tariffs, because almost $48 to $50 billion worth of exports from India will be impacted.
We have basically reached out to the president and asked him to at least delay the implementation. We need a runway to find a solution between the two countries itself. And it's important that to understand that, yes, the secondary tariff are unjust and they shouldn't be put in. But we can't just keep on going on the media and keep on calling it just. Let's keep on working and finding a solution. So I think by postponing this by 90 days or 120 days, it's like US has done with China, it will give us a runway to sort things out. But more important is I think a call between the Prime Minister and the President can untie the knot which we have got ourselves into it, so at least both countries can work in a positive manner.
Well, industry is still hoping that there will be some sort of a breakthrough. But as I mentioned, India's gems and jewellery sector is bracing for a tough ride, as is the textile sector. Manisha joins us now with more. Manisha, explain to us the impact both the gems and jewellery as well as the textile sectors are likely to face on account of the 50% tariffs coming in.
Well, absolutely. As you mentioned, India's gem and jewellery industry will be among the worst affected due to the US tariffs. US is the biggest market for the sector, accounting for 40% of its overall exports, which is worth $10 billion. The 50% tariffs make India far less competitive compared to countries like Turkey, Vietnam and Thailand, which face tariff rates less than 20%. And the jewellery industry has issued an SOS warning about potential job losses to the tune of 1.7 lakhs. The industry has also written to authorities seeking relief, including special schemes and a duty drawback scheme as well. The industry is also seeking market access initiatives and deferring of the interest cost on working capital. The industry is also looking at government approval to offloading the stock in the domestic market. The president of the Gujarat Jewellery Association did not mince his words, saying that 50% tariffs effectively make it unviable to trade with US.
Very tough time, very challenging time. It's very difficult to work with US. As I mentioned in my previous interview also, 25% also very difficult to ask. 50%, so there is no point of discussing anything. We'll have to explore new markets. We'll have to negotiate. My team, GJPC, is also working very hard with Commerce Ministry. There is sufficient goods in pipeline in US. So I'm hoping this season will not be wiped off absolutely. But the road ahead is very, very tough.
Another sector that will feel the brunt of the tariff is textiles. The US accounts for 35% of India's total textile exports. The value of these exports last year was nearly $11 billion. The industry is also asking for government intervention. Textile exporters are calling for a special financial assistance to tide through the crisis. Many textile units in Tamil Nadu's Tirupur have been shut as consignments are put on hold. The industry is fearing job losses, even though has not happened so far. The industry fears that the exports to the US could decline by anywhere between 28 to 40%. The Federation of Indian Exporters remains hopeful, though, that both nations are engaging in talks and that would ease the tough tariff burden going forward.
We are also hopeful that very soon they will come on a negotiating table. As and when the BTA is finalized, please bear in mind that the top two leadership has given a terminal date of fall of 2025, which is still a few months away. And therefore, we have time till October to finalize the deal. To bridge in, they don't have that much of profit margins. And therefore, I'm pretty sure that in September, we will see export to US dropping down drastically. The good thing is that 45% of the export, which is under Section 232 or in the exempt category, that may continue for some more time.
Well, tough times for India's exporters and now seeking government assistance and support. Mark Mobius, chairman of the Mobius Emerging Fund, has said that India will be okay despite the tariff impact and that only certain sectors, including pharma and garment industry, will be hit. In fact, pharma is exempt. Speaking to CNBC, Mobius said that despite these high tariffs, India's economy will continue to do well. Take a look.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the US. The garment industry, of course, will be hurt because a big portion of their exports go to the US. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous.
Well, that's Mark Mobius. Moving away from tariffs, Prime Minister Modi flagging off the first unit of the e-Vitara in Gujarat's Hansalpur. This is, of course, a car from the Maruti Suzuki stable. He also inaugurated a lithium-ion battery manufacturing facility. The auto giant will start deliveries of its battery electric vehicle within few months, and the target is to emerge as the country's largest electric car maker in the first year. Maruti will also export its battery EV to nearly 100 countries, including Europe and Japan, with the aim to export between 50,000 to 1 lakh units on an annual basis. Speaking at the event, Prime Minister Modi has said Maruti Suzuki's project in Gujarat is a big leap towards the Make in India target.
भारत की मेक इन इंडिया इस यात्रा में एक नया अध्याय जुड़ रहा है। ये मेक इन इंडिया, मेक फॉर द वर्ल्ड हमारे उस लक्ष्य की तरफ एक बड़ी छलांग है। आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे।
Well, you must be wondering, where is the steering wheel of this car? Well, this is the e-Vitara, which is going to be made in India and exported globally. So, for the Latin American markets and a lot of other abroad international markets, the steering wheel is on the left side of this car. I am sitting, you have guessed it right, in the newest e-Vitara, which is going to be manufactured in India in its Hansalpur plant in Gujarat and will be exported to over 100 countries, including high-tech markets like Europe and Japan. And it's rolling off the production line right here at the plant, making India a global EV manufacturing hub. Now let me show you the car. Now this car was showcased by Maruti Suzuki in the Bharat Mobility Auto Expo this year. So there is nothing new in this. However, it is a spacious car. Look at the controls. It's very much similar to the current e-Vitara. It's spacious, very luxe interiors. Nothing new and major over here. However, it has some modifications for the international market, especially for other Latin American markets, which has different tonalities and different things in their car.
So our effort is to localize the supply chain as much as possible. Maruti Suzuki stands for deep localization. And the other inauguration that you saw today, our fellow subsidiary TDSG, they achieved deep localization from the battery to the cell and from the cell to the electrode. So they are manufacturing the electrode for hybrid batteries, and that has been inaugurated today. So the effort is to localize as much as possible.
Well, that's Maruti Suzuki's new electric vehicle, the Vitara. Up next on Business 360, the government has done all it can to help Vodafone Idea, says the Minister of State for Telecom in an exclusive conversation with CNBC-TV18. That and more when we return.
By that target, then to also make sure that the financing is done in the right way as they scale up, and the ambition is to go to the capital markets, as you've seen so many of our colleagues here doing that. You need pre-IPO finance, you need to bring in probably private investors into the mix, you need some kind of bridge finance at times. A lot of startups have gone and accessed international markets, so they want to grow their business overseas and they also want to get funding from offshore. I think that's where the super connector banks that have offshore operations have a network in place. Those are the ones that can act as super connectors and make sure that these startups understand the new ecosystem that they are going into, which could have regulations, it could have market nuances, and all of that can then be brought in a sensible way to the core of the business.
You know, in your conversations that you're having with startup founders today, what do you believe are the key challenges that they continue to contend with, that they continue to cope with?
So the good part is startups are now coming from tier 2, tier 3 cities as well. So this is a more inclusive entrepreneurship story that we are seeing. During these phases where they are able to test their hypothesis and grow. So I talked about $5.7 billion of funding coming in.
Yeah.
$2 billion of that has come in the growth phase. $3 billion has come in the late phase. It's the startup phase, the actual when rubber hits the ground.
The Union Minister of State for Telecom, Chandrasekhar Pemasani, has said that the government has done whatever it could to help Vodafone Idea. In an exclusive conversation with CNBC-TV18, Pemasani ruled out any further measures for the cash-strapped company. He also added that there are plans for a nationwide 4G rollout by BSNL, which is likely to cost 1 lakh crore rupees. Take a look.
I just want to get clarity because there's so much speculation in the market. Is there a relief package in the works either for Vodafone Idea or for the sector-wide approach that would address these financial issues that the company appears to be dealing with?
No, whatever we wanted to do has already been done. At this time, we are at the ministry level, we are not discussing any additional packages for Vodafone.
But is there a need felt, sir, if not for Vodafone specifically, then across the sector, at least in terms of maybe options being considered, such as advancement of the tenure or maybe waiver of some penalty interest dues? Is that something that can be?
No, whatever we could do, we have already converted into equity. Okay. Right now, our focus is to how to rebuild BSNL. Sure. So make the BSNL. You know, Vodafone is up to their management. They are all business people. They know how to manage. It's up to them how they want to take it forward. From the government side, there is nothing that's being discussed at this time.
And the government, sir, enjoys a 49% stake. That's a sizable shareholding. Any view on what that shareholding could look like going forward? If not increase, then is there a view on perhaps monetizing it? Any timelines that you?
No, increasing will make it like any other PSU. Sure. So at this time, we do not have any plans to increase.
Staying with BSNL, very recently in the Parliament, in the just recently concluded Parliament session, you had informed the Parliament that there's a capex of nearly 7,000 crores that's been approved as far as 4G deployment for BSNL is concerned. tell us, given that it is inherently a local domestic technology, indigenous technology, you mentioned is what 4G, what BSNL is relying on. What will a nationwide 4G rollout for BSNL cost you in terms of what would be the capex required to undertake a 4G express 4G services across the country?
See, right now that 7,000 crores and everything is for combination of these 100,000 4G towers plus 20,000 4G saturation project, where the rural villages where there is no Airtel, Jio, no connectivity, to deploy those remote, far-flung areas, northeast.
Sure.
So that will cover total 100 plus 20,000, 120,000 towers. Next is, if you look at Jio, Airtel, they have close to 4 lakh, 5 lakh towers of all of these. How to generate that kind of, it requires much more capex. Maybe another 100,000, 100,000, I would say, crores is what is required. But there are effective ways you can do with technology. See, now what BSNL is working on is enabling Wi-Fi calling. If we get the Wi-Fi calling, most of the people have internet facility, Wi-Fi access. And if we can do that, then that will be, every Wi-Fi spot can become like a BTS tower. So our goal is to get that within the next 2 to 3 months for the large extent. So that itself can replace large number of towers. That's number one. And number two, we have asset monetization plan, so we can get internal accruals. Second, as the revenue increases in BSNL, we get additional revenue. In combination of these three things, then we will see what else we need. So it will be a continuous incremental increase in the number of towers. So, it's reinventing the BSNL in an upward trajectory.
I think the name Elon Musk catches on as far as headlines are concerned. But given that he has deep pockets, is there an expectation or an apprehension that perhaps he could undercut some of the existing players using some of these deep pockets that he has?
See, this I can only tell you hypothetically, and based on history, they have not done in any other country, including in a country like Sri Lanka. They have not given any subsidy or whatever you call it. So history hasn't revealed that. So it is very hard to see that they will do differently here. But as I said, these entire satellites are given by ITU in a coordinated International Telecom Union. Even if somebody, Elon Musk, wants to put some satellite, it's just not possible without the coordinated effort.
Sure.
So the total satellite is around 12 to 13,000 that was given.
Right.
So the entire world may not have more than 1 crore or 1.5 crore connections, entire world, if you talk about it. So, and these satellites have to be replaced. LEO satellites, low Earth orbit satellites, are prone to damage due to heavy weather-related events. So every 4 to 5 years or 5 to 6 years, you have to replace these low Earth orbit satellites. So it's a very expensive process. So it's not so easy to build massive number of satellites, to keep them and to serve everyone on the Earth.
Sure.
So this is something a lot of people may not understand, technical limitations. Just because Elon Musk or anybody has money doesn't mean they can take all the customers because of these technical limitations and how much investment it needs for recycling the satellites.
Seed funding phase, we've seen a number of transactions of smaller value, and that's where I think a little more work can be done. And that's where when helping startups find their feet and moving through the various phases.
Let me end by asking you, what do you take away as inspiration? If you could start up today, what would you want to do?
So a startup is very hard work. It starts with an idea, and you need to believe that idea is a real world requirement. You need to test the hypothesis, then you need to put money behind it, probably your own. So it's very tough for a startup entrepreneur to actually convince a whole lot of people that this is the need of the hour, and this is a better need of the hour than the idea next door, because everyone here has a startup in their head. But what really inspires me is the manner in which, the diligence with which I think a lot of these ideas have actually grown into real world solutions, solving issues that are large and adding value to mature businesses in economies like ours at scale.
PD Singh, what an absolute pleasure. Thank you very, very much for joining us here at the Bengaluru edition of the Leadership Collective. Appreciate your time and look forward to having more conversations with you. Moving on to our next conversation, India's digital public infrastructure is one of its strongest global narratives today, but it's what happens between platforms and people that sets a benchmark. Dr. Shalini, you've been part of the state's journey for over decades now. Tell us, what were some of the early bets that Karnataka... Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space.
Of the darkest times for us and has a very deep implication, and we are in a hole, but we're in the hole with an amazing team of people.
Dream11 founder and CEO Harsh Jain says the company will not legally challenge the new law banning real money games, also promises not to lay off employees, hopes to pivot to a free-to-play model driven by advertisements and sponsorships, also plans to launch global products. That's an exclusive.
Harajuku Tokyo Cafe, an authentic Japanese casual dining and QSR chain, has raised 19 crore rupees in its first institutional funding round from Samved VC, Let's Venture and Capital Ventures to support its aggressive expansion plans. The company is targeting 90 outlets across 20 cities and over 200 crore rupees in revenue by 2027.
Hexafun, a sustainability-driven lifestyle accessories brand, has secured 4.5 crore rupees in seed funding from early-stage investor Prajay Advisors. The proceeds will be used to expand its retail presence, strengthen marketing efforts, and launch new product lines.
Paytm's parent company 197 Communications will invest up to 455 crore rupees in two of its wholly owned subsidiaries, Paytm Money and Paytm Services. 197 Communications will subscribe to a rights issue of equity shares for 300 crore rupees in Paytm Money and 155 crore rupees in Paytm Services. The company expects to complete the cash transactions within 30 days.
Elon Musk files a lawsuit against Apple and ChatGPT maker OpenAI, accusing both companies of joining hands illegally to stifle competition. Musk takes aim at Apple's decision to integrate ChatGPT into its smartphones through an exclusive arrangement. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Fintech startup Kiwi, that claims it pioneered the concept of credit on UPI in India, has raised $24 million in its Series B funding round, led by Vertex Ventures, Southeast Asia and India. In 2 years of operations, Kiwi has issued over 2 lakh RuPay credit cards, processes more than 5 million transactions every month, and the company says this fresh capital will power product innovation, sharpen unit economics, and help it scale to 1 million cards by 2027. Joining us now to talk about Kiwi's growth story and the future of credit on UPI is Anup Agarwal, co-founder and CEO of Kiwi. Anup, welcome to Startup Street. Now, with the fresh funds raised, you're planning to roll out EMI on UPI and add-ons for credit cards. If you could elaborate on what's next on the product roadmap and how do you see Kiwi's rewards program evolving?
Thank you. Thank you for having me on CNBC. Two questions. I think the product roadmap for us stems from customer demand. I think as we see today, most of the consumers are using credit card and UPI as a two-payment instrument. And what we are trying to solve for a consumer is to completely shift their behavior on UPI credit card. So do away with completely a physical credit card, which is there on their wallet. So that is what the first product line which we launched, and we are seeing tremendous amount of demand in that particular segment. The second area which we think is going to be very, which will see exponential growth is credit line on UPI. Basically, consumers who don't have a credit card will migrate to a credit line on a UPI product, which is basically they will have a line from the bank, which they will use for emergency or basically discretionary purchases into EMI. We are very bullish on that particular product line because the consumer demand is very high for that segment because they don't have a credit card and their demand is basically to use their credit line for discretionary purchases. So that's where we are very bullish on. Yeah, so that we are going to invest in that particular category of.
Okay. You know, Anup, you've set yourself a target of issuing 1 million RuPay cards by 2027. What gives you the confidence to hit that milestone and what's the playbook to get there?
I think the confidence is because the market is so large and it is so underpenetrated. And we believe that the gap is primarily the education. Consumers today just don't know that they can transfer their UPI savings account transactions to a credit card. Just the education itself can drive insane amount of growth for us. And that's what we believe will be our growth trajectory coming from.
All right. So let's talk about the fundraise. Apart from accelerating the product growth journey, Anup, you also plan to strengthen unit economics. Now, what does that mean for Kiwi in practice? If you could share the current business growth numbers and how close you are to turning profitable.
So we have set ourselves a target of 2 years to turn profitable.
Okay.
Strengthen unit economics. I think the day we started our company, we were very clear that we want to have a very clear unit economics. And that is one of the reasons we chose credit card, which is a very healthy unit economics. Basically, ensuring that we are getting the maximum wallet share of the consumer on Kiwi through the cards which we have issued on our platform. That is something which we are focusing on very closely. We become the choice for all the transactions which are converted into an EMI, basically making our product so convenient for the user that we become the go-to product for all their credit needs. So those are the two focus areas for us as we strengthen our economics.
You already have partnerships with Yes Bank and AU Bank, and I believe you plan to onboard 2 more large banking partners within this financial year. Anup, what can you tell us on this front and how critical are these banking partnerships in scaling your credit on UPI proposition? And with more players now entering this category, what will differentiate Kiwi in a competitive landscape?
Very good question. So look, ultimately, RBI is very clear that the credit line on UPI or credit card on UPI can only be issued by banks. And hence, banking partners are very critical for our success and for our growth. So having multiple banking partners allow for both. So banking partnership is key for our success. So that is something we will continue to focus on. As you rightly said, the TAM is very large. The market is very large for UPI today. On UPI, 22 lakh crores are spent every month. And we believe that UPI credit on UPI will see about 2 lakh of spends in the next 3 years, which is currently hovering at about 20,000 crores, so 10x growth. So there will be a lot of players who will be eyeing to get into this particular space. I think Kiwi is poised with this right brand positioning in consumers' mind for the right experience. And we are focusing primarily on this particular category itself. And this 3 will help us win in this particular segment.
All right. Picking up from what you just mentioned, India has 350 million UPI users, but only a fraction use credit cards. You spoke about the opportunity, but how big an opportunity does this gap represent for Kiwi? And also, do you see credit on UPI eventually overtaking traditional credit cards in India, given the sheer size of UPI's acceptance network?
Very good question again. So 350 million, which is 35 crore consumers are using UPI. Credit card consumers are about 4 crores. If you look at unsecured lending, is given to about 12 crore consumers. So if you look at a difference, about 8 crore consumers don't have credit card but has a good credit history. We believe that a large portion of these consumers will eventually move to credit line on UPI or a credit card product in the next foreseeable future of 3 to 4 years. And that's where the opportunity is. So whether credit line will become larger than credit card, it's for, we'll see it in the future. I don't have any comments on that, but we believe credit line on UPI will become very, very large in the near future.
But at the same time, Anup, there are growing concerns around credit discipline in a market where millions are new to credit. So how is Kiwi building safeguards into the product, and what are you seeing on NPS so far?
So on the credit side, we partner with banks and the credit is underwritten by the banks. And banks have shown traditionally has been very, very prudent around discipline, around leverage, not lending to leveraged clients. They are highly prudent about making sure they are not over leveraging the customer. So we don't control the credit policy, which is the bank's prerogative in our case. But we have seen very low NPAs in our case so far. And I think this is something which is closely monitored by bank. So I think we are in good space there.
All right. You've said you want Kiwi to be the go-to platform for credit on UPI. So paint us a picture. What does success look like for you over the next 3 to 5 years in terms of revenue growth? And also give us a sneak peek of the product pipeline in the near-term future.
Awesome. So for us, there are many ways to looking at success. From a business perspective, I think if we have a 10% market share in the next 3 to 4 years as key UPI credit on UPI grows, a 10 to 15% market share will be a win for us. And on the product line, we are launching, obviously we already have a credit card on UPI, credit line on UPI will come, and we will deepen our credit card product roadmap and rewards roadmap for our existing customers so that it feels much more rewarding to be at Kiwi with UPI credit.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Anu, for joining us on Startup Street today, and wish you the very best for all your growth plans.
Thank you. Thank you. Thanks for having me here.
And moving on, India's baby products brand R4Rabbit has raised $27 million in a Series B funding round led by Filter Capital and co-led by 314 Capital. The round also marked a successful exit for early investor Exponential Capital. Founded in 2014, the company has grown into one of India's most trusted parenting brands with a revenue CAGR of over 35% since FY21 and an ARR now crossing $30 million. With this fresh capital, R4Rabbit plans to scale its omni-channel presence, drive product innovation and strengthen its digital reach as India's premium baby care market continues to expand rapidly. Joining me now to discuss this further is Kunal Popat, the founder and CEO of R4Rabbit. Kunal, thank you so much for taking time out and being here with us on Startup Street. Let's start with the fundraise itself, right? What will be the key focus areas for the $27 million that you've raised? Product innovation, digital expansion, or scaling distribution?
Okay. So thank you, first of all, very much to have me on the show. Okay. Regarding the fundraise, there are 4 major priorities. First, that we are going to invest is product innovation. R4Rabbit as a brand is known for its innovation in the product. And it's a brand which is built by the parents for the parents. So the brand was started by me and my wife being a co-founder with me, and started out of the dear needs when I became the father. And I was into corporate. So it was started with the dire need to have a great quality, most safety certified products for our country. That's how the brand was started. So safety and product innovation are the key pillars of the company. So the main objective to put the funds are product innovation, scaling up different channels like D2C is one of the key priority for us. Other channel developments, there are new channels that are emerging. So we want to focus on that and putting more on the brand, because still we feel that brand needs to get in the mind of consumers. So we are still small in terms of brand penetration. And I think there's a lot to work on that.
So brand penetration is where you're looking to mostly work on. But India's, baby care market is rapidly premiumizing, right? So how is R4 Rabbit sort of positioning itself to capture this growing demand? If you could kind of take us through the growth you're witnessing and how are you keeping yourself ahead of competition?
Okay, so as you rightly pointed out, okay, that India is moving towards premiumization. R4 Rabbit foundation is on the premiumization. We are not a massive brand, or we are not into, we are a mid-premium or premium brand in the baby category. What separates us apart is the products. Okay, the amount of efforts that we invest and the amount of nitty-gritties that we have in our products separate us, and consumer love us for that. In terms of NPS, if I can say that we have one of the best NPS in the industry, which is 80%. Okay, so consumer love us because what we are giving to them. How we are, at the end of the day, like your product speaks for itself. Okay, your brand speaks for itself. So brand and product will take care with the competition.
All right, so brand and product will take care. So you're saying what sets you apart is the type of products that you have. You delivered over 35% CAGR since FY21 with an ARR now exceeding $30 million. So what are your growth targets for the next 3 to 5 years? And also if you could tell us where you hope to end this year.
Okay, we are expecting to end this year close to 40 million, 45 in terms of ARR. It will be around 50 million. Okay, in terms of net revenue, around 45 million. Where, as I said, that where we are gonna get the further growth. So as new channels are emerging, like quick commerce. Okay, so we are gonna invest our time, money, efforts to develop this channel. Second, we are still yet to get strong on the foothold of India, which is tier 2 cities and the offline presence. Our offline presence still needs to be better compared to what it is now. So we are going to expand the team to strengthen our offline presence. Third, we are going to expand in the categories. Lot of categories, or I would say subcategories in the 5 major categories that we deal with, where we call it low-hanging fruits, or a subcat, even the categories. That's the major expansion plan looking like. More on the channels, strengthening our core channels where we are into, developing the new channels as I spoke, and expanding into different subcategories of baby.
All right. And, R4 Rabbit, like you pointed out, also boasts an NPS of 80+ and a strong organic traffic, right? So what has been the secret to sort of building such deep trust among Indian parents? If you could take us through which of your categories is doing the best right now, and, what are these subcategories or new categories that you're looking to enter?
Okay. So you need to understand the gene of us, okay? It's a company started by parents for parents. So when the founder gene, and founder himself is a parent and so passionate about the quality and the innovation on the product, it will come out in the products. Okay, that's the gene. And we, being a company, started with the core philosophy of, parenting, making this journey of parenting easier. Or I would say parenting solution. That's where our key focus is. Okay, in terms of, so that's where I would say that we are very strong into. Second question that you asked is about subcategories. Okay. In terms of subcategories, let's say there are 5 major categories. Baby gear for us, diapering, ride-ons and toys, baby furniture, and feeding and nursing. We see that feeding and nursing and furniture are having a strong momentum of growth for us. And the leading category for us at the moment is baby gear and diapering. We are, consumers are accepting us, and we are one of the leaders in the premium segment in these categories.
All right. So diaper is where you're seeing like most of the traction. You've highlighted your omni-channel distribution as a key growth driver, right? How do you sort of plan to balance the online and offline presence to reach modern Indian parents more effectively? And how many, stores are you currently present in? What's the revenue mix between online and offline?
Okay, very nice question, I would say. In terms of number of stores that we are present, we are currently into 2,000 plus stores across the country. Still, there are, if you ask me how many stores you can be present, I would say that we can still be present in 3,000 plus stores, where we will, put our efforts and expand our team to be present. In our category, baby as a category, it's a highly researched category. Okay, mothers put their heart when deciding a product for the little one. Every mother wants to, first of all, touch, feel the product. That's how we are going to balance our omni-channel, that the more the presence of the product that we are able to create in offline space will give a room for experience the product to the mothers. In terms of distribution of the business of online and offline, currently, we are 65% more digital or online, 35% I would say offline.
All right, so 35% offline. But, you said you're present in over 2,000 stores. If you could sort of tell me, where are these stores, currently present across India? Take us through what the presence is. How many cities are you sort of catering to? You're obviously targeting the premium segment. So what's the expansion plan?
So in terms of number of cities, we are present in top 40 cities. The major stores that I'm talking about are present in top 40 cities. But what we are seeing is strange, I wouldn't say strange, but India being changing, okay? We are seeing a strong demand coming from tier 2 cities, even from the places like Northeast, like Arunachal Pradesh, Nagaland, sometimes gives you the revenue or the footfalls that they carry or the spending capacity that they carry is far out of the blue that you can think of. Kashmir, you feel that Kashmir is not a lot of people feel that it's not a great market, but for the premium products, they love premium products and they love quality. Lot of pockets like this, Kerala is one of them. Such are the pockets that we need to strengthen ourselves, where consumers are looking for a premium quality products for the little one. So we are gonna go deep down into all those territories in the country.
All right, Kunal. So you are going to deepen your presence across all of these territories. All right, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on your journey going forward.
Thank you very much. Thanks a lot.
On that note, it is time for us to head into a short break. But coming up next, smart kitchen tech brand Beyond Appliances has raised $4 million in Series A funding. How do they plan to use the funds to scale the business? We put the firm's co-founder Ishwar K. Vikas on the hot seat to find out more. Stay tuned.
Welcome back. You're watching Startup Street. Now, smart kitchen technology company Beyond Appliances has secured $4 million in a Series A funding round, which was led by Fireside Ventures. This capital is going to be deployed to scale its manufacturing capabilities. It currently operates about 4 facilities and plans to set up 2 additional units in the next 12 months. It also claims to have doubled its revenues post the seed round in November last year and now aims to strengthen the core product categories while also expanding into new appliance segments, which will be supported by this upcoming manufacturing capacity. But for more on the company's growth trajectory ahead, joining me now is its co-founder and CEO, Ishwar K. Vikas. Ishwar, thank you so much for your time here on CNBC-TV18. Briefly tell us about Beyond Appliances and how do you plan to strategically allocate this $4 million?
So Beyond Appliances is a smart kitchen appliance company. We have seen that there are a lot of changes that has happened in various smart homes. Like you have smart TVs, you have vacuum cleaners, you have everything. But smart kitchen appliances is something that has not come. And we spend a lot of time in kitchen. We love to cook and we spend a lot of time. So we said at Beyond Appliances, we'll make smarter chimneys and smarter stoves/hobs. That's what we do. And because we are seeing a lot of demand and requirement for production, and hence we have raised some capital right now that is going to help us make our production better. We are going to invest in a couple of new facilities where we are going to manufacture all these products while we have been making them in India right now. Bulk of the will create a lot more facilities here and also to build brand and create a lot of IP around this whole kitchen space. So that's where we are going to use this capital for.
Okay, Ishwar, currently you operate 4 manufacturing facilities, as we understand, and this plan to set up 2 additional units in the next 12 months. Where will these be and what kind of production capacity increase is this going to give you?
So we are going to open 2 new facilities while we might shut down 1 or 2 of existing because the 2 new facilities will be quite massive. We'll be looking at 1 chimney and 1 hob facility, 1 for stoves and 1 for chimneys. We are yet to zero in on where the location will actually be. That's something we are still searching for. But once these facilities are ready, we'll be looking at huge volumes that we can do. And with BIS standards and everything that are coming in, I think we'll have some of the best labs and some of the best production equipment that can do the smart appliances at.
All right, got that. You've doubled your revenues since your seed round, you say. What is driving this kind of growth and how confident are you about getting to that 400 crore ARR target in the next 3 years?
See, the industry, Ritu, is quite large. It is a $2 billion industry between chimneys, stoves and hobs. It's a very large market, and today customer is looking for new appliances, smart appliances. They want the latest in the market. They want the best feature because when you're redoing your home or when you're upgrading your home, you want a better feature. Nobody buys a normal TV anymore. They buy a smart TV. Nobody buys a normal watch. They all buy a smart watch. Similarly, there is a trend to buy better kitchen appliances because in Indian context, kitchen is like the heart of the home. So people always want a better and the newer appliance that can come. And hence we feel, because it's a $2.5 billion market, CAGR of around 15%. So we feel that the number which we're looking for is sort of doable. And hence we feel that these are good targets for us to have our results.
Okay, got that. Quickly, Ishwar, as you expand beyond Bengaluru and Hyderabad into markets like Mumbai and Delhi, what is the role that offline retail and modern trade will play compared to your D2C and online channels?
While we are heavy on e-com and D2C right now, we see a lot of inbound demand from a lot of modern trade and retail partners across the country because most of the people in all the other cities also want to see and touch and buy the product. There's a lot of demand for them in these respective cities and their respective outlets, and hence we will definitely expand offline as well, but we plan to remain a digital first brand in the near short term.
Okay, and finally, Ishwar, before we let you go, the kitchen appliance market is very much dominated by legacy brands today. What is your moat in terms of technology, pricing, and consumer adoption, would you say?
See, I think the real moat is consumer insights. Legacy brands have done a fantastic job and continue to do a good job in terms of distribution, brand, and manufacturing. I think creating specific IP, like my stoves have timer, my chimneys have Android screens, we have integrated AI features in our chimneys which can count whistles and turn off the stove automatically. So these are some of the industry first IP that we have created, and hence we feel that the customers today love these features compared to what is already available in the market, and that is the moat for us to ensure that customers like to buy our products, we believe, than other products out there.
All right, Ishwar, we'll leave it at that. Thank you so much for your time here today on Startup Street. It's been a pleasure speaking with you. And on that note, we're going to say goodbye from all of us. And thank you so much for watching. But stay with us. More news and updates will continue after this break.
Hello and welcome to Finding Alpha. On today's episode, we dive into the cement sector, a sector that could see a major shakeup from the GST rationalization. What are the re-rating triggers and what are the stocks to invest in at this point of time? Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. With me today is industry veteran Anil Singhvi, who's joining us. He's also the executive chairman of Sri Digvijay Cement. And we're also joined in the studio by Jashandeep Chadda, the Vice President Equity Research of Nomura. Well, thanks a lot, gentlemen, for joining in. Well, in the next 20 to 30 minutes, we'll explore the possible benefits of the GST cuts, what could spark a re-rating for the cement companies, whether it makes sense to bet big on the players, or, in fact, look at the takeover candidates and what are the expectations we're building up for FY26. Well, thanks a lot, gentlemen, for joining in, and thanks, Jashandeep, for coming down to the studio as well. But Mr. Singhvi, let me come across to you first. You've been rallying for this GST cut. Could you tell us this GST rationalization, probably from 28% to 18%, will it bring real affordability, or is it at best a sentiment booster?
Well, look at this way that today industry is paying perhaps one of the highest GST in terms of total collection. According to me, this year should be about 75,000 crore on cement alone, which is, according to me, even exceeding cigarettes. So definitely 28% per se is a very high rate. Now, if it is brought down to 18%, would it spur demand? Answer is yes. For simple reason that prices which are about 325 rupees, 350 rupees will come down to about 325 rupees. If the industry passes on the entire reduction in the GST, which I think, according to me, industry should do it for the larger benefit of both industry and the consumer. So the short answer is yes, it will spur the demand, because in the rural areas, cement still is perceived to be a little more expensive on account of GST being at 28%.
All right, Mr. Singhvi, so you're impressed with that, but Jashandeep, let me come across to you. What do you think? A GST rationalization, will it be enough, to boost up sentiment, push through volumes as well? Or do you think at best you leave it to sentiment?
So, first of all, thank you, Nigel, for having me here. So, I believe, GST cuts will largely not impact demand as much. Okay. We believe, cement demand is inelastic to prices. It's not that the prices go down, people will start consuming more. The cement is consumed as per the project requirement, right? However, what I believe is that instead of, demand increasing, there will be an increased share of premium and category A producers. Okay. So, right now, what category A producers are selling at post GST, they will be selling at, closer to the level of what category B are selling at. So the price decline in category A gives an opportunity to the customers to upgrade themselves in the same budget. So I believe while the demand will, flow as we are expecting, but the share of category A and premium products will improve. Okay. So that's how we look at GST.
All right, Jashandeep, just explain this to us then. Because as you're saying, in cement, you have broadly three categories. Category C, which is cheaper than category B, and category B, which is cheaper to category A. Right. Now, you're telling us because of the GST rationalization, those that were earlier buying category C could probably move to category B, and those who are buying category B could probably move to category A. Could you tell us what is the pricing difference as of now if I look at category A, B, and C?
Right. So, Nigel, largely it's 4 categories broadly. Okay. There's also one premium product which comes above category A, but however, their penetration is less than, let's say, 3% right now. So, the price difference on an average is around 25 to 30 rupees between category A, B, and C. Okay. Right. So let's say if there is a 10% decline in GST, which gives you around 27 rupees decline in the cement, retail prices, which means category A, after GST cut will be trading at what, currently category B is trading at. Okay. So hence, without spending much more, increasing your budget, a customer will be able to buy a better category, brand. And normally, we believe that customers are price sensitive in India. I believe they are value centric. So, in their budget, they would like to have the best brand available.
Best brand at the least cost, and GST rationalization will help you get there.
Yes. So right now, category A is around 40% of India market. I believe, if GST, if the complete, cut is passed through, we can see 55 to 60% penetration of category A by FY30.
Well, that is important. And if you could break it up for us as well, which are the players typically that come in category A, B, and C? I think there's a geographic element to it as well. So if you could just explain to us with a quick example.
Yes. So, it's a regional business, but there are 2 companies or 2 brands which are category A pan-India, Ultratech and Ambuja. Ultratech, Ambuja and ACCI combined, so Ambuja Consol and Ultratech both are category A players pan-India, but then there are regional dynamics. For example, in South, Ramco is category A, whereas in East, it will be a category C or category B player, right? Dalmia is category A in both the regions, East and South, but Novoco is category A, in fact, even higher than category A in East, but a category C player in North. So they are regional dynamics, but Ultratech and Ambuja are pan-India category A player, and they have the highest penetration in premium products also. So I believe they will be the biggest beneficiary if GST cuts happen.
Got it. So you're saying premiumization and better value product at a lower cost is something that could play out. And as you said, Ambuja as well as Ultratech, they are mostly category A, while others it differs from region to region. On Shree Cement, I think in East, they are in the low category, but I think in the North, they are in the top category.
So Shree, historically has maintained a view of volume over value. Yeah. So they have always indulged in, having a better utilization and asset sweating than focusing on pricing, right? Okay. So they are category B in North. However, since last year, they have been doing a lot of work on their rebranding, launch another, Bhangur brand in the premium segment. And our channel checks suggest, since the start of this financial year, there has been the acceptance of their premium or category A brand has increased. So they are able to, narrow down the price gap between category A and them from 25 to around 10 rupees.
Got it. And actually in the recent past, Shree Cement has suddenly started focusing more on profitability rather than on volumes as, they have pivoted.
So value over volume.
We'll talk about that in just a bit. But let's get Mr. Singhvi back into this discussion. Mr. Singhvi, in your career, you have seen it all, right? If you could tell us, because a lot of investors would like to look at this old economy sector, which is cement, tell us what is that pivotal moment for a cement company, which helps the company re-rate?
I think twofold. One is demand, definitely. Last year demand was just about 4-5%. I expect the demand to spur, and maybe it is looking for a trigger, and GST reduction could be that trigger. Demand should come to about 7-8%. So, and secondly, the consolidation. I think the consolidation journey has been very good. It got accelerated only in 2022 because hitherto Holcim, as you know, was not, participating into the industry's growth, either for consolidation or for organic growth. But I think 22 was, according to me, a complete change in the industry's profile. Today, the top 5 players own almost about 65% of capacity. I expect the consolidation to still accelerate, and that will be the trigger for industry's re-rating coming in. Though, of course, EBITDA per ton or ROE and ROC continue to play in terms of what the valuation game should be. But the trigger for the industry, according to me, could be the GST reduction from 28 to whatever it is, 18, 15. And secondly, the demand impetus, which will come on account of rural market really opening up. With good monsoon and reduction in the prices, I think we're going to see some very, very high demand coming from the rural pockets. And consolidation still is an ongoing process. It's not complete yet.
Mr. Singhvi, I want to ask you a little bit more about that consolidation process that you're talking about. But Jashanti, let me come across to you. According to you, what is that big re-rating event? You know, we have seen it in the past. Suddenly you saw Dalmia coming into favor. We have seen how Shree Cement has got those premium multiples as well. So according to you, what is that re-rating trigger? And if you could delve a little bit more.
Yes.
Cost structure is obviously important. You know, that's what helps ratings as well. And I think those that are backward integrated and they have that clinker advantage, they as well stand to gain. So if you could particularly dwell on both these two aspects.
Sure. So, you know, cement is a commodity business at the end of the day. In any commodity, especially in cement, the industry is price taker. So for the industry to have a re-rating argument, there should be a trigger that shows that there is increasing pricing power in the industry, right? However, the utilization remains very low in this industry. So we do not believe an industry-wide re-rating is quite possible right now.
Okay.
But however, you know, when we come to specific companies, there are certain events which cause re-rating. For example, an expansion of capacity into multiple region, or a company from a multi-region becoming a pan-India player. For example, for instance, in Ultratech, from FY16 to 18, their capacity, cement capacity, grew at a CAGR of 20% versus 6% for the industry, which led to their re-rating happening. You know, they expanded, they bought, it was also supported by a lot of inorganic expansion, but they entered into multiple regions.
Yes.
Similar case we can see in Shree Cement from 13 to 16, they expanded a lot. And in Dalmia's case, if we see, there was a slight re-rating when they announced that they will be acquiring JP. So they will be entering center, again, a step forward to becoming a pan-India player. But when that did not play out, you know, the re-rating happened. So I believe for a company, the first thing is how much, you know, geographical presence you have. So multi-region or a pan-India player will always have a higher rating than the other. Second, as a commodity, at the end of the day, it's the cost structure that governs it, right? The lower you are on the cost curve, the higher incremental ROC you will have. And that's why Shree Cement, despite when they had some, market share loss or reduction in their volumes, their multiples continue to rate higher because they are one of the lowest cost producers.
I just want to come on to that point before you move on to the clinker aspect. You know, when you're talking about low cost producer, better ROC, could you tell us for Shree Cement, what are the numbers? What is the industry average and what is Shree at in terms of ROC? Because that is one of the reasons why Shree gets those premium multiple.
Sure. So if I take 10 years from FY22 back, the industry, the average ROC post-tax was around 10% for the industry.
Yeah.
Around 10%, 9-10%. But at the same time, Shree was around 12-13%.
Okay.
So that's a big difference, and that is largely because they have worked on their cost. They are one of the company with highest green power mix in the world right now in cement industry, around 58%. They have worked on a lot of other things that has resulted in them being on the lowest end of the cost curve.
Yes.
So that advantage they have when even the pricing unfavorable, their EBITDA per ton largely sticks.
Yes.
Whereas other fines is difficult.
So got that. ROC of 13-14% in comparison to the industry average of around 10%. So Shree, one is the cost aspect. It translates into better ROC historically. These are the details. And on the clinker aspect?
Yes. So, when I say multi-region presence, I am talking about clinker. So at the end of the day, clinker or limestone reserve, to be very honest, are the key ingredient for cement. So,
yes.
So every cement company is basically a limestone miner.
Yes.
Because they have legacy mines. So if you have clinker plants at different locations, you can set up grinding units near the market. Hence, you have a couple of things. Firstly, your freight cost to the market goes down. So you have a cost advantage. For example, Dalmia, I'll take. In East, most of the clinker reserves or limestone reserves are in Chhattisgarh.
Yes.
Everyone has a clinker plant there. However, Dalmia and Shiva Cement, which is a subsidiary of JSW, have clinker plants in Odisha. Now, what happens is because of this, they can provide cement to places like West Bengal or Bihar at a lower freight rate. So hence, their profitability increases in that. So multiple, when I talk about regional presence, I'm talking about clinker and not cement.
Got it. And just on the cost aspect, the cheapest cost cement producer is who? Shree.
So it is, Sagar and Shree. So very close, but Sagar has also been a low-cost producer. But in larger players, players above 20 million ton, it's Shree, definitely
Shree and Sagar Cement, they are the lowest cost producer. Got that. Mr. Singhvi, let's come across to you. Elaborate a little bit more on that point you made about the consolidation theme. And are we due to hear something about the company that you're heading? Shree Digvijay Cement, is there something in the near future with regard to this consolidation drive?
I am right now talking about larger picture. So let's not talk about the micro and small picture which is there, which is not going to move the needle of the industry at all. In fact, when you look at the total capacity of the industry today of 650 million approximately tons and demand this year of 500 million tons, still the large players are, I think, just about close to 400 million tons, which is of the capacity is just about 65%. I expect this 400 million tons by the top 5 players to go at least up to 500 or 550 million tons before we start seeing the real benefit of consolidation coming in. So according to me, the consolidation is a journey, and I think we're going to see it much more in next 1 or 2 years' time. And I would stop it at that as far as consolidation of the industry is concerned.
We'll be waiting back to hear from you, Mr. Singhvi, whether or not Sri Digvijay Cement, there's a deal in the offing. But as you said, we'll keep that aside for now. All right, before we let you go, Mr. Singhvi, could you tell us when do investors need to be a little bit cautious on cement companies? Sometimes, over-aggression, wanting to expand everywhere. I've seen that in the past as well. Tell us more.
I think two things very clearly, perhaps you answered the question itself, is that aggression in volume game. You cannot create the demand. The demand will take its own course. So there's no point in pushing the volume just because you want to have a market share. That's actually just a very, very nominal push one can have it on that. But oftentimes we are seeing that just you're getting a 1% or 2% or additional market share, you're dropping the prices by 10%. Cement is actually, to that extent, is a highly competitive landscape. In that, if you try to gain the market share in the shortest possible time, I think that takes the toll on the market and the pricing. I for one, have seen in the last 40 years that finally you are a long-term player. You don't have to look at one quarter or 2 quarters for your market share gain. Gain will come definitely because the industry itself is going 7-8%. But if you wait and watch and see and don't spoil the, so to speak, the market sentiment, I think that it's a long-term haul. And I'm glad that with the consolidation, now the serious players are emerging. Those who are to create a moat for the investors, they can't just look at capacity and the capacity utilization. Both of them are actually at the two ends of the spectrum. So look at what your capacity utilization is. It has to be in excess of 80% for you to create really good value for the shareholders on that. So I'm sure, I think going forward, this will be played out in a much better manner than what we have seen in last 1.5 years. Demand definitely played the spoil sport. I hope and expect the demand post, maybe that's a trigger which I'm still hoping the GST reduction should be the trigger for the demand to spurt up.
You're extremely happy with this GST rationalization, Mr. Singhvi. We thank you for joining in and filling us in with your views on the show. Jashandeep, coming across to you before we take a mandatory break. The street is divided. Should you look at the big boys, the ones that are ruling, Ultratech, Ambuja, Shree, Dalmia, should you look at them? Or should you look at the smaller ones, which trade at a sharp discount in comparison to replacement cost, and they could possibly be takeover candidates? Where are you placed out there?
So I'll answer this in a different way. How basically that's the question is whether the consolidation will increase or not.
Yeah, Mr. Singhvi believes it's going to go on.
Yes, I believe the consolidation in any industry, especially where the utilization are low, will happen. But what we have to think about how the pace will be from here on.
Yeah.
I think the pace will temper from here. The pace will decline from here. It will not be as aggressive as we have seen in the last 2 years. So just to give you an instance, from FY14 to 17, around 12% or 51 million ton of the cement capacity exchange hand. Since the entry of Adani from FY24 to 25, already 63 million ton have exchange hand. So that's roughly 10% of the industry. I believe from here on the consolidation pace will go down, because if we look at two metrics, right? Firstly, the we look at share of top 6 and top 3 players across the regions. So if in the case of top 3 player share, it's already above 50% in all the region except South and East.
Yes.
And in case of top 6 players, it's already above 80%, way above 80% in all the regions except South. So I believe any more inorganic, significant inorganic expansion might result in Competition Commission, coming in and checking in. Plus, there are not many, stressed assets also that companies will be looking to buy at a discount. So I believe the consolidation will happen. Companies like Ambuja, still have to expand their capacity by 20 million ton, and inorganic is a easy way to do that. Sorry, not easy, but it's a quick way to do that.
Yeah.
But the pace will not be as we have seen in FY24 and 25.
So consolidation will slow down. It could happen, but it will slow down. So you rather stick to the big boys.
Yes. I'll stick to the large caps.
Got it. We got some more questions for you, Jashandeep. For the time being, we'll take a short break. You come back. We've got a lot of queries as well because you'll have written in. Stay with us. Jashandeep will answer all of them. Welcome back. You're tuned into Finding Alpha. You're on CNBC TV18, and we are in conversation with Jashandeep Singh of Chadda of Nomura, who joins us. Jashandeep, two numbers I want to get out of the way. One is on volume growth. You know, Mrs. Singhvi is sounding quite optimistic that volumes are going to recover in the second half of the year. The first half actually has been soft. What volume growth are you factoring in for the industry? And EBITDA per ton is expected to improve. How much it improves for the industry in 26 versus 25?
Yes. So talking about volume, I think I am also very positive. The fact is that around 55-58% of the total volumes come in the second half. So there's a majority chunk of volumes which is still yet to come. I believe this year, FY26, the industry should grow between 7 to 8% YOY. And on the EBITDA per ton, I believe last year the EBITDA per ton was a little suppressed because there was, pricing were very weak. Prices have recovered, strongly. Even in a monsoon quarter, we are seeing pricing being resilient. So I believe around 200 to 250 rupees per ton for the large players, it is quite possible. On an industry-wide, I think 100 to 150 rupees per ton is quite possible.
Got it. Okay, Jashandeep, we have a couple of viewers who are listening to what you have to say, and they're looking at the charts and they're saying you have buys on a couple of stocks. So Rohan Sharma is writing to us from New Delhi. He's saying between Ultratech and Shree, he wants to know which is the better placed company according to you. You have a buy rating on both of them. What's your take?
So yeah, so to answer between Ultratech, so right now both the companies are, doing something which the other company used to do earlier. So Shree Cement is on a path of improving their realization. Ultratech is already a category A player who's, on a path of cost reduction. I'll say that, very close, but I'll go with Ultratech because I think in a commodity business, cost reduction will provide you, sustainable EBITDA per ton reduction. Shree Cement is on a path. The absolute, the total volumes to be upgraded will take some time. So I believe Ultratech will see, better delta in EBITDA per ton than
Got it. All right. So Ultratech over Shree, it's buy rating on both, but preference, Ultratech comes first. Ravi Kumar as well has written to us from Chennai. He has around 500 shares of ACC at 2,300 rupees. Wants to know what's the outlook on this one. Valuation comfort, large player, but still that's been a big underperformer. What's your view?
So we have a structurally negative view on ACC. We believe there are a lot of structural challenges in the company. I'll not, the prices are at 2,300 he has booked, right?
Yeah.
So what I'll suggest is to wait for, some price increase and then shift. If he wants to play in the Adani group only, then shift to Ambuja or, switch to some of the large cap players.
Ambuja over ACC, and I think that's what the street as well. And that's why it's been getting those multiples. So we got that. But there's another interesting, query that's come in from Riaz Khan, who's written to us from Hyderabad. He holds around 225 shares of Deccan Cement at 628 rupees. Wants to know the outlook on the stock. I have my ear to the ground. And I try to find out who's visiting Deccan, who's interested in, what kind of assets they have, what is the capacity expansion. What do you believe? What should he do? He's nearly doubled his money, but that bride is still out there. The groom has not yet been found.
So, Nigel, I think you are at more liberty to talk about Deccan Cement. We don't cover that stuff, so I won't be able to give my opinion on that.
But what's your view on South India? In South India, do you all like anything? Because these valuations give you comfort. The problem is capacity utilization level is so low. Now there is hope that, utilization will improve and pricing has improved after being a big underperformer for the last 12 months.
So what I'll suggest, to the viewer is that if they want to play in South India, I think Aramco Cement and Ultratech or even, Ambuja might be a better because they will see sustainable increase in their EBITDA per ton because their volumes will expand more than, I think Ultratech and Ambuja's volume will expand more than the industry. And Aramco, once the pricing come back, is closest to the highest price market of Kerala and South Tamil Nadu. So there's one advantage over there as well. So either, play with, if they want to do a mid-cap player, Aramco, otherwise Ultratech and Ambuja.
Okay, all right. Final question, Jashandeep, before we let you go. What is the risk to this entire thesis? That cement, people are quite positive actually because Q1 for the market on the whole has been soft. But cement has been showing that, maybe the second half is going to be much better. It has a low base effect as well. So what do you think is the risk to this thesis?
So for any commodity industry, right, these stocks react to how the pricing is going, but the structural risk is always the demand.
Yes.
Right. So I think if now we are also seeing the government stance is changing from more of, more towards consumption, right? So if the government demands, declines,
yeah,
I believe then we might, all the price hikes might not be able to sustain. So the failure in demand is the biggest risk than any pricing else.
Okay, all right. Well, Jashandeep, it's been a pleasure having you on the show. Thanks a lot for joining in, telling us about the various aspects, not just pricing, but within pricing, there are various categories, the way you're looking at the industry with regard to the cost focus as well. And GST could in all probability at least help, on the volume parameter, hopefully. But more importantly, it will help in premium use of cement. Thanks a lot for joining in. Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching.
Welcome to Standard Chartered presents CNBC-TV18 Leadership Collective, where we bring together the minds rewriting what leadership looks like in a changing India. Thank you for joining us this evening. We open the evening with a keynote from someone who has witnessed India's transformation across finance, education, policy, and private capital. Please welcome TV Mohandas Pai, Chairman 314 Capital, co-founder and Chairman Iron Capital.
The big challenge for India today is to grow the economy from 4 trillion to 10 trillion. Can we do it? The answer is an yes, and let me tell you why. 1991, our GDP in rupees was around 5,32,000 crores. It's grown to 331 lakh crores today in 31st of March 2025. That is 12.2% a year for 34 years in rupee terms. In dollar terms, it grew from $275 billion to $3.94 trillion. That's 8.1% a year in dollar terms, CAGR for 34 years. And from here, to grow to $10 trillion, we need to grow the GDP from around 331 lakh crores to around 9 lakh crores, possibly by 34-35. That's about 11% CAGR in rupee terms. Of course, the big zinger is the rupee dollar rate. The rupee dollar rate, if you assume at 85 and assume it stabilizes at 90, we should be able to do that. Out of 14%, 7% could be the nominal rate, 4% could be the inflation, with the rupee possibly depreciating to 90 and stabilizing to 90. I remember when I joined Infosys in 1994, the rupee was 27 to a dollar, went to 33, now it's come to 85, 86. So even though our GDP has grown, it doesn't reflect in dollar terms, primarily because the rupee depreciation of 3.5–4% a year for the last 34 years. But in rupee terms, it is very clear. And the rupee terms is reflected in the PPP GDP. We are $17.5, $17.6 trillion in PPP. Across all areas of industry, traditional industry, we are number 2 or 3 after China, and we are going to be number 2 after 3 of China, because China today is about $20 trillion nominal and about $36 trillion in PPP. So can we be a China? No. There's room for only one China in the world, which is 30% of the world's manufacturing capacity, the largest exporter, possibly the largest importer, the largest holder of foreign currency reserves. But we can grow the economy in our own way, because we have to grow at 11% and we have to make sure it reflects. So I want to end by saying, we are on a great wicket. We are going to build this country to 10 trillion with the 85–90% probability by 2035. We are investing adequately. We are midst of the digital revolution. We have young entrepreneurs coming up. Country is becoming efficient, and entrepreneurship is going up, and corporate profitability is at an all-time high, and that's going to continue. We have a great future. Go for it, and we'll all do well. Thank you very much.
At a time when speed, trust, and integration define the future of finance, our next conversation brings us to a space where institutional depth meets the startup drive to build fast and at scale.
To take off from where we are today in Bengaluru, the startup ecosystem, the startup ambition bank financing has not been part of the picture, part of the story so far. Do you see a greater link now between banks as well as the startup ecosystem?
So banks have been closely associated with the startup ecosystem for a very long time. If I can say, in the first phase, providing them the banking rails, providing some of the tech startups, the banking rails was the first phase that we saw. During that phase, we also learned about how this ecosystem is growing and what the startups require. Each one had a slightly different requirement. So for example, a very fast growing tech startup would require a B2B platform, or would require someone who can do the reconciliation for them. So that's where I think the bank stepped in, and the bank could do a good job of that. In the next phase, there was a